and walk away. No 8 hours of charts, no 50 indicators. That is the 10 a.m. game. And in the next 5 minutes, I'm going to show you exactly how it works. Quick thing, PDF for this episode is inside the description and in the Discord. All the slides, the frameworks, free. No time to waste. Let's go. This is episode 1 and we are in the technical side of the trader pyramid, layer 1. So first, why the 10 a.m. game specifically? New York opens at 9:30 a.m. EST, New York time. And what happens between 9:30 and 10 a.m. is basically the market hunting liquidity, running stops, fake moves, creating conditions for the real move. In this time between 9:30 and 10, we build our bias. Most days there's no clear entries just after the open. We wait. And by 10 a.m., the manipulation is done, the direction is clear, and then is when we strike. And most traders know the Asian, London, and New York kill zone. But this window is also a kill zone. The 10 a.m. kill zone. Every day, same time on NASDAQ, that's it. So here's the actual model, step by step. Step 1, you need a bias before 10 a.m. You need to know if you're going to look for longs or shorts before the New York Open starts. I cover exactly how to build a daily bias in later episodes, but for now, look at this chart. There is a 4-hour bullish fair value gap. It's a 4-hour chart. The recommended time frame to build your bias is on the 1 and the 4 hour. And we have a clear bias that we first trade into the 4-hour fair value gap and then go to an old high. Why? We are bullish. If you have that bullish bias, then we want the next 4-hour candle to be a bullish one because we want price to trade higher. Then on the lower time frame, this 4-hour candle is going to make this exact structure. It accumulates, then it manipulates into a key level, and then it breaks structure, changes character, and distributes towards the target. So we wait for the accumulation and manipulation to happen just after the open between 9:30 and 10, and then we strike, catching the distribution of the move. So where we wait for at the open, the AMD, the accumulation, manipulation, distribution, the first step you wait for is displacement, a strong aggressive move in your bias direction, in this case higher. And that displacement, this energetic move, creates fair value gaps. This example is a overlapping 1, 5, and 15-minute fair value gap. It's an imbalance in price that the market will want to come back and fill before continuing the move. Entry in the fair value gap. You wait for price to retrace back into the fair value gap, and that retracement is your entry. And you're not chasing the move. You're waiting for price to come to you. And step 4 for the stop loss goes below the fair value gap or below an old low. And why there? Because if price comes all the way through that area, the whole setup is invalid. So do not move your stop here. If it goes there, you're just wrong on the idea. And the target is the next liquidity level, old highs. Previous high, previous low, whatever drawn liquidity is sitting above or below price. That's where you're aiming. So bias, displacement, fair value gap entry, clean stop loss, clear targets, and then price will move in your direction. Here we're looking at NASDAQ at the 1-hour chart. We just had a liquidity sweep and we traded lower, leaving 1-hour bearish fair value gaps. And this is at the New York Open. We have 1-hour bearish fair value gaps and we have a clear bullish fair value gap here and an order block sitting right here. So these are targets, these are targets. Price can do two things. It can manipulate up and then go lower, or first go lower and then go up. Here we're looking at NASDAQ at the New York Open. And what do you see? There's an accumulation. Now manipulate into the 1-hour bearish fair value gap. So now the targets are going to be the 1-hour bullish fair value gap and the bullish order block. Is there displacement? Yeah, there is. It's a one-sided move with a fair value gap. So already the entry could be here. Let's say you miss that move. If there's going to be another entry, there's another fair value gap. So here is another entry. Price comes back into that area, and there is where I want to take the trade. Target that 1-hour bullish fair value gap. Stop can be above this high for almost a 1 to 3. And then price runs to the target. And it even runs all the way towards the order block target. So the only thing I want you to take away from this is the 10 a.m. game only works if you have your bias before the New York Open starts. Bias first, always. Without that, you're just gambling on a random fair value gap. Later in this mentorship, we cover exactly how to build a daily bias in under 5 minutes. So here we build the first layer of the trader pyramid. If this video helped, like it, share it with a trading friend, and subscribe with the notification bell on so you don't miss any of the 35 episodes. PDF for this episode is inside the description. Setup rules, checklist, all for free. And the Discord link is also in the description, where I share my daily outlooks and you see more free education. Thank you for watching, and I see you in the next episode. Most traders think a market structure shift is just price breaking a high or a low. It is not. And that one mistake is why they get stopped out out over and over on setup that look perfect. In the next 5 minutes, I'm going to show you exactly how a market structure shift looks like and the one filter that makes it actually work. And quick thing, PDF for this episode is inside the description and inside the Discord. All the slides, frameworks, all free. This is episode 2 of the trader pyramid. We are in phase 1. No time to waste. Let's go. So here's the problem. Most traders just see a high and a low. And the second it breaks it, they think, yes, that's the structure shift and let's go. And they get stopped out immediately. And what you actually need are the following steps. And the first step is the liquidity sweep. Price runs to a key level, and a key level can be a session high or low, like Asia, London, or New York, or a daily or weekly high and low. But there needs to be some form of stops getting hunted first. That is the trigger. And watch closely what happens after. Because the single best filter you can use for a market structure shift is displacement. An aggressive move in the opposite direction. If you first go lower, we sweep sell side. Boom, we need energetic moves upwards, leaving imbalances, fair value gaps. And there's inversion fair value gap here. There's a fair value gap here. But there is displacement. But how can you identify the actual shift in structure? That is when the last swing high that made the low, that made the move for the low, is broken with this green candle. That confirms the shift. If you want to trade on that, just like you've seen in episode 1 with the 10 a.m. game, your entry is going to be in a fair value gap. There's also an inversion fair value gap where you can take your entry, but let's just stick with a fair value gap. Your stop loss below the fair value gap or below a low. And if price closes through it right here, then your whole trade idea is invalid. So don't move your stops. Be okay with taking the loss if it hits that area. And your target needs to be the next liquidity level, in this case previous high of the London session. Just set your trade and let it run. So there's a liquidity sweep, there's displacement, the last swing high that made the low is broken right here. That move left a fair value gap, entry there, stop below the low, target a high, and there you have your trade. And here we're looking at NASDAQ at the 15-minute chart during the New York Open. And there's a 15-minute bullish fair value gap sitting down here. And now let's drop from the 50-minute time frame to the 1 minute. Here's the last swing high that made the low. There is a inversion fair value gap and a fair value gap, but we're still waiting for the structure shift. This is already looking very good. Another fair value gap, and we are about to close above the last swing high. We tap into it, and here if you close, there is where we can get in. Where to? Next obvious target is this high. Stop below the fair value gap, and let's go. We left behind equal highs after a very clean push, and then in the PM session we pushed to take profit by just waiting for the market structure shift. So the one thing I want you to take away from this, and it's very important, a market structure shift without displacement is fake. Don't trust a market structure shift without displacement. The displacement is everything, that energetic move. That tells you big money is involved. That's what makes the fair value gap in it worth trading. No displacement, no trade. Simple. And now we build the second part of the technicals layer of the trader pyramid. PDF for this episode is inside the description. The checklist, all the rules for free. Discord link is also in the description with daily outlooks, live setups, and more free education. And if this video helped, like it, share it with a trading friend, and subscribe with the notification bell on so you don't miss any of the 35 episodes. Thank you for watching, and I see you in the next episode.
Every morning before I take a single trade, I already know the direction. And not because I have some crystal ball, I have a framework that tells me before the market even opens whether I'm going to look for longs or shorts. And in the next 5 minutes, I'm going to show you exactly how to build that daily bias. PDF is in the description and inside the Discord. All the slides, the frameworks, all for free. We're now in episode 3 inside the technicals layer of the trader pyramid. No time to waste, let's go. So in episode 1, I told you bias first, always. Because without it, you're just gambling on a random fair value gap for random structures. Because here's the thing that most traders do. They open trading view, look at the 5-minute time frame, and they try to figure out what's happening. And then wonder why they are confused all the time. What you need to do is start at the daily time frame and work yourself down. On a daily, to the 4 hour, to the 1 hour, all the way to the 5 and 1 minute. Top down analysis, always. Never start the lower time frame like the 5 minute, because with bias, you know the direction before the market opens. And you can just only take setups in the direction of your bias. And the cool part about this, because you do that, you filter out 50% of your bad trades. So the bias is the first line of defense. So here's the framework I use every single day, and it's the AMD framework. It's the accumulation, manipulation, distribution. And what that means for the futures trading around the New York Open, before I'm expecting price to have some form of accumulation, some ranging price action, like you see right here. Liquidity builds on both sides, stops are below and above, and the market is setting a trap. And the trap is going to be activated at the New York Open, somewhere between 9:30 and 10 a.m., the first minutes after the open. Then you will see the manipulation, and the manipulation is nothing more than a fake move in the opposite direction. So if you want to go long on idea, then the manipulation is going to be other direction, it's going to be short. And the manipulation just hunts stops. It's a fake move and it tricks most traders into the wrong direction. And then the distribution of the move is where we want to get in. It's the real move. After the sweep, price aggressively moves into the opposite direction. There you see the displacement, the market structure shift, the fair value gaps, and the order blocks creating. And there is where your money is made.
So here's exactly how I build my bias every single day in 4 steps. Step 1 is the daily. Where is price now? Well, we are very bullish and we're respecting bullish fair value gaps, bullish arrays. So I'm expecting price to go up. So from the daily, my bias is bullish. Then I go to the 4-hour time frame and I see exactly the same. We are bullish. So daily and 4 hours bullish. Hopefully lower time frame, we can find a bullish AMD. Same on the 1 hour, bullish with a gap right here and also a bigger fair value gap sitting there. So here is where I want price to accumulate, manipulate in, and then just continue the move. And then I drop to the lower time frame. This is the 5-minute time frame to see, do we have an AMD? So there's an accumulation here during Asia. And now we are in the London session. We are inside that massive 1 hour value gap. And then see if we have the manipulation. Yes, we do right here. And now we start distribution. And this happens before the New York Open. So now fast forward to the New York Open. I'm already expecting that the accumulation and manipulation already happened. So now we're just going to distribute higher. Where to? Well, at least towards all these equal highs. So here we are at 9:30 a.m. EST at the New York Open. We have also a small manipulation here. We don't take out liquidity, but there is an SMT here on NASDAQ during New York Open with a 5-minute fair value gap. And you can do the same on the 1 minute. You can take your entry in your value gap, stop below the fair value gap, 4-1 to 2, where we had the bias from the top down, daily, 4 hour, 1 hour, everything was bullish. And now we pay a bullish AMD and price goes to the target. So the checklist is very simple. Daily chart, 4-hour structure, pre-open liquidity, is there a sweep, and take the trade with the structure shift and the fair value gap entry. Just like you've seen at the 10 a.m. game in episode 1, now you know how that bias is created. And there we built another technical layer, daily bias in the trader pyramid. If this video helped, like it, share it with a trading friend. Make sure you subscribe so you don't miss out on any of the 35 episodes. PDF is inside the description and inside the Discord. Thank you for watching, and I'll see you in the next one. In this video, I'm going to show you everything you need to know about liquidity. Where is the draw on liquidity? What are the best liquidity pools to trade? When is a liquidity sweep valid? And how to spot high and low resistance liquidity. This is episode 6 inside the technicals layer of the trader pyramid. No time to waste. Let's go. If you want to know the draw on liquidity, price does only do 2 things. It trades back to old high and lows, and it trades to fair value gaps and imbalances. The old highs and lows we call external range liquidity, ERL. And it's a fancy term for just old swing highs and lows. And why there? Because there's buy stops and sell stops at those highs and lows. And it likes to grab liquidity there. Internal range liquidity are fair value gaps, imbalances, IRL. Price likes to rebalance back to fair value gaps before continuing the move. And next to fair value gaps, you also have volume imbalances and gaps. They all do the same. Price just comes back there before continuing the up move. So price can trade from internal range liquidity to external range liquidity. We call this from internal to external, or it can rebalance from external range liquidity, sweeping and high, and then trade back into internal range liquidity from external to internal. The internal to external is always better. Why? You are trading with the trend. From external to internal, you trade counter trend. You basically trade the retracement before the continuation upwards. Both is good, but if you want the highest win rate, focus on internal to external. If you know external range liquidity and internal range liquidity, the next question is, what highs and lows do you actually target? Because if you go through all the time frames, there are a lot of highs and lows. Which one do you mark out? And the answer to that is weekly, daily, and session highs and lows. So before you take the trade, the most recent weekly high and low should be marked out. The most recent daily high and low should be marked out. And you should mark out the session highs and lows. Where's Asia high and low? Where's London high and low? Especially for the New York Open, my best trades are just back towards Asia or London high or low. That's it. And what you can do intraday if you want to trade the New York Open is that during the New York Open window, you wait for the Judas swing, the AMD, the power of 3, where during the open, you have an accumulation, and a manipulation, and then we start distributing higher, all based on a higher time frame, fair value gap, internal range liquidity, back to old highs, external range liquidity. But now you might wonder, Dion, but why is this not a liquidity sweep, right? Because here this takes out liquidity. Why shouldn't I trade this? Why is this the manipulation and a valid liquidity sweep, and why not this one? First of all, of course, the higher time frame key level. But let's dive deeper into this. Because to understand what makes a higher low stronger or weaker, you need to know what intermediate term highs and lows are. An intermediate term low is a low with a swing low to the left and a swing low to the right. These blue buttons are short-term lows, and this is an intermediate term low. Same here, 2 short-term lows in between intermediate term low. Those intermediate term lows are the highest probability lows. If you're just gonna randomly mark out swing highs, you're maybe gonna mark out short-term highs and lows, which were way less likely to hold than intermediate term highs and lows. And together with the intermediate term lows, the liquidity sweep should happen inside a kill zone, ideally for futures in the New York Open, 9:30 a.m. EST. Because if you have a liquidity sweep during the New York Open, you know that the big money is involved and a big move is going to come. And the third pillar that makes it strong is the SMT divergence. If you have 2 correlated pairs, in our example, NASDAQ and ES, same with gold and silver, euro dollar and GBP US dollar, they must follow each other. So if NASDAQ goes higher, ES should go high. When NASDAQ goes lower, ES should go lower. But what if they don't and they change their correlation? So in this example, NASDAQ makes a higher low, ES makes a lower low. They stop following each other. And a crack in correlation indicates a potential reversal. So in this example, we have NASDAQ that does not sweep liquidity, but it does the market structure shift, the fair value gap, the order block to trade higher. And I still took that trade for one simple reason, because we have an SMT. ES made the liquidity sweep. It made the lower low and then did the same structure. And the goal is, when you trade SMTs like this, is to long the strongest pair. And the strongest pair is the one that did not even go lower here. It was so strong that it refused to make a lower low. Long that one. Vice versa for short. If NASDAQ does this and ES does this, ES makes a lower high, NASDAQ makes a higher high. That means ES was so weak that it didn't even make a higher high. That means ES is the weakest, short ES. Long the strongest, short the weakest. So now you know how to find the drawn liquidity with internal to external. You know the most obvious liquidity pools, weekly, daily, session with the AMD. And you know what makes a higher low strong, intermediate term highs and lows in a kill zone with SMTs. Then we need to talk about how clean we can make the moves. How fast can we get our trade towards the target? And for that, we need high and low resistance liquidity. And the name says it already. Low resistance liquidity is something we need to target because there's low resistance. Price just goes there. And this is building on top of our previous example. We have the daily weekly high, we have the session high, and we have the AMD. But in that same schematic, we have failure swings. Those are highs that do not take out any other highs. Failure swings are low resistance liquidity. So what you will see if those are left behind, that if we make that reversal, like we do right here with the fair value gap, the structure shift, look at how clean with big candles we go to the targets. It has to do with there's low resistance liquidity created. So these highs look like they're gonna hold. No, they don't. So if you want to have a higher win rate, do not put your stop loss close to low resistance high and lows, because you want your position to be defended by high resistance liquidity. And there is where there was a liquidity sweep. You know already what makes a liquidity sweep high probability. The SMT in a kill zone with intermediate term highs and lows. So the low that happened here inside a key level during the kill zone is a high probability liquidity sweep, and this low is protected liquidity sweep in a key level. And your stop loss should go below a protected low. That's your defense. So in this example, we are defended by high resistance liquidity. We're gonna target low resistance liquidity. We make a structure shift with a fair value gap. There's order blocks, there's breakers. We go from internal to external range liquidity to session highs and daily and weekly highs. And there's where all the liquidity concepts come together. And now you build the liquidity layer inside the technicals layer of the trader pyramid. If this video helped you better understand liquidity, make sure you like it and share it with a trading friend. And of course, subscribe and hit the notification bell to not miss out of any of the 35 episodes inside this free futures mentorship. All the slides and the framework from this video are inside the description as a PDF and inside my Discord. Thank you for watching, and I'll see you in the next one. Most traders mark out order blocks on every single down close candles they see. But in the next 5 minutes, I'm going to show you the difference between a real order block and a random candle, how to mark out an order block correctly in simple steps, and the system for grading every single order block so you only take high probability setups. PDF for this episode is inside the description and in the Discord. We are in episode 4 of the technicals layer of the trader pyramid. No time to waste. Let's go. So quickly, what is an order block? Order block is smart money's footprint, the big money, where institutions accumulate or distribute quietly before moving the price. You just see big bodies being created before real moves. And price always likes to come back and revisit an order block before continuing the move. So in a bullish order block, it's the last down close candles or series of down close candles that swept liquidity before price reverses. In this case, we have this down close candle, mark out the wick. You can also mark out the body. It does not really matter. I like to mark out the wick. You also see an overlapping fair value gap before price goes to the target. A bearish order block is the last series of up close candles before the move lower. So you see here up close candles. You can mark out the wick or the body, and you see the price taps into it before trading lower. And bonus points here is if the order block is formed at a key level. So this is, for example, a higher time frame fair value gap or an old higher time frame high. That's when it becomes higher probability. So the more confluences are available, the better it becomes. And that brings us to the grading system. We have 4 different levels. We have A+, we have B, C, and D. And the goal is, of course, to just trade as many A+ order blocks as possible. But what are A+ order blocks? A+ order blocks is that there's not only an order block, but there are more confluences available, like a liquidity sweep, like a market structure shift, inside a kill zone, the New York Open, and an overlapping fair value gap. So in the example here, you see that we have an old low in this example. There's a liquidity point before we start trading higher. And here we see that there's a liquidity sweep. Then there's an order block created. The order block is created when we close over it. So this up close candle creates the order block. There's a market structure shift, the last swing high that made these low. This is during New York Open. And there's also an overlapping fair value gap inside the order block that makes it a A+ order block. There's even another one here because we have a down close candle that trades into liquidity, a fair value gap, overlapping with a fair value gap. Inside the kill zone is also an A+ order block. And you see how price just trades into that. There's another one here until we reach the target up here. There's also B order blocks. And those you can trade, but be more selective. And that means when there is 2 or 3 of the 4 conditions present, it is still a valid trade, but just less nice. So in this example, there's no market structure shift, but still price delivers to the target. So you can keep your risk the same, but be more patient. Let the setup come to you. So we have the last down close candle that swept liquidity. There's a liquidity sweep. There's an order block created. There's an overlapping fair value gap during the New York Open. You see the price trades to the targets. And what are the targets? Those are these highs. Failure swings, that is a B quality order block because there's no market structure shift. The market structure shift is here, the last swing high that made the low. If you wanted to wait for that, you could only take your trade right here. Then there's C order blocks. Here you need to be careful. This is danger territory. Only one condition is present. It's becoming a low probability setup. So here there's a liquidity sweep. There's the last down close candle before that move. So here's the order block and we tap it. We trade higher. But because there is not more present, this is out of kill zone. There's no market structure shift because this is the last swing high. We don't close over it until we are right here. And then we already start trading lower. So when the order block feels random, it probably is. And there's the D setup, just a random down close candle in a random structure, no liquidity sweep, no structure shifts, no kill zone over value gap. And yeah, then you just deserve to lose the trade. And skipping the C and D order blocks is a skill by itself. So here you have all four, the A, the B, the C, and the D. And the rule here is only trade A and B. Everything else is just patience. Wait for those to be created. And now you have another part of the technicals layers of the trader pyramid. And if this video helped you, make sure you like and hit the subscribe button with the notification bell on to not miss any of the 35 episodes of this futures mentorship completely for free. PDF of this is inside the description and inside the Discord. Thanks for watching, and I see you in the next one. You want to start trading futures prop firms, but you have no idea where to start, which prop firm to choose. You are confused with all the different rules, and you have no idea how to actually execute inside TradingView with mini and micro contracts. In this video, we're going to discuss all of these pillars step by step. This is episode 15 of the technicals part in the trader pyramid. No time to waste. Let's go. So why prop firms? Prop firms have a higher upside. That means for only a fraction of the price, you can get 10, 50K, 100K in capital without actually risking that amount of money. The lower downside is that you only pay, let's say, between $50 and $100 per challenge to get access to that capital. If you're not profitable yet, you should use prop firms and not demo trading, because prop firms, you have that emotional game that is present because there's something on the line. You can win something with a prop firm challenge. That's the capital you can trade with. But at the same time, if you make mistakes, which you will probably do, then you don't lose 10, 20 or 100K. You only lose the challenge fee you put in. And if you talk about futures prop firms, there are basically 7 big ones where I would recommend you choose from. You have Lucid, Alpha, TradeFi, TopStep, Take Profit, Apex, and Fund the Next Futures. There are more, and maybe by the time you're watching these videos, there will be new ones, or these ones will not be there anymore. But it's all about why are these prop firms the biggest ones, and what account sizes, what rules, what types of accounts should you actually look at. And there's where I have 5 things you should look at that decides if you should choose this specific account. First one is the drawdown type. And the drawdown type is the end of day versus the intraday trailing drawdown. End of day drawdown means, let's say you have a max drawdown of $2,000. It means you start an account with 50K, and when it's 48K, your account is breached. Let's say you need to trade the account to 53K, and then you pass the challenge. You start here, and what happens with an end of day drawdown? Let's say on a day you trade your account to 51K, the trailing drawdown will move up with you. So from 48K, because you made 1K profit, also that 48K will go up with 1K. So then now your max drawdown is not going to be a balance of 48K, but 49K. It trails up in the end of the day. That's basically what end of day drawdown is. Intraday drawdown is the most dangerous one, and I would not recommend you using this, because with end of day, at the end of the day, it is just what is your balance at the end of the day? Well, let's say it's 51. Cool, that's 1K profit. So your drawdown will move with you. Intraday drawdown is very tricky because it's over your actual paper profit. So let's say you take a trade, you start at 50K, and that trade goes to 52K, which is amazing, great trade, but you don't take it off yet because you're maybe a little greedy. You just want to go to 53 immediately. This is all paper profits. There's no profit taken yet. It's all just floating in the air. With intraday trading drawdown, because your balance at some point reached 52K, regardless if you took profit, intraday trading drawdown will move with you already. So without you taking profit, because your balance at some point was at 52, this is +2, your intraday trading drawdown will now be at 50K, back to the starting balance. So in a hypothetical scenario, you go to 52K, but then price just comes back to your entry, you lose the account because the intraday trading drawdown already went back to 50K, which is very tricky. I think it's a criminal rule to use. So that's why I always use end of day trailing drawdown instead of intraday trading drawdown. The second rule you should be aware of is the consistency rule. Some prop firms call this the best day rule. It basically means that your best trading day cannot be more than a certain percentage of the total profits. And it sounds weird, but let's run the numbers. Let's say you have a profit target of $3,000 and there is a consistency rule of 40%. That means your best trading day, the best day rule, your consistency rule, cannot be more than 40% of the total profit. 40% of 3K is $1,200. So that means your best day cannot be more than $1,200. So that means trade 1 needs to be $1,200. Trade 3 needs to be $1,200. Well, then you are at 24. And then you only need for trade 3, $600 to get to the target, and then you pass the account. So that means you need at least more than 3 trading days to pass your account with a consistency rule of 40%. 50%, same numbers. 50% of 3K is $1,500, so your best day cannot be more than $1,500 to stay in that consistency rule. So that means trade 1 is $1,500, trade 2 is 1500, and then you are already at the target. So then consistency rule of 50%, only you need more than 2 trading days. So if you want to get funded faster, choose an account with 50% consistency rule. I see people buying accounts with 40% consistency rule, sometimes even 30% consistency rule. In my opinion, that's just dumb because you just made your life so much harder. So choose end of day, choose 50%. And the third rule you should be aware of is the buffer or the safety net. And that is only when you are funded. It means you need to trade to a certain amount if you are funded to get the payout. And it's a hidden rule. Because what you might think is, let's say you have a 50K funded account and then you trade it to 52, then you can just take out 2K and run for the hills and get your payout. It's unfortunately not how it works. What most prop firms do is that they let you trade to a certain threshold, a certain buffer before you can be eligible for a payout. And that can be a buffer of a certain amount. That can be a certain amount of profitable trading days. So if you choose your account, make sure that the buffer and safety net rule is not super unfair to you. And of course, you need to have some buffer because if you trade to 52K, for example, and you have your end of day trading drawdown, remember, then that means your max drawdown is already at 50K. It's already trilled up. Then if you take out all the money, all the 2K, your account is blown by default. So it doesn't make sense also for a prop firm that you get funded, get a payout, or because you get a payout, automatically blow your account. Doesn't make sense. So the buffer rule is there for a reason, but make sure the buffer rule is not too strict, not too tight. Because at the end of the day, you should care about the money in the bank, not about the amount of funding you have. Fourth thing is payout caps and ladders. Most prop firms have just a 100% or 90% split. Don't worry about payout caps and ladder and all that stuff too much, because most likely you're now in a phase where you just need funding. So don't worry about that a prop firm only can get 5 payouts on one account. Please just go first to those 5 payouts. Build proof that you actually can extract money out of the market before caring about payout caps, ladders. And it also brings us to the fifth one, and that is forced live moves and other weird stuff that is happening. So recently in the recording, it's summer 2026. What prop firms now do for the highly profitable traders who get like 30, 40K payouts, they're like, yeah, we don't want that too much because it's hurting our business model. So we get you to a live account. We're removing you from the sim account. We're just putting you live. And I see on social media, everyone, oh no, a scam prop firm, blah, blah, blah. But 99% of traders will never be moved to live. That is only for like the 0.001% traders who probably have like 50K or more payouts with a prop firm. And I believe that this is actually a good thing. Why? Usually when you had big payouts on a prop firm, they will just ban you and say, oh, you did this rule bad, so we don't want you on the platform anymore. They changed that same approach, but then to a forced live move. So instead of banning you to be more profitable, they just put you on like a random live account with not super nice rules, but you can still trade with their capital. But for these two, please just get consistent payouts, just get max allocation on all the prop firms before worrying about stuff that is so far ahead in your journey. For now, just focus on end of day trading drawdown, consistency rule. Be aware of the buffer and safety net of a funded account. Some prop firms also have an activation fee. That means if you are funded, there's an activation fee, but there's a big shift currently that prop firms are removing the activation fees. So you just get your account, get funded, and get a payout for the same price. And if you're not sure which prop firm to choose, I made a 16-page PDF where I go over all the biggest prop firms, why you should choose them, why you should not choose them, and made a tier list of the best ones to choose right now. Okay, with all the boring stuff out of the way, now let's go to the most exciting part, and that's actually getting a prop firm challenge, setting it up so you can actually start executing in TradingView. So I will not only share with you how to get a prop firm challenge, but also how to connect it with TradingView and actually take a live trade on it, so you also know how to calculate the correct contract size using, for example, mini contracts or micro contracts. So make sure you stick around until the end so you're not confused about any step of the way. And I will even share my strategy at the end to get funded within one trading. For the example, we're going over Lucid Trader funding, and what I'm about to show you, you can apply to all the different prop firms. You can see their different accounts. So you have Lucid Pro, Lucid Flex, Lucid Direct. If you're not sure which one to choose, because Pro, Flex, and Direct, for example, have different rules, different approaches, every single prop firm has like an FAQ page or knowledge base, whatever they want to call it, where you can see for everything, for example, Lucid Flex, you can see, okay, cool. For the evaluation, for the challenge account, what are the rules? So you see the max loss, you see the consistency rules, every rule you need to start taking the trade. Same for the funded account. If you are funded, is there a max loss? Yes, there is. So we need, for example, to look at payouts. There we see, cool, we need to have 5 trading days. And also there's a payout cap. All the platforms work the same. So you press get started, sign up for an account. And what you then will do is you just create your account, log in, and there you have your login credentials. When you get your account, make sure you choose Tradeovate. Then now go to tradeovate.com to log in on your account. So when you go to tradeovate.com and log in with your account, you will see this very ugly chart. I have no clue how to navigate this. We're going to do Trading View because that looks very clean. We go to settings, then to add-on, and please check if Trading View under add-on is activated. Most platforms have this already. With Tradeovate Pro, please check this. If not, there will be like a blue activate button under Trading View, because if this is not activated, you will get an error while logging into your Trading View. So make sure it's active. And with that, let's now drop to Trading View to log in and actually start taking trades. Cool. Now, so we're looking at a very sexy daily chart here on NASDAQ. No, it's consolidating, but let's go to the job at hand. And that is logging in on the Tradeovate on our platform account in Trading View. There are sell and buy buttons here. If there's not appearing, right click here and make sure show buy and sell buttons are on. You can click one, and then it will show all the different brokers you can log in via Trading View. Well, because we do Tradeovate, we need to do Tradeovate. You can even favorite them, so they always be on the top. They do Tradeovate. You press connect, then you log in, your username and your password. Then it will log in. Then you are logged in on the broker. In this case, Tradeovate. And now let's take an actual trade. The time of recording here is London session on NASDAQ, so I would not like to take a trade, but for example sakes, let's just take a trade. So let's say we want to go long to this high. Let's say this is your trade for a 1 to 2. Again, like it's not about taking a good setup. It's about showing how to actually take a trade. So we connected Tradeovate and Trading View. And now here comes the best tip I can give you, because now we are on MNQ. If you go to a plus sign here and press Tradeovate, you're going to see all the different assets available you can trade with Tradeovate. Gold, ES, YM, Bitcoin, Euro, dollar. A lot of you can trade. Because we only have a 50K account, we need to trade micros. You also have minis. But to understand the difference between micros and minis, one mini is 10 micros. That's the only thing you need to remember about minis and micros. So I would recommend always choose micros because you can be very specific with your risk per trade. So we are now at the micro contract MNQ. Then we're gonna take this trade. What you can do to not need to put in everything manually or using a lot size calculator, you have this markup, right click, create a limit order. And now what will happen is this window will appear and we're only going to use limit and market orders. And this is the amount of contracts we're going to shoot. So let's say we only shoot one contract. And you see already here on the right side, 69 take profit and 34 stop loss. We are seeing the same numbers here in the risk to reward window. But we don't want to risk $34 to make 69. No, we have 50K account. So let's say we want to risk 1%, $500. How can we risk $500? What I like to do is then go play with unit sizes. And you see that every time I change, the risk will change with me. So 374, that's not enough. Here, this is good. 15 contracts. This is what we want to shoot for 1 to 2. But this is a limit order. We don't want limit orders. We want to actually execute in real time, playing around with the unit size. What actually lot size we need to choose is here on the limit side. Now we need to go to market order. And we're going to use the same 15 contracts, 15 micros. You see it changing in real time, right? Because the market here is moving, but it's still good, like 540. So maybe we need to go back to 14 contracts, right? You see here, and I need to adjust it a little bit because the market is moving up right now. And then you can just press buy. I'm not going to press buy because this is an account. I don't like to trade London sessions, also a bank holiday. So but this is how you execute. And then you take the trade with 500 risk. If it gets TP, that's going to be up here. It's now 850. And this is how you can calculate your contract size without lot size calculators or need to calculate how many points a NASDAQ is. And you can use this approach on all the different assets, also on ES, also on YM, also on gold. So now you know what prop firm to choose and why. The different rules like the consistency rule and the trading drawdown. You know how to actually set up an account, connect Tradeovate with Trading View and take your first trade using the correct contract size approach. Now let me share a strategy what I use to be very aggressive on the prop firms to get funded faster. And the whole approach is very simple. We are very aggressive in the eval, in the challenge stage, and then we size down when we are funded. So we get a lot of funding first, and then we take base hits to get the payouts. Now I'm going to put in a clip of me explaining this exact strategy. What if I told you getting funded doesn't have to be a multi-month emotional roller coaster? Most traders have limiting beliefs that passing a prop firm challenge requires weeks of stress, journaling, and perfect psychology. Today, I'm giving you my prop firm hacking framework to get funded in 2 minutes. No time to waste, let's get into the video. We are leveraging futures prop firms that allow 1 or a couple days to pass. And instead of grinding just one account, we play a numbers game. It is a one-shot, one-kill strategy. And let's say your strategy only has a 20% win rate. Statistically, if you buy 5 accounts and take one massive full risk trade on each, one of them will hit your profit target and instantly pass the test. And pause the video here and screenshot the table that is now on the screen. Pair your current win rate with the amount of accounts you need to buy to pass. And here's the exact math on how much capital you need to risk based on your win rate. And if you don't have a lot of money to invest into evals, just get the cheapest one. And pause the video here again and screenshot the table that's now on the screen and pair your win rate with the amount of money you need to pass. And now I know what you're thinking. Isn't this just gambling, right? Wrong. Gambling is trading and hoping for the best. This is an aggressive, calculated statistical approach based on your real trading data. And how do you actually get a payout? Once you hit that one trade and you get funded, the aggressive strategy stops. To actually reach your payout, you immediately size down your risk. You go from swing from home runs in the eval stage to just hitting small base hits until the money is in your bank account. Then you rinse and repeat. Reinvest your payouts to get consistent funding and payouts. And there you have it, the complete technicals layer of the trader pyramid. 15 episodes where we go over different entry models, the confluences, and the actual frameworks to get funded. If you got value from this video, make sure you like it, share it with a trading friend, and make sure you're subscribed with the notification bell on. Do not miss out on any of the 35 episodes here in this futures mentorship. The PDF with the prop firm frameworks are in the description, and the next video will now appear on the screen. So looking forward to see you there. Thanks for watching, and I'll see you in the next one. This is a fair value gap, and this is why yours are not holding. In the next few minutes, I'm going to show you why your fair value gap keeps failing and what you actually need to trade strong fair value gaps. This is episode 5 of the trader pyramid inside the technicals layer, and no time to waste. Let's go. Most traders take fair value gaps on a random time frame without any confluences, without context. It's like 50-50 every single trade. The first mistake traders make is they trade against the higher time frame trend. Because when the higher time frame is bullish, the high time frame wants to go make higher highs and higher lows. And what most losing traders do is they see this move happening. So we see down close candles, and they're gonna take all their short ideas. So this on the higher time frame looks the same here on the lower time frame, where you indeed have your displacements. So you have your bearish fair value gap, and then you're wondering, why is it not holding? It is because you were shorting a very bullish move. The higher time frame always wins. Always. The second mistake to avoid is not waiting for the third candle to form, because when there's 2 candles forming and you see massive displacement, you see this massive green candle, people think that's going to be the move. So they get in early without the actual fair value gap, the third candle being created. We need a third candle to have a fair value gap. Because if you don't wait, you're going to have this scenario where it looks like displacement, but it's not. So wait for the third candle to close before the gap is confirmed. And that means patience sitting on your hands. And the third mistake is fair value gaps outside of kill zones. Fair value gaps formed between sessions are lower probability. So try to trade the fair value gaps that are created during the New York Open, during the London session, because those are just higher probability. So now you know you shouldn't trade against the trend. You know that you need to wait for the third candle, and you need to trade fair value gaps inside kill zones. Let's now touch on what makes a fair value gap strong. First is the consequent encroachment rule, the CE rule. It's a fancy term for the 50% level of a fair value gap. It's a wick trades into the fair value gap, but the bodies close above the 50% of the fair value gap, it is still holding, and it's more likely that it just is respected to continue the move. If it's closed below the 50%, then you should anticipate it might fail. Because here in the bearish example, this green candle closes above the 50% of the fair value gap, even above the fair value gap itself, making the fair value gap invalidated. So that means it's most likely it's going to fail, and of course, can be used as an inversion fair value gap to continue the move. The second pillar that makes a fair value gap strong is stacked confluences. That means not only a fair value gap, but also a liquidity sweep, a market structure shift, an order block, inside the kill zone, clear drawn liquidity. There needs to be more confluence available because the more confluences are around that fair value gap, the more likely it is that it's going to hold and trade to the target. With the extra confluence available, you basically have multiple lines of defense that will help push your trades to your profit target. And use the second PD array rule. If you have the structure here, you have a liquidity sweep, you have a market structure shift, you have a fair value gap, you can take your trade in that first fair value gap. But some traders have a lot that they take that trade and then it just goes lower and then it goes higher. And they get faked out before the real move a lot. There's where the second PD array rule comes in, where you use the first area as your confirmation and you wait for a move away from there. And it looks like this. So instead of taking your trade right here, you wait for the push upwards. With the push upwards, there's new fair value gaps created, there's an order block created, and there is where your entry. And that series of confluences in the first PD array area is just an extra layer of defense to push your trade towards the target. So if you want to massively increase your win rate, use the second PD array rule. So the key takeaways trading fair value gaps is don't trade against the trend, wait for the third candle, trade inside a kill zone, use the consequent encroachment rule, use more confluences, and use the second PD array rule. The main takeaway is don't trade fair value gaps alone. The context around it is everything. So pause the video right now and screenshot this. And if you want all these slides with all the frameworks, I'll leave them in the description and inside my Discord. And now we build the fifth layer in the technicals layer of the trader pyramid. And if this video helped, make sure you like it and share it with a trading friend and subscribe with the notification bell on to not miss out on any of the 35 episodes in this futures mentorship. Thank you for watching and I'll see you in the next one.
The single best way to skyrocket your win rate is using time inside your trading. That means only executing when your trade appears inside one of the kill zones. And in this video, I'm going to break down what the kill zones are, how to combine the kill zones with news trading like NFP and CPI, and how to put all this together to take the highest probability trades. We are in episode 7 of the trader pyramid in the technicals layer. No time to waste. Let's go. Profitable trading uses both time and price. Here on this channel, I cover price all day. The fair value gaps, the order blocks, the entry models. But this is the time part of time and price. And honestly, using time fixed most of my problems when I was still losing. So if your setup was fine and you still got stopped out, check again if it maybe was not just a wrong time. When trading futures, there are 4 types of kill zones. We have the Asian session, the Asian kill zone. It's from 8 p.m. to midnight. That is all in New York time, EST. We have the London session from 2 to 5. The New York AM session is the New York Open. So for Forex from 7 till 10. For indices from 8:30 to 11. And the PM session is from 1:30 to 4 p.m. And you've probably seen this schematic already, but how to use it. If you want to trade the dollar pairs on futures, you can use this side of the schematic. If you want to use the indices like NASDAQ, ES, YM, here is where you need to take your entries. And the highest probability windows, the silver bullet windows, is for London session between 3 and 4. For New York AM from 10 till 11. That's why we have the 10 a.m. game. If you go back to episode 1 of this mentorship, you see that that is why the 10 a.m. game is so powerful. And 2 to 3 is for the PM session. And most entries just form in this high probability window. And what you will see is that if you trade outside of these windows, that your win rate will just go down. And you don't want that. You also need to pair the asset with the specific kill zone. For the Asian session, the JPY pairs move to the cleanest, AUD and NCD. And for the indices, you can trade the Nikkei in the Asian session. Why? Because pairing the asset with the region it comes from, it will give the cleanest move because the most volume is there. For London session in Europe, Euro and GBP. And for the indices, you can use the DAX, the JR40 and the UK 100. And for the New York Open, NASDAQ, ES, YM, and of course USD and CAD. That is why the 10 a.m. game is for NASDAQ, ES and YM. That does not mean that in the New York Open, these do not move. They will, but their main time of movement is in their own kill zone. And if you struggle with marking out the kill zones on your chart, there's an indicator who fixes this. If you go to indicators and type in ICT kill zones and pivots from Trade for All, if you click on that, then these boxes will appear. And if you double click on the settings, here you can adjust everything you need. So you can just pause the video now and screenshot this. You can copy my settings for indices, for futures with the New York Open. If you want to switch to the Forex side, you can add the London close and you can change this from 7 a.m. till 10. And on top of taking your trades inside a kill zone, you need to take news into account, the red folders. And here's a very simple approach to not get stopped out by news events. If you want the highest win rate, don't trade before news. Just don't do it, because price accumulates and manipulates before news or it ranges, and it's just low probability, especially for the three big boys. That is NFP, non-farm payroll, CPI, and FOMC, the interest rates. During news events, don't do it. Why? You don't know what the news event will bring. So you're basically gambling. You have no idea on the direction or the candle size. And this is, of course, why prop firms ban it. On most prop firms, you cannot trade during those big red folders. So that's why if there's a news event, a big red folder, just wait. Trade after. Because the market then shows its hand. It will show you, hey, was this a manipulation or a distribution? Does it sweep the liquidity or just starts the expansion? And there comes the A+ setup. And in a later video in this mentorship, I'm going to show you exactly how these different news events can create different types of structures. That episode is called Time and Price. If you go to forexfactory.com, it will show you the exact news events. If this doesn't show up, you need to click here on this week. And then on the right side here, there's a green button. You can filter on the red folder, the orange folder. And I always do the red folder and the gray folders. Gray folders are bank holidays, and you can turn off and off the currencies. Let's say you want to do everything only red folders. Then the time of the recording is June. So you'll see that we have CPI week. That means I did not trade before CPI on Wednesday. For futures, most of the time it's just USD pairs. So you can just turn it off and just only do USD. So you know exactly for NASDAQ when to trade and when not to trade. And it also means as part of your daily routine, you need to know what news events are occurring on the day you are trading. Thinking about the kill zone rule, that if your structure appears outside of a kill zone, it is most likely not trustworthy and most likely not going to hold. If we look at this exact schematic, there is a liquidity sweep, there's aggressive sells, aggressive buys, there's an inversion for value gap, there's a for value gap, and it's at 9 a.m. And you might wonder, well, this is inside the New York kill zone, right? But if you've been trading NASDAQ for a while, you know that if you trade NASDAQ, and it's the example on NASDAQ, NASDAQ moves after the New York Open, 9:30 a.m. EST. So that means you need to wait for structure to appear after the open. Because if you look at the same structure, you will see that that liquidity sweep we saw did not hold. We have another sweep when after the open. Liquidity sweep, then we had the market structure shift and left a for value gap, and it gave the entry. And it's the exact same structure, but now in the correct time. It's after the New York Open. So every time you see a high or a low or a structure in general, not on the correct time, just don't trust it yet and wait a little bit longer for the market to show its hand. So the key takeaways for trading kill zones. You have 4 sessions, Asia, London, New York AM, and New York PM. You need to know when each one runs and only trade inside them. Pair the asset with the kill zone. So the JPY pairs are in Asia, Euro and GBP are in London, USD and CAD are in New York, just like NASDAQ, ES, and YM. And if you want to trade news profitably, you need to know how Forex Factory works and just don't trade before it. Let the news push give you the exact information you need. And if you use a time filter in your trading, your win rate will just be so much higher because you just wait for the structure to form inside the correct time, and then you can trust it way more. And that means when you execute inside the correct time with the correct structure, your trade will go to your profit targets way more often than if you don't do that. So master the time and the price will follow. It will fall into place. And now you build the 7th layer of the trader pyramid inside the technicals. If you got value from this video, make sure you share it with a trading friend and hit the like button. Make sure you subscribe to the channel with the notification bell on to not miss out on any of the 35 episodes of this mentorship. The PDF, the slides of this episode are inside the description and also inside the free Discord together with daily outlooks, more free education. So make sure you check it out as well. Thank you for watching, and I'll see you in the next one.
I gave you my high probability New York Open entry model, and I gave you the PM session model. But what if you want to trade London session? In this video, I'm going to share my 2 London session bread and butter setups that you can use trading NASDAQ, trading futures, and you can even translate it to the Forex pairs. We are in layer 14 of the technicals part of the trader pyramid. No time to waste. Let's go. There's 2 different models you need to understand trading London session. But before we go into those models, keep in mind if you trade futures, let's say NASDAQ on London session, it moves like the PM session. It means not every day, and in smaller ranges. And the one question that decides if you can trade London session and which model: did Asia expand or consolidate? What did the Asian session do? Model 1 is Asian expansion, what you can use if Asian session already expanded, or when Asia consolidates, the classic Judas swing. But more on these models in a second. And an important rule when not to trade London is when there's a huge prior range. If Asia already moved hundreds of points, or if the previous day was like a massive move, London is not the highest probability. Or when there's big New York red folders coming up like NFP, CPI, or FOMC. And the London session is a kill zone. That means a certain time of day where the highest probability entries will come. Your highest probability entry models will be between 2 and 3 a.m. EST, where most USD pairs, so the Forex pairs, but also NASDAQ, ES, and YM, and gold start moving. What you will see if you're going to build data on the US indices is that where most entries come between 2 and 3, there will also be many entries around 4 a.m., 4 a.m., 4:30 a.m. EST. So when there's no entry after 3, keep in mind that the entry can come a little later. And you can not only trade NASDAQ, ES, and YM during London session, you can also trade the dollar pairs on futures. So the Euro and GBP crosses move the best in London session. If you then go to a live chart, you see that there's different boxes here. There's an indicator, ICT, kill zone, and pivots. It is this one. If you edit and then go to the settings, you can just copy the settings I'm using right here. You can pause the video and copy the settings. Our focus is going to be on the London session between 2 and 5 a.m., the pink-ish box. And this is on NASDAQ. If you want to see the other futures pairs, you can press the plus icon here, and then you see all stocks, funds, and also futures. And there you can see everything you can trade with futures. You see ES, we see gold, the Hang Seng, silver, gold. But I want your eyes also to go to not only the indices, like the Nikkei indices, but you can trade the Canadian dollar futures. That means USD CAD, USD CHF, NCD USD, Euro USD. If you want these blue boxes removed, you can go to settings, go to symbol, electronic trading hours background, and then move this to 0%. But let's focus for now on NASDAQ. If you look at the pink boxes, you'll see that not every day is a trade day. Small range, just like the PM session. That you can trade London session does not mean there's a setup happening every single day. There is where the entry model comes in. I'm about to show you next. You see, recently there's not many entry models. There's entry model right here where we sweep Asia. No entry model here. There's entry model here. Not here. There is here. Not here. And you see that if you zoom out, there will be entry models, but not 100% of the days. So there's where we need filters, entry models, to filter, is London session nice to trade on this certain trade day? Let's go over the first entry model. The first model is the Asian expansion, and it activates when the Asian session already hits the key level. And we need to combine a higher time frame level with a lower time frame structure. So what that means is that Asia already taps a higher time frame array. In this example on the right, there is a very bullish trend. So when Asia trades into a key level during a very bullish trend, we could see a potential Asian expansion. An example, we see that Asia already trades into a key level during Asian session as the new week opening gap, the volume imbalance and the gap right here. And what we are looking for is when Asia session trades into the key level, that it already displaces higher. It also leaves a fair value gap, and also it invalidates this bearish fair value gap. So there's where you need to pay attention during the London session for a potential Asia expansion model. And what we are looking for is that London retraces into those fair value gap and then runs to the draw on liquidity. So we have a 1 hour bullish fair value gap here. We assume that Asia already made the low here because we are very bullish and it's already in a new week opening gap. That means we expect London to trade into there before continuing higher. Where to? Low hanging fruit, just an old high right here. And if you then zoom into the lower time frame, it can be the 1 minute, the 5 minutes. If you zoom in on that price action, what you'll see is here's the new day opening gap, the purple box. We have a liquidity sweep, break of structure, leaving a fair value gap. It could be the start of the move. If we mark that out, you see that there's 2 fair value gaps with the displacement move breaking structure. So the entry could be already here. And then we have multiple options. If you look at this price action, this to draw on liquidity, we expect price to go to the 1 hour fair value gap and go higher. You can do 2 things here. There's an entry nuance. There's no right or wrong. Do what your risk management works best for in your trader personality. You can go for 1 to 3, 1 to 2, or somewhere there in between. The 1 to 3 you can get in this trade idea by entering in the first fair value gap. The 1 to 2 you can get by entering in the second fair value gap. If you are early, you have a higher risk that price maybe goes stop you out before the real move, but you have a higher risk to reward. If you want to be more safer, So lower risk entry, you can wait for the second fair value gap, but you have a lower risk to reward. Again, both is good because if price goes up, you most likely will make money regardless of 1 to 2 or 1 to 3. And then fast forward, price runs to the target with speed. What you saw here is that after the 2 fair value gaps were created, there was like a massive move down. And I'm a big fan of not touching your trade. What that means is you take your entry, you set your stop loss, set your TP with the right risk management, and then you just walk away. And it doesn't mean walking away from your screen, but just don't touch the trade anymore sitting on your hands, because that would have saved you taking your trade off too early before the real move. And you will see if you start doing that, we're going to touch on that more in the psychology part of this mentorship, is your win rate will skyrocket because your discipline will become better by doing this. So both trades went to TP by just following the entry model, where Asia tapped into the higher time frame array. It displaced away, leaving fair value gaps. Then London retraced into that fair value gap, and on the lower time frame, we played from this low with the liquidity sweep back to the high, and it even went higher. But that's irrelevant because we made our money already at the TP point. This Asia expansion model is a very strong entry model, but what if Asia doesn't expand? What if Asia just consolidates, just trades around and nothing happens in Asia? How to approach that situation? There's where the Asia consolidation model comes in, and it's also known as the classic Judas swing, where there's an accumulation, manipulation, distribution, the power of 3, where Asia accumulates, London manipulates, and then starts distribution. We are again going to use a higher time frame level with a lower time frame structure. And this happens when Asia never tapped into the higher time frame array. London manipulates into that array first and then reverses through the structure to the draw on liquidity. And we're going to build on top of the expansion example from the PM session model. If you've seen the PM session model in the previous video, you're going to recognize this exact structure. We traded this PM session model. And now we're just going to use the expansion we had the TP on for the next day during London session, because that PM session model created a overlapping 1 and 4 hour bullish fair value gap. And now we are in the Asian session. You see it accumulates a bit. What we're basically waiting for is we have a fair value gap here. There's also a small fair value gap right here. We just wait for price to or trade into here, goes higher, or trades into here and goes higher. Both is good. We just wait on a lower time frame for the structure. Those are the key levels for the London session right now for the Asia consolidation model. Zooming in on the price action on the lower time frame, we are now in the Asian session and the start of London. Asia accumulates. Then with the start of London session, it starts to manipulate into that overlapping 1 and 4 hour fair value gap. But there's no long ID here yet because we need to see reaction from that displacement. And if you dropped even to the lower time frame here on the 1 minute, there is where it becomes interesting, because in the middle of the London session at 3:15 a.m. EST, it creates a low. The liquidity sweep, market structure shift. There's an order block here. That's the down close candle here that made the low. We move away from that, creating a fair value gap, creating a fair value gap here, multiple fair value gaps. So here is the buy structure we need to start looking at the buy idea. So if you mark that out, liquidity sweep, break of structure, fair value gap 1, fair value gap 2. And again, here there's 2 different entry possibilities. First entry possibility is in the first fair value gap. Second entry possibility is in the second fair value gap. If we then zoom out here, we have the Asia accumulation, then we have the London manipulation lower into the key level, and then we start potentially the distribution move higher. What could be the TP point? Well, obviously the high of this accumulation is going to be the target like this. Then if you zoom in for the entries, just like the previous model, it's up to trade discretion if you want to enter early for a high risk to reward with the risk of being stopped out before the real move, or you want a higher probability entry with a lower risk to reward, then choose the second fair value gap. Both is good. It needs to fit your trader identity, your risk tolerance. And then if you fast forward, price goes to the draw on liquidity with both entries in the first fair value gap and in the second fair value gap. And if we zoom out then on this speed of price action, this was the PM session model from the previous video. And after that, we played an accumulation in Asia, a manipulation in London session, and the start of the distribution after we created lower time frame structure. Remember, we combine higher time frame level with lower time frame structure. While we are bullish on the higher time frame, that's the context. We have a 1 and 4 hour level, the intermediate time frame, and then we use the lower time frame to find our entries. The key takeaway for the London model is the time is the most important factor. NASDAQ is around 4 a.m. EST. The USD pair is also in 2 to 3 a.m. Try to use the Euro and the GBP futures as well, because those tend to move during the London session. You can trade them on futures too. How the Asia moves is the deciding factor. Does Asia expand or consolidate? That is what picks your model. It can be Asia expansion, Asia consolidation. Very important. If there's no higher time frame level close to your current price action, there is no trade and you just sit on your hands until the next session comes, and that is the New York Open. And there you have it, layer 14 of the technicals part of the trader pyramid. If you got value from this video, make sure you like, share it with a trading friend, and make sure you're subscribed to not miss out on the other of the 35 episodes here in this futures mentorship. The next video in the mentorship is now appearing on the screen, so make sure you check it out right now. If you want the PDFs and the slides of this video, you can find them in the description and inside my free Discord, together with hours of more free education. Thanks for watching, and I see you in the next one. This is NASDAQ, this is ES, and they should follow each other. NASDAQ go up, ES should go up, and vice versa. But what if they don't? In this video, I'm going to show you how to use SMT divergences to find reversals in the market. I'm going to give you a complete checklist and frameworks so you can find the correct correlation, uncorrelated pairs too. We are in part 8 of the trader pyramid inside the technicals layer. No time to waste, let's go. An SMT is a crack in correlation. Correlated assets need to move together, and when one fails to follow, there is where the SMT comes in. So if we zoom in on a bullish SMT at the lows, one makes a lower low and the other one does not make a lower low. It makes a higher low. If it happens in a key level, high time frame fair value gap, an old high or low, there's where a reversal can start. Same with a bearish SMT, they need to follow each other. So if NASDAQ makes a higher high, ES should make a higher high. When it doesn't do that, then you have a potential SMT on your hands. If you combine that with a structure shift, displacement, fair value gaps, then you can add the SMT as a confluence to your model. So two pairs, one breaks off, that crack is the signal for a potential reversal. Keep in mind that the SMT itself is not an entry model. It is just one confluence that you can put inside your entry model, just like a fair value gap, just like a market structure shift, just like displacement. So don't fall into the trap to blindly trade every SMT. Use it as an extra confluence to confirm your trade idea, to confirm the reversal in your target's direction. And there's more correlated pairs than just NASDAQ, ES, and YM. SMT only works between assets that should move together. And for the indices, NASDAQ, ES. For Forex, you have Euro and GBP. So that means Euro dollar and GBP US dollar, AUD and NCD, gold and silver, Bitcoin and Ethereum. And the USD pairs, Euro dollar, GBP US dollar, have an inverse correlation with the dollar. That means when dollar goes up, USD pair should go down. When it cracks, you have a potential reversal on your hands. So they should move together. When they don't, that is your SMT. So at this point, you know what an SMT is, you know the correlated pairs. Which of the two of the correlated pairs do you trade? In a bullish SMT, trade the strongest. So the pair that did not take the low. It made a higher low for a reason, while the other broke down. That is relative strength, and smart money is holding price up. So in this case, NASDAQ makes a lower low, ES makes a higher low. ES was so strong that it did not even make a lower low. That means that is the strongest pair. That is what you should trade. In a bearish SMT, trade the weakest, because you want your shorts to be as weak as possible, to drop as fast as possible. The pair did not make the higher high. In this case, NASDAQ makes a higher high, ES makes a lower high. ES was so weak, it did not even make a higher high. That is the pair. So in this case, you also trade ES. You still can trade NASDAQ in these examples, but you will see over a long period of time that if you trade the strongest and the weakest, you will see the cleanest and fastest moves. So how to trade this step by step? One is spot the SMT in a higher time frame key level in a kill zone. In previous parts of this mentorship, we already talked about key levels, about liquidity, and about kill zones. And here you should find your SMT. So in this case, we have a London high that's being swept here. So there's a higher high created in a key level, golden high and all-time high. And at the same level, there's an SMT. NASDAQ makes a lower high. Next up is dropping time frames. Just like every other confluence, like a fair value gap and an order block, an SMT, if you trade it on the 1 minute, you're gonna see bullish and bearish SMTs everywhere. That's why the rule, the higher the time frame, the more reliable your confluence, also applies to SMTs. So find your SMTs at the 15-minute, 1 hour, 4 hour, and then drop to the lower time frame, your entry time frame, the 1 and the 5 minute, to use that knowledge in your favor to find the best trades. So if you then drop time frames to the execution time frame, you will see in the lower time frame that during the New York Open, during the kill zone, before that we have the SMT, the liquidity sweep, and then we start dropping lower, creating fair value gaps. And it's on the 5 minute. You could do the same on the 1 minute. And because we want to trade the weakest in a bearish SMT, so we want to trade NASDAQ, you see that we have a fair value gap here where you could take an entry, value gap here where you can take an entry. And you see that NASDAQ just moves lower, very clean sell structure. When? During the New York Open and 10 a.m. game. That is why you should study episode 1 of this mentorship, because this actually comes back into all the entry models. And then step 3 is take your entry. Your model itself does the entry. You just spotted an SMT, a potential reversal, and then the model does the heavy lifting. You can do the 10 AM game, you can do the ping pong model, you can use the FTS model. All these models can be found here in this channel in the entry model playlist, and they will also come back inside this mentorship. And SMT was just the confluence, not the entry model, but was the starting point, like, hey, we might reverse from here. And we did. And a little bonus here, sometimes there's a second SMT in the same range. So we have already SMT at the external range liquidity at the highs, make a higher high and a lower low. The NASDAQ is better. But sometimes inside the range, there is also an SMT created where one makes a lower high and one makes a higher high. Then inside that range, you also have another SMT, making it even higher probability for your actual entry on the lower time frame. But it all starts with the higher time frame SMT, where you can just find the start of your reversal. So the checklist needs to be a key level. The SMT needs to form inside the higher time frame PD array, fair value gap, order block, some liquidity point, high or low. Follow the order flow. That means aligns with your higher time frame bias. If the higher time frame is bearish, try to find shorts. If the higher time frame is bullish, try to find longs. It needs to form during a kill zone, London or New York. And this ties back to the previous episode about kill zones. So the key takeaway is be a cracking correlation. One correlated pair fails to follow the other. Which pair in the bullish trade the strongest, in the bearish trade the weakest? If it's not very clear which one is the strongest or the weakest, just trade the cleanest structure. The clearest fair value gap, the clearest displacement. And the SMT is a confluence, not an entry. So spot the SMT, drop in time frames, take your model. SMT never enters the trade by itself. It needs to be supported by, for example, displacement, a market structure shift, fair value gaps, order blocks. Use as a confluence inside your entry model. And use the checklist. It needs to happen in a key level, following the higher time frame order flow inside a kill zone. So spot the crack, confirm the model, and take your trade. That is it. And now you build the 8th layer inside the trader pyramid in the technicals part. If you got value from this video, make sure you like, share it with a trading friend, and make sure you subscribe with the notification bell on to not miss out on any of the 35 episodes here in this futures mentorship. A PDF with the slides and all the frameworks from this episode are inside the description and also inside the free Discord. Thanks for watching, and I see you in the next one. This is time, this is price. And to make money with trading, you need to use both. In this video, I'm going to show you how to increase your win rate using time and price together with a step-by-step delivery sequence. I'm going to show you why you keep being stopped out before the real move and how to trade the red folder news events like FOMC, NFP, and CPI. We are on episode 9 of the trader pyramid inside the technicals part. No time to waste. Let's go. There's 2 non-negotiables when trading because every single trade has these 2. Before you even think about making an entry, there needs to be a key level where price can react from. And a key level is nothing more than an higher time frame PD array, and higher time frame fair value gap, order block, alt high or low. That is your entry zone. Price need a reason to turn around, to reverse. So when you see your trade and you see this structure happening, what we see in previous episodes as well, this reaction needs to come from a key level. For example, here we went away from a weekly low. It's a key level. And next to reaction from a key level, a higher time from key level, there needs to be a draw on liquidity. And in the liquidity episode of this mentorship, you saw already that there's 2 things price can do. It can go to external range liquidity and it can go to internal range liquidity. External range liquidity is alt highs and lows. Internal range liquidity is alt fair value gaps. So there needs to be reasons why price moves to certain targets. And when you have these non-negotiables in place, we need to talk about the delivery sequence, the step-by-step approach on how to trade time with price. Because in the previous episode about kill zones, I showed you when with the kill zones, but there's more to that. Let's take a look. So during the kill zone, there needs to be price into the key level. In this example, there is a 4-hour bearish fair value gap after we sub liquidity, is a 4-hour chart. And we need to see a reaction. Well, if you look at this candle, this is a clear reaction from that level. We leave a wick. If we drop to the lower time frame then, to the 5-minute time frame here, we need to see some form of Judas swing and manipulation into the key level. And here we see that wick into the key level and then we reject from there. So there's where you need to pay attention. From that point, the 3rd step is the structure shift. It's the last swing low that made the high. And when that gets broken, right here with displacement, with a fair value gap created here, there is where the entry comes. And see how choppy the delivery was before that. You can just ignore that because you just need to wait for the structure shift in your direction. Because there was a clear drawn liquidity in this example. It was an Asia low, a session low. And then if you want to enter, you enter in the fair value gap. and then price delivers to the target. Recommended time frame for entry, I would recommend do the 1 and 5 minutes. For the key levels, I would recommend using the daily and the 4-hour time frame. In later episodes, we're going to talk about time frame alignment, but for now, just remember these time frames. And then you look at this trade and you're like, okay, I see this, but I always get stopped out before the real move. What can I do to avoid that? There is where using high and low resistance liquidity. If you look at low resistance liquidity is where you get stopped out, you enter before the level was hit, nothing was swept, and nothing defends your position. And low resistance liquidity are failure swings. It's low resistance liquidity because there's all swing highs that did not take out any other high. It's easy to take out. So when price comes there, it goes there very energetically. What we want is our position to be defended by high resistance liquidity. Because when we have that key level from the step-by-step sequence, higher time frame key level, and we have the structure shift during a kill zone, ideally during the New York Open, there is where the entries will come. And high resistance liquidity is a liquidity sweep into a key level before the real move. We want to be defended by high resistance liquidity and we want to target low resistance liquidity. So if you're getting stopped out before the real move, think about the following. Is your stop loss not defended by low resistance liquidity? Most of the time it is. And there's one exception to this rule, and there's where there's high resistance liquidity. So there is a liquidity sweep, but that liquidity sweep has been made outside of a kill zone. When I see highs and lows that are high resistance created between kill zones, not inside the kill zones, I trust them less. And I even consider them to be also low resistance liquidity. That's the only exception to this rule. And in the kill zone video, you already saw that trading before FOMC, NFP, and CPI is not the right thing to do. Let me show you what you can do with all the red folders. This is the framework you can use to successfully trade all the red folders. And the key is waiting for where the liquidity is being swept. Because the first option is that news manipulates. That means the news is responsible for the liquidity sweep before the real move. If you are before a news event and there is no liquidity being swept yet, that means you can anticipate to wait for the red folder and then execute because the red folder did the heavy lifting for you. It did the liquidity sweep, the manipulation before the real move. But what if before news, price already swept liquidity? So before the news event, we already have the liquidity sweep, we already displace a little bit, and the news comes right here. What can you then expect? Then you can expect price to start expansion with the move. And in these scenarios, I'm willing to take a trade with maybe a little bit bigger stop loss. In these scenarios, I'm willing to take a trade just before news with, of course, a good stop loss because I'm expecting this is high resistance liquidity. We are targeting low resistance liquidity. I'm willing to take that move any time of the week. So the key to trading news successfully is watching if the liquidity sweep in your key level has already happened. If it is, awesome, then you should expect news to expand. If it's not, expect news to do the heavy lifting for you. And there you have it, the 9th layer inside the technical part of the trader pyramid. If you got value from this video, make sure you like, hit the subscribe button and turn on the notification bell to not miss out on any of the 35 episodes here in this futures mentorship. PDF with all the slides and the frameworks are inside the description and also inside the free Discord with a ton of more free education. So make sure to check it out right now. Thanks for watching and I see you in the next one. What if you have no time to trade the New York AM session? Or what if the New York AM session is super ugly, but there's still so many targets that we can trade towards? There is where the PM session model comes in. And this video, I'm going to show you the 2 highest probability approaches towards the New York PM session. We are in layer 13 of the technicals part of the trader pyramid. No time to waste. Let's go. In episode 7 of the Futures Mentorship, we talked about kill zones. We have the Asia kill zone, London, New York AM. This video is focused on the PM session. And the PM session runs from 1:30 till 4 p.m. The highest probability window, the so-called silver bullet window, is between 2 and 3 p.m. What a coincidence that it's also the start of a new 4-hour candle on NASDAQ. And it also means the 10 a.m. game framework can be applied to the 2 p.m. candle as well. It's just the next 4-hour candle. But more on this later. And before we dive deeper into the slides, I want to show you an expectation for trading the New York PM session. Because the New York Open gives most of the entries during the week and the PM session is just an extra. You rarely get a decent trade every single trade day of the week. The boxes you're seeing are all the kill zones. It's an indicator called ICT kill zones and pivots. And if you add that in the settings, you can copy my settings. Asia from 8 till midnight, London from 2 to 5, New York AM from 8:30 till 11, and PM session from 1:30 till 4. So screenshot this if you want to add this indicator to your chart. And I want your eyes to go to the purple boxes. So here is Monday, very small range PM session, not an entry. Here, very small, not an entry. Here, definitely an entry. Maybe an entry, no entry. See how small that box is? The purple box? Very nice PM session. Here, 3 PM session in a row. Very small, very nice, very small. If we zoom out more, you see that the PM session not always gives a nice entry, but when it does, it's amazing. And let me show you now how to anticipate getting a very nice PM session instead of a very ugly PM session. There's two different models. Before we go into the models, remember that the PM range is smaller than the New York AM session on average, so don't swing for the fences, take your base hits, and time plays a massive role into this because there's an overlay between the New York AM session, New York lunch, and then the PM session. Model 1 is a continuation. It's activated when the draw is not hit yet, so price continues the 10 AM game move towards the target that is still not being hit. We'll go over this example in a second. And the second model is the retracement model where we go from external range liquidity when that draw is already hit and price goes back into the range. And what are the invalidation points for both trades? When not to trade, when there's no clear draw on liquidity and there's no clear structure. Make sure you write these two down because that will save you a lot of losses trading the PM session. Let's go over the continuation model. It is basically a continuation from the 10 AM game. If you don't know what the 10 AM game is, it's my most profitable entry model I've been trading for multiple years now that got me towards full-time trading. The first episode of the Futures Mentorship is about the 10 AM game. If you look at this chart, look at the 50-minute time frame. There was already an SMT with ES. Then there was a 5 and 15-minute fair value gap. And our eyes now need to go towards here. This is the New York Open. You might wonder, New York Open, you're trading the PM session. Yes, but we need to use the previous price action from New York AM, from London, from Asia to see is there still a trade available. So let's zoom in on this price action from the New York Open. Here we look at that same price action on the 5 minutes and there is no entry here. The New York Open. So when you traded the 10 AM game here, there was not a clean entry because it's just consolidating here. So we did do a small liquidity sweep at the New York Open at 11 AM here, but then we didn't displace away. It was just not very clean. So that means if there's still a drawn liquidity open, which there was a 50-minute fair value gap, there was a 1 hour fair value gap, those old highs, and we had, go to the previous slide, we had bullish structure because it's a reversal structure, SMT, key level. So we're expecting price to trade at least somewhere towards here. That's our daily bias. So seeing that, fast forward to the PM session, we start displacing higher. Massive green candle, probably a news event or a tweet. At 1:25 PM, you see displacement, the start of the PM session, and the structure is there because we have a liquidity sweep, we have a structure shift. There now is displacement, leaving a fair value gap, and we have clear targets. So there is a high probability model appearing here. And now let's see how we can execute on this idea because we have the target here, but the price already moved away, so FOMO can play a role. Let me share a framework on how to remove FOMO and just trade a very clean 1-minute structure. Here we look at that same price action on the 1-minute time frame. Looking at the time, it's the PM session where we're now trading in. And my rule is with a big fair value gap, like we see here, massive, we don't want our stop loss to be all the way below here, right? Because then our whole risk to reward is getting destroyed. Ideally, we want our stop loss to be somewhere in the fair value gap and then our target somewhere here to have a nice 1 to 2, 1 to 3, 1 to 4. So for that, I drop to the 1-minute time frame and wait for displacement from that level. I want to see aggressive sells, aggressive buys, the V-shaped recovery inside that level where I'm hoping to see movement from. That's of course the massive fair value gap. If we fast forward to 2 PM, the highest probability window, we have aggressive sells, aggressive buys. In that area, the V shape in the key area, we leave 2 fair value gaps. My rule is if there's 2 fair value gaps, I like to take my entry in the first one, in this one, and my stop loss covers the other one. So of course, ideally below this low, but also below this fair value gap. Here is where you can put your stop. Both is good. It's up to you, up to trader discretion. And then entry in the first fair value gap, stop below the low, target that 15 and 1 hour fair value gap, and see how clean this PM session model is. The delivery was very slow at the start. That's why I just need to hold and just wait, and then price goes to your target. And on the 1 minute, this looks nice because we have a liquidity sweep, structure shift with this candle, multiple fair value gaps. So the structure was there from a key level. And if we zoom out here, look at what we traded back to the 50-minute time frame. We did a 1-minute time frame execution on the 50-minute structure. And this was the low that was created. to come back to my point about risk to reward, you don't want your risk to reward to be all the way down here, right? Because then your whole risk to reward is very ugly. With using the 1 minute structure, we allowed ourselves to have a higher risk to reward because we're just waiting for the aggressive sells, aggressive buys in the key level, the overlapping 15 minutes, 5 minutes, and 1 minute fair value. This first model is super nice when there is a clear draw on liquidity. If you don't know how to find your draw on liquidity, I discussed this in a previous mentorship episode, but if the draw on liquidity is hit, there is not much to do for this exact model. That's why we also need to talk about the second model, and that is the retracement model. That is when the drawn liquidity is already hit and we trade back into the range. So we go from external range liquidity to internal range liquidity. We're looking at the Sunday low here and looking at the time. This is New York open territory, and we are going to try to find a trade in the PM session. So this Sunday low, if you zoom in on this price action, is now right here. We're now looking at the 5 minute time frame, and also I want your eyes to go to the time of day. We are inside the PM session, the high probability area here. And what do we see? There is accumulation, manipulation, and potential distribution. So the AMD, the power of 3 from the daily bias framework. There's a liquidity sweep. There's aggressive sells, aggressive buys. There's a fair value gap for entry. There's a structure shift, and we have a clear drawn liquidity. If we zoom out again, it was this fair value gap. So we trade from external to internal. That's the bias. Now let's see if that comes and how we can execute on it. So with the model there, this is how you can execute. You can do two things here. I would say entry in the fair value gap, stop below the low, or stop below the fair value gap. If you want a high risk reward, you can do the below the fair value gap, but sometimes it comes back there and stops you out before the real move. That is up to you if you're willing to have a higher risk to reward and be okay with being stopped out sometimes. If you don't like that, put your stop below the low for 1 to 2, target the 1 hour fair value gap, and then price goes to the target. And that is how you trade the retracement model. So the key takeaways for trading PM session is that time is a very important factor. It's a smaller range than the New York AM session. The draw on liquidity is the deciding factor. Look at what draws on liquidities are there. If it's already been hit, go for the retracement model. If it's not hit yet, go for the continuation model. So read the draw on liquidity, pick your model, retracement or continuation, and then target base hits. And there you have it, layer 13 of the technicals part of the trader pyramid. If you got value from this video, make sure you like it, share it with a trading friend, and make sure you subscribe to not miss out on any of the 35 episodes here on this futures mentorship. PDFs and frameworks from this episode and all the other episodes are inside the description and also inside my free Discord. The next episode's video is now on the screen. It's going to build on top of what we discussed today, so make sure to check it out right now. Thank you for watching, and I see you in the next one. This is me losing all my life savings. This is me finally understanding what direction the market is going. And in this video, I'm going to show you my advanced daily bias framework so you can actually predict where the market is most likely headed next. We are now building layer 12 inside the technicals part of the trading pyramid. No time to waste. Let's go. In the previous daily bias video, I shared the AMD framework. That's just the basic framework I use every single day. We have an accumulation before the New York open where price is just ranging. Then between 9:30 and 10, we have some form of manipulation. And after that, we start the distribution move towards the target. But if you now go to the market, you're not going to see that picture perfect example every single day, right? So we need a framework on top of this so we can create our highest probability daily bias. And to do that, you need to understand the anatomy of a candle. In a bullish candle, there's an open, there's a low, there's a high, and a close. If I talk about open, high, low, close, this is it. It opens, then it trades lower, create the low of the candle, and then it starts trading higher to the high of the candle, and then it closes. Same for a bearish candle. Bearish candle opens, then it creates the high of the candle, and then it starts selling off to the low of the candle, and then closes. In this move, you can already see that there's an accumulation, a manipulation, and a distribution in a candle. But not all candles look like this. Some have a bigger wick, smaller body. There are many different candles that can be printed. So we need to have frameworks in place to counter different type of candles. Let's do that right now, because there's 3 types of days. The first day is the trending day. Small wick, huge body, is an expansion body, and the previous candle rejected a key level, and we are just riding that momentum. If we look at on a chart, there's a higher time frame chart. This is the day before. We see a reaction from a fair value gap, and then we just trade the next candle that has the biggest chance to make a nice green candle. This candle is where I make 80% of my money. Because if you remember the 10 AM game, my go-to entry model for over 3 years now, where I make all my money with, you have accumulation before the New York Open, then at the open, we manipulate, then we displace higher, breaking structure with fair value gaps and order blocks, and it goes to a clean target, session high, daily high. These are the easiest days, but not all days are as clean as this. So we need to dive deeper into this with the next type of day, and that is the reversal day, where the previous framework went over this candle, the expansion candle, the trending day. The reversal day is what do we do when we trade into that key level. That can be a fair value gap, that can be an old high or low, in this case a bullish fair value gap, and do this on the higher time frame. If you've seen the time frame alignment with a top-down analysis, you know that we do this on the higher time frame, and with that reversal day type, we go to the lower time frame. So let's say this is a daily candle and this is the 5-minute chart, or this can be a 4-hour candle and this is the structure on the 1-minute chart. And in a reversal day, it is lower probability, but we just need to wait for what do we do inside that key level? Because we accumulate at the open, then we drop lower, creating the low of the candle in that key level. And what we need to wait for is that V-shaped recovery. I've been explaining it for all these videos already. The aggressive sells, aggressive buys from that key level. Because when you have an aggressive sells, aggressive buys, that V shape or the smart money reversal, whatever you want to call it, in a key level, ideally also during a time window that makes sense, the New York Open, for example, then you have a high probability low on your hands. Then you have a structure shift, you have fair value gaps, and then you can just trade the continuation higher, the distribution higher. But it all comes down to, do we create that V-shaped reversal, aggressive sells, aggressive buys in that key level? If we don't get that, we're most likely not going to get this candle and we just start trading lower. And that saves you a loss. And how this looks like on the chart, this is a daily chart. And we're going to zoom in on the reversal day. That is when we sweep the liquidity and we're looking at this candle, because that's the start of the reversal lower. So this is the reversal day, and let's see how that looks like on the lower time frame. So from the daily, we can drop lower to the 5-minute time frame, and on the 5-minute, in this piece of price action, you see a liquidity sweep, and we have displacement lower, breaking structure. In that move lower, we create fair value gaps, we create multiple order blocks, and it goes back to an old low. It's a very easy short. Based on the daily time frame, that we just took out an old high, was a weekly high, and then we just start trading lower. So the reversal day, we hit a key level, a weekly high, and on lower time frame, we start reversing from that, the reversal day. If we build on this example, what if we look at the next day? Because if this is the reversal candle, then this black candle is the trending day, it's the highest probability day. So let's zoom in on that. This is the reversal day example, and now we're going to zoom in on, okay, what happens the day after in the highest probability day? And in hindsight, you see already that's of course going to the next target, where the previous trade went from the old high back to this low, and now we're going to trade back to this low. And how it looks like on a lower chart is the daily time frame, it's the 1-hour time frame. Here we're looking at the lower time frame. Price trades into that 1-hour fair value gap. Then it sweeps liquidity, it breaks structure with a fair value gap, price comes back a couple times to the fair value gap, and then starts trading lower towards that drop on liquidity, making that the highest probability trade. So this is the reversal day, and this is the continuation day. And the third type of day is the one you need to avoid, is the doji day. Small body, massive wicks. You can expect these candles on the higher time frame to form after a massive expansion where price just needs to build up more liquidity. So after large range days, I'm expecting the doji candle to form. So that is why I skip it, because saving my capital, so I have more capital to expose myself to when there's trending days or reversal days, that is the key. And on the lower time frame, these days look just like this. So it looks like we sweep some liquidity, trade lower. Oh no, we then trade higher back and then lower, and it just doesn't do anything. So one more time, the 3 days together. The trending day is the cleanest one with a 10 AM game example, where you can use the power of 3 with the open, high, low, close in the most easy fashion. There's where I make most of my money. You have the reversal day where we trade to a key level. You're not sure if we're going to move away from that key level. That's why you wait for that V-shaped recovery. And after large expansion days, you get these kind of ugly candles and try to avoid them as much as possible. If you see it already happening, just close your charts and go outside to do something else. When do these happen? When we hit a key level, after we hit a key level, and if we had a massive expansion. So if we have a massive trending day, the next day, I'm not per se expecting a very nice day. I'm expecting a doji day. And to build on top of the top-down analysis framework from the previous mentorship episodes, That open high low close candle is fractal. If you expect a weekly candle to look like this, then have your accumulation, that's going to be Monday. And if your manipulation lower, that's Monday or Tuesday. And then the rest of the week will start the distribution, the AMD. That's the classic buy week. But you can do the same open high low close on the daily time frame. For the US indices for futures, accumulation happens during Asia. Then London or New York manipulates into a key level, and then New York Open starts distributing. Sometimes the manipulation happens during the New York Open, and then 10 a.m. will expand. You can even do this on the 4-hour candle, that's the 10 a.m. game, where the first 30 minutes after the open is the accumulation. They will manipulate lower in a key level and then start distribution in a 4-hour candle. All the structures are the same. So if I talk about a buy structure, this is what I mean. And you can play it on the weekly candle, on the daily candle, on the 4-hour candle, and that is called price is fractal. So when you hear other gurus say, this is my fractal model, don't buy their course. This is what they mean. And there you have it, the 12th layer in the technicals part of the trader pyramid. If you got value from this video, make sure you like it, share it with a trading friend, and make sure you subscribe with the notification bell on to not miss out on any of the 35 episodes here in this futures mentorship. Slides, frameworks from this episode and the other episodes are all inside the description and inside my free Discord, and with so many hours of other free education. The next episode that will build on top of this one is now on the screen, so make sure you check it out. Thank you for watching, and I'll see you in the next one. These are all the time frames you can trade, and this is how you can make a top-down analysis to go from the monthly time frame all the way to the 1-minute time frame for your entries. This is one of the most confusing parts about trading, and in the coming few minutes I'm going to simplify everything from how to trade high probability 1-minute entries, how to use time frame alignment in your trading, what time frames to use as a day trader and a scalper, and the 3-bucket framework to create a high probability top-down analysis. We are in episode 11 of the technicals part of the trader pyramid. No time to waste. Let's go. If you go to the chart, you will find 20 or 30 different time frames. And trust me, you don't need them all. You just need these 3 buckets. You have the higher time frame bucket. That's the daily time frame, the weekly, and the monthly. That's for your context. If the daily, weekly, monthly is bullish, try to find more longs. If the higher time frame bucket is bearish, try to find more shorts. The intermediate term time frame bucket is the 1 and the 4-hour. There is where you find your structure. For example, a market maker model. And the lower time frame bucket is where we find our entries. The 10 a.m. game, the FTS model, the ping pong model, where you can insert your favorite entry model. And from previous episodes in this mentorship, you recognize that the context is the internal to external. The 1 to 4-hour is the market maker model, and the entry model is the different entries inside that market maker model. And how you can align time frames the best. Use these 3 alignments to take the highest probability trades. If you have a weekly internal to external, find your structure on the 4-hour and your entry on the 15-minute. If you have a daily context, use the 1 hour for structure and the 5 minutes for executions. If you have a 4-hour context, use the 15-minute for structure and the 1 minute for execution. And this is the one I'm using every single day with the 10 a.m. game, with the FTS model. And before we continue into the execution, you need to determine your trader identity, because the alignment needs to make sense with the personality you are as a trader. If you're a day trader, you should have your context on the daily, your structure on the 1 hour, and your entries on the 5 minutes. If you're more of a scalper, like me with the 10 a.m. game, use the 4-hour context, the 15-minute structure, and the 1-minute entry. This is the 10 a.m. game. And don't get me wrong, everything works, but it needs to work for you. That's why you just can choose and commit. Don't try to be a hybrid between those two, just choose one. Now let's actually apply these 3 buckets on the chart. So here we have a daily time frame chart where we go from internal, hopefully, to external. That's the bias. So we wait for price to sell off and then create structure. Let's zoom in on this price action. So here you see that same price action from the daily, but now we are zoomed in on the 1 hour time frame. And what do you see here? We see that price trades into this daily fair value gap, and it makes the signature move of a market maker model. Aggressive sells, aggressive buys. So maybe we're going to have a 1 hour market maker model here. We have fair value gap 1 here, and then we can just trade towards the target here to complete the market maker model. And in hindsight, yes, we will do that. So we have the fair value gap here, then we create an order block, and then we come back to the order block overlapping with a 1 hour fair value gap, and then when we trade to the target. So also the intermediate term time frame structure, the bucket, was pretty easy to read, right? But we don't take trades on the 1 hour and the 4 hour. We take trades on a lower time frame. So then we need to check again. In this fair value gap, we could have taken an entry, and in this fair value gap, we could have taken an entry. Let's see how we could determine that on the actual lower time frame, how to execute this. And now we're looking at entry 1 in the first fair value gap. So here's the 1 hour fair value gap, and we're looking at the 5-minute time frame. Remember the time frame alignment to the daily, 1 hour, and 5 minutes. So here during the New York Open, we have a mini market maker model because we have equal highs sitting here. We have aggressive sells, aggressive buys with a fair value gap, with a structure shift. There's a mini market maker model here on the 5 minutes. You can take your entry in the 5-minute fair value gap after we took liquidity inside this fair value gap to take a really clean trade. 1, 2, 3. So the first entry, pretty easy to determine. Let's zoom in on this piece of price action inside the 1 hour order block and fair value gap. Here we're looking at the 5-minute time frame of that exact same schematic where you have the 1 hour fair value gap and order block sitting here. And look what's happening on the 5 minutes. This is a market maker model. Again, we have original consolidation. We have a sell side of the curve. We have a smart money reversal. Why is there a smart money reversal? Because we have a liquidity sweep. We have a structure shift. We have multiple fair value gaps. And we have a clear internal to external target. From the 1 hour fair value gap back to the old highs, the equal highs here. So then you can look for entries here and here in these fair value gaps. And then just wait until price completes the 5-minute market maker model. And this 5-minute market maker model was nothing more than this piece of price action on the 1 hour. This was the smart money reversal on the 5 minutes. This was the high. That's it. Where we went from internal to external on the daily. For context, we went from internal to external with a market maker model on the 1 hour. And on the 5 minutes, we could see multiple market maker models inside that 1 hour market maker model. That is the mini market maker model I was referring to inside the previous episode of this mentorship about market maker models. And that is how you do a top-down analysis. And this also works on the 4 hour, 15 minutes, and 1 minute, what we do with the 10 AM game. So what to remember from this episode, you have 3 buckets: the higher time frame bucket for context, the intermediate term time frame bucket for structure, and the lower time frame bucket for entries. Use the alignment table: weekly 4 hour, 15 minutes, daily 1 hour, 5 minutes, and 4 hour, 15 and 1 minute. Last one is the 10 AM game, executing on the 1 minute. Pick one protocol. Are you a day trader or a scalper? If you are a swing trader, then you can use weekly 4 hour, 15 minutes. But for this futures mentorship, we focus on scalping and day trading. Because for most futures pro firms, you need to close your trades by the end of the day. And what if the buckets don't align? If there's not a clear structure, very simple. Then there's nothing for you to do. Then you sit on your hands, there's no trades, and you can keep your data set, the amount of trades you take, very clean. If the trade is there, you take the trade. If the trade is not there, you don't take the trade. And there you have it, layer 11 of the technicals part of the trader pyramid. If you get value from this video, make sure you like it, share it with a trading friend, and make sure you subscribe to not miss out on any of the other 35 episodes here in this futures mentorship. PDF with the slides and the frameworks are inside the description and also inside the Discord together with hours of other free education. So make sure you check it out right now in the description. Thank you for watching, and I see you in the next one. This is a market maker model, and this is how to use it to determine your daily bias every single day. In this video, I'm going to show you what a market maker model is, the elements of a market maker model, and how you can start using it in your trading as soon as today. We are at episode 10 of the trader pyramid in the technicals layer. No time to waste. Let's go. Both in the daily bias episode and the liquidity episode, I told you that price only does 2 things. It goes to external range liquidity, old highs and lows, and it goes to internal range liquidity, imbalances, fair value gaps, and order blocks inside the range. So every trade just goes from internal to external, from a fair value gap to an old high, or from external to internal, from an old high or low to a fair value gap. And there's exactly where the market maker model comes in. Because let's say you have an old high and you have an old fair value gap. And you know from the liquidity concepts that price goes from internal to external. That is the order. Or from external to internal. But let's say, for this example, we go from internal to external. How price delivers to that is first we have some form of accumulation, some consolidation. Then it goes towards the fair value gap, is the key level. Inside that key level, we expect a reaction because it's going to start internal to external. We see a displacement move, leaving fair value gaps on the lower time frame. And then it starts moving towards the high, and then we go from internal to external. This is the base schematic, how we go from internal to external. But we need to address some elements here, because here's an element, there's elements here, there's elements there. Let's dive into that right now. Because here's the same market maker model, but then on a real chart. And we go from internal to external. First step is there needs to be some form of original consolidation. That's also going to be the target when we come back later back to the highs. That'll leave that clean equal high, the external range liquidity. After the consolidation, we start trading lower towards the higher time frame key level. And higher time frame, I mean 4 hour, daily, weekly. More on that in the time frame alignment video later in this mentorship. And the sell-off into the key level is called the sell side of the curve. And once we reach that higher time frame key level, then you can see the elements of a trade setup again. We have a liquidity sweep, we have a displacement with a market structure shift, we have fair value gaps, and then we trade towards the target. That's the old high. And the move upwards, it's called the buy side of the curve. But let's zoom in more in this price action. Why does the reversal happen and how does the reversal happen? And the name for this in a market maker model is the smart money reversal. And I'll give you 3 confirmations. The first confirmation is the key level. You need aggressive sells and aggressive buys, V-shaped recovery basically, inside a higher time frame PD array. For value gap, order block, hold low. If we zoom in on this price action, we see that we have aggressive sells and aggressive buys. We have an inversion for value gap sitting here. We have a fair value gap sitting here. We have a market structure shift sitting here. There's a clean reaction after liquidity sweep inside the key level. After the key level, structure shifts, the last swing high that made the low is broken. And if there is no liquidity sweep, also check there's maybe an SMT with a correlated pair. For NASDAQ, it's ES. For gold, it's silver. For Bitcoin, it's Ethereum. For euro dollar, it's GBP US dollar. So when you see reaction from a key level, aggressive sells, aggressive buys, with a structure shift, with the liquidity sweep or SMT, you have a valid smart money reversal on your hand. And you can assume the price is now starting the buy side of the curve towards the old highs. And let's go deeper into this market maker model. Because let's say this is a 4-hour chart or a 1-hour chart. We don't take our entries on the 1 and the 4 hour, right? We take our entries on the 1 minute, maybe the 5 minutes, at max the 15 minute. How can we use then a 1 and 4 hour market maker model in our advantage? Because let's say this is a 4-hour chart and this is a 4 hour for value gap. This is a 4 hour for value gap. Inside those 4 hour for value gap, all we do is find mini market maker models. So in this piece of price action where we see that wick, I zoom in on this as well. Inside that wick, if we then zoom in on the 1 and 5 minutes, we're going to find the exact same schematic, but then on the 1 and 5 minutes in this wick. It's a mini market maker model. Same here. If we have this candle, we zoom in on that candle on the lower time frame, we're going to see exactly that schematic. We have old highs here. That's the original consolidation. And we have the sell side of the curve and the buy side of the curve. And same in the third entry. In this piece of price action, we have an old high sitting here, sell side of the curve, buy side of the curve, all on the lower time frame. And this is called that price is fractal. What happens on the higher time frame also happens on the lower time frame. So inside higher time frame market maker models, you can find mini market maker models when price trades into those higher time frame key levels. And here's another example where price has an original consolidation, sell side of the curve, leaving failure swings, low resistance liquidity. If you remember the liquidity video, low resistance liquidity, creating high resistance liquidity. Then we have the smart money reversal, structure shift, fair value gap, order block. And inside these areas, the fair value gap here, but also the fair value gap here, there you can find mini market maker models on the lower time frame. And it all comes down by just remembering internal range liquidity and external range liquidity. We go from internal to external. So the key takeaways for this episode is price goes from internal to external and from external to internal. Ideally, go with the trend. So that means internal to external is always higher probability because you're trading with the trend. Remember the schematic, consolidation, sell side of the curve, reversal, buy side of the curve. You need to know the key elements of a reversal. We have a V-shaped recovery. That's aggressive sells, aggressive buys, or aggressive buys, aggressive sells. In a key level, there needs to be a structure shift, a liquidity sweep, or an SMT. And most of the time in a market maker model, there's 2 or 3 entries. Price never goes to the target in one go. There's always 1, 2, or 3 entries inside a market maker model. which also helps if you have FOMO, because the market will give you another opportunity. And there you have it, the 10th layer in the technicals part of the trader pyramid. If you got value from this video, make sure you like, share it with a trading friend, and make sure you're subscribed to the channel with the notification bell on to not miss out on any of the 35 episodes here on this futures mentorship. PDF with the slides and the frameworks are inside the description, also in the Discord, together with hours of free education. So make sure you check it out. The link's in the description. Thanks for watching, and I'll see you in the next one. This is an order block, and these are all the mistakes and secrets no one is talking about to trade high probability order blocks. And in this video, I'm going to show you how to identify the key levels of an order block, how to take winning trades on them on NASDAQ, gold, and the Forex pairs, and the biggest mistakes and secrets trading order blocks you will only find in most paid courses. Basically, just take better trades so you can get more funding and make more money. So no time to waste. Let's get into the video. If you clicked on this video, you most likely already know what an order block is. But to refresh your memory in the next 20 seconds, the order block is the last down close candle in a bullish example before the up move. And to go a little bit deeper into that, an order block are candles where smart money buys or sells to get into the market. Smart money buys at key levels that allow them to accumulate for long positions or distribute for short positions without having a big impact on price. That's why you see that there's big bodies before the real move. How we are using them as institutional reference points that price is likely to revisit before continuing its intended price direction. So with ICT trading in general, before you want an up move, you want to see first a manipulation move downwards before the up move. And the down move, the manipulation move, there is where you find the order block. So to give you the complete definition for a bullish order block, it's the lowest series of down close candles before a move higher. So if there's one candle, it's just one. If there's two, it's a series of down close candles. And bonus points is when an order block is formed at a key level. And a key level in a long example is a discount array. A discount array is an old low, a bullish fair value gap, bullish order block, bullish breaker, discount levels. And when can a bullish order block be used? A bullish order block can be used when the candle closes above the opening of the lowest down close candle. So we need to take our eyes to here. This is the open of the down close candle. If we trade over that, ideally over the high, we do it right here with this candle. There is where the order block is formed. Don't make the mistake, and we're going to talk about more mistakes in this video. Don't make the mistake to thinking the order block is formed when price is just somewhere here. No, it needs to close over it. Same as you can see in this example. There's a liquidity sweep, then there's a market structure shift, and there's a series of down close candles, a manipulation move before the move upwards. The order block is formed when we trade over the down close candles. So ideally it's this candle. See here, there's another down close candle right here. It's created here. And see that the order blocks here are forming pretty nicely in this structure. Down close candles before the move higher. Bearish order block, vice versa. It's the highest series of up close candles before the move lower. And bonus points if it's in a premium level. That means an old high, bearish fair value gap, bearish order block, bearish breaker. If you're not sure what PD arrays are, premium and discount levels, I have a dedicated video here on this channel on PD arrays. And when it can be used, once we have that candle close below the order block. So in this candle, the order block is formed. And you can see that in this example where we have a liquidity sweep, then we displace lower, leaving a series of up close candles. Before the move down, the manipulation move before we're going down. And there's the order block. And you see once we trade lower, so this candle creates the order block. And then you see the price comes back to the order block, of course, also overlapping with a fair value gap before continuing the down move. And this is an actual trade I took live on YouTube. Cool. Now you know what an order block is. Let's talk about the key levels of an order block. If you have a series of up close candles, we have the body low, basically the start of the order block. And we have the mean threshold. That's the 50% of the order block. Just like for the fair value gap, the 50% is called a consequent encroachment. The 50% of an order block is called a mean threshold. Fancy terms, it's just the 50%, the midpoint. And if you have one candle, the mean threshold is not the 50% of that area, but the 50% of the candle. So let's say only this green candle is the order block, then the 50% of the body is the order block then. But if you have a series of candles, mark it out from high to low, and put the 50%. And why the mean threshold? Why do we have these levels? If we expect price to trade into it before moving away. Sometimes that's the body low, sometimes that's the wick, sometimes that's the mean threshold. I'm going to share later in this video that we're going to use this mean threshold to also see if the order block is still valid or not, if it's not going to hold or not. So don't be confused when there's just one single candle, just use the 50% of the body. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. And now the million-dollar question. Do you mark out the wick or the body? This is a question I get them at DMs so many times when talking about order blocks, and it depends. And I want to give you two frameworks for this. The first is the size of the wick. So if there is a small wick in the order block, then you can use the body. When there's a big wick, use the low of the 50% of the wick. And then it's the question, okay, big and small is quite relative, quite subjective. And how you can use it is look at how the wick is compared to the body of the candle. So if the wick is more than 25% of the body size, then I would call it big. So in this case, the wick here is more than 25% of the body of the candle. Cool. So then we know the wick is big. And with a big wick, we use the low or the consequent encroachment. So the consequent is the 50% of this wick. So the order block area where I'm expecting price to move away from is from here. That's the area I would mark out when there is a bigger wick. If there's not a bigger wick, let's say it's a very small wick, then I want to use the start of the body right here. And of course, the mean threshold, the 50%. And in general, I said here, I favor to just use the body. So just use this one. But price does not always come back to that, which is fine because you have just different levels of an order block where you expect price to move away from. And you just wait for price to trade into it and then trade lower and react. The second thing you can use to see if you can determine a wick or body is if there's an overlapping fair value gap. Because when there's a fair value gap just before an order block, you see it in this example, there's a fair value gap right here, the yellow box. And there's an order block sitting right here, the series of down close candles before the real move. Then you can use the wick of the body. And again, the body is marked out here and the wick is marked out here. So the little area here where price can move away from. And when there's an overlapping fair value gap, just expect price to come back to the wick. It can trade deeper, but it needs to move away from it right there. And for entry purposes, we're going to talk about it later in this video. I'm rarely in blindly here. I'm waiting for this reaction to form. So when you see a rejection, it's called like a rejection candle because there's a big wick, small body. Most of the time, I'm waiting for a swing low to form right here, or I'm just waiting for the reaction, and then I'm going to take my entry in this candle, then with my stop loss below this low. So do you use the wick or the body? Look at the size of the wick compared to the body, and look if there's overlapping fair value gaps. Use those two frameworks to see where the order block is most likely to react from. It's never 100%, so just mark out both and just see how price reacts from it. Both is good. And let's talk about how to find high probability order blocks. And I'm going to give you a little checklist here. I know you love checklists, so let's dive into that. The first thing for a high probability order block is a move into a higher time frame discount array. This is a bullish order block example. If you talk about a bearish order block example, it's a premium array. And most of the time, that's an old low where price trades into a daily low, 4-hour low, 1-hour low, or a higher time frame fair value gap. Then price takes sell side liquidity, does it right here, takes some low before displacing higher. If you're not sure what displacement is, it's a fancy term for just a big energetic one-sided move. And you see that right here. So one is we trade into a discount array after sweeping liquidity. And then we see all these green candles coming in, all these green candles. That is displacement, one-sided energetic move. And 9 times out of 10, a displacement candle, a big energetic move, leave behind a fair value gap. So use them together. When you talk about displacement, you need to see a fair value gap. When I don't see a fair value gap, and you hear me talking about this on the live streams as well, when there's displacement without a fair value gap, for me, it's not a displacement. I want to see that 3 candle pattern. If you're not sure what a fair value gap is, on the channel, I made a fair value gap secrets video. Make sure you check it out after this video. And here we have the scenario where there's an order block created right here. When is the order block created? With this candle. Why with this candle? Remember when an order block is created? When we close over the down close candle. And we do that here. There's order block created and a fair value gap created. And then step 3, we get a clear close above the high of the last down close candle. Cool. We have that. And entry can be taken in the overlapping order block and fair value gap. So if we mark out those levels we had before, we could take it at the wick, we can take it at the body, and we can take it at the mean threshold. Well, there's a series of down close candles. So then you have from the low till the high. We already marked out the high. There the 50% from. So probably somewhere around here. And I think it's pretty nice. The picture is pretty nice here. So here you see that it reacts from the 50% level of the fair value gap, the mean threshold. And your entry can already be taken from the body, because from the fair value gap here, there's an overlapping fair value gap and order block. And then you have a little bit of drawdown here, and then put your stop loss just below the low, and you should be good to take a nice trade. Okay, so now most courses stop. They explain to you the order block, they explain to you the mean threshold, the levels you can move away from. But as you know by now, if you're trading even for a couple of weeks or a couple of months, you know that there's way more to these PD arrays than it seems. Like all these things are too simplified. Of course, we can mark out these levels, but there are so many nuances. You need to know when trading order blocks. So next up, we're going over the biggest mistakes I see my students make trading order blocks. So yes, you know the basics, but let's build on those foundations to make it more advanced. So you know the ins and outs of order blocks after you finish this video. So take out your notepad and let's go. The first mistake is I know what an order block is, but I can't find them in real time. So you've watched 10 order block videos. You can identify an order block on a marked up chart, but then when you open NASDAQ at the New York Open and you try to find the order blocks, you don't know where to start. And then most traders just mark out everything they think is an order block and they are too confused and overwhelmed. Let's fix that right now. Here we're looking at gold at the 4-hour chart. And what I'm now going to show you on the 4-hour chart also works on the 1 minute to 5 minute. Price is fractal. It's all the same. I trade mainly NASDAQ, the futures, but you can also use futures on gold. And you can also use futures on the dollar pairs. Let's now talk about this example on gold. So we know from an order block, if we have a bullish example, that is a series of down close candles before the move upwards. Let's start here. So we have a series of down close candles, this one. And is this already an order block right here when we are here? Let's put up the replay button. There we go. This is not an order block yet. Why? Because there's no candle close over the down close candles. Cool. Then we wait. Here, I would say here is now a candle close above the down close candle. So now I'm going to mark it out as an order block. I'm going to use the body for starters. And what more do we have? I also see an overlapping fair value gap being created right now, which is awesome. Then the question I get asked a lot, but what about this candle? This is also a down close candle before the move upwards. And I see some traders marking this out as an order block. I don't mark it out as well because then my charts get too crowded. What I use is, okay, I see this down close candle, but it is inside the already bigger order block. So it's like a smaller order block inside the bigger order block. I know some traders explain this differently, but trust me, it doesn't really matter. Because if you have this area marked out, we have an overlapping fair value gap and order block. So somewhere in this area, we can expect price to move away from. And here comes the cool part. If you remember what price is fractal, this is a 4-hour chart. So this is a 4-hour order block and a 4-hour fair value gap. That means once price trades into here, and you expect a reaction higher because that's what we do with an order block and a fair value gap, you can drop to the lower time frame, to the 1 minute, 5 minute, and the 50 minute to find your entries. Then price trades into this and trades higher. So you see where it comes back to? Overlapping fair value gap and order block. And inside this candle, you can find lower time frame entries to the upside. Cool. Now we have a down close candle that trades to a fair value gap and moves away. Once we trade over this candle, this becomes also an order block. We know when there is a massive wick compared to the body, we ideally mark out the wick. So we have this area, the wick, but we also mark out the body. So this is the area of the order block where we expect price to move away from later. Cool. And see where price comes back to. Comes back to that exact area of the order block and moves away. And let's do this more. You have a series of down close candles. They're small bodies, big wicks, before another move upwards. It's called a displacement move, leaving a fair value gap. Series of down close candle is an order block. When there's big wicks, you mark out the wicks or the 50%. I think with these candles, it's pretty hard to give like an actual precise like 50% of the wick because we have just 3 down close candles with massive wicks, small bodies. When I see this, I'm just like, okay, cool. This is an order block area. There is a fair value gap area. So I'm just expecting in this area as the overlapping fair value gap and order block for price to move away. And it does here. Cool. Now we have a series of down close candles, trades to a fair value gap. We trade over that right here. So here the order block created, and also with the displacement candle is a fair value gap created. So Here again, overlapping fair value gap and order block. Series of down close candles. I use lines. So you can also use boxes for this, but I use boxes for fair value gaps. And if I do also a box for the order block, you see how ugly my chart now becomes. I like to use lines because of that, because I like it a very clean chart. It's better for my eyes. But this is what I see. This is the order block area from the low of this candle to the high of this candle. And there's a 50% of that level is right here. So let's remove this. So this green line is the 50% level. It's the bottom of the value gap. We also have the body. So somewhere in this area is where I'm expecting price to move away from. And unfortunately, we cannot look here because it's a live chart. So that means on this trading day where I'm now recording the video, I'm probably going to wait for price to come back. I see a fair value gap here and a fair value gap here and an order block. So I'm going to wait for price to come back here. And then I'm sitting on the lower time frame to take longs back to the high again. This is how you mark out order blocks. So if you're starting by just looking for order blocks, you're starting at the wrong place. Just look where liquidity was taken first and then wait for displacement candles. There is where the order blocks are formed. The order block will just reveal itself. It's a down move before a big energetic move, or it's an up move before a big energetic move down. The order block will reveal itself. Don't force it. If you want to find them, look for liquidity sweeps or where price rebalances back into a fair value gap. The second mistake I see my students make is they say, I enter at the order block and get stopped out, and then price reverses perfectly from where I got stopped. So there's an execution issue here. So here we look at NASDAQ at the 15-minute time frame. This is what I see so many traders do wrong, so please pay attention. Here we have a very clear trade idea. It's on a Monday, and there's a Sunday low still open. That's always a nice draw on liquidity. Before the New York Open, this massive down close candle is the New York Open. And before that, at 7, we had a massive sweep of liquidity right here. Big wick. So this is the series of up close candles before the big energetic move downwards. So the second we closed below here, the order block was formed. The order block was formed right here, a bearish order block. That's a series of up close candles before the move down. Some traders might argue that this series of up close candle is the order block, but I disagree with that because I'm looking at the highest point of that move. This was the highest point of the move. We didn't go higher here, so I mark out this as the order block. If you want to use the area with the box, it's like this. So then we have multiple levels we can trade away from the start of the bodies, or the 50%, that is somewhere around here. So those are the levels I'm expecting price to move away from. Do we have something more? Yes, we do, because we have an overlapping fair value gap. And the mistake that traders make is they just blindly enter in the order block here, and they want to target, for example, the Sunday low in this example. And then they try to be fancy right here. And then price comes back to the order block, but not at the start, but it just goes a little bit deeper into the order block and then moves. This is the mistake I see traders make. So how can we fix this? Let me show you. This is a 15-minute time frame. What I like to do in 15-minute time frames, similar for 1 hour, 4 hour, whatever higher time frame, I just go deeper into the time frames. So when, for example, here on the 15-minute, I might want to drop to the 1 minute to see, do we see a reaction from it? Because I don't want to just guess to see if we're gonna hold or not. Like, I'm expecting price to do this, but what if it doesn't? Like, I don't want to be like blind in the trade and hope for the best. I want to wait for this reaction to form and then somewhere be in here. Entry here, and then my stop loss above that high and trade it here. So let me show you what I did on this exact day to show you how you can fix this mistake. So here we have the 1 minute, and here's the 15-minute order block, the fair value gap, and the mean threshold. We wait for price to come back to the area. So here we see we come back here. But before we do, if you are in 1 minute and you see this happening, you're like, oh, we're probably going higher. So I don't want to blindly go in. I want to see, do we move away from it? And I would say this is a nice reaction, right? See a rejection. And we see displacement lower, fair value gaps being formed right here. So that's nice. Let's see, do we tap into it? No, not for now. Do we get tapped into it here? We do, but we don't move away yet. And I was trading this myself. I remember this. I took already a short here. So I got stopped out on this first move, but I got a second bullet in. Let me show you why. But if you see this happening right now, the Sunday low is still open. The 50-minute bearish order block, zooming out, this is how the 50-minute looks like. Yes, this is a little bit choppy. If you know the 10 EM game, my favorite entry model, this is the 10 EM game. So we have 2 taps into the fair value gap and order block, the overlapping part. And now I want to see how we move away from that towards Sunday low. Just waiting for reaction. And this looks like a reaction to me. What do you think? So here we are not on the 1 minute, but on 5 minutes. Again, the time frame doesn't really matter. Just zoom in time frames and see if you can find an entry. But I think this is a very nice trade idea. We have fair value gap, stop above the high. to Sunday low. This is a trade I took for 1225. We are at the 5 minutes. This is the order block for value gap and the mean threshold of the 50 minutes. And let's see what we do. And price goes to Sunday low. Just using a 50-minute order block overlapping with fair value gap to a obvious drawn liquidity. And I know many traders who blew their account in this move because they were just trying to be fancy. But the goal is to wait for lower time frame reaction, lower time frame structure. In this case, I took 2 trades. So I was in on this trade here. So ironically, I made this mistake myself. Like I was a little too fancy. So I got stopped out somewhere here. I got stopped out by this wick. But either way, if you know the secret and you know the mistake you can make, I think this is a pretty nice framework to use yourself right now. So the order block area isn't your entry signal. The reaction inside that area, inside that box, that is your signal. And one extra confirmation step is the difference between getting stopped out or getting filled at the perfect level and we see this price going to the target. So wait for a reaction inside the order block on our lower time frame. And it can just be one time frame below it. The third mistake I see traders make is they say, I'm trading valid order blocks, but fighting the trend and losing. Because if the order flow is very bearish, but you try to find trades inside these up close candles here, this is a higher time frame chart. I see traders try to catch longs here, try to catch the bullish fair value gaps, but of course also the bullish order blocks and hope for the best. But keep in mind, in higher time frame bearish order flow, the bullish order blocks on the lower time frame inside these candles are less likely to hold because the higher time frame just wants to trade lower. So your setup can look perfectly on the lower time frame with the bullish order blocks and maybe the overlapping fair value gaps, the whole checklist of a high probability entry model. But if the higher time frame is against you, those models will most likely still fail. So if you see you get stopped out or your setup looks perfectly, but you're just getting stopped out, keep in mind that you most likely not trade with the higher time frame trend. So a valid order block in the wrong context is a technically justified trade, but always ask yourself, where is price being delivered? Like where does price want to go before you ask, where's being rejected? And just a simple fix, if you see price on the higher time frame going higher, try to catch longs with bullish order blocks. If you see the higher time frame going lower, try to catch shorts with bearish order blocks. Don't overcomplicate things. And the fourth mistake and question I get is I cannot tell if the order block is broken or still valid. And for that, I want to take you back to the example on gold. We were marking out with the overlapping fair value gaps and the order blocks. And there's 2 rules you need to apply here. One rule is if the order block is touched already, it is less likely to hold. The second one is see how the candle closes inside the order block. And keep in mind that the mean threshold is the key there. So when I looking at, for example, the order block right here, the mean threshold of this order block is the 50% of this level, like this, the red line. Does this candle or the retracement here into the order block, does this go below the mean threshold? Do we see a candle close below the mean threshold? Do we see the candle closing right here? Of course, it needs to be a bearish candle, but we don't see that. There is no candle close below. So this is still holding. How many times did the order block get tapped? 1, maybe 2 times. So in this case, I see it's not being tapped yet, so it's good. If you then look at this example, we have an order block resting right here. It's a series of down close candles that rebalances this fair value gap, and it gets tapped here already before moving higher, making it weaker. Also here, there is a fair value gap we moved away from. And once we then come back, because it's already been tapped, this area, you call this area has already been mitigated. If you see that happening, so price already used it to trade higher from. Once we then come back to that area, it is less likely to hold. And you see that happening right here. So order blocks are not magnets that work forever. Like see them as fuel tanks. The first time price hits it, the tank is full. But after that, every time it touches, the tank becomes more empty. And most of the time after 1 or 2 touches and it's already moved away, it's already been used, just consider it mitigated. So it's already been used. It's probably not going to hold anymore. And we're now going to just break it. And if you've seen the fair value gap secrets video, fair value gaps work in the exact same way. If the value gaps are already being used, it's most likely not going to hold when it comes back to it. Cool. And now you're like, but is there also a nice indicator for this? Do I need to mark out those order blocks myself? And of course not. There are hundreds of indicators on TradingView. And I was looking into the order block indicators, and this one was the nicest one. It's called volumized order blocks. So let me show you on the chart. So if you go to indicator and type in order blocks from Flux charts is this one. If you then go to the settings, double click on it or go to the settings. Do you want volumes in it? I don't want volumes in it. Let's go to a live chart. So here you see it marks it out for you. So there's here a series of down close candles before the real move. And it marks it out. And I see this indicator uses only the last candle, not the series of down close candles. So there's a little deviation there. So you can tweak this inside the settings. Also, the order block we marked out for our short idea earlier. Use these indicators to train yourself. But I think if you've seen this video, you don't need this indicator, to be honest. I think indicators are for lazy people, so I would not recommend using them. But if you want like this on your chart and you want to make it very messy, have fun. I don't believe in having indicators on your chart like this, because you know if there's a liquidity sweep like this, they're a big move away. You know by now that the last series of down close candles before the real move is the order block. No need to have like all those different colors on your chart. So use it maybe for 5 minutes and never move it again. And what sucks is when I look at other order block videos, I see everyone promoting their indicator and selling their indicator for money. And I'm like, you don't need that to make money. So save your money, use it to train your eyes, but I don't think you need it. Just use this video, go to the chart and mark out some order blocks. If you have questions, go to the Discord and just send a screenshot of the order block. Hey, is this a valid order block? And I will say yes, because of this, or no, because of that. Link to the Discord, by the way, is inside the description. And yes, it's free. And now you know all the mistakes I see my students make trading order blocks, all different nuances. Let me share the 3 biggest secrets I see nobody talk about. And these secrets will make sure that you know what an order block is, you know the mistakes, but how can you actually use them to take the best trades possible? Because at the end of the day, you want to learn order blocks to take better trades and make more money. So let's fix that right now. The first secret is that not all order blocks are created equal. And there's like a ranking system here. And I want to give you 4 different levels, 4 tiers. The tier 1 is like, mwah, like perfect, A+ setup. And that's an order block that has been formed after a liquidity sweep, after a market structure shift, inside a kill zone. If you're not sure what a kill zone are, there are different trade sessions. There's a video on this channel called Kill Zone Secrets, where I explain how to trade the Asian session, London session, New York session, and an overlapping fair value gap. If you see those core 4 inside an order block, it's a very good setup. That's why it's called an A+ setup. A B setup is when it's order block with only 2 or 3 conditions. C setup is order block with 1 condition only, and a D setup is when there's just no condition. There's just a random order block, a random down close candle before an up move, or not even an up move. It's just not good enough. If you know this, you know, okay, I can mark out this order block as a high probability order block. And the less of these confluences are present together with your order block, the less likely is that your order block will hold. So you don't need more order blocks. You need like a grading system. Try to focus on the A+ trades only. So with all the confluences ready, sometimes you can take in a B setup, but let it be like a small percentage of your trades, but never force yourself to take C and D setups, where there's just a random condition. You see a random liquidity sweep, and then you're like, okay, this should be a liquidity sweep. Let's just trade it. Not worth it. Wait for A+ setups. The second secret, and it's now not a secret anymore because you've already seen it a few times in this video, use the overlapping order block and fair value gap combination. That is so nice. I want to take you back to the gold example we've been discussing throughout this video. And I want to take you through a real trade I took the day before this recording using this exact logic. So back to the 4-hour time frame. The trade was taken on a Tuesday. So that's right here in this candle. And we see that we have the order block sitting here, the down close candles right here in this area. And we have the overlapping fair value gap on the 4-hour. Amazing. Let's do a top-down analysis. I know many traders love to do a top-down analysis. I do too. So on the 4-hour, let's see what we have on the 1-hour. On the 1-hour, there is a 1-hour fair value gap sitting here. Cool. What else is here? There is a down close candle before the real move. So also a 1-hour order block sitting here. Order block 1. Go to the 50-minute time frame, and you see the same order block sitting in this area. Is the last down close candle before the real move. It's the liquidity sweep. Remember the A+ grading system, liquidity sweep, market structure shift, overlapping fair value gaps, and order block. That's like your A+ setup. Let's focus on that. So cool. Based on that, we had one of the conditions was a kill zone during London or New York kill zone. What do we have here? We have this rebalance here at 6:30 between London and New York kill zone. And after that, we need to focus on the New York kill zone right here. So here at 9 a.m., here is where we need to pay attention because price is fractal. So inside that area of the overlapping 4-hour order block, 1-hour order block, and 1-hour fair value gap, there we made a low. So we had a liquidity sweep. It's all fractal. Liquidity sweep. There's a structure shift. So this is on the 50-minute the order block. Mark it out. So now we have different levels where price can move away from. Can be this fair value gap, can be this order block, can be the 50% of this order block. So here I'm just waiting for where do we move higher from. So ideally, I'm expecting price to come back to the order block, right? Because it's a high probability order block. Remember, liquidity sweep, market structure shift, fair value gap. And before we also had down close candles. So you can even say this whole series of down close candles in order block. But for now, let's just make it simple. And let's just wait. Where do we react from? Cool. So here, you're like, oh no, I missed the move. Why did price not come back to the order block? Because order blocks are just a confluence. It will never have a 100% hit rate. So in this example, price did not come back to this order block. It moved away before. Does that mean we're going to cry now and sit in a corner and not take any trades anymore? Of course not. Why? Because now we have a series of down close candles that trade into a fair value gap, making this an order block, overlapping with a fair value gap. Here is where I took my trade during the 10 a.m. game. As you guys know, 10 a.m. game, where you, after 10 a.m., you trade a very nice setup. I'm not going to explain 10 a.m. game in this video. There's on this channel, there's a 10 a.m. game checklist. Make sure you check it out because this is literally using order blocks, overlapping with fair value gaps, with the concept and the secret and the mistakes I discussed in this video all together in a trade. Because right here, when price came back into the wick here, into this area, I was like, okay, we're probably going high. So in this candle, I took the trade. Where was the target? If you zoom out here, what is the most obvious swing high that we can reach? The most recent one is this high. That's the first one that's coming up. Like this, you can put your stop below the fair value gap or below the low. Let's say you want the 1 to 2. And your entry does not need to be perfect. So let's say you just put it in like this, 1 to 2. Zooming out, with the order block, fair value gap, market structure shift in this structure. So the whole A+ setup grade system is there as well. But this was during the Asia session. I don't trade the Asian session. But then it happened again right here, where there's a liquidity sweep, a market structure shift, order block creation, and a fair value gap creation. We didn't come back to the order block, but we moved away from it. And then we have a new order block sitting here. This is enough for me to press the button. And then I don't care, to be honest. I moved away from being the sniper entry guy who has like the perfect 2-tick entry. I just want to make a lot of money. And so I let my stop loss be able for price to maybe come back here or back here, because officially this is the low before the up move. So that means these two candles are the order block right here. So my stop loss is below the mean threshold of the order block. That's the official order block. But again, I don't want to be perfect. I just want to make money. So I got in and price chilled around for a bit. And now in hindsight, this looks very nice, but this is like an hour of trading. And then price went to the target. All using, zooming out, all using higher probability order blocks with the framework overlapping for value gaps and order blocks. So the secret here is you find the liquidity pool first. Like, what can we sweep? And liquidity pools are very simple. You have two. One liquidity pool is called internal range liquidity. It's a fancy word for fair value gaps. The other liquidity pool is external range liquidity, the second one. And it's a fancy term for old highs and lows. So find the liquidity pools first. That is what we did on the chart, where we looked for where old lows, where we can sweep, or where can we rebalance to. And we saw on gold the 1 to 4 hour fair value gaps. And if you have that, the order block is always nearby, very close. And the sweep of liquidity tells you where smart money just moved. And then the order block tells you where they moved from. Because if you have an order block and a fair value gap in the same level, both are institutional reference points. So smart money is both in the order block and in a displacement move leaving the fair value gap. That is the reason why the fair value gap and order block together are so powerful, is the signature in price that the big money is present there. So the big money got a big order sitting there. And if we want to make money, we want to be on the same side of the big money because they move the market. That's where the easiest money is. And the final secret is about the indicator. I shared this before in this video, but the indicator shows you where. It shows you like cool boxes, but it cannot tell you when or why. If you go to this same example and you put that order block thing on your chart here on the 50 minutes, it marks out the order blocks for you. You see that order block we marked out here. Perfect. It did the same right here. Well, it was a little more precise than I was. That's true, because look at this. I made a mistake here because this is the last down close candle before the low. So it did better than me. Awesome. But either way, now you see this on your chart. If you zoom out, look at this. Like your whole the whole chart look like this now. When I was not a profitable trader and I had a few indicators on my chart, it just looks like this. This looks like a children's color book. Super overwhelming. It tells you where order blocks are. Like that's true. But when and why do you use them, right? There is where you go back to the grading system. So you have the indicator you use for spotting them. But I'm sure that if you do that for like 30 minutes now after this video, you go to the chart and find some order blocks, your eyes are already trained to just see them without the order blocks. And now you have extra context because if you use them together with a liquidity sweep, a market structure shift, inside a kill zone with overlapping fair value gaps, then you know when and why. So the indicator does the spotting for you, but you need to do the filtering. So if you're trading every box it draws, like it's like a children's color book, you are outsourcing your judgment to an algorithm that has no idea what session it is, where liquidity is resting, and where your actually high probability order blocks are forming. So don't be lazy. Use at the start, but then transition to just training your eyes to find them yourself. And now you know what an order block is, the key levels, the biggest mistakes, and the secrets. This is everything you need to know to start trading order blocks. If you got value out of this video, make sure to check out the video that's now appearing on the screen, because using these order block secrets together with the fair value gap secrets, you have two superpowers so you can take more winning trades. If you enjoyed this video, make sure you press the like button and the subscribe button so I can just keep feeding you with more free education. And of course, comment your biggest takeaway of this video down in the comments. Thank you for watching, and I see you in the next one.
Most NASDAQ traders are now on the 1 minute, stressing over few points, stressed out and getting chopped up by the noise. This is gambling. And this video, I want to show you why I only care about the story the daily candle is telling me. Not indicators, not news, not 100 PD arrays. And I make over $10,000 per month doing this. So we're going to speedrun this in 3 simple steps. In step 1, I'm going to show you how to create a daily bias on using one candle so you can understand where and when the probabilities are on your side. In step 2, we're going over 3 different types of days you can encounter and how to anticipate them to make the most amount of money. And in step 3, we're going over how to use this to actually execute trades, get funded, and get payouts. Let's get into it. When I was $60,000 in debt, digging myself out of a hole, my biggest problem was not the strategy. I knew what a fair value gap was. I knew what an order block was. But my problem was blindness. I was obsessed with this 1 minute chart. I thought because I was trading futures, for example, here on ES on the 1 minute, I needed to be a scalper. I thought I needed to be fast. So the market would open at 9:30. And I would just look for the first structure I could find. I would find here inversion fair value gap, this disrespect. And at the candle close, there was already my entry to trade lower. Stop above the high for a 1 to 2. My monkey brain would now be, okay, let's go. We're going to retrace all this money towards the lows. When I would take my trade and price almost to my TP, and then I see a V-shaped recovery. And then eventually, after hoping and praying and feeling very bad, I will just be stopped out again. The thing is, I was selling the bottom. If I just zoomed out, if I just looked at the daily chart, I would have seen that we are super bullish right here. So there's no need in shorting here. The best trades are longs. And that crash here on the 1 minute, it wasn't a crash. That was just manipulation. Market makers creating the low of the session so they could buy cheap before just continuing the higher time frame trend on the daily. And you're probably doing the same right now. So let me show you how to fix it. To master daily bias, you need to understand how a candle is built, because it's not random. This candle follows an exact script, and we call this the power of 3, or the AMD. It stands for accumulation, manipulation, distribution. So what you will see in a daily candle is that there's an accumulation first. This will happen mostly during the Asian session. Then there will be a manipulation lower, and the manipulation is nothing more than a fake move. So if the daily candle is most likely to be a bullish one, you will see a manipulation, a fake move the other way, so down. Ideally also in a key level, that can be an old low or a fair value gap or a order block. And after that, you will see a market structure shift or a change in state delivery. You will see a fair value gap being printed, an inversion fair value gap, and order blocks. You will see many PD arrays form in that area where the V-shaped recovery, the market structure shift, the reversal is going to start. And it starts the distribution of the move. So let's look at a bullish day. Every candle has an open, a low, a high, and a close. In a bullish candle, it opens. It also starts the accumulation. Then it will trade lower, manipulating, setting the low of the candle. Again, ideally in a key level that can be sweeping an old low, a fair value gap, or an order block. Then it starts the distribution higher, bring the high of the candle, and then when it creates the high of the candle, it closes. So where amateurs here are selling, you now know that you need to wait, and we're probably going to go higher. We're going to need to look for buys, because once the liquidity is taken below the open, algorithm steps in and you will see it with aggressive movements. And this is the speed run. Like price just rips higher, displays higher, it breaks structure, it leaves for value gaps, and this is where we want to be in the trade, holding the trade. And we just ride that momentum, we ride the expansion. I trade this setup live with my students every single morning inside my Discord, where not only there's a group of very smart traders, I share my own insights, analysis here, together with weekly outlooks, boot camps, free resources, entry models, and way more. Link towards Discord is in the description. And yes, it's free. So here's the rule. Write this down. If you are bullish on the daily, you want price to drop at the open, creating that low of the candle. You want to see red. You want to see lower prices first. You don't buy the open. You just wait for that manipulation to occur. And you will have scenarios where the market opens and just rips higher without leaving any wick. When that happens, you just wait. You don't chase, and you wait for price to create that low. And it's okay to miss a move once in a while. So we wait for that wick to form. If there's no wick, there's no trade. So once I start respecting this open, high, low, close, the anatomy of a candle, I stopped trying to catch every move. I just started waiting for the trap to form and then just ride that momentum. And that is when the consistency came together with the funding and the payouts. Now I showed you how to play an open, high, low, close with the AMD, but how do you actually anticipate price to be green on the day or black or red on the day? Why does it go up or down? You need to be able to identify what kind of daily candle is forming. And that is what I'm going to show you right now. There are only 3 types of days. Day 1 is the speed run day. If you look at these daily candles right here, we are now looking at this candle. And why this is a trending day, that is because the previous candle trades into a key level, a fair value gap, and the body of that candle is respecting the fair value gap. So on the lower time frame here in this wick, if you see my video about how to catch reversals using wicks, you already identify this. But in this wick, on the lower time frame, we have seen already that V-shaped reversal happening. So this low is protected. So if that happens, the previous candle being a rejection candle, you can anticipate that the next candle is going to be a bullish one, expanding from that level. And this candle is where I make 80% of my money. Small wick, huge body. So if yesterday closed strong and today we open and we dip a little bit, we go lower and we created AMD, I'm confident in my trade. So then you identify the open, you wait for the drop, then you wait for the aggressive sells, aggressive buys. And here comes the fun part. You can take your trade in this structure in an fair value gap, an order block, a breaker, an inversion fair value gap. It doesn't really matter because price will go up. So it doesn't matter if you're in here or here or here, you will catch the move either way. This is the easiest money you will make. The second day is the reversal day. And that is when we saw that candle inside the fair value gap. This is where the wick is formed. This happens when we sweep a major level, like a daily, weekly fair value gap or a weekly or daily low, and we reject from it. So what happens is the market opens and then we just sell off like crazy. And you're like, okay, well, we're probably never going back up again until we reach that key level. I mean, old low, came old fair value gap, and there's where the manipulation is formed. A V-shaped recovery, aggressive sells, aggressive buys back into the range. And when you see that, you need to pay attention because there's where your entries will come. And from this simple open, high, low, close and AMD is if you see price coming back into a key level and then create on the lower time frame a V-shaped recovery, aggressive sells, aggressive buys, you will most likely have a reversal on your hands. And I take this trade always. And there's where you just wait for the displacement, come back into fair value gap or block or breaker, and then catch the distribution. While the speed run day, the trending day, is where I make the most money. After that, definitely I'm always looking for higher time frame fair value gaps and old highs and lows to catch these reversal days as well. And the third kind of day is the doji day. This is where we open, we trade lower, we trade higher, and then we trade back lower, where just nothing happens. Very small body, big wicks on both sides. This is horrible. This usually happens after a massive expansion day or when a massive drawn liquidity has been hit. So for example, on NASDAQ, the previous day or previous session has like a 500-point move, you can expect the next day to be a doji day because it's probably just engineering liquidity, not doing much. And this is where the monkey brain is starting to blow accounts because you saw the big day in the previous day, maybe you missed it, or even if you caught it, you want more of that. You think, oh, let's go, I'm gonna catch another big move. And that's where so many accounts are blown. So that means after a large range day or even a large range session, you should anticipate this doji to form. So what can you do then? Go to the gym, read a book, go live outside of the charts. It's okay to skip a session. You will still still be a very good trader if you skip a session, especially if you anticipate it to be a very low probability day. In this first example, we're looking at YM on the daily chart. And the principle I'm showing here not only works on YM, but also works on ES or NASDAQ. And it's going to be the reversal profile. So here on the daily time frame, we have a massive daily bullish fair value gap sitting here. And we are bullish. We swept liquidity down here. So I'm anticipating price to make a liquidity sweep, displace, and then come back to the fair value gap. Also the series of down close candles that made the low. There's also a daily order block sitting right here in this series of down close candles. So with that in mind, during the New York Open is where I'm expecting the reversal day to come, where we open and we trade lower, making the manipulation into this level and then create a reversal from there. So now let's drop to the 1 minute time frame to see how that would look like. We're now looking at the 1 minute time frame, and just before the open here at 8:50, we already traded into the daily bullish fair value gap and order block. So you're just waiting for some reversal structure, and most of the time that happens around 9:30 in the first hour after the open. And here you see this massive candle. Like, I don't catch these candles. I just wait for a reaction. Cool. But this is, I guess we don't need to discuss about this. This is a pretty nice reaction. So what do we want to see after a reaction like this? We want to see fair value gaps being created. Say fair value gap here. There's also a fair value gap right here. I don't take my trades blindly in this. I just want to see, okay, do we trade into the fair value gap, the first PD array rule, where I'm waiting for the first PD array to be the confirmation. And if that is respected, then I will take the trade in a second PD array. So let's see, we trade into it and then we displace higher. So when we now create a fair value gap, that would be the entry right here. In this second fair value gap, I would take my entry, and this is all based on the reversal profile on the daily. Stop below this low for a 1 to 2 or 1 to 3, and price goes to TP in a few minutes. If you would have missed this trade, because we are reacting from a daily fair value gap, I'm expecting us to expand. So let's zoom out a bit. Let's see if we have clear targets. I think we do have a 1 hour bearish fair value gap here. Let's see on a 4 hour bearish fair value gap also right here. Premium and discount on this. You'll see the price as here is premium of the range. So I'm expecting price to go to premium in this session. So then there will be another trade ID in this fair value gap where you take another trade. Let's say you're late to the party. Let's say you see this happening, like, okay, now I'm going to take it at least to premium of the range or 1 to 2. You also would have had take profit and price goes to the fair value gap. So multiple trade ideas, all based, and let's go back to the daily, all based on price reacting from this daily bullish fair value gap, just like in the reversal day framework. But what if you could use this exact same framework from the daily, but then on the 4 hour time frame? And that brings us to my favorite entry model that makes me 5 figures a month, and that's the 10 a.m. game. And revolves around the 4 hour candle that starts every day around 10 a.m. Let me show you. Here we're looking at a 4 hour chart on ES. Here we're looking at yesterday's price action on ES on the 4 hour time frame. And there's a 4 hour bullish fair value gap resting right here. So what I'm expecting, like we are bullish, so I'm expecting price to open at 10 a.m., then trade into 4 hour fair value gap, and then reverse from there. That's what I do with the 10 a.m. game. I'm expecting this candle to form, where we open, we trade lower into a key level, and there's a wick created, and we reject from there higher. That's the candle I'm anticipating based on the frameworks I gave you in this video and what I also traded myself. So with this bias, let's drop to the 1 minute and see if we can find this entry on the 10 a.m. game. So at the open, it's also a nice indicator for this. It's called higher time frame power of 3. I'm waiting for price to come back into the 4 hour fair value gap, which we do right here. And from here, I'm just waiting for fair value gaps. No fair value gaps here, but here we do fair value gap 1. After that, we create fair value gap 2. There is where the entry is. Entry in the fair value gap, stop below the low for 1 to 2. These failure swings is a nice target, so you could trade towards the highs here. In the second fair value gap 1 here, and it's all based on that reversal candle we anticipating on the 4 hour. And there we go. But most importantly, look at how the 4 hour candle looks like. It's the exact rejection we were anticipating from the 4 hour bullish fair value gap. And we anticipate this candle to form. Your bias is pretty easy, because then you just wait for price to create a low in a key level of 4 hour bullish fair value gap. You try to trade the wick, and that's this exact structure with fair value gap 1 and fair value gap 2. Now let's go back at this first example on YM, where we had that reversal profile from the daily bullish fair value gap. And I want to show you how to trade the 10 a.m. game here as well. So here on Monday, I think we are still pretty bullish. We trade away from a daily bullish fair value gap. So I think on Monday, we can trade towards this high and maybe even towards this high. And when I have a bullish bias, I want price open, manipulate lower, and then trade higher. accumulation, manipulation, distribution. So now let's drop to the lower time frame on Monday during the open and see what we get there. Here we're looking at YM on a 15-minute time frame. We can drop lower to the 1 and 5 minute too. Here just before the open, we still have these highs intact. So there's going to be a draw on liquidity and we are bullish. So we're anticipating for the open price to trade lower and then higher. So let's see if there's a manipulation going on. And the manipulation ideally is taking out liquidity pools. What type of liquidity pools? I would say London liquidity is nice. Like, of course, we can take out these lows, but the liquidity pool, like a session liquidity like London is pretty nice. So let's wait until the open. It's now 9:30 almost. And at the open, immediately at 9:30, we drop lower very aggressively, taking out this low. And when this happens, your monkey brain thinks, let's sell, price going lower. But we now know, based on the frameworks we get, that this was the mistake. It was the mistake we talked about at the start of the video, where your monkey brain wants to sell and you get stopped out within a few minutes. But we know better. We know that if we have a bullish bias on the higher time frame, on the daily or the 4-hour, just wait for price to manipulate lower, taking out some liquidity, and then start trading higher. So this is a very nice V-shaped recovery, aggressive sells, aggressive buys, making these series of down close candles an order block right here. Also a breaker sitting here, and of course many for value gaps and inversion for value gaps. It doesn't really matter which PD array you use because all of them will make you the money when your bias is right. And that can be found on the higher time frame. I'm waiting for price to trade into a fair value gap, PD array 1. Let's see if we react from that. We do right here. This is PD array 2. It's PD array 1. We zoom out to the 5-minute time frame. We also see that there is a 5-minute fair value gap sitting here. So because there's a 5-minute fair value gap here, to add a nuance to the entries, I'm not going to put my stop loss below this low because I'm anticipating price to come back to the 5-minute bullish fair value gap. Because this is a very classic 5-minute structure where there's a 5-minute order block right here and a fair value gap. So ideally, I'm going to wait for price at 10 a.m. with a new 4-hour candle to open. Let's look at the new 4-hour candle. We want price to open, trade lower, and the wick of the 4-hour candle needs to be inside its 5 minutes for value gap and then trade higher. That's the bias. So we trade lower. Now let's see if there's a reaction from this. And a reaction looks like how a bearish for value gap here is disrespected, inversed. So the second it closes above it, I'm okay to take an entry. So it's not now, but right here. This is the entry. Because now, not only do we react from this 5-minute bullish fair value gap and the order block, also we potentially create the low of the 4-hour candle. There's where I take my entry. Right here, stop below the low. Right here for a 1, 2, 2. Towards the highs, yesterday's highs. And let's see what we get. And there you go. And if we then zoom out again, where this was the reversal we caught earlier in example 1. In this example, we just caught the reversal in a 4-hour bullish fair value gap. And then we just traded the next candle at the open. On the lower time frame, it looks very aggressive, very fast. But on the higher time frame, it's just a very easy reversal candle from a key level, a bullish fair value gap. So if you cannot see this open, high, low, close setup very clearly, you sit on your hands. Preserving capital is a very offensive strategy because you will have more money to play with when the actual setup occurs. If you want the exact technicals checklist I use to identify these days before they happen, together with all my entry models and my frameworks, check the link in the description for the market maker blueprint. And yes, it's free. I break it all down step by step. And if you like this video, make sure to check out the video that's now appearing on the screen, because this video will show you step by step on how to use wicks of candles to catch the best reversals and get those sniper entries. Thank you for watching, and I'll see you in the next one. Bye-bye.
This is an entry model, and these are the mistakes and secrets you need to know to skyrocket your win rate and make every entry model work. And this video, I'm going to show you everything you need to know about how to use an entry model together with time frame alignment, liquidity, confluences, the biggest mistakes I see my students make, and of course, the entry model secrets. No time to waste. Let's get into the video. An entry model is a repeatable checklist that tells you exactly when to press the buy or the sell button. It's not a gut feeling or I think the price is going up. No, it's a mechanical set of rules that you follow every single time. And before we dive into the mistakes and the secrets around entry models, I want to share my exact entry model with you. And the first step of 4 of my entry model is the liquidity sweep in a key level. A liquidity sweep when we have an old low that gets swept before the move upwards, ideally in a higher time frame key level. And a key level is an old low, an old high, a fair value gap, or an order block. And that sweep tells you that smart money is involved. They just grab the liquidity they need before a big move is coming. and we want to catch that big move. The second step is the market structure shift. And a market structure shift is after that sweep, you wait for the last swing high that made the low, that is this swing high, to be broken. And it's broken once price trades over here. So when this happens, then there is a market structure shift. And that confirms the direction. We go from bearish to bullish. And without this, I don't take any trades. So next to the liquidity sweep and the market structure shift, they have the retracement into a PD array. Because now you wait for price to come back into a fair value gap, an order block, a breaker, an inversion fair value gap, whatever of the PD arrays you like to use in your trading. An important rule here is the more confluence is present in an area, so we have an overlapping fair value gap, breaker, order block, the higher the probability the trade is going to be. I don't have a set PD array collection I trade with, but most of my winning trades have fair value gaps and order blocks in them. So price suits liquidity, then breaks structure, then in that displacement move, the energetic move, leaves behind a fair value gap. Also, there is an order block created with the market structure shift. And in this move also is an inversion fair value gap. There was an old bearish fair value gap that turns into a bullish array because it was inversed. And the fourth and final step is kill zone confirmation, time and price. Because this structure we just discussed need to form inside a kill zone. London, New York AM or New York PM. So that means in New York time needs to be between 2 and 5 for London. Needs to be at the New York Open for the New York AM session and after New York lunch in the PM session. The structure can be formed there too. Don't trade in between those. So 6 AM EST, for example, between London and New York AM is lower probability because the structure is formed outside of a kill zone. I trust that less when I take my setups. And pause the video and screenshot this. So you have the exact 4 steps. The liquidity sweep, the market structure shift, retracement into a PD array, fair value gap, order block breaker, inversion fair value gap inside a kill zone. Currently you're watching entry model secrets, but before this, there was kill zone secrets, fair value gap secrets, and order block secrets. So if you're not sure what a fair value gap, an order block, or a kill zone is, I will leave the link to those videos inside the description. So make sure you check them out after you've completed this video. And to see these 4 steps in action, I want to take you to an actual trade I took in the week before this recording. And we are at the Dow Jones YM on the 1-minute chart before the New York Open. And we are very bullish, higher time frame. So I'm expecting price to trade higher. So that means we need to have a liquidity sweep of an old low. I see an old low here and here. So at the New York Open, I just wait for aggressive sells, aggressive buys, that liquidity sweep, and then also breaking structure, leaving a potential fair value gap and order block inside the kill zone. We are in a kill zone because it's New York AM. It's 9:30 AM EST. It's a New York Open. So let's see what the price gives us. So we sweep this low, and then also we sweep the other low. All right, here, the 7 AM low. So if we zoom in this price action, what is the last swing high that swept liquidity? That is this one. So the market structure shift already happened right here. So if we put our fair value gaps here, right there, there's an order block right here. So it is already nice structure. And then price trades back into this fair value gap before going higher. So the order block sitting right here again. And price respects that order block and trades higher. Also leaving another fair value gap. If we look at the same price action, but on the 5-minute, we see the same structure happening. There's a 5-minute fair value gap open here. We trade back into that area and then create on the 5-minute another fair value gap. It doesn't really matter if you do this on the 1 or the 5 minutes. And here is where I started looking for an entry. I was looking for, do we respect this fair value gap? If we do, I want to take an entry. So if we now close above this area here, this is enough for me to take the entry because we have another order block sitting here, overlapping with a fair value gap. So there is where I can take the entry in this fair value gap. What do we have for targets? Well, there's a lot of very sexy failure swings sitting here. These equal highs for my target. It looks very sexy. I think you can also target these highs because it's all very low-hanging fruit, high probability targets. Ideally stop below a low. That's going to be this low, target the highs for I wanted to, and let's see what price gives us. And then eventually price reaches the first area and then also the second area, giving full TP. But it all starts down here with a liquidity sweep, break of structure also here on the 5-minute, the last swing high that made the low. Once that is violated, right here, you can take your entries in the fair value gaps and with a little drawdown, but eventually price goes to the target. But what if you missed that move? Let's fast forward to Thursday. This trade was taken on a Tuesday. This is on a Thursday. We are at all-time high. And right here at the London session, we swept all-time high. There's a lot to rebalance here. For example, this
1 hour fair value gap and also this low are nice rebalancing, because higher time frame, we could just do this on a higher time frame, retrace and then go back higher. So why not ping pong, first lower then higher? So let's see if we can catch a short here. We cannot take our trade outside of kill zone. It's now 8. So let's fast forward to the New York Open. That is right here at 9:30. We have a sweep of London high. So liquidity sweep. There is aggressive buys, aggressive sells. So we have a liquidity sweep. What is the last low that made that high? Was this one. So there is a liquidity sweep, a break of structure. And now we need PD arrays. There's inversion for value gap right here, a small fair value gap right here, and a massive order block sitting right here. So let's see from this area if we can see some reaction lower. We tap into the inversion for value gap, and then we start trading lower. There's already where you can take your entry, because we already react from a PD array, ideally already here, but let's say you're late to the party, stop loss above the high for 1 to 2, or we're going back to our original targets. That was the low right here, Wednesday AM, New York AM low. So are all the 4 steps present? We have a liquidity sweep, break of structure, retracement into a PD array, reaction from that inside a kill zone. All the 4 steps completed. That is why we press the button. We have an obvious target. Now let's see if we can make some money. And here is where most traders take their trade off, because they think, oh, the move has happened, and now at 10:30 we're gonna see buy structure coming in. If you've been trading for a while, you know your data, you know, have confidence in your model, you just do nothing. You set your stop loss, you set your TP, you take your entry and do nothing. So you cannot touch it anymore. So let's not touch it. And there it goes to TP for more than a 1 to 3. And now you know the 4 steps of my entry model. Let's talk about the 3 biggest mistakes I see traders make trading entry models. The first one is using other people's entry models and expect the exact same results. Because the thing is, if I'm going to give you my entry model right now and we're going to trade for 2 weeks together, you take your trades, I take my trades, you are going to have a different win rate, different results than I have. For one simple reason, we cannot press the button at the exact millisecond, at the exact same time. So that means sometimes the market moves away a couple of points. It will always be slightly different. So some weeks with the same entry model, you have a 80% win rate, I have a 50% win rate, and sometimes you have a 40% win rate and I have a 60% win rate, all using the same entry model. So instead of copying your next 90% win rate entry model, why not steal from your favorite influencers or from your favorite courses or YouTube videos? Pick what confluences you like, for example, the 4 steps I just gave you, and then make it your own. That means going to the chart, backtest and journal, build data that what you are doing with your entry model actually gives you the results you want. And it also helps with your confidence. Just like you have a lot of confidence that you can drive a car because you have thousands of data points, proof that you can drive a car, same with your trading. If you have hundreds of examples, hundreds of data points that your model works by journaling, by backtesting, you have a lot of proof that what you're doing works. And because you have proof, you become more confident. And it helps with, for example, not taking your trade off like we saw in the previous trade example. And if you want to steal my entry models, there's a playlist on this channel with my entry models, all of them. And you're gonna see that core 4, I just explained, you will see them back in all my entry models, but then with different nuances. So go to that entry model after this video. I'll leave the link inside the description, and then watch them all and find your favorite entry model and start building data on this to make it your own, get the confidence and get better results. The second mistake I see traders make is waiting for all the stars to align, for all their confluences to align. Because some entry models not only have a liquidity sweep, a market structure shift, a fair value gap and a kill zone, but they also have inversion fair value gaps, reapers, market maker models, N-box, N-dogs, CRT, some support resistance, some EMAs. And some entry models just have a checklist of 15 different confluences. And if you need to wait for all those 15 stars to align, you're going to have a very low volume of trades because there's not many occasions where all those 15 confluences come together. So the first step you need to do is reduce the amount of confluences you need to take a trade. The most healthy entry models
I've seen have between 4 and 7 confluences. I just gave you 4. That means you can add 3 of your favorites to it. And don't wait for all 7 all the time. Most decent setups from those 7 confluences have like 4 or 5 or 6 of them. Of course, if it's only one confluence, you're gonna take a B setup, don't take it. You don't always need to wait for all those 7 stars to align. 5 or 6 is already enough. And the third mistake is changing your entry model every time you are in a losing streak. And that is called strategy hopping. You think your model doesn't work anymore, so you buy a new course, watch a new model, and you keep being stuck in that cycle. But the thing is, let's say my entry models I give you have a 50% win rate. If you shoot a 1 to 2, that's pretty decent. You can make a lot of money with that. But if it has a 50% win rate, that means over the next 100 trades, you're still gonna lose 50. And even while you lose 50, you're still making money because your winning 50 trades are gonna outperform your 50 losing trades. And those 50 losing trades can come in sequences called losing streaks. So that means you can have a 10 losing streaks by doing everything right and still make money in the long run. But if you're in between that 10 losing streak, gonna buy a new course or just change your model altogether because you think it stopped working, you will never become profitable because there's no consistency in your trading. The one thing that needs to be consistent is the model you execute. So the moment you start hopping, you actually self-sabotaging your own trading. So maybe think twice for getting another entry model inside your trading. Maybe go back to your last 10 or 20 winning trades and see what's already working for you and do more of what's working. And the fourth mistake is not trading with the higher time frame trend. In this example, we have a very bullish market. We are trending upwards. But what if inside this piece of price action on the higher time frame, we think, oh yes, we're now going in a reversal. So on the lower time frame, we drop, for example, from the 1 hour time frame here to the 1 minute time frame here, and we catch the first bearish fair value gap, get our hands on. We do that, and obviously we will get stopped out because the market was super bullish. Trending higher, shorting a bullish market is not very nice. Same with longing a bearish market. It is lower probability. So your entry model does still work, but the trend is still your friend. So just take your model with the trend to make your own life very easy. And I'm really ashamed to share you this, but this is also a trade I took this week, making this mistake. So we are hyper bullish on NASDAQ. We are at all-time highs. We just went up for a few thousand points. And here we are at the New York Open. So I was trying to be fancy because I was like, going to the 4 hour time frame, I think we can rebalance at least to this 4 hour bullish fair value gap. So that was my target for a potential ping pong. First lower, then higher. That was my idea. So then during the New York Open at 9:30, I was aiming to trade back towards these lows, towards that 4 hour bullish fair value gap. So I was just waiting for the model. And you know the model by now. It's a liquidity sweep. And there was no liquidity sweep here, but there was an SMT. I'm not gonna go deeper in what SMT is, but that means if two correlated assets do not follow each other, so ES, the correlated asset, made a higher high. This made a lower high. And I was like, hey, I see SMT, I see a fair value gap. What is the last swing low that made the high? Well, the SMT, that was this low. So we have a liquidity sweep for SMT. We have a market structure shift, NPD raise. So when I saw this reaction, I took a trade right here. TP at that 4 hour fair value gap. Stop loss is high for a 1, 2, 2. And let's see what price did. It went up and up and up without any retracement. And if you want to make it even worse, look at what happened after. Like this was my target. Look at what happened in hours after. I just shorted low of the week. So please don't make this mistake too. Don't short trending markets. So now you know my 4-step entry model and you know the biggest entry model mistakes. Now it's time to look at the entry model secrets. And the first secret is going to be time frame alignment. Your entry time frame, it doesn't matter if that's the 1 minute, the 5 minute, the 50 minute, the 1 hour. It needs to be always 1 or 2 levels below your key level time frame. Let me show you. The first thing you need to know in time frame alignment is that price is fractal. What happens on the higher time frame happens the same on the lower time frame. So if we look at this example where we have a bullish fair value gap and we have a target that is this high, we are trading from internal range liquidity, a fair value gap, to external range liquidity. So what we expect on the lower time frame is a market maker model, where we first trade lower into that fair value gap and then trade higher towards that high. I have a dedicated video on market maker models here on this channel. I will leave the link to that in the description. But for now, what you need to know is that a market maker model has a sell side of the curve where we go lower, and have a buy side of the curve where we go higher. And inside a key level, you find a market structure shift, just like you saw in my entry model. Key level, liquidity sweep, market structure shifts, and then we start trading the other direction, a reversal. And once we reverse, you can see it right here, with a market structure shift, we start creating those blue boxes right here and right here. Inside these boxes, you can find actual entries in the time frames below the structure. So what I mean by that, if this is the higher time frame structure, let's say the daily or the weekly or the 4-hour, inside those blue boxes, you can find mini market maker models on lower time frames. And there's where time frame alignment comes in. So we have market maker models inside market maker models, market maker modelception. And how we can use the time frames in that, if you're a swing trader, you can use a monthly internal to value gap to external to the old high. You can use a daily structure, or you can have a weekly internal to external and use a 4-hour structure, or a daily internal to external and a 1-hour structure. If you're a day trader, for example, trading futures, what I like to use is a 4-hour internal to external. So I'm looking for that 4-hour move to happen. I use a 15-minute market maker model. And inside that 15-minute market maker model, I'm using a 1-minute mini market maker model. That's where the 10 AM game comes in. That is where the FTS model comes in. And basically all my entry models you see on this channel. And if this went too fast for you, let me explain it one more time without all the colors. This is the key level. We trade from internal range liquidity to external range liquidity, all high. This is the lower time frame structure with the liquidity sweep, with the market structure shift, with the fair value gap or the order block, and then we trade higher. Inside that lower time frame structure, in these moves, there are fair value gaps created. Where do the fair value gaps trade to? Towards old highs. That's the same move, but then the mini version. So in this move, you can have on the lower time frame the same structure. So for example, if this is a daily fair value gap, and this is a daily high, to a daily internal to external. With the time frame alignment, what I showed you right here, in a daily internal to external, we need a 1-hour structure. So this structure is the 1-hour time frame. And then we go back to the time frame alignment. In a 1-hour structure, you can have a 5-minute mini market maker model. So we go from the daily to the 1-hour structure, and inside that 1-hour structure, we find 5-minute mini market maker models. But the structure is always the same. It has those 4 components: a liquidity sweep, a market structure shift, some PD arrays inside a kill zone. And another tip here is the more time frames that align with your trade idea, the higher the probability. That means if not only the 1-minute, the 5-minute, and the 15-minute structure is bullish and you want to take longs, what if the 1-hour, the 4-hour, daily, weekly, monthly, everything is bullish? If all the time frames are bullish, your long idea is going to play out very sexy. But vice versa is also true. If the monthly, weekly, 4-hour, daily, all the time frames are bullish, and your 1 and 5-minute entry on the lower time frame are bearish, you're going to see that those setups do not play out as you want, because the time frames above that are super bullish, or the other direction is counter trend. The second secret you need to know for entry models is using the second PD array rule. And you've seen this too in the fair value gap secrets video, but here's how it works. Here we have the exact structure again, with the liquidity sweep, the market structure shift, the PD arrays inside the kill zone. Before I can tell you what the second PD array rule is, I need to explain you what the first PD array rule is. The first PD array area is this area where we had that market structure shift, the liquidity sweep, and then we have that first batch of PD arrays. It can be fair value gaps, order blocks, breakers, inversion fair value gaps, whatever you prefer. I like to use that first area as my test area to see, do we actually move away from this in the direction I want? Or we don't do that and start just trading lower. I don't like to get faked out in my moves. So what I then do is wait for the second PD array area to occur. And that means that there is a reaction from this level. And it looks exactly like this. We have a reaction from that first PD array area, and now there are new extra PD arrays created. Because with this move away from that first PD array area, there is a new order block created, there's a new fair value gap created, and that is the second PD array area. And then we can use this first PD array area as our defense. There's an extra structure created for our trade idea. And for actual executions, that looks like this. So if you want to use the second PD array rule, your entry is going to be in that second fair value gap or the second order block. And if you want to want the 3, you can put your stop loss below the first PD array areas low. If you want to want the 2, you can be even more safe. You can put your stop loss closer to the low of the structure. Both is good regardless of what risk to reward you are shooting for. And the third secret is don't just trade individual PD arrays. Use them together. So not only trade fair value gaps blindly or order blocks blindly. Use them together with the liquidity sweeps, with the order blocks, with the market structure shift, with the market maker models. We talked before about that there's multiple stars that need to align. That is this. Don't wait for too many stars to align, for all the stars to align all the time because your volume will be too low. But never trade just one PD array. Trade them together. And the fourth secret is use your entry model on one then more asset class. So if you now, for example, only trade NASDAQ, there can be a problem. Let me show you. If we go back to the NASDAQ example, we showed that I was shorting the very bullish move. If we go to the daily here, look at what happened here. There's just one big energetic move upwards without any retracements. So the entry model I showed you before with a liquidity sweep, a market structure shift, and then go higher. If you have a hyper trending market like NASDAQ here, this model will not come for one simple reason. There is no liquidity sweep. We just go higher and higher and higher. There is no sweep. And because it's one of the core 4 of my entry model, it needs to be there. I did not take a lot of trades in this move. And that's a problem because I want to make money. I want to expose myself to the market. I want to take trades to start making money. But if my model is not there, I'm not going to force my setups like you saw me doing on that short trade earlier. You need to sit on your hands. But because we need to expose ourselves to the market, to risk money, to make money, the secret I'm showing you here is use more than one asset class. So what I like to do when NASDAQ is like this, I like to go to, for example, to ES or YM, the other conference. Well, ES did exactly the same. So also ES, it was not nice. But YM at the same time had cleaner, higher time frame fair value gaps where we could trade from and order blocks. And we know that if there's a higher time frame fair value gap, like for example here on the lower time frame, we can find our structures because price is fractal. So YM here was more sexy to trade. Same for if you trade futures, gold. In that move, where NASDAQ was trending, we had some nice fair value gaps here on the 4-hour time frame. We also had some nice fair value gap. It's a nice bearish fair value gaps here to take shorts towards the low. So even this looks like consolidation, lower time frame in these moves, I made some nice money because in these moves, I was on the lower time frame trading the model. Liquidity sweep, market structure shift, PD arrays in a kill zone. And now you know my entry model, the biggest mistakes trading entry models, and the secrets to execute your entry model like a professional trader. This is everything you need to start going to the charts and executing your model. But if you want more of this, make sure you check out the video that's now appearing on the screen because it's going to be the start of my entry model playlist. You can just steal my entry model so you can use the secrets I share with you right now to or steal my entry model or make your own entry model even better. So make sure to check it out right now. Don't forget to subscribe and hit the notification bell and leave a like if you learned something from this video. Thank you for watching and I'll see you in the next one. This is time, this is price. And it's the only 2 concepts you need to become a professional trader. And this video, I'm going to show you how to use time, when to trade, and price, how it delivers to the target, to skyrocket your win rate, and basically just take better trades. And with better trades, you can make more money, more funding. So no time to waste, let's go. If you only look at technicals and only buy courses trying to find a new entry model, you're making a huge mistake because you need to combine price with time. You can have the best entry model in the world, but if you're executing it on the wrong time, you will have a big problem and you will not get the results you want. And when talking about time and price, we need to talk about the when, the time, when do you trade, and the price. How do you trade? How does price go to the certain target? And if you dive deeper into the when, into time, there are 2 things you need to master. And it is how to trade news and how to trade the kill zones. And news is very simple. It is the red folders. And for the red folders, use forexfactory.com. You'll see a screenshot here. If you go to forexfactory.com, you will see this exact page. And this is not enough. Like you need to filter a little bit. But this is only today. If you press here and you do them this week, you will see a lot of red folders. This is too much. We need to filter right here. Go to filter. And then you can turn off the CNE, the Chinese yuan. And you can turn off the yellow and the orange one. The gray one is always with bank holidays or daylight savings. Keep that on. It's the week of February 22 until February 28. And here you see the red folder. It's a low news week. If you go to the next week, you will see that there's NFP. And every day before you trade, you need to know, is there a red folder coming? So for example, right now there is an 8:30 red folder coming up. So that means I'm not going to press the button until 8:30. I'm going to wait for 8:30 to most likely sweep some liquidity into a key level. After that, I'm going to execute my trades. Very important here, you don't need to know what the exact red folders do. It is good to have a higher time frame perspective of what the economic situation is. So for example, if the economy is really bad, of course the NASDAQ will sell off. When it's really strong, of course the NASDAQ or the markets will go higher, but you don't need to know the exact details. You can, but I can promise you, I don't know all the red folders and I make money, so you don't need it to. And if you know how Forex Factory works, how you can filter to the red folders and to the certain assets you're trading, you need to ask yourself the following question. Do I trade before, during, or after the red folders? Because if you trade before the high impact news, you should know that it's very low probability. Price will accumulate or manipulate. You will see that before big news events, you will see price just ranging. And then when the news drops, for example, this screenshot about CPI, then the liquidity will be taken out and then we trade lower. This also can be recognized as the accumulation, manipulation, distribution. And you don't want to be in a trade before the manipulation happens. And that's why it's important to not trade before a red folder. And what if you trade during the news, when it actually comes out? Please be aware that that is just straight gambling. You don't know what the news will bring, if it goes up or down, how big the candle will be. So trading during the news, avoid it at all costs. There's a reason why prop firms ban news trading, and it has to do with the high volatility and high unpredictability of the candles that are printing during the news. And your risk profile will not be followed because the risk to reward you're going to take, the size of your stop loss is going to be so big when you need to account for the move of a red folder. And if you want to trade during the news, you most likely will see that you will get wigged out during the news and then we make the real move. But what if you wait? You don't trade before the red folder, you don't trade during the red folder, but what if you wait until after the red folder? When accumulation and manipulation probably already happened? What then? That is the best thing you can do. The market already showed its hand and it becomes obvious where it wants to go. In this case, there was a news event. At the news event before that, we accumulate, ranging. It's a news event. We manipulate, taking out liquidity. And then with the news after news, this is where when the fair value gap and the market structure shift is created, there in this piece of price action is the market showing its hand that it wants to go higher. And this is also the A+ setup and the 10 AM game that you can find here on this channel under the playlist of entry models. But you must have seen Forex Factory by now, and some days there's not one red folder but multiple. And what if you have two red folders, one before the open and one after the open? The New York open is 9:30 AM EST, New York time. Then what is the best approach? Because every month there are days with the, let's say the 8:30 red folder or the 8:15 AM and then the 9:45 or the 10 AM red folder. How can you trade that? And it's very simple. Use this as your rule of thumb. If the pre-New York open red folder will sweep liquidity, the 8:30 or the 8:15 red folder sweeps liquidity, then the post New York open, so the 10 AM candle, 10 AM news candle will be the push to the target. That's very important here. But what if the 8:30 news event does this and there's no clear liquidity sweep? Then it's best to wait for the post New York open red folder to do the liquidity sweep before getting into the move. So the thing you need to remember from this is you need to be waiting for the manipulation, for the liquidity sweep. And if it happens at the 8:30 red folder, you're probably going to take your trade at the next red folder. If it doesn't happen with the 8:30 red folder, just wait until price sweeps that liquidity before going to the target. It needs to manipulate before distribute. And right now, I want you to pause the video and make sure to put these two rules in your trade plan right now. These are the most important ones. One is no trading before the three big boys. And the three big boys are NFP, non-farm payroll, the first Friday of the month. It is CPI, that means inflation data, and FOMC. FOMC is the interest rates decision. NFP and CPI are always at 8:30 AM EST, and FOMC is always in the PM session at 2:30 PM EST. So that means in the sessions before NFP, CPI, and FOMC, you can expect low probability conditions. And low expectations mean you can still trade, but there's a strong possibility of weird or choppy delivery to your targets. So instead of price going very clean to a short target, for example, it'll probably just seek and destroy and do nothing. And then at the actual news event, then it will make the move. And the second rule is when there's no news days, also have low expectations, because we want the red folders to sweep that liquidity, to take out the liquidity, to manipulate before the real move. If there's no news, most days there's also not that big liquidity sweep, and we need to wait for the next day for when there is a red folder to then make that low or high buy that sweeps the liquidity. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. So when talking about time and price, you now know how to trade news, but we also need to talk about the kill zones. What time do you trade? And the kill zones are very simple. They're also referred to as sessions. You have the Asian session, the London session, the New York session. And for the indices, what we trade the most, NASDAQ, ES, and YM, we also have the PM session, the afternoon session. And these times are all in New York time. That means EST, Eastern time. And there's a little nuance difference between Forex and the indices. The Asian session is the same. That's from 8 p.m. until midnight. London session is from 2 to 5. The New York AM session is different. Forex New York kill zone is from 7 till 10. Indices is 8:30 until 11. And the PM session is not per se a thing for Forex, but you will see the indices moving during the PM session from 1:30 to 4. And inside these sessions on the indices, you have silver bullet windows. There's where most entries are forming. And for the London session, it is between 3 and 4. For the New York AM, it is 10 and 11. And for PM, it is 2 to 3 p.m. And my best performing entry model, the A+ setup, is the 10 a.m. game. And now you also know why. It's because most entries are around 10 a.m. New York time. The window after the New York Open that starts at 9:30. And why do you need to remember these kill zones? Is if you go back to your losing trades, most likely your trades are taken at the wrong time. So your structure was there, like the price was pretty good. You see your setup, but the timing was way off. And to give you some nuggets here, you should pair the asset you are trading with a certain kill zone. So if we talk about Forex, if you want to trade the Asian session, you should trade pairs that move in the Asian session. Well, what is the Asian session? It's the JPY, the Japanese yen. It's the Australian dollar, and it's the New Zealand dollar. Those are in the Asian session. So those pairs, those assets, those currencies move. For London, well, which currencies are in London session? It is the euro and the GBP. And the New York session obviously is the dollar and the Canadian dollar. And that is why if you have, for example, euro dollar, you will see the euro dollar moves in London and New York AM because euro is from London and the dollar is from the New York session, New York area. You will see euro dollar not moving in Asia. It will most likely consolidate, waiting for the London session because there is where the big liquidity comes to the market. And same for the indices. If you trade the NASDAQ, the S&P, ES, or YM, the Dow Jones, those are the New York stock markets. So that means you will see that those indices move during the New York session because there's where the US money comes into the market. If you want to trade, for example, indices during London session, you can look at the German stock market, the DAX, for example, or the UK 100 from England. So when you start matching the kill zone with a certain pair you're trading, your win rate will go up. And if you're confused about the kill zones, there's an indicator on TradingView you can use to mark out these exact kill zones. If you go to indicators and type in ICT kill zones and pivots, this one from Trade4Up, it will show the exact boxes of the kill zones. If you go to the settings of the indicator, you can even adjust this. You can pause the video and just copy these settings. I have the Asian session, the London session, New York AM. I also have the London close, but if I'm trading the indices, I don't use the London close. It's the yellow one right here. I use the New York AM and the PM session. And you also see in this exact example that for this NASDAQ trade, we just accumulate the whole day. This is Asia, this is London. And then in New York, we sweep the liquidity and start making the move to the upside. Especially if you're new to trading kill zones, make sure you put this indicator on your chart to make your life easier. So now you know when to trade. You know the time element. But now you need to talk about the price. So when we know when to trade, we also need to find a certain pattern, certain technicals we can pair to that. So now we're going to talk about how does price go to the target. And it's very simple. You need to know the daily bias. Where is price most likely headed next? Are we going up or down? And how we're doing that is very simple. It's by combining few different elements. One is the AMD, the accumulation, manipulation, distribution, and the other one is the open, high, low, close. The understanding of the AMD or the power of three is very simple. The accumulation is the consolidation. It's right here when we just consolidate. Intraday, very important from a daily bias perspective, Asia on most assets, euro dollar, the NASDAQ, is accumulation. So trading the Asian session, you will most likely trade the consolidation of the day. You don't want that. You want to catch the big expansion moves. There's where the most money is. And after that, you will see, after the accumulation, you will see a fake move. So if you want to go up on the day, you will see a move lower before going higher. The fake move in the opposing direction of the target. And then the distribution starts. That's literally boom, to the target. Pro tip, mark out the midnight open. And the midnight open is the New York midnight open. And if you are bullish, and let's say this is the midnight open, try to buy below the midnight open. So most of the time in the manipulation, there is where the buy structure will form. In this schematic, most of the time, this will be a fair value gap or an order block or a supply and demand area. There will be some nice structure forming below the midnight open. And of course, vice versa when you are bearish. And here's where you already need to combine time with price. So most of days, this will be Asia. The manipulation will happen during London, and New York AM session is on most of the days or the manipulation, or when a manipulation already happened in London, it's just going to be the expansion. That is why most traders, the biggest traders, only trade the New York session intraday, because there statistically is where the biggest moves, the biggest ranges happen. So now you know how to combine the kill zones with the AMD schematic, but how do we know if we're gonna go up or down? If it's gonna be a green candle, an up candle, or a down candle? And there's where the open, high, low, close comes in. Because when you expect a bullish day, play a bullish AMD. It means if you expect the next candle to be green, you wait for price to open, then drop lower, creating the low of the candle, and then start trading higher towards the high of the candle. And here you see again, accumulation, manipulation, distribution. Expect the next candle to be bearish, then we're going to do vice versa. Wait for price to open, accumulate, then manipulate higher, and then start the distribution lower towards the low of that candle. And there's dedicated videos on daily bias on how to predict the next candle to be up or down on this channel. I'll leave a link to them in the description. Also, just find them here on this channel. But right now we're going over the service level of those daily bias videos, because price only does two things. It is go to external range liquidity, that means old highs and lows, or it rebalances. And the golden rule is, that should be in your trade plan, you should try to always have in your mind, I trade from internal to external or from external to internal. What does that mean? It means this. External range liquidity, meaning trading back to an old high or low. So in this schematic, we leave a old high behind and then start trading lower into internal range liquidity. Internal range liquidity is a fancy word for a fair value gap or a supply and demand area. Just a price inside a range where we could react off from. So we go from internal back to the high from external. Ideally, use premium and discount in this. So go from swing low to swing high and try to catch that move into discount of the range. The second thing price can do is rebalance, both from an old high back to or a fair value gap, the internal range liquidity, the imbalance, or back to 50% of the range. Remember, premium and discount, then you can just short back to discount of the range. And if it's overlapping with a fair value gap, that's a very nice target to trade towards. That is the only thing price does. Or go from internal to external, or from external to internal. With that golden rule, where you only can trade from internal to external, or from external to internal, you only can have 3 types of days. The first one is the easy day. There's where I make the most money. It's the expansion day. And that happens the day after price trades into a key level. And when it trades into a key level, then it reacts from it. And then the day after that, so this candle is the most easy day because you already can anticipate that this low is going to hold. And then you have that exact green candle you expect. And then intraday, during the day, you just wait for price to accumulate, then trade lower below the midnight open and start creating the distribution, the buy structure. Those are the easiest days. Then after that, where you can also make money, but it becomes a little bit more tricky, it is on the reversal day. That is the day when we actually trade into that fair value gap. And then we try to trade the wick of this daily candle. So that means here is that fair value gap, that yellow box right here. And we just wait for price to make the manipulation move into the fair value gap and then trade higher. This most likely happens during news. And then your entry will be somewhere around here and then catch the distribution move. And that's why it's so important to always have higher time frame fair value gaps and old highs and lows on your charts, because you just wait for or the easy day, the trending day, or the reversal day to happen from those key levels. And it's nothing more than old highs and lows and fair value gaps on the daily, weekly, and monthly. And the third day, the low probability day, is the doji day. There is where most of the time we are in between 2 highs and lows or 2 fair value gaps. It's trapped order flow. Price just doesn't know where it wants to go. Very important, the word trapped order flow, that you anticipate that if there is a, for example, a bearish fair value gap and a bullish fair value gap very close to each other, and we're just in between there, then that is a very low probability condition where you should expect consolidations and just wait for one of the two to be respected and one of the two to be disrespected. And this schematic is the only thing you need to remember on how price delivers to a target. You use the AMD, the accumulation, manipulation, distribution, together with the open, high, low, close, together with if you anticipate price to go up or down. Combine this with executions during the kill zones and executing around the red folders. That is exactly what you need to take way better trades than you're doing right now. And now let's see the kill zones in action. Here we're looking at NASDAQ at the 5-minute chart, and we have Asian session here in the blue. There is London session right here, and New York session is the green one. You're used to me showing everything before it happens, but I want to make sure this depiction of the kill zones is very clean. Because if you know the power of the kill zones when time, you will recognize the setup when it needs to happen. Because if you would not know the kill zones, you don't know where to trade. You see this happening and you see price trading lower, creating fair value gaps. You're like, okay, cool. We're now going to take shorts towards here, stop above this high or above this high, towards the low right here for 1 to 2 or 1 to 1.5, and you'll be stopped out before the real move because you ignore that NASDAQ moves after the New York Open. If you know that because you used the indicator, then you knew that you need to wait until 9:30, and there is where there's the A+ setup. There's a liquidity sweep. After that, we have displacement, breaking structure, and there is where the entries can be taken. And if you're not convinced yet, let's go to the next day, where there is the PM session here. There is Asia, London, and New York. Same story. If you would have not known the kill zones and we're like, okay, cool. I see here aggressive sells, aggressive buys. I see an order block. I see a small fair value gap here. I see it moving away. So somewhere here, you take an entry, stop below the low for 1 to 2. You again would have been stopped out before the real move because you don't use time in your trading. Do the kill zones again at the 9:30 at the open. We sweep the liquidity, then we break structure, and there is where in this fair value gap is where you can take your entry for 1 to 2, 1 to 3. The exact same scenario 2 days in a row. And these are the exact trades I took myself as well at the time of the recording because this is a live chart right now. It was yesterday. And of course, if you want to learn more about how this exact entry model works, on this channel is a playlist called Entry Models. This exact model is inside there, so make sure you check it out right now. Here on this day, on February 12th, we have an 8:30 red folder. And you see before that red folder, we do not do anything. If we zoom out a little bit, the price is not very nice. But then we can just play a very classic open, high, low, close, and AMD, accumulation, manipulation, distribution. Can be bullish, can be bearish. But let's see if the 8:30 AM candle gives us the manipulation we are looking for. So here at 8:30, we move upwards. And after that, we create a 15-minute bullish fair value gap here on the expansion of the news. So let's drop to the lower time frame to see what we get. So we trade into that 15-minute busy, but then we don't move away. Then to New York Open, price chops around a bit. We sweep the liquidity right here. Then we start trading lower right here. So in this change state delivery, you could already have taken your trade around here, stop above the high for 1 to 2. But most importantly, it is so important that you wait before the red folder because the red folder push price up before going lower. If we zoom out on this price action right here, this candle is the 8:30 candle. So we have the accumulation, manipulation with news, the 8:30 manipulation, and then we start the distribution higher towards clear targets or these swing lows right here. And that is how you combine time with price, when to trade and how we trace towards a target. If you got value out of this video, make sure to check out the video that's now appearing on the screen because using this exact method about time and price in combination with the A+ setup that happens almost every single day, you are ready to start making money, get funding, get payouts. Don't forget to subscribe and comment your biggest takeaway. Thank you for watching, and I see you in the next one. Is it possible to trade profitably without using 20 time frames? Oh yes, and it's the only way I went from losing $60,000 to trading full time. Most traders think they need to analyze the weekly, the daily, the 4-hour, all the way to the 1 minute just to take a trade. And they're frozen by analysis paralysis. This video is not about adding more lines or more time frames to your charts. It's about deleting them. I'm going to show you the exact time frame alignment framework I use to skyrocket my win rate, ignore 90% of the noise, and got me to over $1 million in funding. No time to waste, let's get into the video. You have so many time frames you can look at, but to execute a trade today, you only need 3 buckets to align. The higher time frame, the intermediate time frame, and the lower time frame bucket. This is the higher time frame bucket, and it's the daily, the weekly, and the monthly. This bucket tells us if the casino is open. If this bucket is empty, so there's no clear setup, we do not trade. And a pro tip here is to look for trending conditions down or trending conditions up for the most clear setups. If you know the context up or down, the next step is to go to the second bucket. That's the intermediate term time frame. It's the 1 and the 4 hour. So inside this down close candle, if we drop then to the 1 and the 4 hour, this will look like this. It's the structure. So we have the context is down, but inside the down context, we are going to find structure on the 1 and the 4 hour. This structure, you see a value gap, there's order block sitting here, it changes a delivery, and we start trading lower. And if you know the context and the structure, inside that structure, so inside here and inside here is where you drop to the lower time frame. That's the 1 minute, the 5 minute, and the 15 minute to find your entry model. This example, there's an order block sitting here and a fair value gap, so the entry can be taken right there and just trade the context and the structure. But the context is lower, structure is lower, and the entry model is going to be short. You have a very high probability trade on your hand. Imagine you trying to rob a bank. Bucket 1, the higher time frame bucket, is the intel, the information. Is there even money in the vault today? Is there not a lot of security? And if that doesn't look nice, you of course not going to rob the bank today. Bucket 2, the intermediate term time frame, the 1 and 4 hour, is the alarm system going down and you getting in through the back door. It's your path to the vault. So when bucket 1 looks nice, bucket 2 looks nice. And in bucket 3, the lower time frame is just you walking in, grabbing the cash at exactly the right time. But your problem now is you're walking into the bank in the middle of the day when there's a lot of security guards and all the cameras are rolling and you're wondering why you do not make the money. You could not have just sit back in your car and wait. You were bored. And the same with trading. You're trying to force a trade when you're bored. You need to wait for the 3 buckets to align to take the highest probability trades. If the buckets do not align, we sit on our hands. But now you know the 3 buckets, you still have more than 10 time frames you can choose from. But to show you exactly which one you should focus on, I will show you a table I use to nail this every single time. Here's the framework. Make sure you screenshot this right now. And this alignment works as follows. If you have a weekly context, you look at the 4-hour structure. If you have a daily context, you look at the 1-hour structure. 4 hour to 15 minutes, 1 hour to 5 minutes, and 50 minutes to 1 minute. And if you have a weekly context and a 4-hour structure, if you then want to take the entry, bucket 3, it needs to be taken on the aligned time frame. And what's the aligned time frame with the 4 hour? Is the 15 minutes. So if you see a weekly context, you use the 4 hour and the 50 minutes. If you, for example, have a daily context, you use the 1 hour structure for this. And if you want to take an entry on a 1 hour structure, you need to find the aligned time frame of the 1 hour, but here's the 5 minutes. So you go from a daily context to 1 hour structure to 5 minute entry. Similar to 4 hour to 50 minutes to 1 minute. And if you see my previous video about trader identity, you know by now if you are a day trader or a scalper. If you're a day trader, you can use the following time frame alignment. It fits your exact identity. A day trader looks at a daily context, at a 1 hour structure, and a 5 minute entry. So you cannot go blindly to the 5 minutes. You need to have a story created in a daily and a 1 hour before you can take a high probability trade. Similar, if you're a scalper, you need a 4-hour context, 15-minute structure, and 1 minute entry. And if you, for example, know the 10 a.m. game, my favorite entry model, in that entry model, I use this exact alignment where we predict in step 1 the bias of the 4-hour candle. I use a 15-minute structure and a 1 minute entry to make money almost every single day. I created an entire dedicated video about the 10 a.m. game. I will leave that in the description and also somewhere here on the screen. But one very important note here, pick only one protocol. Or you're a scalper or you're a day trader. Don't be a hybrid. You need to master one of the protocols. And please, if you're scalping the 1 minute, don't care about what the weekly time frame does. It is just noise. Keep the data set small. Especially with time frames, complexity is the enemy. And if you don't know how to identify key levels, create a top-down analysis, or just want to steal all my entry models, I created a free video course called the Market Maker Blueprint. It covers the exact technicals and the exact frameworks I use myself in my trading. If you want it, the link is inside the description and go get it. It is free. We're now looking at the NASDAQ chart on the 4-hour time frame. It is an example of the scalper protocol where you have a context on the 4-hour, the aligned structure is on the 15-minute, and the entries on the 1 minute. If you look at this 4-hour structure, the context is pretty easy to determine. With aggressive
aggressive sells right here into a 4-hour bullish fair value gap, a liquidity sweep, and we have aggressive buys. Up here, we have these relative equal highs sitting here, also this high. So the buys is going to be higher to these highs. So the context is going to be higher. Then what we need to wait for is 15-minute structure. Ideally during, because NASDAQ, ideally the structure is going to be formed around the New York Open, around 10 a.m. Now let's drop to the 15 minutes. Right here, we look at a 15-minute chart and the time now is 8:30. So we're going to open very quickly. And during the New York Open here on Tuesday, January 6th, you can backtest yourself as well. There's a massive expansion. So the context is higher and the structure with the displacement is also going to be higher. And most of the times when this move happens, you will miss the move. But then you need to just wait for the structure, for value gaps, order blocks, all that stuff. So once 10 a.m. starts, there is on the 15-minute time frame, there's a fair value gap sitting here, also a fair value gap sitting here. So all we wait for the structure is price to come back into this 15-minute fair value gap. Can be this one or this one. And then on the 1 minute for the entry, we just wait for a reaction. So price comes back into one of these and then starts creating buy structure towards the target. So now let's drop to the 1 minute to see if we can find an entry based on the 4-hour context that's higher and the 15-minute structure, there's these fair value gaps. And then on the 1 minute, let's see for the entry. Now look at the 1 minute time frame and let's see what price gives us. So there's accumulation here. And now we're trading lower into the 15-minute bullish fair value gaps, both the top one, but also now the bottom one. So we're going to remove this. So we're going to play around here. So in this case, we just wait for buy structure to be created. We can zoom in on this price action and we need to wait for it. Do we see bullish fair value gaps? I do. Right here. Also an order book sitting there and see if we move away from that. We do. Second fair value gap right here. This is already enough for me to take the entry. I don't care if we chop around here. This is the entry. You know the 10 a.m. game. Links in the description. You know PD array 1, PD array 2, this PD array 2, this PD array 2. So long in this fair value gap, TP at the target for a 1 to 2 or 1 to 3. Say you want to do a 1 to 2 right here. And let's see what price gives us. And in the PM session, it gives the take profit point. So you see at the start, we chop around a little bit and that is normal, that can happen. But your focus should be on the scalper protocol where you saw the 4-hour context was bullish, the 50-minute structure we're in right now. And inside that 50-minute structure, there is where you wait for the 1 minute entry. And most of the time, price will not go immediately to your TP. It will hang around for a bit. When the higher time frame bucket, the context is nice, structure is good, the entry will follow through. Now, I know what you're thinking. Dion, this looks so easy. Is this actually the only thing I need to make money? Of course not. Here is why time frame alignment alone won't save you. To be a profitable trader, you need 4 core things. You need technicals, you need data during a backtesting, you need a trade plan, and you need the mental frameworks. 90% of traders only focus on technicals. So when they hit a losing streak, they start strategy hopping, hoping a new course will fix their problems. And that's a losing game because you're ignoring the other 75% of the trader pyramid. You need proper mental frameworks. You need a trade plan that says if XYZ is happening on the charts, then I press the button. And you need the data, the proof that what you're actually doing with your trade plan works in the long run and makes you money. Technicals are only 25% of the equation. And the trading industry sells you a technical solution to a psychological problem. And you understand this logic about time frame alignment, but tomorrow morning you wake up, you see the candles moving fast at the 1 minute, and your monkey brain will wake up like, oh, what do I need to do? And you will ignore the daily chart, the context, you will ignore the structure on the intermediate term time frame, and you'll just start chasing a move again. But please remember this: time frame alignment is not about lines or some magical holy grail entry model. Time frame alignment is about patience. It is about the discipline to say no to a trade because the 3 buckets aren't activated yet. We are trading like the casino, like the house. And the casino does not guess. A casino waits for its edge to play out. And for that, you need to sit on your hands a lot of the times. In this next example, we're looking at ES at the daily chart. And for the day trader protocol, we need a daily context, inside the daily context, a 1-hour structure and a 5-minute entry. So let's see how that looks on the charts. Here there is a daily bullish fair value gap and we create a swing low inside a daily bullish fair value gap, making the bias for this day bullish, ideally towards this high right here. So inside this daily context, we need 1-hour structure. So now let's drop to the 1 hour. We're already forming structure on the 1 hour inside this daily fair value gap. Aggressive sells, aggressive buys. And we displace already on Monday right here, leaving a 1 hour bullish fair value gap. Inside this 1 hour bullish fair value gap, we can maybe look for structure on the 5 minutes. So now the time of day, it's the
Asian session is coming up. But let's fast forward towards the London session and the New York session. Here in the London session, we trade into the 1 hour bullish fair value gap. Usually ES, NASDAQ, and YM, the US indices, the futures, trade in a New York session. But we can already look if we see some structure forming for the entry on the 5 minutes. From the daily context, we went to the 1 hour structure that's right here. And now we're on the 5 minutes to see if there's maybe an entry coming up. So right here, there's not much. I'm waiting for clear displacements. For example, right here, this is already pretty nice. Right here, a fair value gap. But look at the time. Entries on the US futures are around the New York Open. So I'm waiting. Another fair value gap sitting here that is nice as well. Price trades into that. Does not respect it. And this is the exact reason why I don't trade before the open. Because then I was like, okay, let's take a trade right here towards the highs. And it got stopped out. So this is not the correct move. Please don't be stubborn about this. Just wait until the New York Open. Now we're approaching 925 and we start displacing higher. Probably the real move is coming right now. So at the New York Open, there's now a 5 minute fair value gap. I'm waiting for the entry for price to tap into here and then respect it. So I want a wick created inside that 5 minute fair value gap. Exactly here. So in this candle, well, let's do the candle close is where I would take the entry. That it would be right here. So it's a little late to the party. Put it right here. Stop below the fair value gap or below the low. Because we already moved away so aggressively, I'm okay with putting it below the fair value gap for a 1 to 2. And let's see what price gives us. And we go to TP in one go. Cool. This is very fast and aggressive. Maybe you see this is 935 and the TP is hit is so fast. What if you miss this move? And if you see my previous video about the FTMO protocol, when this happens, zoom out because there probably will be another entry. So this was already TP, but let's say you missed this. Now we're going back to the 1 hour time frame. We zoom out. And what is created on the 1 hour right now? There is a new 1 hour structure created. Same daily context, but the 1 hour structure, new 1 hour value gap. So let's do the same. Let's see if we can catch an entry inside this 1 hour fair value gap to catch the continuation. Back on the 5 minutes, price comes back into the 1 hour fair value gap. And let's see if there's a reaction. We do not move away from this yet, but once we start creating buy structure, once we create up close candles and especially trade above these series down close candles, I'm open to press the button. There's a small fair value gap here. So the entry would be from here. So again, we wait for price to come back into it, reject, just like this first example, where we wait for that candle to close, take the long up there, stop below the low for 1 to 2, and then price goes to TP as well. So with the day trader protocol, with the daily context, 1 hour structure and 5 minute entry, you could have had 2 entries right here on a single session. And you also should know that if you trade before the session, you will probably get faked out before the real move. And it's a very nice example of this. So make sure you don't do that and sit on your hands. You need to be patient for the 3 buckets to align. So stop trying to predict every candle. Use the 3 buckets framework. Wait for the time frame alignment to play out and execute only when the 3 buckets are aligning. If you want the exact technicals and entry models I use in my trading to get over $1 million in funding, make sure you check out the Market Maker Blueprint. Link to that is inside the description. And if you like this video, make sure you check out this video that's now appearing on the screen, because combining this video with the one you're now seeing on the screen will make you grow even faster. So make sure you check it out right now. Thank you for watching, and I'll see you in the next one. Bye-bye. What if I told you that everything you think you need to learn about ICT, the break blocks, the order blocks, inversion value gaps, the silver bullets, is actually holding you back? I've traded for 5 years and I found that 99% of traders are drowning in complexity. They're trying to learn it all and it's killing their results. In this video, I'm going to reveal the 1 core concept that underpins all of ICT. Master this and I promise you, the charts will finally start to make sense. Stick with me because it's the video I wish I had when I started. The concept is the market structure shift, or MSS, but not just any break of a high or low. I'm talking about a specific type of shift that signals a true change in order flow. Let me show you. Forget anything else for a moment. This is the tell. This is the moment the algorithm reveals its hand. It's a starting point for every high probability trade you will ever take. And most traders get this wrong because they're looking for any old break of structure. They're looking for random highs or lows to be taken and classifying that as a structure shift. They're not looking for the character of the move. And that's what we're going to break down right now. So what makes a market structure shift valid? It's one word: displacement. This is what most traders see, but this is what you need to see. This right here
is displacement. This is an aggressive move that leaves behind inefficiencies, fair value gaps. This is the clue that big money has stepped in. This is where the magic happens. The fair value gap is your new point of interest, and it's where you'll be looking for your entry. And on this bad example, you see a little bit of displacement, but the last swing high that made the low did not get ran. So there's no valid market structure shift. And you will see those most of the time just failing. Just like you see here in this example, you see a fair value gap, but we fail to take out that last high before the low. We stay under that. So eventually you'll see that we start to break down. So how do we trade this? It's a simple 3-step process. Step 1 is you identify the market structure shift with displacement. For example, here you see a liquidity sweep during a kill zone is 930 is the open. If we zoom out a little bit, we see that we are in a massive fair value gap here. So also a key level. So we have a liquidity sweep, then we displace higher. Displacement is characterized by fair value gaps. I see one here and I see one right here. And the last swing high that made the low, that is the one that needs to be broken right here. So you see a valid displacement. So step 1, the market structure shift is right here. When we break this with this candle, we break the low. The candle that makes the market structure shift, if in that candle is a fair value gap created, that is a high probability fair value gap. So we wait for step 2 is when we come back into this fair value gap right here. And then step 3, wait for price to come back into this fair value gap, which we do here at 1045. And then you can take the entry from the start of this fair value gap. I will put my stop loss below the bottom fair value gap, and you can trade for 1 to 2 or 1 to 3. I like to shoot 1 to 2s. And you would have here a 1, 2, 2. And it's also overlapping with a nice target. That's this bearish fair value gap.
I spent hundreds of hours studying ICT concepts, and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, want to get it right now, I will leave the link to this PDF in the description.
If we look at that same price action a few days later, we see that we have a liquidity sweep right here. Then we displace. How do we characterize displacement? It's because of fair value gaps right here. And we come back into the fair value gap. You can take your entry into fair value gap, stop below this bottom fair value gap for a 1 to 2, and you would not get it here, but the next day you would have your TP and even a 1 to 3 or a 1 to 4. We're waiting for the market to show his hand with a clear, energetic shift, and then we're looking to get in on the pullback. Simple, clean, and effective. Now there's a few traps you need to avoid. The first mistake is taking every break of structure, because every time you see displacement, you think there's a break of structure. You see price creating a high. We swept it high with displacement. So you take this trade because you think it's a break of structure and you are getting stopped out very quickly. A quick tip here is to add a liquidity sweep to this framework, so you're trading higher probability market structure shifts. I have a video dedicated to finding liquidity here on this channel. I'll leave the link to that in the description. You basically have a few types of liquidity. You have session liquidity, London low, New York low, Asia low. You have daily liquidity, daily highs and lows, and weekly liquidity. Those are the liquidity pools I'm looking at. And for example, in this example, we didn't take any significant liquidity. The only liquidity we took was from a PM session here on Euro US dollar. That's not enough liquidity. Ideally, liquidity pools are all daily higher low or weekly higher low. The second mistake I see traders make is trading on the wrong time frame. I use time frame alignment for my highest probability time frames. So if I have a weekly level, I'm looking for a 4-hour structure. If I have a daily level, I'm looking for a 1-hour structure. And if you're an intraday trader, you're most likely going to do from the 4-hour level, a 1-hour level, or a 15-minute level. So intraday, most of the time, you have a 1-hour bullish fair value gap where you can wait for the price to come back into. And once price comes back to the fair value gap, then you can drop to the 5-minute to find your 5-minute market structure shift. What most people do is they just chill at the 1 minute like we're doing right now. We see some candles print and randomly we try to find the next market structure shift and hope that it's going to work out. That's not how it works. Use time frame alignment in your favor. So the first mistake was trading every market structure shift. Try to add a liquidity sweep to that. This second mistake is trading every time frame. Use time frame alignment to get more structure into your market structure shifts. And the third mistake is ignoring the higher time frame narrative. All your trades should be based on a daily, weekly, or monthly narrative. At the start of each week, I mark out the daily, weekly, monthly for value gaps at all highs and lows. Just like, for example, here on USD JPY, where there is a clear monthly bullish for value gap. And this is a trade I actually took. And from this monthly level, we can go to the daily, to the 1 hour, to the 5-minute. So let's drop here from the monthly to the 1 hour to see like, hey, how can we incorporate all the traps, the 3 mistakes to find a high probability trade. It starts for mistake 1 is finding a liquidity sweep. We got this inside a key level. The key level is the monthly bearish fair value gap. What is the last swing low that made the high? I would say that's this one. But if you want to be very complete, you can even do this one. So you're only going to mark it out as a market structure shift once this swing low is broken with what? With displacement, characterizing by fair value gaps. Big energetic move to the downside. And here, this swing low gets violated by this small fair value gap. So this already could be your first entry right here. And we're trading here at the 1 hour. You can drop here to the 5 minutes in this level to find your entry. So right here, you could already have a 1 to 2. What if you thought, hey, I don't think this is enough for my market structure shift. I would rather wait for this to happen. Cool. When we have this displacement, so you missed this first move. Here, there's another displacement breaking the low here, closing below the low. What is the candle that made the displacement? There's a series of these 2 candles. So right here, you can do this one or you can make it bigger like this. Here is where your entry is. Remember the steps? We have the last swing low that made the high. It gets broken with displacement, an energetic move. We wait for fair value gaps to be created and we wait for the pullback to get in to trade the fair value gap. So here you could take your entries in all these moves. It was a long wait. It's an hourly. It's a long wait, but you can trade here and here during the London session, another displacement during Asia and London, another displacement, and you can even take another entry in this fair value gap. If you missed that one, we can even drop lower here. We have short-term liquidity here, gets taken by this high. This high trades into this bearish order block, and then we displace lower. What do we leave behind? Fair value gaps, because this looks pretty bullish, right? Pretty bullish, but we change structure to the downside. Last swing low that made the high got broken. And why are we not looking for bullish market structure shifts here? Is because we have a higher time frame narrative. That is from the monthly, we expect a reaction. Let's zoom out again. We expect a reaction from this monthly bearish fair value gap to the downside. So our structure shifts, the high probability structure shifts should be to the downside. So when we see a liquidity sweep right here, we see displacement leaving fair value gaps, market structure shift. So here, these candles is where you can take your entry. And then we retrace, displace again. Let's see how many entries you could take inside this move. And this is a live, we're looking at the live chart right now. And we displace lower again. And you just follow the fair value gaps into this sell model. Look at this. You can, this, of course, it didn't hold exactly, but pretty nice entries. And now we are just trading lower. All starting from that higher time frame narrative, the monthly bearish fair value gap, we drop down with time frame alignment to the 1 hour. And the 1 hour, we see liquidity sweep, we see displacement leaving fair value gaps. We wait for the pullback to get into the fair value gap, and then we take the trades. And this whole sell move from the monthly SIBI to the downside, you could have taken 5, 6, or 7 intraday entries. So no matter if you're watching this as a swing trader or an intraday trader, you can use the concept we are discussing right now in all of your trades. And because of that, pass more challenges and get more payouts. So why does this one concept beat everything else? Because it simplifies your trading into one core pattern. It forces you to be patient to wait for the right high probability setups. If you got value from this video and you're ready to simplify your trading, subscribe to the channel and let me know in the comments what your biggest aha moment was. And if you want to see me trading this concept live, check out this next video where I break down how I use this concept to pass profit from challenges and get to over $1 million in funding. Thank you for watching, enjoy the next video, and I see you on the charts.
This is a fair value gap, and these are the 5 secrets that will determine if your fair value gap is going to hold or not. Understanding this about fair value gaps is the shortcut to become a professional trader. In this video, I'm going to show you everything you need to know about how to use fair value gaps. Fair value gaps together with time frames, liquidity, volume imbalances, gaps, the biggest mistakes I see my students make trading fair value gaps, and of course, the 5 fair value gap secrets. No time to waste, let's get into the video. A fair value gap is a 3-candle pattern that shows a gap between the first and third candle's shadows. And if you clicked on this video, you probably already know what a fair value gap is, but let me break it down in the next 10 seconds. A fair value gap, in this example, a bullish fair value gap, is also called a busy buy-side imbalance, sell-side inefficiency. If a bearish fair value gap, you call it a SIBI. B for buy-side, S for sell-side, SIBI busy. And you'll see that the first candle's high does not overlap with the third candle's low, creating a gap. That is fair value gaps 101, but we need to dive deeper into this to fully understand why we need to use fair value gaps. And the first area inside a fair value gap that you need to know is the consequent encroachment, the CE. That's a fancy term for the 50% of the fair value gap. The 50% level of a fair value gap is important to see if the fair value gap will hold or not.
That means if you have a candle and you see that the body is closing at the top of the 50%, then you can conclude that the fair value gap wants to hold and we're just going to trade higher. And how you can use the consequent encroachment is if you have the next candle, it trades into the fair value gap, but it closes above the 50%. So this is the candle you will see. You see that the wick comes to the 50%, but the body closes in the top 50%. Then you can conclude that it's most likely want to hold. And you will see the next candle being up as well, continuing the trend. But there's also a scenario where price does close below the consequent encroachment of the fair value gap. And when that happens, it hints that we're most likely not going to hold the fair value gap and just going to trade lower, most likely towards a recent low. And fair value gaps are family of the imbalances. And an imbalance in the market is where price likes to come back to before continuing the move. And other forms of imbalances are volume imbalances and gaps. Where the volume imbalance is the gap between the open and close of the bodies with overlapping wicks. So in this example, you have the body here and the body here, and the volume imbalance is when there's no trading in between those bodies. In a gap, there is space between the two candles' wicks with no trading activity. You will find these imbalances together with fair value gaps on the charts, and they are all forms of imbalances. And screenshot this exact depiction, pause the video so you know the exact difference between a fair value gap, a volume imbalance, and a gap, fair value gap, 3-candle pattern, when there is no overlap between the first and the third candles. Wicks, volume balance, 2 candles when there's no trading in the bodies, and gap when there's no trading between the wicks. Keep in mind, very important, fair value gaps, volume balances, and gaps are not the same, but they can be used for exactly the same liquidity purpose. Let me explain what that means. If we talk about liquidity, price does only 2 things. And that is, one is grab liquidity, external range liquidity. External range liquidity is another word for old highs and lows. I have dedicated videos on liquidity on this channel. I'm not going to break the exact liquidity concept down in this video, but the only thing you need to know regarding fair value gaps is that price has external range liquidity and internal range liquidity. That's the only 2 places price wants to go back to. If we talk about internal range liquidity, those are the imbalances. So fair value gaps, volume balances, and gaps are internal range liquidity. And old highs and lows are external range liquidity. So that means price goes back from old highs and lows back to imbalances, fair value gaps, volume balances, and gaps. So no, they are not the same, but they will be used for the exact same liquidity purpose. When price goes back to internal range liquidity and moves away from internal range liquidity. And now you go to the chart and you're trying to find your fair value gaps. You're on a 1 minute, you find fair value gaps, on a 5 minute, on a 1 hour. And all of a sudden you have 20 different fair value gaps on all different time frames marked out. But that's the question. When do you use which one and on what time frame? And there are a couple of rules for this. The first rule is the higher the time frame, the more reliable the fair value gap. It means if you have a fair value gap on the 4-hour and a fair value gap on the 1 minute time frame, you must understand that the 4-hour fair value gap is way more likely to hold or to move away from than a 1 minute fair value gap. The second rule is overlapping time frame fair value gaps are powerful. For example, if you have a fair value gap on the 1 minute, on the 5 minute, and the 15 minute all at the same place, you can mark that out as a very strong fair value gap. And you can see that price is like a magnet that wants to move towards that target, but also it likes to move away from that target. And the third thing you need to understand is that price is fractal. So you need to understand what happens on the 4-hour time frame, that there is a whole concept below the 4-hour time frame on the 1 hour, the 50 minute. Let me show you how that works. This is a depiction you've seen in my market maker model video. And this shows exactly why price is fractal. If you have a market maker on the higher time frame, and to understand price is fractal, you don't need to understand what a market maker model is. But in that video, I explain if you have a market maker model and you want to enter here, let's say this is the 1-hour time frame, your 1-hour market maker model, and inside here you want to drop to the lower time frame. You go from a higher time frame to lower time frame. So let's say this blue area is a 1-hour fair value gap where price comes back to and it wants to move away from. From the 1-hour time frame, we go to the 5 minute or the lower time frame to look for the exact same schematic, but then on the lower time frame. So inside a higher time frame fair value gap, you can find lower time frame structure, lower time frame fair value gaps to trade off from. That is how you also do a top-down analysis. You go from the higher time frame, your fair value gaps. Inside those higher time frame fair value gaps, you drop to the lower time frame, find fair value gaps inside fair value gaps, because then you can discover the second powerful rule about overlapping time frames, 4-hour, 1 hour, 50 minutes fair value gaps on the same level are super powerful. I've been helping traders for over 3 years now. And based on hundreds of data points, these are the 3 biggest mistakes I see my students make when trading fair value gaps. The first one is not trading with the higher time frame trend. And what that means is that if price is super bullish, you want to take longs. You don't want to trade counter trend. You will see that those trades are just very low probability. But if you zoom in, let's say this is the 1 hour time frame, and we zoom in on this piece of price action, specifically down close candles, if we then drop to the lower time frame, you will see that it creates sell structure. You will see a bearish fair value gap, and you're like, hey, I see a bearish fair value gap. Bearish fair value gap means shorting. But biggest mistake you make is you don't trade with the higher time frame trend. So if the higher time frame trend is bullish, a bearish fair value gap is not likely to hold. So you will see that we come back to the fair value gap and then just completely ignore it and start the continuation back upwards. That is because you need to follow the higher time frame trend. The second mistake I see traders make, especially trading the 10 AM game, that's my 1-minute scalping model, is not waiting for the third candle to form. Because when you're looking at the charts and you see this candle happening, this is also called an engulfing candle, just a massive candle to one side, this massive green candle. You're like, hey, this is nice. This is probably going to create the fair value gap and it's probably just going higher, right? But the mistake is you need to wait for that third candle to form. Because in this example, after the second candle, it just created this. There was no fair value gap created whatsoever. And that's what we want to avoid. So always wait for the third candle to form and then price comes back to that fair value gap and then moves away from it. And that means you need to have some patience when a fair value gap is forming. And the third mistake is trading fair value gaps that are created outside the kill zones. And vice versa, fair value gaps created inside the kill zones are higher probability. If you don't know what kill zones are, those are the high probability trade sessions, London session, Asia session, New York session. I have a dedicated video on kill zones here on this channel. I will leave a link to that inside the description, together with the early mentioned market maker model videos. And on all the specific concepts I'm talking in this video, there are specific videos on this channel already. So after this video, make sure you check out the rest of the channel. There's a lot of nuggets to share. I spent thousands of dollars on courses in my 5 years of trading, and I made it my mission to put out all the information just for free so you can learn for free as quick as possible. Back to the video. You have 4 different sessions: Asia, London, New York, AM, and PM. And if you trade Forex, you need to memorize that if you trade, for example, the London session, fair value gaps created between 2 and 5 AM New York time, these times are New York time, that means EST, those are nice. But if they are created at 6 AM in between the kill zones, I wouldn't trust them too much. Same for the indices. Fair value gaps created during the kill zones are super nice, and especially in the silver bullet window. Silver bullet windows is a 1 hour window where there's the highest probability of a nice trade to form. That is between 3 and 4 for London, 10 and 11 for AM, and 2 to 3 PM for the PM session. So now you know the 3 biggest mistakes my students have made trading for value gaps based on hundreds of data points: not trading with the trend, not waiting for the third candle to form, and trusting for value gaps that are created outside of kill zones. Now it's time to look at the exact secrets you need to start trading for value gaps like a professional trader. And the first secret is when the fair value gap is already being touched before, being traded into before, it is less strong and it could most likely fail because it already has been used. And here's an example of this. Here we're looking at NASDAQ at the 50-minute time frame, and this secret I'm sharing works on all the time frames. If you see this 15-minute bullish fair value gap, if you zoom in a bit on this, you will see that here we already traded back into it and we moved away from it. So here we can determine it has been touched already. It has been traded into and be moved away. But then there's no follow through on that trade idea. You see the price just starts consolidating and doesn't move higher. That is interesting because that gives you a hint that we maybe don't want to go higher, especially if then price comes back to the fair value gap. Like you see, this sweeps a little high here and then it just starts trading lower. Then it comes back again inside the fair value gap. And here is the best secret, and also the mistake I see traders make, is to think, hey, price comes back to the fair value gap again. Now let's take another trade because the fair value gap is still there, right? Because you know the rule about fair value gaps. If we trade above the 50% of the fair value gap, the fair value gap is still valid. That is true on paper, because here you see that in the first step, the first touch, we trade into it multiple times, but the bodies are closing in the top 50% of the fair value gap. That is nice. That's what we want. But you now know that if we then come back again, it is most likely not going to hold anymore because we already traded from it. It's already been used. So how you can trade that and use that is use this low as a drawn liquidity. We're most likely just going to take out this low then. So where amateur and beginner traders think, hey, let's move away from that fair value gap, you now know that you can try to then take short shorts towards that exact low inside the fair value gap. So that's the first secret. When it's being used, don't trust it anymore. And that will save you a lot of losses. And the second secret is the question of what if there is multiple fair value gaps created in the same big move? Which fair value gap do you take and why? And there are two different strategies for this. And I want to use this as an example. Most of the time during the New York Open or during a news event, you will see massive green candles being printed. And then you have two fair value gaps. And you're like, hey, okay, do I enter here or do I enter here? The first strategy you can use is that you enter in the first fair value gap and you put your stop loss below the other fair value gap. In this example, if you would have done that, you would have been in the move. Price steps into it and then trades higher. It doesn't come back to the second fair value gap. The second strategy you can use is use premium and discount in the displacement range. So there's a low right here. There's a high right here, premium and discount, and you try to long from discount of the range. So the bottom 50% of the range. And based on that, you can say that probably this fair value gap then would be the entry. And keep in mind here, both 1 and 2 work like a charm. In the long run, it's almost 50-50 on what works best. It needs to work for you. And to give you some food for thought, how you can determine what works best for you, these are the pros and cons. Strategy 1 gives you less risk to reward because you need to have a pretty big stop loss. Your stop loss is here, your entry is here, but you will be in the move when you are right. If price wants to go higher, it will just tap in and goes higher. If your trade personality doesn't like to miss a move and you will get tilted fastly because of that, which is completely normal, I would suggest use the first strategy. The second strategy gives more risk to reward because you just wait longer. You can just put your entry here and your stop loss at the same place and you have a way higher risk to reward, but you can miss the move when price does not come back into discount. If you're okay with missing moves and you favor a higher risk to reward, I would recommend using strategy 2. Again, both work like a charm. It needs to fit your trade personality. And the third secret is don't just trade individual fair value gaps. Use other confluences too. Like a fair value gap is just a confluence on the market. If you just trade fair value gaps, you will be confused. Your trade idea should be based on multiple confluences. And confluences examples are liquidity sweeps, order blocks, market structure shifts, market maker models, supply and demand areas, support and resistance areas, doesn't really matter, but there needs to be more than only a fair value gap in your trade idea before you take the trade. For example, in this trade idea, you see the fair value gap, right? But there's not only the fair value gap. There is premium and discount. So we come back to premium of the range. There is a liquidity sweep. There is a market structure shift. There's a breaker sitting here. So there's a lot of confluences supporting the fair value gap idea. So in this case, you don't just trade a fair value gap blindly. There are multiple confluences available in that same area, and that will make your trade idea way stronger. The rule of thumb is the more confluences that are present in a certain area, the more confluences you can motivate to back your idea with, the higher the probability of your trades. That also means you shouldn't wait for 20 different stars to align because then your trade volume will be very low. But there needs to be a sweet spot. Most of my entries are with a liquidity sweep, market structure shift, fair value gaps, order blocks, and sometimes things like a inversion fair value gap inside the market maker model. But most of the time with 4 or 5 confluences, you already super high probability territory. And the fourth secret is use the second PD array rule. And let me show you what the second PD array rule means. So here we're looking at the NASDAQ at the New York Open, and we're just creating a fair value gap. Where? Right here, fair value gap. If we use the previous secret, where we need to also have multiple confluences, I see that before that, we sweep a low, we take out a low right here, and we take out the last high that made the low, that's right here. So there's also a market structure shift. So there's a lot of confluences present in this area. The second PD rule is in case you are faked out a lot. And faked out means that you take the fair value gap, you take just the first fair value gap, and all the time, instead of it goes higher, it just trades lower, and that fair value gap didn't hold, and you take a lot of losses because of that. When I was starting trading fair value gaps years ago, I had this a lot. I took a fair value gap and it just didn't hold. And I was like, hey, how can I fix that exact problem? There is where the second PD array rule comes in. And what it means is you wait for the first PD array. A PD array is a fancy term for a fair value gap, an order block, a breaker, hold highs and lows. And what you wait for is price to come back to the first PD array, in this case, the fair value gap, and it moves away from it. So it gives the confirmation, this first fair value gap, that your trade idea is most likely correct. And you're most likely going to trade higher towards old highs or another obvious target. And you see that happening right here. So yes, this first fair value gap would have held. And yes, you could have had a better risk to reward. But if you care more about win rate, you just want to take more winning trades, you wait for what's now happening. Because of this down move into the first fair value gap, this down close candle trades to a fair value gap and now is traded higher, engulfing candles, big green candles. This becomes a bullish order block. So now next to that, we have the fair value gap and the liquidity sweep. I call this fair value gap 1. We now have also a second PD array, the order block, stacking on top of this. So you can see this as different lines of defense. You have buyers and sellers, and here the buyers are in control. So next to that, this is a very nice defense for your trade. Now there's another layer of defense created by the second PD array. That is what you want. So then you can just take your entry at the second PD array, stop below the last low, 412. And inside that move, there's also another fair value gap created. So you have two areas here where price can move away from. So in this idea, liquidity sweep, market structure shift, fair value gap 1. We wait for fair value gap 2 because we want our win rate to be higher. And now let's see what price gives us. See, price comes back into the order block, taps in, and then it goes to the target. Now I see this another fair value gap here. So it came back to an overlapping fair value gap and order block right here before going to the target. If you trade the New York Open on NASDAQ or the other indices, this depiction you should screenshot right now because this exact model presents itself so many times per week. So just copy this, wait for liquidity sweep, market structure shift for value gap 1 and 2, and you should be golden. I've dedicated videos with all my entry models here in this video, and this exact model will come back into these models as well. And the fifth secret is how you can use fair value gaps to battle FOMO trading. FOMO means that you miss a move and you feel very bad about it because your bias was good, but you are just not in. Fear of missing out. And I want to give you the FOMO protocol using fair value gaps. Here we're looking at NASDAQ at the New York Open. And we are bearish higher time frame. So we're trying to catch shorts at the New York Open. So let's fast forward to the open right here. And we try to find fair value gaps that we can use that trade back into. So we see a fair value gap here, there are many fair value gaps created. But there's just no entry whatsoever. And we completely miss the move. This is what creates FOMO because you will be sitting in the 1 minute here for minutes and minutes and minutes. And you just miss the move. And here's where the FOMO protocol comes in. Use this as your rule of thumb to completely eliminate FOMO out of your trading. When this happens, you're in the 1 minute or you're in 5 minutes or the 50 minutes. The time frame doesn't matter. You zoom out one time frame. So if you're at the 1 minute, go to the 5 minutes. If you're in the 5 minutes, go to the 50 minutes. If you're in the 50 minutes, go to the 1 hour. And what will happen is because you missed the move on one time frame, it could create a fair value gap on a time frame above your position. So if you're here on the 1 minute time frame, if I now go back to the 5 minutes, what do I see here? I still see multiple fair value gaps right here, and here. But now we have more context. Like, hey, we can maybe just wait for price to come back to one of the fair value gaps and go lower. And remember, one of the secrets is if there are multiple fair value gaps, you have two options: price to come back to premium or discount of the range, or retake it in the first fair value gap. So we can literally apply that right now in this example. So let's see where there's a low created. Looks at now that now is a low created. Then we can do the last swing high and the last swing low. That's right here. And you see that the fair value gaps are already in premium of the range. So we should be good there if we want to trade from these fair value gaps. So then we can just say, okay, we're going to take the trade from here. If it comes back, stop loss above the last fair value gap here, and then target a 1 to 2. So where we felt a lot of FOMO on the 1 minute because we missed the initial move, zooming out one time frame fixes that. And then price comes back to the first fair value gap inside premium of the range and then goes to the profit target. But what if you trade on the 5 minute, not on the 1 minute, and you see this move and you completely miss it? You are not at 10:05 here when it happens on the chart and you're like, no, I missed the whole move. You see price just going and now it's just already market close and you feel like you will never be in a trade again. Cool. Let's do the same, zooming out again. Let's say, for example, we go to the 1 hour time frame. Because in that same move where you have all these 5 minute fair value gaps, there's also a massive 1 hour fair value gap created, which is nice because this gives a trade idea that we want to trade from internal back to external, just continuing the down move. And then you just wait for price to come back there at the 1 hour and then just wait for price to move away from there. So if you miss the move, you just wait for the fair value gap that has been created to trade back into before continuing lower. And you can do it here again on the next day. So see how if you missed on the lower time frame, zoom out, FOMO protocol, zoom out a few time frames, and just get your entries on the fair value gaps above your entry time frame. And I can promise you, inside this price action on the 1 hour and then this candle on the 1 hour, you can find lower time frame entries as well. And now you know everything you need to know about fair value gaps, the biggest mistakes, the secrets. And if you get value out of this video, make sure to check out the video that's now appearing on the screen, because using this new knowledge about fair value gaps together with a very high win rate entry model will result in you getting funded and payout faster. So make sure to check it out right now. Thanks for watching. Don't forget to subscribe, and I'll see you in the next one.
You think price moves randomly? It doesn't. Price is a delivery system. It moves from one specific level to the other, from premium to discount, from internal to external. If you don't know where price is going, you're just gambling. You are hoping for a move. You can know where price is going and predict massive daily expansions by understanding PD arrays. The frameworks I'm about to show you got me to over $1 million in funding and over 100K in payouts. And in this video, I'm going to show you exactly how to use these PD arrays to catch the big moves, or revealing the 3 PD arrays you actually need to make money, and how to use them to predict your daily bias. No time to waste, let's get into the video. Let's kill the confusion first. PD array stands for premium and discount array. P is for premium, D is for discount. And you can draw premium and discount by drawing a line in the last swing high and the last swing low. That is called a range. So we have a swing high here, a swing low here, and the range is where we are in between. And it's similar if you're bullish and similar if you're bearish. Swing high, swing low, and the range is right here. If you have that swing high and swing low marked out, the midpoint is going to be the difference between premium and discount. Premium is the top 50% of the range. Price expensive and the smart money wants to sell here. Discount is when prices are cheap and the smart money wants to buy here. So usually you want to take long trades in discount of the range. And what you need to remember from premium and discount arrays is that we can only do 2 things. We are moving towards a PD array as a magnet, or we are trading away from a PD array. Most of the time, just go from discount to premium and back to discount. Your job isn't to guess the next candle. Your job is to identify the next magnet of price. And if we trade in discount and we react from it, where is the next magnet? It's probably going to be a premium array. And when you're going to look at PD arrays, you will find this exact depiction. It's called the PD array matrix. And personally, I think this is very overwhelming and you don't need this. But it's about having the dealing range. You already know what the dealing range is. It's from a swing high to a swing low, and you have the range in between. And the different PD arrays are all highs and lows, rejection blocks, order blocks, fair value gaps, liquidity voids, breakers, mitigation blocks on both the premium side and the discount side. Again, you don't need all of this to make money. Don't let anyone tell you you need to memorize these or to use them all. That's not true. This is all way too confusing and you only need 3 of those. If you're not careful, you're going to look like this, where you need to memorize all of this and all the nuances and take it all step by step. And that's what we're going to do right now. Starting with my favorite, the fair value gap. If you compare that when the first candle's high and the third candle's low do overlap, there's no fair value gap. You need to know the difference between the two. And of course, similar for a bearish fair value gap, also called a sell-side imbalance, buy-side inefficiency, a SIBI. The first candle's low does not overlap with the third candle's high. And the fair value gap is the most powerful magnet because price hates gaps. It wants to fill them. It's also called imbalances. Price wants to rebalance before continuing the move. So if you see a fair value gap above or below current price, price likely want to trace towards it. And this is how you can spot a fair value gap. It is a 3-candle pattern. When you see a massive candle, you see this one right here, and there is a high from the first candle and a low from the third candle. There is no overlap. So there is where the fair value gap is created, right here. You see the price comes back into it and then moves away right here. There's another one here with a high of the first candle, low of the third candle, and it taps into it and moves away. And it creates an even bigger one right here, where it is here for a while, comes back to it, and then moves away. And you can keep doing this. If you're trending, you will see that fair value gaps will keep holding. From the 3 PD arrays, you need 1 fair value gaps and 2 is the order block. And if you know how to combine fair value gaps and order blocks, there's where I make all my money. It's so stupidly simple. So listen up. With a bullish order block, you first need to have sell-side liquidity. That is old lows. A bullish order block is a series of bearish candles that sweep the sell-side liquidity before breaking structure to the upside. The break of structure is when the last swing high before the down move is violated.
That's happening right here. And when that happens, these two candles are the order block. So what you'll see is there's a liquidity sweep, then a break of structure, and then price wants to come back to the order block and then continue the move. If you look very closely here, a lot of times for your most high probability entries, there's an overlapping part between that order block and also a fair value gap. So then we already combine two of the three PD rays together for a very nice entry. So don't think when you see this candle prints that it's gonna go higher without you. Price loves to come back to imbalances and to order blocks to then continue the move like this. If we look at that same example with the fair value gaps, you also see a series of down close candles before the move up. This down close candle is an order block. Mark out the start of the body. Then you see this candle trades into the fair value gap and then price moves away from it. So this candle also is the order block right here. And if you then go higher up in the range, we have a series of down close candles before we go higher. Again, bullish order block. And there's overlapping parts between a fair value gap and an order block. And you see how price comes back to it right here and then moves away. So now you know how to identify fair value gaps and also order blocks. And the third PD array you need to know is liquidity, swing points. If you hear liquidity, don't overcomplicate this. It's nothing more than old highs and old lows, where you need a swing high, and a swing high is a high with a lower high to the left and a lower high to the right. Why is a swing point, a swing high so important? Because there are stop orders, stop losses. So people go short here and put their stop orders below here because they think price will go lower. And same for swing lows. A swing low is a low with a higher low to the left, a higher low to the right, and there's stop losses, stop orders below these swing lows because people go long here with their stop loss below here because they think it's going to go higher. Price loves to get stop losses because there's liquidity there. And that's why we call it buy-side liquidity. There's a swing high here and there's stop losses from short traders. And there's not only stop losses from short traders, but there's also breakout traders who want to go long here. So there's a lot of liquidity resting above this high. That's why it's called buy-side liquidity. Same for below a swing low. You both had stop losses from long traders, but also traders who want to go short below this low. So there's sell-side liquidity sitting here. So next time you hear the word liquidity, just think about old highs and lows. And the three most important liquidity pools are weekly highs and lows, daily highs and lows, and session highs and lows. And with session, I mean London session, the Asian session, and the New York session. Also referred to as kill zones. If you want to know more about kill zones, there's a dedicated video about that on this channel as well, together with liquidity. If you go back to the same example, but I'm talking about swing points, we have a swing low right here. There's sell side liquidity resting below here. And we sweep it before making that move, creating the fair value gap and the order block. So when you see this signature in price right here, with the 3 PD rays, with the liquidity sweep, with the fair value gap and the order block, there is where you can have a high probability reversal on your hand because this is already a very strong structure. And now we are at the 4 hour. If you look at this exact price action, but then on a lower time frame, you will find a similar structure appearing as well. So here we're not looking at the 4 hour, but on the 15-minute time frame, and price is fractal. So what happens on the higher time frame also happens on the lower time frame. So what do you see? There's a liquidity sweep, there's a swing low being taken out, then we displace, leaving a fair value gap. And there's also before series of down close candles that swept liquidity, and that's the order block. You see the price moves away from that, and then price displays again. What do you see? Fair value gaps. I also see a short-term liquidity sweep right here, swing low created before the move upwards again. And we keep doing this exact same thing over and over and over. So we briefly discussed fair value gaps, order blocks, and liquidity, but there are dedicated videos for this on this channel. So if you want to dive deeper into that, I will leave the link to that in the description and you can find them on this channel. And I'm sharing all my ideas and frameworks inside my Discord. Not only do I share all my insights together with weekly outlooks, there's a group of amazing smart traders who are just printing money, and you can find all my resources, frameworks, and everything you need to become a profitable trader. I'll leave a link to the Discord in the description, and yes, it's free, so join now. Now let's see these 3 PD rays in action. Starting with liquidity, we're looking at NASDAQ here at the 50-minute time frames, and these concepts are fractal. That means they can be used on all the different time frames. You can use different time frames together. It's called time frame alignment. Please check out my time frame alignment video as well. So here during the Monday New York session, we sweep a old low right here. There's a liquidity sweep. There's sell side liquidity taken. After that, there is series of up close candles. And inside this up close candles, there is a fair value gap created. Zoom in on that right here, because between the first candle high and the third candle's low, there's a gap. And here, price comes back here. See how clean price goes and then moves away. Another fair value gap right here. Looking at the time, if you trade NASDAQ around the New York Open, that means 9:30 a.m. EST. That's not here. We only at 8:30, so we're not there yet for an entry. But we need to use this. And also, we have a series of down close candles that trade into a key level that is an order block. Also here, these series of down close candles can be marked out as an order block. And there is a fair value gap created between the first candle's high and the third candles low. So for the open, here is where you can take potential trades because 9:30 is coming. If we zoom out to the higher time frame, we have been pretty bullish for the past couple days. So I have a bullish bias. And then inside this 15-minute fair value gap and order block, I'm going to drop to the 1-minute time frame to find an entry around the New York Open using these three concepts. So we're now at the 1 minute and we are approaching the New York Open. It's now 9:28 and this is the 15-minute bullish fair value gap and order block. We're in a 1 minute and we have some short-term liquidity here. Let's see if we can run that. Going higher and here at 9:30 exactly, we sweep that liquidity. Well, this is just liquidity. We need all three. So we need a liquidity sweep, we need a fair value gap and an order block. After that, the next candle displaces over it, creating the order block right here. After that, we trade back to the order block 2 times and then starting moving away. What do we leave behind? A fair value gap right here. So here is the entry. So the 3 PD rays you need, a liquidity sweep right here. We have an order block right here with this down close candle that sweep liquidity. And now we also have a fair value gap in this structure. This is a high probability trade. Take the trade in the fair value gap. Stop can be at the order block. So we already tested it. I'm not expecting it to come back where I wanted to. Price goes to TP very easily. You could even catch a 1 to 3 on this trade. All using 3 PD rays only. So no mitigation blocks, no breakers, nothing. Just liquidity sweep for value gap and order block right here. Okay, but what if we now fast forward to the next day? So this was the Monday we took this trade. What if we fast forward to Tuesday and we're going on the 4 hour to see if there is a key level? And a key level, I mean a fair value gap. So here I see a bullish fair value gap sitting right here. These are 2 key levels. So this is what I'm marking out on the chart. And then I'm going to do exactly the same. Going to drop to the lower time frame, now to the 15 minutes. You see inside this level during the New York Open, do we get the exact same structure? And the structure is we trade into a key level, the 4 hour bullish fair value gap, and we have the 3 PD arrays. It is the liquidity sweep right here and the break of structure with the order block and a potential fair value gap. That's what we look for. To screenshot this because this is what we want to see at the New York Open. Now let's fast forward. And here's 9:15. So let's go to the 1 minute to see if we can find a similar setup, different day. So we're almost opening and then we trade lower. So here we have a bullish bias, but this is not very bullish. At some point now, we are creating bullish structure. So we sweep some short-term liquidity right here into a key level, the 4 hour bullish fair value gap. And now we already create a fair value gap right here. I don't trust it yet. I want to see a little bit more. I want to see reaction from this. And we do get that here. So right now, there's not only a first fair value gap, but we have a series of down close candles that trade into a fair value gap. There's an order block sitting right here. And also a fair value gap created right here. So let's see if price comes back there and reacts from it higher. And we do. So when this happens, you already have enough to take a trade. Let's see the next candle. This enough. So let's see you're late to the party and you're going to take your trade. In this trade, your position is defended by a 4 hour bullish fair value gap. That's the big box. Then a fair value gap, an order block, and another fair value gap. And of course, the liquidity sweep into a key level. Those are the 3 PD arrays you need. Stop below the last low. Again, for a 1 to 2. It will be a bigger trade than the one on Monday. Aggressive sells, aggressive buys, fair value gaps, and order blocks. Only 3 PD arrays. Liquidity sweep, order block, fair value gap. And only 40 minutes later, already TP. Only based on the key levels using liquidity sweeps, fair value gaps, and order blocks. And yes, these are trades I took myself on both challenges and funded. And these exact trades added $300,000 to my collection of funded accounts. One more thing. You're probably overcomplicating this. But the market is very simple. It moves from old highs and old lows to imbalances. From external range liquidity to internal range liquidity. From premium to discount. It's all the same. If you can just identify the next PD array, you don't need to predict every candle. You just need to ride the bus to the next stop. And this way you can be a thief in the market, being in and out and make your money very quickly. And if you want the exact checklist of PD arrays together with all my entry models and technicals I use to get over $1 million in funding, I put it all together in the Market Maker Blueprint. Link is in the description. And yes, it's free. And if you like this video, make sure you check out the video that's now appearing on the screen because it will help you using these 3 PD arrays because it will show you how to use time frame alignment, combining different time frames with these 3 PD arrays to filter out 90% of the false moves. So enjoy that one. Thanks for watching, and I see you in the next one. Bye-bye. Okay, listen up. You probably have been trading ICT for a while, but you just hit a wall. You wake up every single day, you think you know your bias, you know where the market is going, you know all the PD arrays, the value gaps, the order blocks, the breakers, but still you're losing every single day. And you just cannot get profitable. You have 4 things that tell you how to be bullish, 4 bias, you can frame both directions. Very annoying. And it makes sense. ICT did not make this easy. He created 100 PD arrays and you just need to navigate around all of these. I was at the exact same point over 3 years ago where my win rate was so low, I was losing every day. I was losing salaries in a day. But it was before I decided to take it in my own hands. And that's exactly what I'm going to do in this video. How do you simplify ICT? What are the concepts you actually need to focus on? Because there's a lot of background noise, right? Let's actually dive into simplifying ICT trading, increasing your win rates, and just rinsing prop firms. And really become consistent and hopefully down the line become a full-time trader. Without further ado, let's go ahead and look at the first concept that actually opened my eyes, simplifying ICT trading. And that's going to be the market maker model. You have 2 types of market maker models. You have market maker sell models and you have market maker buy models. And market maker models give you the direction of the market. So it starts with an original consolidation. We have the sell side of the curve where we're selling off. We see accumulation, expansion, relation, expansion. At some point in a key level, we reverse, smart money reversal, accumulate, expand, taking out the original high right there. It's called a market maker buy model, vice versa for a sell model. The price goes up, then does a smart money reversal and starts trading lower towards the lows right here. So I have a buy side of the curve, sell side of the curve. On the YouTube channel, I have a dedicated videos to understanding market maker models. I will leave the link to that inside the description, and also a little link to that right here. And the 2 concepts I'm discussing today, where one of them is the market maker model, has such a high win rate because it simplifies so many of the ICT concepts. It doesn't matter if you're trading for value gaps, order blocks, breakers. It doesn't really matter because all those concepts come back into these models. So what you'll see inside a market maker model is that we are on the sell side of the curve right here. And you will see price accumulating, then expanding, accumulating, expanding, accumulating, expanding. Same here on the buy side of the curve. But what you will see before it expands, you see a little manipulation. If you know the Judas swing, the ICT power of 3, the AMD, you accumulate, manipulate, distribute. We accumulate, then manipulate, distribute. Then we accumulate, manipulate, distribute. And before the distribution, many times you have a little accumulation here as well. Accumulation, manipulation, distribution. And that's the second concept. To really simplify ICT trading, you need to combine the market maker model with the AMD. So when price starts a sell model, for example here, most amateur traders just try to catch the move here and hopefully make some money by shorting this move. But they'll get stopped out because of the manipulation. If you want a high win rate, you need to wait out that manipulation. So you see displacement, you just wait for price to come back into for value gaps to then start a distribution of a move. And you can use market maker models on all time frames using time frame alignment. If you have a weekly level, trade a 4-hour market maker model. If you have a 1-hour level, trade a 5-minute market maker model. So what I mean by that is, let's say we are here in a 1-hour structure. If we zoom into this move right here, this is a market maker model of itself, but then on the 5 minutes. So this on the 1 hour, if you now go back to the 5 minutes, you will see this happening. You will see a little mini market maker sell model. So combining the accumulation, manipulation, then distribution, like your accumulation, manipulation, distribution, that will give you the buys every single day. But the question is, how can you combine these 2? There's one part of glue you need to have to put these one together. And it is called time. If you combine time with market maker models and the power of 3, you are golden and you will see the market through a completely different lens. Let me show you. You will start to see market maker models everywhere. Here, accumulation, expanding, accumulating, manipulation, distribution, smart money reversal, accumulation, manipulation, distribution, accumulation, manipulation, distribution. You're going to see this everywhere in your charts on all the time frames. So you can use this for both your bias, but also for your entries. So in this example as well, if you're at the 1 hour right here, then when price comes back into that 1 hour value gap, then is when you drop to the 5 minutes to find a mini market maker sell model. You wait for price to accumulate, manipulate, and then distribute on the 5 minutes. Same here, this little wick right here is during the New York Open. This on a lower time frame will look exactly like this, and there's where you can find your entries. So what if you now combine time together with the AMD and a market maker model? So right here, we have a sell side of the curve, accumulation, distribution, 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 leaving all these low resistance liquidity. Low resistance liquidity are swing highs that don't take out any other swing highs. After we sweep liquidity, what liquidity is swept here? It's a weekly low has been swept here. So there is a key level that has been violated, and we see some massive reaction from this. And if you look at the time, it's now 9:30, New York Open. And every day at 10 a.m., there's a new 4-hour candle opening. So my exact model, I'm using market maker models together with the AMD, accumulation, manipulation. That is right here. And now I'm anticipating a lower time frame market maker model to form. Anticipating price to aggressive sells, aggressive buys, and then start trading upwards towards at least these highs. And I'm using that by predicting the next 4-hour candle. So where on the higher time frame, we see a liquidity sweep in a key level. Here's where we expect a reversal. So we're expecting here a mini market maker model to form. On the lower time frame, we want to see accumulation, manipulation, distribution right here, and then start the market maker model. We then drop to the lower time frame. You see accumulation, manipulation, and the distribution is starting. So when that's starting, look for where is the lowest liquidity, where are we most likely headed. I would say the swing highs right here. Relative equal highs is also compared with session liquidity, Asia high. That could be our draw on liquidity for this specific trade. And now combining time with this every day at 10 a.m., there's a new candle opening, a new 4-hour candle. And based on this expansion, I'm expecting the next 4-hour candle to be a bullish candle. And if you understand the autonomy of a candle, we open, then we trade lower, manipulating, setting the low of the candle, and then start trading higher towards the high of the candle, and then close. If you do that at the 4-hour, I like to place at 10 a.m. every day. You can also place at 10 p.m. for Asian session and 2 p.m. for the PM session. I'm waiting for price to open. That's going to be here at 10 to trade lower and then start distribution higher. So from that perspective, let's drop even lower to see how we can find the entry. So the new 4-hour candle just started. I'm just waiting for price to trade lower and then start creating buy structure. Here's the bearish for value gaps. And then here we start trading higher. So we see an inversion for value gap sitting here. We have bullish for value gap right there. Entry, TP at the highs, 412. So price is now allowed to trade even into this bottom per value gap. And then you can just let price do its thing. So we have an accumulation. I'm anticipating this to be the manipulation, setting the low of the candle. And then we are supposed to start trading higher. We see there's another bullish for value gap created here with an order block. And price trades to the drawn liquidity. So at the bottom, we see accumulation, manipulating, distribution. If we zoom out, we see the start of a market maker model being formed with the sell side of the curve right here. And now the buy side of the curve is starting. We're actually looking at the live chart right now, so I cannot show you this, but in the next couple of days and weeks, I'm going to trade this to the highs. Just like, for example, a couple of weeks ago, where we saw the exact same thing happening. It's where we take out liquidity here. Aggressive sells, aggressive buys, starting from the sell side of the curve. Right here, starting the buy side of the curve. And here in these moves, you can drop to the lower time frame to find your entries. Also right here in this for value gap, lower time frame, find your entries. So find mini market maker models inside the bigger market maker models to have your bias correctly, and then use the power of 3. They use time to find high probability entries. And the one I show you here is exactly one I took this week. So it's not in hindsight, it's actually taken in real time. And I'm going to hunt this exact same model the next week and the week after. It's called a 10 a.m. game. So every day at 10 a.m. we look for this power of 3, the AMD, where we wait for price to open, manipulate lower, expand higher. If we are bearish, we play it vice versa. Wait for price to open, then trade higher, and then start the sell model. But this buys on lower time frame. It's only high probability if you understand that higher time frame picture with the market maker models, with the power of 3, and then combine the 10 a.m. game to rinse prop firms and skyrocket your win rate. I created a 10 a.m. game cheat sheet with all the entry criteria that I use every single morning when I trade. I'll leave the link to that inside the description. So simplifying ICT concepts with market maker models, the AMD together with the 10 a.m. game is all you need to start making money. If you want to dive deeper into market maker models, I'll leave the dedicated videos to market maker models somewhere around this video and definitely also in the description. So make sure after this video, you dive to the market maker models to fully master that. On this channel, there's also a video about the 10 a.m. game. I'll leave that step-by-step plan in description so you can keep learning, keep growing, and start getting payouts.
This is the market maker model, and it's the only signature in price you need. It has many different names: the V-shaped recovery, the smart money reversal, the head and shoulders. And it does not matter if you trade ICT, supply and demand, or support and resistance. All that matters is that it gives you the exact bias and signal for when the market is going to reverse. In this video, I will show you how to identify a drawn liquidity, how to use market maker models to create a daily bias towards that drawn liquidity, and how to combine different time frames to create those sniper entries so you can get funded and get payouts. No time to waste, let's get into the video. Before we dive into the model, you need to understand that price only does 2 things. If you're confused about your bias, it's because you don't know where you are in this exact cycle. The only 2 things price can do is grab external liquidity, also called external range liquidity, and rebalance. That means go to an imbalance to internal range liquidity. And the golden rule here is price only trades from internal range liquidity to external range liquidity, or from external range liquidity to internal range liquidity. liquidity. And let me show you what I mean with these two. External range liquidity is a fancy term for old highs and lows. So the first thing price can do is grab external range liquidity, simply going back to an old high or low. What you'll see in a classic buy structure is that we have higher highs and higher lows. And at some point we leave an old high behind and we start retracing. Where do we retrace back into? Internal range liquidity. Internal range liquidity means a fair value gap or an order block. In price, you will see that it goes from internal range liquidity back to external range liquidity. That's the first thing price does, goes to an old high or low. The second thing price can do is rebalance. And price can rebalance to two areas. One is equilibrium of the range. Equilibrium of the range means the 50%. And if you take the most recent high and the most recent low, that is the range. You go from swing high to swing low, and the 50% of that is called equilibrium. The price goes back from an old high, it trades back to equilibrium of the range. Second thing it can do is go back to an imbalance, a fair value gap. It also can be an order block. It goes back from external range liquidity, an old high, back to internal range liquidity, a fair value gap. That is the only two things price will do, or go from internal to external, or go from external to internal. In other words, it trades from a fair value gap to an old high or low, or it trades from a higher low back into a fair value gap. And all your trades must have one of these two IDs in it. If you are on the 1 minute or the 5 minute on a lower time frame execution, and you don't know from the higher time frame if you go from internal to external or vice versa, you are trading blind. So you need to have one of these two cycles in every single trade you take.
And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video.
And now you know about internal and external range liquidity. How can you frame trades around this? We need to find the highest probability trades. The highest probability trades mean that when you see your setup, that is the most likelihood that trade you take is going to be a winning trade. We want to have as many high probability trades as possible compared to low probability trades where we should not take them because we're most likely going to lose them. And the highest probability trades are with the higher time frame order flow and trend. And the higher time frame is the daily, the weekly, and the monthly. And what you want to see is higher time frame trending conditions. So when we make higher highs, higher lows on the higher time frame, we will go from internal to external, from internal to external, from internal to external. Basically from a higher time frame fair value gap or order block back to an old high. Same if you're bearish, we want to go from a bearish fair value gap, internal range liquidity back to an old low, fair value gap back to an old low. Keep doing that. If you know high probability conditions, you also need to be able to identify low probability conditions. And there is where the higher time frame is trending. Those are the lowest probability trades, higher time frame consolidations. And why they are lower probability? In consolidations, internal and external range liquidity, that means imbalances, fair value gaps, and old highs and lows are less likely to hold. So when you see a higher time frame consolidation, it doesn't really matter what you see on the 1 and the 5 minutes because it becomes low probability. If you see trending conditions on the higher time frame, for example, a long in this example, and then on the 1 and the 5 minutes, you also see very clean longs, then your time frames are aligned and it's very high probability. If the higher time frame is consolidating like this, and the 1 minute gives a very clean long or short entry, it becomes lower probability because this is what is behind your trade idea on the higher time frame. What you'll see is that we have an old low, and then we trade higher, creating an imbalance. So ideally, we want to trade from internal to external in trending conditions, but it fails because we go back to the old low, then we go back to the old high, back to the old low, creating a bearish fair value gap. We want to trade from internal back to external. We don't do that. And you will see that they just start failing. If you look, for example, here at gold on the daily time frame, you will see this exact thing happening. Before in trending conditions, there was a very clear internal to external. So we have trending conditions. This was the external range liquidity up here, and we just had very easy trades towards that. There's a daily fair value gap here, and even inside here. Here we have a fair value gap and we have an old high. We trade up internal to external. Then after that was a trade I took on a swing account. An old high sitting here. Let's make it a little bigger. Old high sitting here. We go from internal on the fair value gap back into external. Internal to external. Internal to external. Zooming out a bit. What do we have here? There is equal highs sitting here, and there is a fair value gap. And it's on the daily time frame. We can do the same on the lower time frame. We go from internal to external. It becomes fun because what do we have here? A fair value gap. We trade back into it. What's the most recent high? Right here. We go from internal to external. That is what you want to see. Trending conditions. That's the highest probability trade. And I made a lot of money inside this move. If you compare this now to the current price action on gold, and that's why I said to my students and also on socials, guys, maybe leave gold alone for a while now, higher time frame consolidation. And what you will see inside a higher time frame consolidation, and we're looking at a live chart right now, if you zoom in on that, so for example, you go from the daily to the 1 hour, your premium and discount arrays will not hold. So imagine you see this on the 1 hour right here, and you try to go to the 5 minute to find your intraday entries. It's just not going to work. Like, it's very low probability price action. So every time you take a trade on a lower time frame, make sure there's a higher time frame story behind it. We go from internal to external or vice versa on the higher time frame, and it's supported by some form of higher time frame idea. You will notice if you start doing that, one, the majority of the trades you might take are not valid anymore because it looks very sexy on the lower time frame, but it's very ugly on the higher time frame. And because of that, you take less low probability trades, meaning you take more high probability trades, and you just make more money. And you want to be reinforced, you want to be rewarded for good behavior on the charts. Start with this. It's a very easy fix to increase your win rate. And it's the exact same story on euro dollar. This is on the daily time frame. There's daily consolidation. Look at these daily candles, very small doji candles. So inside this, that's why you need to go to the higher time frame. If you want to trade inside here, inside this higher time frame, you now go to the 5 or the 15 minutes for your entries. Like, for example, right here, this looks very sexy. This looks like a very nice buy structure. And then when you trade higher, right? Wrong. We just trade lower. This signature price looks like a nice reversal to the upside, and it doesn't happen. Why? Because there's a higher time frame story telling you to stay away. And that's fine. So then you know what to remove from your trading to get better results. That's awesome. And if you then go back to the highest probability trades, you're like, yeah, nice daily, weekly, monthly, the higher time frame. But how can I trade on the lower time frame using this concept? There is where market maker models come in. So in those V-shaped moves right here, there is where you go to the lower time frame. So look for market maker models inside the internal to external range move. And the V move on the higher time frame is a market maker model on the time frame below. Let me show you what that means. This is the market maker model. We're going to dive deep into this exact schematic. But what I want you to remember is that inside every V right here on the higher time frame, you can spot this on the lower time frame. The rule here is a higher time frame internal to external. There's that V shape here is a market maker model. And what exact is a market maker model? A market maker model has two different stages. It has the sell side of the curve, is when we are selling off, obviously, and it has the buy side of the curve when it's going up. And this is an example of a market maker buy model. So we will go up. First we'll go lower, then we'll go higher, and we reverse at some point. And what you will always see in a market maker model, the starting point is a original consolidation. After that original consolidation, you will see price selling off into a key level. And the key level most of the time is a higher time frame for value gap, order block, breaker, just a PD array. If you trade support and resistance or supply and demand, it can be a demand area, support area. You get the point. Into a key area where you expect on a higher time frame price to reverse from, to react from. And price will sell off most of the time in 2 or 3 stages. Just very quick, rebalance, go, until you reach that key level. And what it will leave behind is low resistance liquidity. And low resistance liquidity means liquidity that do not take out other liquidity. So for example, this high does not take out this high. So once we come back here, this low resistance liquidity, it'll be very easy for price to just trade through them, completely ignoring it. So you will see very clean, aggressive moves when we come back here in these areas. So we have the sell side of the curve, we trade to a key level, hold low, release your value gap, order block breaker. There is where we're gonna see something called the smart money reversal. And this exact schematic every day on my live stream with my students and also on the YouTube streams, this is where I look for every single day on NASDAQ, on gold, on the Forex pairs, everything I like to trade. Aggressive sells, aggressive buys in a key level. That's the schematic every single day. And that's called a smart money reversal, V-shaped recovery. That's the key in the market maker model because that indicates the reversal. And what you will notice is there will be a market structure shift with aggressive sells, aggressive buys into the key level. Market structure shift in this move called a low risk buy. You will see a, for example, a fair value gap or an order block or an inversion fair value gap, like the PD arrays, and it can also be supply and demand areas or support and resistance areas. In this aggressive move, the V-shaped recovery, that already indicates we're probably making the reversal. And it will go from the sell side of the curve to the buy side of the curve. And also the up move, just like the sell move goes in a few stages, also the up move will not go up in one go. If you struggle with FOMO, know that the majority of the moves will not be in one go. It will be like this. It will give you 1, 2, or 3 entries to go up to the drawn liquidity. These are called a low risk buy, accumulation, and a reaccumulation. Those are fancy terms. Just remember that in a up move, in a market maker buy model, you will have more than one opportunity to get into the move, to trade back into the buy side liquidity, the draw on liquidity. And before we dive deeper into how we can use the market maker models to get actual entries, we need to dive deeper into the concepts around the smart money reversal. Those are the market structure shifts and the SMT. The SMT is a crack in correlation. There's 2 correlated pairs, and correlated pairs are, for example, NASDAQ and ES, or euro dollar and GBP, US dollar, gold and silver, Bitcoin and Ethereum. And correlated means if one goes lower, the other one goes lower. If one goes higher, the other one goes higher. But what will happen with an SMT is there's a crack in that correlation. So one of them does not go lower, and it indicates a potential reversal. So if we trade back into an old low, for example, and NASDAQ makes a lower low, but ES does not make a lower low, there is a crack in correlation, because ideally they both need to go lower, and it doesn't happen. And what this indicates is that we might want to reverse. You, of course, want to see this in combination with the aggressive sells, aggressive buys, also with a market structure shift. The market structure shift, very simple, is when the last swing high that made the low is violated. So if you can draw a line here, that's the last swing high that made the low. When price trades through that right here and closes above it, there we call it a market structure shift. So when you have an SMT and a market structure shift, you see the aggressive sells, aggressive buys, you know, hey, we are in a key level, we might start the reversal. And that is why a clean reversal most of the time revolves with an SMT and a market structure shift before we start the buy side of the curve, where we're gonna start discount array hunting. And with the discount array hunting, I mean, is in these areas where we're gonna find our entries, there is where we're gonna look for the fair value gaps, the lower time frame structure, to trade towards the buy side, to trade back into the original consolidation, the old high. And here is where it gets fun, because a market maker model is fractal. And what that means is what happens on one time frame also happens on the other time frames. So this is the depiction we just discussed. And inside all of these blue areas, those are also fees. So inside of areas, there are mini market maker models appearing as well. So when this original move is a market maker model, for example, a daily fair value gap to a daily high, inside that market maker model, we're going to look for lower time frame market maker models inside the market maker model. Market maker modelception, it's fractal. And there is where different time frames come in. I have dedicated videos on time frame alignment here on this channel. In regards to market maker models, the only thing you need to remember is this, is that if you are a swing trader and you look for a monthly internal to external, use daily market maker model. Your weekly, look for a 4-hour market maker model. If you go from daily internal to external, look for a 1-hour market maker model. And if you're a swing trader, there's where you stop. You don't need to go lower. I know most of you watching are more day traders or scalpers, especially like the NASDAQ and the 1 and 5 minutes. There is where we need to dive a little bit deeper. So if you see a 4-hour internal to external, go to the 50 minutes to find your market maker models. If you're trading a 1-hour internal to external, look for 5-minute market maker models. For a 50-minute internal to external, wait for 1-minute market maker models. So one of my favorite entry models, the 10 AM game, is a scalping model where I execute under 1 minute. The time frames, I use a 4-hour internal to external, the 4-hour. I use a 15-minute market maker model for this. So I use this one. But what I also use inside that 15-minute market maker model, so this is the 15 minutes, I use these ones, the lower time frame ones, on the 1 minute. So inside the bigger 50-minute market maker model, I wait for on the 1 minute, mini in these blue areas, look for 1-minute market maker models. Market maker model, you know the depiction. This is a lot of information. Just remember this depiction. We trade lower into a key area. We have aggressive sells, aggressive buys. Then we start trading higher. This needs to be at a key level. Needs to be a market structure shift, ideally an SMT, and look for PD arrays like a fair value gap, order block, supply and demand areas. Just look for areas that can hold price to trade higher. And this always vice versa for bearish structure, if you go from internal to external lower. And the fun part about these educational videos is that the majority of the viewers stop watching the second they need to put in some work. So next up, we're going to look at examples how to use these exact frameworks in the charts. And at the same time, after this video, you cannot just watch this, magically remember it, and start making money. You need to go to the chart yourself and build some case studies. That means go to the chart, see if you can recognize these market maker models, and see if you could, in hindsight, would have taken certain entries yourself as well. You can just screenshot them like a journal entry and build case studies. And with those case studies, you train your eyes to see this in the chart before it happens. And I'm going to help you build those first case studies right now on the chart. Let's go. If you look at this example on gold, there is on the daily time frame here, there's a old high sitting up here, and there's a daily bullish fair value gap. We expect on a daily time frame to go from internal to external. That's the bias we have from the higher time frame. Internal range liquidity, old fair value gap to an old high. With that idea, let's drop to the lower time frame to see if we can spot a market maker model. Going from the 1 hour, let's see what we do once we trade into the key level. This is the daily bullish fair value gap. We're now in the 1 hour. And here is where we trade into the key level right here. Do we see a smart money reversal? So if we now expect a market maker model to form, it is very nice that we have some failure swings. We have a clear draw on liquidity, and all we need to wait for is, with this failure swings, is an aggressive sells, aggressive buy. So we already have a liquidity sweep here. Let's see if we can see some aggressive buys. We need to see big green candles coming in. We just wait for that. If you're not on the chart, you just need to wait for this to happen. Cool. Awesome. Zoom in a little bit on this. We have some green candles. If you see this move, you already think I missed the move. But that's the power of the market maker model. Now you know you don't. Price rarely goes up or down in one move. So there's a 1 hour bullish fair value gap sitting here. So from that point, you have another internal to external on the 1 hour, internal 1 hour to external. So we can even play inside this. If you are not a person who trades on the 1 hour, you can go to the 5-minute now to see if you can find an entry from a 1 hour internal to external with 5-minute market maker model inside this 1 hour market maker model. That's why the market maker model is fractal. So the green line here is the 1 hour high, and here's the 1 hour bullish fair value gap. So let's see if we create a market maker model inside here. Zooming in here, we trade into the 1 hour bullish fair value gap. There's a horizontal consolidation. There's a mini market maker model here. We have the aggressive sells, aggressive buys. We see a fair value gap. There's another one right here. Let's see if we can trade in back to that. We don't, and we just push higher. We then zoom out back from the 1 hour. We see how clean we moved away from. We are in a daily internal to external. So draw liquidity on the daily is very clear, and using it on the 1 hour and the 5-minute now. There's another fair value gap sitting right here on the another 1 hour. See if we can use that to trade to the drawn liquidity. And here you see the delivery is less clean. It takes a while. It takes a few days here. So here inside this day on the lower time frame, you most likely did not find an entry because there's no clean displacement like this candle, for example, from this 1 hour fair value gap. But what we do have is an order block sitting here, which is being respected by all the candles. But that's nice. So from this point, we can just drop back from the 1 hour to the 5-minute to see if we can find the entry. So here's a big consolidation. So there's nothing going on here. So let's see if we can find an entry later. We expect price to go from 1 hour bullish fair value gap and order block towards the high on the 5-minute. What do we see here? Signature in price. There's a liquidity sweep. There's a market structure shift, leaving a fair value gap. There's where you could take your entry. Mini fair value gap or 1 to 2. And price delivers to that. Here on the 5-minute, all based, zoom out back to the 1 hour, all based on that daily internal to external and the 1 hour market maker model. And we're not done yet because the actual target on the daily was here. So we're not done yet. We can still try to take more trades. Because price comes back and then goes. I'm not going to bore you with 5 or 6 examples inside this price action, but this is how you can spot how fractal price is. We go from internal to external on the daily. Inside that on the 1 hour, we can find multiple 1 hour setups. And inside that on the 1, 5 or 15-minute, you can find your intraday entries as well. And now zoom out back to the daily. All we did was trading these 4 daily candles, all looking for longs until we reach that old daily high. Here we're looking at NASDAQ at the 15-minute time frame. And let's train your eyes on the market maker model. Here up top here we have a original consolidation. Why is original consolidation? Because it consolidates, not rocket science. So we're going to mark this out as an original consolidation. That is going to be the draw on liquidity once price starts making the smart money reversal. And here we made this sell set of the curve. So we have a fair value gap here. We trade lower, order block, trade lower and lower and lower. At some point, we stop trading lower and we see some reaction from it. We see aggressive sells, aggressive buys. And what I want to see in a smart money reversal, for example, is this is a bearish fair value gap and it's ignored. We trade over it. It doesn't react from it. It's interesting. So this becomes the inversion fair value gap. And at the same time, there are bullish fair value gaps created. One here, also one here. The only part between a fair value gap and an inversion fair value gap is called a balanced price range. Very nice area to trade from. PPR, also an order block here. So there's a lot of PD arrays for a smart money reversal. Aggressive sells, aggressive buys. And let's see if we move away from here. We trade into this fair value gap and then we start moving away from it. That is interesting. Very interesting signature in price. So here is in this market maker model is where you already can take your entry right here. If you want to execute on a 50-minute, you can do it here. You can put your TP at the original consolidation, a high here. You want a 1 to 3, you should be good like this. This will be the first trade idea from a market maker model. This is on the 15-minute. And also we look at the time. This is during London. NASDAQ moved during New York. So probably later this day we can get a better entry. But this is already a first idea you can trade from this entry because you just expect a market maker model to form. We have an original consolidation. We create failure swings during this move. You remember the low resistance liquidity. Those are highs that do not take out other highs. So once we trade higher, this is going to be very easy. We're going to just pierce straight through. Then you fast forward a bit closer to the New York session. You'll see that we already started moving. We're now approaching the New York session. So here at the New York Open at 9:30, you will see that we sweep liquidity down here and then start trading higher. So the second trade idea could already be right here. Same TP, stop below the low or 1 to 2. And then fast forward, price completes the market maker model. 2 very clean trade ideas from a 15-minute market maker model. And inside this 15-minute market maker model, you can go to a lower time frame to find more entries around this. But this is how you can see this depiction. If you anticipate this to happen every time we hit a key level, you train your eyes, you see the original consolidation, you see the sell side of the curve into a key level. We made the smart money reversal with all the PD arrays. You start taking entries here, and you just trade towards the draw on liquidity. Trading doesn't have to be hard. You just need to know where to look for. If you stop chasing random candles and start waiting for the higher time frame to give you that drawn liquidity using internal and external range liquidity, then wait for market maker models to navigate you on a lower time frame, and then use high and low resistance liquidity to take your entries. You will see your consistency change overnight. And if you got value from this video, make sure to check out the video that is now appearing on the screen. This video will help you using market maker models together with high and low resistance liquidity, so you can use market maker models to get even more cleaner and precise entries. Let me know in the comments below what was your biggest takeaway, and don't forget to subscribe because I post one of these videos every single week. Thanks for watching, and I'll see you in the next one. Bye bye. I spent 3 years getting wigged out by random volatility. I would enter a trade, get wigged out by 1 pip, and then watch the market run exactly as I predicted. The truth is, these wicks aren't just noise. They are hidden hints, physical evidence of price wanting to go a certain direction. And because I ignored them, I was the liquidity. In this video, I'm going to show you exactly how to use wicks to catch reversals, and the 50% rule I use to catch sniper entries that 90% of traders miss. I use this exact framework to gain over $1 million in funding, over 100K in payouts. I'm pretty confident it will work for you too. Let's get into it. What most of you don't understand is that behind a wick, there's a hidden story most of you are missing. And this is the physics of a wick. Most of you just see a line on the chart. But here is that hidden story. Price is fractal. That means a wick on the higher time frame is actually a trend on the lower time frame. Let's look at a candle with a longer, lower wick. What actually happened here? Price opened, sellers stepped in and pushed price down aggressively. Buyers stepped in, absorbed the selling and pushed price all the way back up. And then price closed. But the wick at that bottom, that is where buyers and sellers are fighting. This is where sellers try to kill the trend and they failed. And that wick represents trapped sellers. They are underwater and losing positions. So when price comes back to that wick, those sellers are praying to get out break even. Buyers are waiting to defend that territory back up. And this is why you shouldn't treat wicks just like an empty space. You should treat them like hidden order blocks. But we don't just buy blindly. We need a rule. And that rule is called the 50% rule, or in ICT's term, consequent encroachment or equilibrium of that wick. I try to keep things simple, so I just call it a 50% of the wick. But it's all different names for exactly the same beast. It's the midpoint, the 50% of a wick. Here's the protocol. Write this down. We measure the wick from the body to the end, and we mark out the 50% line. Now we have a binary scenario. The market can only do 2 things. The first thing it can do, scenario A, is respect it. That means if price trades down into the wick, but the body of the next candle closes above the 50% line, that means the defense is holding. The buyers are strong, the reversal is valid, and this is where we can look for lower time frame entries to go long. The second thing that can happen in this binary scenario is that it doesn't get respected. And this is what nobody talks about. It's like, what happens if the wick fails and it isn't respected? If price trades into the wick and the body closes below the 50% line, it means the defense has failed and the sellers are stronger, and that wick is no longer support. It is now a magnet. The market will likely want to fill the entire wick and go lower to the low of the wick. And this is where the monkey brain gets challenged, because you see price in that wick and you're like, it's probably support. Let's just buy blindly. If you really want a high win rate using this, don't do that. You wait for evidence. So that means in this buy scenario, above the 50% means you buy, below the 50% means you can look for sells or just step aside. And inside this higher time frame wick, you will find lower time frame structure. You will also see this in the examples we're going to discuss after this. We are not predicting. We are reacting to the data. We wait for the actual candles to be printed. Wicks are either barriers or they are bridges. And at 50% line tells you which one it is. Perfect. So I just gave you the secret sauce, and now you can just take it and trade profitably, right? Not even close. On this YouTube channel, I only focus on the 10% of trading, the technicals, which is what you guys want to hear. And knowing technicals is kind of like having a really cool car, but your wheels are missing and it's driven by a 7-year-old. The chances of you getting anywhere is approximately 0. And that is what I teach my students in my inner circle program. If you want to check it out, it's the first link in the description. In this first example, we're looking at ES at the 4-hour chart. And this massive wick was created after we sweep some liquidity right here. So using this framework, this wick, mark out the body to the top, 50%. And for the next candle, we want to play an open, high, low, close, where price is respecting the 50% of the wick. There's also a 4-hour bullish fair value gap sitting here. So all in all, we have a bearish bias towards this area. If we then drop to the lower time frame, for this next candle, we want price to open and not create structure above here. We want it to stay below in the bottom 50%. Price opens and we trade immediately towards it. Price comes back here inside this area, but it respects the 50% and then trades lower. In this next example, we're looking at the NASDAQ at the daily chart. And this Thursday candle made a wick. And for the next trade, we look for, do we respect the 50% of the wick? If you want this on your chart, you can go to the top left here, choose Fibonacci retracement, and then inside settings, you can just copy this where you have the 0, 0.5, and the 1 and the colors attached to it. We drop from the daily to the 1 hour. We wait for price to open on the next day. That's right here. And wait for the New York session. Where the New York session is, there's where the NASDAQ moves, just like ES and YM. And we see a bullish 1 hour fair value gap. And the goal is for this day is to play an open, high, low, close where the 50% of the wick of the daily is respected. And the question is, do we do that? We trade into it right here, but the body is respecting here at 10. And it's interesting. And now we can even drop to the lower time frame to play the exact same game, but then from a 1 hour wick, let's go to the 5 minutes. So here for the next candle, we want price to play an open, high, low, close where we respect the 50% of the wick. And obviously we do that. Why do we do that? Because on a lower time frame structure inside that wick, we already had aggressive sells, aggressive buys with multiple fair value gaps. Fair value gap 1 here, fair value gap 2 here. Also an order block with a breaker. So here was already where you could take your entry here at 10 and 40 with your stop loss below this fair value gap where I wanted to, and you could have TP very quickly right here. And that was all based, if we go back to the daily, all looking at how the 50% of the wick is respected. Once we see the rejected here on the 1 hour, which we did right here, we traded into the 50% of the daily wick and then rejected here at 10 during the New York Open. And then you can take a trade using that bias and that logic. In this next example, we're looking at YM at the 1 hour chart, and we just created a massive wick right here from the body to the bottom. 50%, we want this to be respected. This wick not only swept liquidity right here, also traded back into a 1 hour bullish fair value gap. So for the next candle, we want the 50% as our key level to see if that's respected. And we create structure from it from an open, low, high, close perspective. We want to trade continuation. Let's drop from the 1 hour to the 5 minutes to find the structure. Here we see that same wick in action, and inside the structure of that wick, I see a massive down close candle that swept the liquidity. That is a order block. Overlapping with that order block is a fair value gap. So this is a area where you could take an entry. Is there clear drawn liquidity? Yes. There are failure swings up here. You can just pick the first swing high right here as a target. You can also pick the other highs or a 1 to 2, where your stop is even covering that 50% of the wick. And the price comes back here, all based on the 1 hour wick, where we zoom in inside that wick on a lower time frame structure, where inside this lower time frame wick, we saw this exact structure forming for the entry. And this is the exact trade I took to get a 5K payout from one single trade. This is everything I had to share with you for today. If you want the exact technicals and entry models I used to get over $1 million in funding and over $100,000 in payouts, make sure you get the Market Maker Blueprint, where I explain everything in detail. It is free and link is inside the description. And if you got value out of this video, make sure you check out this video that is now appearing on the screen. It shows you step by steps on how to combine wicks with time frame alignment, so you can filter out 90% of losing trades. So make sure you check it out right now. Thank you for watching, and I'll see you in the next one. Bye-bye. Is there really an algorithm? And even if there was, the only thing you need to know to make money is if price is more likely going to go up or down. The truth is, the algo does not matter, because all you need is order flow, in what direction price is going. Understanding order flow played a massive role in becoming a full-time trader, living all over the world and currently pulling up 5-figure months while living in Vietnam. In this video, I will show you step by step how to read order flow to create a daily bias, and how to use that to execute on a lower time frame. So you can just copy this to become funded and get payouts. No time to waste, let's get into the video. The first thing you need to know about order flow is very simple. Are we bullish or are we bearish? Order flow is a fancy term used by gurus to just identify bullish or bearishness. For most intraday traders and scalpers, the entry time frame will be on the 1 minute, the 5 minute, or the 15 minute. It means for the highest probability trades, your entry should align with the current structure. During this bullish structure, you want to take as many longs as you can. And if you are bearish, you want
to take as many shorts as you can. You can identify market structure very simply. In a bullish structure, you will have a high, a low, a higher high, a higher low, and we'll just keep making higher highs and higher lows to the upside. In a bearish structure, a high, a very low, then we have a lower high, a lower low, lower high, and we keep trading lower. Only thing you need to understand about structure. Bearish structure you can identify by making lower highs and lower lows. Once we hit a key level, we need to be able to identify a shift in structure. And what that means is that price goes from bearish to bullish. And a valid market structure shift has only three things. The first thing is a liquidity sweep. That's a sweep of an old low or inside a key level, a discount or a premium array. In this example, we trade into a discount array. That can be an old low, a fair value gap, an order block. And the second thing is displacement. And displacement is a fancy term for a big, energetic, one-sided move in the opposite direction. If we are bearish, this displacement means a one-sided move to the other direction. Ideally, leaving a fair value gap. And a market structure shift is confirmed when the last high, that is this high, that made the low is violated. So we can make a line right here. Here is where the market structure shift happens, right here. And what you will see is price comes back to that area and then starts moving away. And what does it do? It creates higher highs, higher lows, and we have bullish structure. And here's a secret how I identify if we're going to have a change in order flow and change in structure. And that is that you will see bearish arrays, premium arrays, you will see failing, and you will see bullish arrays holding. Inside a reversal pattern, on the sell side of this curve, you will have bearish fair value gaps and bearish order blocks sitting here. Those are the premium arrays. And what I want to see in a valid change in order flow is that these arrays are filled. So for example, we have an order block here sitting as well. Whatever arrays you can find here on the bearish side, mark them out. And once you see they're completely ignored, for example, a bearish fair value gap becomes an inversion fair value gap, a bearish order block becomes a breaker. At that point, you already have a tiny hint. At the same time that you want premium arrays to fail, to be ignored, you want bullish arrays, bullish fair value gap, bullish order blocks to be created and respected. So if I look at all my winning trades, this always happens. Is when we trade into a key level, we made the aggressive sells, aggressive buys. There's a displacement, so we break structure, and then I will wait for this to happen. The price ignores premium arrays, bearish arrays. It respects bullish arrays. When I see that inside this piece of price action, I'm going in towards a obvious draw on liquidity. 90% of my trades look exactly like this. Using this small secret about how to spot changing order flows. Here on NASDAQ, you can see the secret in action on how order flow is changing. First, we have bearish structure. We have lower highs and lower lows, lower highs, lower lows. But at some point, when we trade to a key level, you see the structure shift happening. You see a liquidity sweep and displacement higher, creating a fair value gap. This is price indicating that we might want to go higher, want to change the order flow from bearish to bullish. So then we're going to create higher highs, higher lows, higher highs, higher lows. We're going to create bullish structure. But at the same time, you want to see bearish arrays failing. Here already, a bearish fair value gap filled. Bearish fair value gap filled. See how already price is hinting if you might want to go the other way. Also bearish order block filled. So this displacement already showed a lot about intention of the market from bearish to bullish. And price now displaces again. Another fair value gap created. And also there's an extra array created because there's a down close candle trading to a fair value gap. That's a bullish order block. So there's where entries can be taken very easily. Here in the fair value gap, stop below the low for 1 to 2. Where are we trading towards? If you go from bearish to bullish, you can target fair value gaps like this one from external to internal. You can also target the highs sitting right here because price will most likely visit them all. As you can see, price did not tap us in. Price moved away right here, tapped us in, and then went to the draw on liquidity back to the highs. So using failing bearish arrays together with supported bullish arrays is how you can spot changing order flow. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. But you cannot just go blindly to the 1 minute, the 5 minute, or the 50 minute, the lower time frame. Because if on the 1 and the 5 minutes, the structure looks very bearish. But if you then look at the daily and the weekly and we are super bullish, we go up very aggressively, your lower time frame structure is not likely going to hold and you will lose. And we want to avoid that. We want to take as many winning trades as possible. So time frames play a big role in this. Write this rule down. The higher the time frame, the more reliable the structure. A daily structure is more reliable than the 1 minute. And I've dedicated videos on time frame alignment here on this channel. I'll leave the link to that in the description. The most important rule about time frames in my trade plan is the more more time frames that are aligned with your trade idea, the better. So for example, if both the daily, the 1 hour and the 5-minute supports bullish structure, higher highs, higher lows, longs are going to be the highest probability trade. If on the weekly, the 4 hour and the 50-minute, everything goes down, we have bearish structure, lower highs and lower lows, then shorts will be the highest probability play. And to create your bias using order flow, you need to know what the most obvious draw on liquidity is. And the most obvious draw on liquidity can be found on the higher time frame, because price only trades to two things: external range liquidity, that means old highs and old lows, and internal range liquidity. Internal range liquidity is another word for imbalances, fair value gaps. And you can use internal range liquidity as a place to trade from towards an old high. External range liquidity, that's why we say we trade from internal to external, from an imbalance to an old high, imbalance to an old low. External range liquidity you can use as a starting point for price to trade back to internal range liquidity. That means you trade from an old high or an old low back to an imbalance. Those are the only two things price does. So once price trades into a key level, like for example an old low on a higher time frame, for example an old daily low or an old weekly low, and then breaks structure with displacement and a fair value gap, then we need to look for a trade from external range liquidity, an old low, back to internal range liquidity, and that's going to be a fair value gap. So then price most likely will make structure back to a fair value gap sitting right here. So here we're looking at the daily time frame, and there's a bullish fair value gap sitting here. We just had a massive displacement, also changing structure right here, the last swing high that made the low. You see here the same profile, liquidity sweep, displacement, fair value gap. And the trade idea here on the daily, we can use it as a place to trade from internal to external, back to an old high right here. This is going to be the bias on the daily, but we don't care about the daily. We want to execute on a lower time frame, but we're going to use this context to make money on the lower time frame. Let's drop from the daily all the way to the 5 minutes. So here we're looking at the 5-minute time frame, and we just trade into the daily bullish fair value gap. All we wait for is these bearish arrays to start failing, bearish fair value gaps, and bullish fair value gaps to be created and supported. So here you see bullish fair value gap being respected while bearish fair value gap being ignored. Again, price trades higher. Massive bearish fair value gap being inversed right now, and from there price trades higher. And after a little consolidation, you already identified that we're probably going to reverse from here. We're going to change from bearish order flow to bullish order flow here in the lower time frame, because you knew from the daily time frame we want to go from internal to external, higher towards the green line up there, and price goes from internal to external. So here you could have caught the absolute bottom, but you don't need to catch the absolute bottom, because in this whole move on the 5 minute, these were 2 entire days. So you could have found entries right here, but also right here. Most of the time on the daily time frame, if you go from internal to external or from external to internal, there are 3, 4, maybe even 5 different entry possibilities for you to make money based on that bias, all using the higher time frame. Okay, now we know how a change in order flow works and how to find the next obvious draw on liquidity, but how can we combine these two to take actual trades? For that, we first need to identify what dealing ranges are, and the dealing range is the most recent swing high and the most recent swing low. And a swing high is a high with a lower high to the left and a lower high to the right. Swing low is a low with a higher low to the left and a higher low to the right. And if you now see that logic in action, the change in order flow occurs when we have a liquidity sweep, then we have a break in structure, the last swing low that made the high is violated with displacement. This candle can be marked as displacement, leaving a fair value gap. And if you have the dealing range, mark out premium and discount. Premium is the top 50%, discount is the bottom 50%. And ideally, you want to take shorts in premium and longs in discount. When we go from higher highs and higher lows to lower highs and lower lows, we want to look for shorts. But it means we want to short in premium of the range, in the top 50% of the dealing range. And you see the price comes back here and then trades away. But that's not everything, because here we're looking at a 1 hour structure. If we zoom out here, because we need to find the most obvious draw on liquidity, if you remember the external range liquidity, an old high, back to internal range liquidity, there is where your eyes should go. So the bias on the daily was external to internal, and then we find the structure on the 1 hour time frame, and we can even drop lower to the 5-minute time frame to make it even more precise. So once you have your bias on the daily, you look for 1 hour structure, and you can even choose to long this towards the value gap and then short this again, but the highest probability trades will just be shorting from premium of the range. Earlier in this video, I mentioned that it's very important that your time frames are aligned. So if the daily is bearish from external to internal and the 1 hour is bearish, you already saw with the structure shift, your entry time frame, that can for example be the 5 minute, also need to align with shorts. And here comes the dangerous part, because let's zoom in on this up price action. On the 5-minute time frame, look at how clean that price action looks like. Super liquidity, structure shift, change state delivery, fair value gaps, order blocks, more fair value gaps, a perfect bullish structure. And if you see this, you're like, okay, Let's hold this trade to the moon. I can hold this. We're probably going up because this is such a clean structure. It is, but you are trading against higher time frame. Because you already saw that the higher time frame is bearish. We just had a liquidity sweep, change in structure, change in order flow, and we're most likely going to be bearish. But we are then trading only this, which can be a nice short-term trade, but the highest probability trades will be the shorts that come after. And let me show you this on an example on the charts. Now let's see how we can use dealing ranges together with the obvious drawn liquidity in external range liquidity to internal range liquidity in action. We just traded into external range liquidity. That's this box right here. If you then look at the current price action, we are very bullish. So we're going to trade from external back to internal, and probably on a higher time frame, we're going to do this. We're going to try to catch the retracement and then continue high. Let's focus on this price action. This is going to be the obvious draw on liquidity. There's another small fair value gap up here. And now let's drop to the 1 hour to find the dealing range. So now we look at the 1 hour at that same price action. So this is the external range liquidity up here. And we try to find the displacement range. And in this range here is where displacement came. We have a sweep sitting here. Then we have displacement leaving a fair value gap. So then we can mark out premium and discount right here. And then we want price to come back to premium of the range inside this fair value gap, and then we can take a short towards here. And this is a bias you can use intraday. If you, for example, know the AMD, the power of 3, accumulation, manipulation, distribution, that is what you can use inside this idea as well. So we can wait for manipulation here on the lower time frame and then trade lower. Now let's drop to the lower time frame to find an entry. If we look here at the lower time frame, we see accumulation, then manipulation, and we see that exact same structure, but then on the lower time frame, we see a liquidity sweep, then we see bullish arrays. Bullish fair value gaps. Let me remove this 1 hour value gap. We are in premium of the range, of the dealing range. We are bearish. Bullish arrays are failing. Already hint that we might want to go lower. Bearish arrays are created right here, and a small one right here. So now you can take your entry if you want already from this small one. We want to trade towards the daily bullish fair value gap sitting right here, or a 1 to 2. So we use the accumulation right here, manipulation into a key level in premium of the range. Then use that secret about order flow, change order flow in the lower time frame. We change from bullish to bearish because we see also bullish arrays fill and bearish array hold. Then use that, get tapped in right here. Use that to trade towards the obvious draw on liquidity that is right here. Order flow is just simply listening to the market. If bullish arrays start holding, the market shows its hand that it most likely wants to go up. If bearish arrays hold, price most likely wants to go down. Stop finding the flow of the market. Stop trying to predict. Just identify the dealing range, wait for premium and discount, and execute. Because if you can read the intention of the market with reading order flow, you don't need luck. You just need patience. And if you got value from this video, make sure you check out the video that's now appearing on the screen, because this video dives deeper into time frame alignment. So you can use order flow and pair it with the correct time frame so you will never feel confused again. Thank you for watching, and I'll see you in the next one. Bye-bye.
How often do you wait for a setup that you like? You wait for a market structure shift to happen and your price runs away without you. The key to fixing that is understanding the difference between a market structure shift and a change in the state of delivery. And this video, I will show you how we can use this to enter trades faster, alongside how I use this to gain over $1 million in funding and over $100,000 in payouts. With actual chart examples, so you can just copy paste this immediately into your own trading. No time to waste. Let's get into the video. First, let's take a look at the industry standards, and that's the market structure shift. I have a dedicated video on market structure shifts in this channel. I'll leave the link to that in the description. This is what every trading book or video teaches you. We have a low. After that low is created, we create a high that sweeps liquidity, takes a liquidity at a key level, ideally in an old high or an old fair value gap or old order block, and then starts to move away, displacing lower. So to get a valid market structure shift, you need displacement. We need price to physically break the structure and close below this low, and price tends to come back to that area before continuing the move. And you can combine that with other arrays like a fair value gap or an order block. And the pro of a market structure shift, it is very safe because the trend has confirmed it has changed. But the con is it is slow. By the time this candle closed, price already 30, 40, 50 points away from the top where the move started. So in this case, you would have been a pretty nice entry, but there are many occasions where price just rips lower lower. And also your stop loss, if you need to put your stop loss above the high, can be quite big. Your risk to reward is not super nice. So it will hit the targets, but it's slow and it's more messy. So this is for your notes. A market structure shift is a change in trend defined by displacement, a one-sided candle, and a candle close above or below, in this case below a swing low. And because a market structure shift is quite slow, quite messy, it is safe, but there's a framework where you can get into trades earlier, and that's called a change in the state of delivery. And this is more like the sniper rifle, because the algorithm delivers price in phases. It goes from buy side to sell side. So when we are trending into a key level right here, this is the algorithm offering buy side liquidity. And here we are not waiting for structure to break, which would be the last swing low that made the high. That's right here. Here would be the market structure shift. If you would wait for that, price would just move away without you. We need to look at the change in the state of delivery. And that change in the state of delivery happens when a single candle violates the opening price of the last sequence of up close candles. So we have 3 up close candles here. That's the sequence, and the opening price, that first candle, is where you mark out this change state delivery. So once that happens, it already happened with this candle. You can already take your trade with your stop above the high and your target down here. And when this candle is created, the market already hints at you that we're probably going lower. So for your notes, when price displaces and closes beyond the opening price of the last candle sequence that trade into a key level, validating it as an order block. We have a series of up close candles that made the high. When we close below it, there's an order block created, and that of course automatically also plays the change in the state of delivery, and you just wait for price to retest the order block and move away from it. And here's the mechanical difference. A change in state of delivery happens first. It validates an order block. This here's up close candles here, and this here's down close candles here, and it gets you in already in this candle when it closes. Similar right here. And a market structure shift happens after. Secondly, it confirms the trend. It happens later, usually when the order block has already been respected. So here's the order block has been created. In this candle, we test the order block and move away from it, and then only the market structure shift is created, leaving of course a fair value gap. So your entry in a market structure shift would be right here in this candle. Then in change state delivery, it would already be in this candle. So you're in way earlier. It's for the sniper entries. So you can use the change in state delivery to be already in the move, even before there's a structure break. So what I see really good traders do, and I use this myself as well, is you can get in already at the change in state delivery. And when you see the market structure shift happening, you can even choose to pyramid to add a little more contracts to your position already to make more money out of a winning trade idea. Now, seeing this happening on a video is easy, but spotting it live when NASDAQ is pushing 100 points in a few minutes, there is where it gets hard. I trade this setup live with my students every single morning inside my Discord, where not only there's a group of very smart traders, I share my own insights analysis here, together with weekly outlooks, boot camps, free resources, entry models, and way more. Link towards Discord is in the description. And yes, it's free. In this first example, we're looking at NASDAQ, and we just traded during the New York Open into a key level where we take liquidity and we start trading lower. And we want to see the difference in execution between a change in state delivery and a market structure shift. The market structure shift is when the last swing low that made the high, that is this high, is violated. That is with this candle. And usually when you have a market structure shift, you also want a fair value gap to be created and then take your entry in the overlapping part between a market structure shift and a fair value gap. The change state delivery is when the opening price of the series of up close candles that made the high is violated, an order block creation right here. And we see that after we do the change state delivery, the change state delivery already happens right here at this candle, because we already traded below the opening of the candle. So here already change state delivery occurs. After that, we see movement upwards. So for change state delivery, your entry right here, where we target the low right here. If you zoom out a bit, I think we can spot more failure swings we can target. We have these equal lows right here. We have a swing low right here. So there's many targets available, and it overlaps with these equal lows right here. There is where these change state delivery target trade would be. That's one. What if we use the market structure shift as our entry criteria, where we have the down close candle that sweeps that market structure shift low. The next candle does not create a fair value gap, which is not nice, because that's actually what we need to take that trade. Even if you want to be really precise and you just say, I'm going to take my trade at the market structure shift after the candle closed right here, same target right here for a 1-2. This is what your trade would look like. Your stop loss is not in a very nice place. What you can use for stop loss placement is of course above an old high, but you can also use the order block that has been created with a change in state delivery, these two up close candles. you can use the 50% of the bodies there, the mean threshold, and put your stop loss above there. That should be safe. And then your TP should be a little bit lower right here. So this one is the market structure shift. This one is a change state delivery. And let's see what we do. And both would have given TP. In this next example, we're looking at YM at the 5-minute chart. During the New York Open here at 9:25, we have a swing high sitting here. I have a series of down close candles. And what happened exactly at the open is that we displace higher. The market structure shift occurs right here, also overlapping with a fair value gap right here. The change state delivery happens where the open of the series of down close candles that made the low is violated. There's an OR block created because of it. So right here is the change in state delivery. For the entry on a market structure shift, you do that overlapping with a fair value gap. So your entry will be right here, stop below the low. If you zoom out a bit, there's a 1 hour bullish fair value gap sitting here. So we have a pretty big target we can target. We don't need that. But if we stop above the low for 1 to 3 or 1 to 2, will be right here. For the change state delivery, we can take the entry when the candle that created the change state delivery has closed. So that will be right here. So where market shifts right here. Change state delivery trade is right here. Stop below the low or 1 to 2. So here you see that the market structure shift trade is smaller, but you need to wait for the entry. And the change state delivery is bigger, but you are in the trade already. Looking at this, let's see what price gives us. Stream liquidity, change structure, change state delivery. And price trades higher towards the 1 hour bearish fair value gap. The problem here is the change state delivery target has TP, but the market structure shift did not get an entry because we did not get back into this fair value gap. And that's a problem. That is why the market structure shift is more often safe, but you also will see that you will miss moves because of it. But that's why using the change state delivery and then compensating price potentially coming back into the fair value gap and then go higher, that is my preferred method for the entry, because I'm okay to sit in drawdown for a while with my stop loss in a nice place than to not be in a move at all. And this means, yes, you will feel more uncomfortable. Your psychology will play a role. You might want to take a trade off because you will think it goes to your stop loss, but you will be in the trade. And that's most important. Like, you don't need to be right all the time. You just want to make money. So I'm okay with being too early in the move like this and then sit in drawdown for a while and then go to TP to try to be fancy, figure out the algorithm for the precise entry, and then maybe not even be in the move at all while it was pretty obvious that we wanted to trade towards a certain target. And one more thing. Now you want me to tell you which one is better, the market structure shift or the change in the state delivery. But you are asking the wrong question. The change in state delivery is pure speed. It relies on trusting your daily bias completely. If you don't know where the daily candle is going, the change state delivery will destroy you. The market structure shift is pure safety. It relies on confirmation and it works when you're insecure, and it will also cost you profits because waiting for a market structure shift could mean price will run away without you. So both work. There's no right or wrong as long as you choose the one that fits your personality and trade style the most and then execute it consistently. Just master one of the two and do not strategy hop. And if you want to get the exact technicals and entry models I use in my trading to gain over $1 million in funding and over $100,000 in payouts, it is all inside my market maker blueprint. It is all free. I will leave the link to that inside the description. And if you got value from this video, make sure you check out the video that's now appearing on the screen, because in this video, I will break down how I turned $500 into $8,000 only using one simple entry model. And yes, the frameworks from today's video will come back into this. So thank you for watching, and I'll see you in the next one. Bye-bye. You've been there. You analyze the chart, you find the bias, you enter the trade, and then the market wicks you out by 2 ticks and then proceeds to run 100 points in your direction without you. And you sit there thinking the market is rigged. And you think it's manipulation, but it isn't. The problem is very simple. You treated a weak high like a strong high. And in this video, I'm pulling down the curtains on how to identify strong and weak highs using high and low resistance liquidity. And I'm going to teach you exactly which highs and lows are engineered to break and which highs and lows are engineered to hold. I use this exact framework to skyrocket my win rate and get consistent payouts. No time to waste, let's get into the video. Before we go over why a high or low is strong or weak, we need to speak the same language. Most of you look at the chart and see random swing points, random highs and lows. And that is why you lose. You need to distinguish 2 types of swing points. The one is relevant to making money. The other one is just noise to confuse you. And I'm talking about intermediate term highs and lows and short term highs
highs and lows. Let's look at an intermediate term high. This is a swing high with a lower swing high to the left and a lower swing high to the right. This is the boss. And in a bearish market, in a bearish structure, this intermediate term high is respected. And what I'm sharing here is exactly the same for intermediate term lows. Then we have short-term lows. This is any high that forms inside the move of an intermediate term high. Basically all the swing points you can find right here. These short-term highs are not walls. They are targets. And if you place your stop loss around those, you're basically donating your money to the market makers. So don't do that. Okay, so when you know the difference between a short-term high and an intermediate term high, but how do we know if price is going to respect them or just slice right through? This brings us to the most important concept in price action: high and low resistance liquidity. We categorize liquidity in two buckets: high and low resistance liquidity. High resistance liquidity is when there is a liquidity sweep before the move. So there's a low being taken out in this example before the move. And in the schematic, you see that too. We have a low that has been taken out before the big move. In other words, there is a intermediate term low created before the move. If you compare that to low resistance liquidity, there is no liquidity being taken out before the move. I also refer to this as the staircase effect because we're just staircasing, stair-stepping upwards. And do these lows look like they are gonna hold once we start breaking down lower? No, of course not. Because low resistance liquidity likes to just be traded straight through. So once you know that low resistance liquidity is not nice to have your stop loss below that because we're probably going to be taken out, there is something we can use here. That you can play attack and defense with these two types of liquidity. The high resistance liquidity, where we sweep a low and we create an intermediate term low before the move, is what you can use as defense. So your stop loss can sit below this low because it's a protected low. And at the same time, if there is low resistance liquidity as your target, you can use that. At the same time, if there's low resistance liquidity at the opposite side of your move, so if you are long and there is low resistance liquidity sitting here, you can use that as a target to have those clean, satisfying moves. And this is how that looks like on a real chart. There's liquidity sweeps before the move. So there's an intermediate term low created right here. There was another one right here created, but there was no move after, there was no displacement after. And once we had that market structure shift right here and also an order block sitting right here, there is where the market started moving very aggressively. And why does it move so clean with so big candles? It's because we are targeting low resistance liquidity. All these highs don't take out any other highs, making it an easy target. So high resistance liquidity defends your position. You should put your stop loss below that. It's going to defend your position. Let's say you take the entry at the order block. Your TP can be at the end of low resistance liquidity. And that is how you can get the fastest profits and the cleanest moves. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It is all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. That brings us to the core of profitable trading, and that's the trader pyramid, with technicals at the top, below that journaling, data building, your trade plan, and your mental game psychology. And 90% of gurus start at the top. Technicals, they sell you courses about order blocks, about fair value gaps, but they only teach you 25% of the equation. The other 75% is the foundation inside the pyramid. The trading industry only teaches you where to click the technicals because it is sexy and unprofitable traders think that is what they need to make money. But they are wrong. I teach you how you handle the emotions of clicking the button and why you are clicking the button with a trade plan. Do you lack confidence in your trading, or your trading feels random? That is because you lack proof, data, that what you are doing actually works in the long run, so you can make money in the long run. That is where trade plan and building data on your trade plan comes in. So we build the foundation first, and then we talk about technicals. So that means for high and low resistance liquidity in your trade plan should be a very clear point that your stop loss should be below or above high resistance liquidity, and that you're going to target low resistance liquidity. This way you can increase your win rates. But it also means you need to build data on this. So you need to go to the chart and find examples, case studies for yourself. So you train your eyes to actually use this in a real-time environment when the candles are printing in a live chart. And the cool part about this is if your stop loss is below high resistance liquidity and it still breaks, your trade idea is just invalid. It's an honest loss, and you will not be sad or tilted about this. It's a good loss. It's part of your edge. But if your stop loss is defended by low resistance liquidity and it breaks, you know you just gambled. You knew you were trading a low probability environment because it was defended by a weak low, and now you know where to focus on so you can improve for your next trades. But there's one exception to this rule, that your position needs to be defended by high resistance liquidity and you need to target low resistance liquidity. An exception to that rule is called an SMT divergence. An SMT divergence is when two correlated pairs fail to follow each other, this divergence, and a SMT divergence indicates a potential reversal. And correlated pairs are, for example, the NASDAQ NES or YM, or Euro Dollar and GU, gold and silver, Bitcoin and Ethereum. And with correlated pairs, correlated means they need to follow each other. So if one makes a higher high, the other one needs to make a higher high. The other one makes a higher low, the other one needs to make a higher low. But what if that doesn't happen? So right here on the left, there's a equal low, and we sweep that low before the move. That means there is high resistance liquidity created. We create an intermediate term low before the move, strong low, so you can put your stop loss below that. In this right example, there is low resistance liquidity being created. There's no low being taken out before the move up. And you might now say, okay, this is the correct one to trade if you want to go long, because you can just put your stop loss below this low and you can target the highs. I agree. But with SMT divergence, if, for example, this is ES and this is NASDAQ, and they must follow each other. So if ES makes a very clear buy structure, the liquidity sweep, market structure shift, and I'm anticipating it to go up, and NASDAQ is correlated, I'm expecting it to do the same. But then your stop loss is going to be below this low, and it's low resistance liquidity. Do we still trade that? And the answer is yes. And that's because we have two correlated pairs. ES shows very clean we want to go higher. That means NASDAQ is going to follow. And because NASDAQ makes a higher high and ES makes a lower low before that move higher, before displacement move higher, that indicates a potential reversal to me. With NASDAQ being the strongest one. If I want to go long, I want to long the strongest pair. And because NASDAQ did not even take out the low, I want to trade higher on the NASDAQ. And ES will also trade higher, but it's going to be a little slower because it's a little weaker because we made a lower high here. It first want to go lower before going higher. And with this SMT divergence, that means the cracking correlation before a move happens to the other direction. It indicates a reversal. And the goal is, if you want to go long, long the strongest pair. If you want to go short, short the weakest pair. In this case, NASDAQ is the strongest pair because it did not even take out the low. And how this looks like on a real chart, on the left we have NASDAQ and on the right we have ES. Here we have a low and we have a higher low sitting here before some displacement up. Here we have the same low, but then a lower low before the move upwards. And the bias is up, so that means there's an SMT created. So once this is an hourly chart, so once the candles are here being printed, there's an SMT confirmed, and inside this SMT we can drop to the lower time frame to find our entry model. But it all starts with the crack and correlation. So here I would trade the NASDAQ here on the left side because the NASDAQ is stronger, so if it wants to go up, it will go up faster and cleaner. Even while your stop loss, which will be below this low, is defended by low resistance liquidity. That is the exception. Now you might say, I see those strong and weak highs everywhere. There's the short-term highs, the intermediate-term highs. Because if you go on the 1 minute time frame, you will see short-term highs and intermediate-term highs every few minutes. And that's why we need a very strong filter. And that filter is where time frames come in. The rule for time frames is the higher the time frame, the more reliable the structure. That means the higher the time frame, the stronger the intermediate-term highs and lows are. And a daily structure, daily high resistance liquidity, is way more likely to hold than a 1 minute high resistance liquidity. And remember this, you don't need to stare at the chart for 8 hours on a 1 minute time frame. That's how you get anxiety and you get overwhelmed. That's how you overtrade. But you need to be able to identify the higher time frame and execute on a lower time frame just in one single session, like the London session or the New York session. So if you now look at this structure on the 4-hour time frame, we see below here, if we zoom in, there is a intermediate term low created. Why? Because there is a swing low to the left and a swing low to the right. And that's going to be a starting point as well to trade towards the, and that's a starting point also a high resistance liquidity being created right here. And we target, what do? We target low resistance liquidity because this high does not take out another high. See how clean we move there. But this on a 4-hour time frame. If we now drop to the 1 minute time frame, let's zoom in on this exact price action down here at the blue area. There is many more swing highs and swing lows, and you can identify intermediate term high here, also one right here, also one right here. And which one then do you pick? There's so many. And that's why the higher time frame context is so important, that you know the higher time frame structure is leading. But at the same time, price is fractal. So what we did on the 4-hour, we can do the same on the 1 minute here, because look at what happens is we sweep liquidity down here, creating an intermediate term low, high resistance liquidity sitting here. And what is on the left side of this is low resistance liquidity, all highs that don't take out any other highs. Yes, they are intermediate term highs and they look like they need to hold, but at the same time, they are low resistance liquidity. And you see how clean we trade towards that. So that's why before you go to the 1 minute, you need to have a very clear understanding on where the higher time frame most likely wants to go. And that is also when you look at all the entry models I give you on this channel with all the technicals, is that this is the #1 profitable reversal structure, where we trade lower into a key level that's in a higher time frame for value gap, order block, or old low in a bullish example. Before we create that first move, we do aggressive sells, aggressive buys. You can also call this a V-shaped recovery or a smart money reversal. But the thought behind that is that there is liquidity sweep, a high resistance liquidity, the high resistance low being created before the move up, before the market structure shifts. Because if you take a long trade, you want to have high resistance liquidity defending your position. How nice is before that high resistance low is created, after that we have a liquidity sweep, you potentially have a fair value gap, maybe it's supported by a bullish order block or a bullish breaker, and before that we might have inversion fair value gap, and then we need to identify, can we target low resistance liquidity? That is the reversal structure, and that is how you can incorporate high and low resistance liquidity inside the overall picture of this reversal model. On this channel there is a playlist called My Entry Models, and you will see this exact schematic in all my different entry models at its core, and all the nuances you can learn in those videos. You should be able to identify which highs and lows are strong and use them as your defense, as your stop loss, while at the same time attack the weak highs and lows as your targets to create those clean, satisfying moves. So now it's time to go into your charts, mark out the intermediate term highs and lows and the short term highs and lows, identify high resistance liquidity and low resistance liquidity, and train your eyes. Don't just trust me on this. Prove to yourself that this works for you. Nothing works for the person who does not want to do the work. And if you got value from this video, make sure to check out the video that's now appearing on the screen, because with your new wisdom about high and low resistance liquidity, you will now be able to master this exact entry model that got me over $150,000 in funding in just 4 days. Thank you for watching, and I see you in the next one. Bye-bye. This is my best entry model, and these are the only things you need to trade this high probability model. In part 1, I showed you this model with an 86% win rate. And in this video, you're going to learn something that no course will ever teach you: how to not blow your account in the months where the market is very hard. Because if you can survive the environment you're about to see, you can survive anything. No time to waste, let's get into the video. In part 1, we had an 86% win rate. And I know that is why people clicked on that video. And I hate that, because there's way more to become profitable than simply looking at win rate. In this video you're about to see, we're going back to May 2024, a random month my students voted for live. And I'm going to show you the exact entry model you saw in part 1 in a completely different environment. Let's go. In the first part of this series, we went over this exact model. And this exact model, what you see on the screen, is the same model you see in the 10 AM game and the FTS model. It's a whole checklist. We're going over that right now. And the first step you need to take is before 9:30 AM EST, that's the New York Open, mark out the most obvious points of liquidity. And the most obvious part of liquidity is for value gaps or old highs and lows. The goal is to trade towards the obvious point of interest or trade from it. So if we zoom out here, we have sell side liquidity, we have buy side liquidity, and this is the depiction. But if you're just going to remove the depiction like this, this is where we start. So after 9:30 AM EST, so after the New York Open, we wait for some form of key level to be traded into. It can be sell, but we're going to do a long example in this schematic. Of course, vice versa is going to be for shorts. After 9:30, we wait for the liquidity sweep. Then we need to see displacement. Displacement, fancy term for a big one-sided move. Energetic candles. Displacement leaves for value gaps. Always. Like 9 out of 10, it leaves for value gaps. And if you have the aggressive sells, aggressive buys, in that area, most of the time there will also be an inversion for value gap. An inversion for value gap that was, in this case, a bearish for value gap, but because we ignored it, it just changed themes to an inversion for value gap. And this was resistance to trade lower, but because it was invalidated, inversed, now we're going to use it as support to trade higher. There's also order block in this area. So the entry can be in a fair value gap, order block, inversion fair value gap. You can even use a breaker. I don't use breakers too much in my trading, but you can. The breaker most of the time is in this up close candle here before the move down. But we're now going to focus on in the model is fair value gap entries, inversion fair value gap entries, or order block entries. Target 1 to 2. Like we're not going to do fancy stuff. So let's say we want to take a trade from here, and we want to put a stop below the low. It's just a 1 to 2. We're not going to trade all the way to the buy side liquidity to be fancy for 1 to 3, 1 to 4. Just base hits 1 to 2. You're going to make a lot of money with 1 to 2s. And the bonus point is for the highest win rate, wait for the second PD array rule. And the second PD array rule is not that you take it right here, because these are all the first PD array, like the test PD array, like the first fair value gap or the inversion fair value gap or the order block. This area I like to use as the test. So do we actually move away from it, or are we just trading lower? Because if we're trading lower, we're getting stopped out. That would suck because we don't like losing. So ideally, you then wait for another reaction from that level. With that reaction, maybe there's even a second fair value gap created, and the down close candle. If you've seen the order block secrets video, the down close candle, the trades to the fair value gap is called an order block. So where this was the test area, I call it the first PD array area. This is the second PD array. So then wait for here. And then just take your entry right here. And then you can put your stop loss below this low or below this fair value gap for 1 to 2. That's it. Let me know right now in the chat if there are questions. If there are no questions, you can press a no. I want to make it interactive. And of course, in the final cut of the YouTube video, I will cut these parts out because that's boring for the viewer, right? With that, this is what we look for every single day. Every single day. And we see here multiple ICT concepts, but also other trade languages. Like we see the accumulation, manipulation, distribution, the power of 3, the AMD. We can use the open, high, low, close of a new candle. There's a lot of different concepts inside this model, but this is at the core of all reversal models. And during the backtest, what you're going to see, and you also saw this in part 1, this is a reversal structure. But I want to add something here. Because of course, we're not going to just copy the first video. We're going to give new and more value. Because at sometimes we have the situation that before the open, with for example, a big news event, at the time this recording, we have an NFP day. So then before the open, we could already have this liquidity sweep. And then at the open, we are here. What then? Then we need to play a continuation model, because then we expect price to not come back anymore to the low. We're going to see this during the backtest as well, that if there's already, we have a key level marked out where we expect price to move higher from, for example, for longs. If that's already been hit before 9:30 and it gives this clear structure, I will just take continuations and trust that that low will hold. It would be nice if that happens. You're going to hear me repeat this during the backtest. If London makes this low, so that around 4:30-ish AM EST, London low, if London low is that, and then 9:30 AM is this, that is very sexy. We love that. And those nuances we're going to see back in the backtest. Cool. And then we're going to just take continuations during the open. So what you will see at 9:30 AM EST, we have just a displacement higher during the open, and then we wait for most of the time for the first 15-minute fair value gap. That's what you most likely see. So that means that the opening candle retrace, boom, higher. That's going to work towards. All right, that's the framework. And now the YouTube viewer gets now a quick cut to the backtest. We need to decide what year and what month. So drop in the chat. Let's just choose between 2024 or 2025. Drop in the chat. 2024, and then we're going to do the month. All right, right now in the chat with my students who are with me during this backtest, we decided on, we had many choices. We had 2024 as a choice, 2025 as a choice. They had the quarter, they had I'm just going to cut this out. Like every time I just stumble over words, it's going to be cut. They had the choice between the year 2024 or 2025. Then they had the choice between the first half and the second half, which quarter and which month. And after a few votes, we came towards May 2024. So now let's go to May 2024. We can do this by going to the calendar down here, and then we go to May. Of course, we need to go to April, because if we I don't want to see the candles. Like I need to be a little bit blind. So what I want to do is do April 1st. Let's see if the candles are available. I think we are. Yeah, the candles are available. And I don't want to see the candles. Okay, I think it's good enough. Good enough. I didn't cheat here. Like I saw in the comments of the first part of the video that people said that I was just cherry picking the best month I could find. I was so insulted by that. I was like, no, I'm not gonna cheat. That's not worth it. It's just not worth it to cheat about this stuff. Cool. Let's go. First up is the higher time frame. Every day before the open, I look at a few things. I call them buckets: higher time frame and intermediate term time frame. And if you've seen my recent YouTube videos, it's also called top-down analysis. Higher time frame. Not sure why this is so ugly. Holy shit. Okay, let's make this text a little bit more sexy. There we go. Boom. Higher time frame. That means daily, weekly, monthly. And we have, well, let's make this a copy of this one because we are lazy. Boom. And the other one is intermediate time frame. That's the 1 and the 4 hour. There we go. If you want to determine your daily bias, it is nothing more than answering the question, where is price most likely going next? And that's just going to be an old high or a value gap most of the time on the intermediate term time frame or the day or the high time frame. So what we're now going to do is very simple. We're going to mark out the old highs and lows and for value gaps from the monthly to the weekly to the daily, all the way to the 1 hour. And it's a boring task, but those levels are super important. So let's do that now. So here in the monthly is March, and where's April? Well, I see already here that we have a monthly bullish for value gap sitting here. That's interesting. I like that. I like that. Let's. I think we can use that for later. Monthly for value gap on the weekly. Now I'm going to fast forward a bit towards the start of May. Is March. Okay, so April. Look at this. April trades into the monthly for value gap. So we can expect potential higher prices from this. That's amazing. Cool. So that is going to be the start of our bias probably. Moving away. And also I see a weekly for value gap sitting here. Down close candle as well. So a small order block here. Let's go to the daily. Daily, I'm going to fast forward a little bit towards the start of May. And this boring stuff I'm now doing live on the chart. This is what I usually just cut from the videos because this is super boring, but I need to do this at the start of a backtest. Here, April 30th. I think April has 30 days. I think the next day. Okay, awesome. So we had the monthly fair value gap. Then we basically closed almost there. So let's make it a little bigger. There's the weekly fair value gap. And on the daily, it does look super clean, to be honest, right now. So let's just see what we have. I see that we just swept some liquidity. And I think also we trade into this daily fair value gap. Yeah, we make a low in this daily fair value gap here in May or in April 2024. They move away from there. And there's also a daily bearish fair value gap sitting here, which is open. That is very sexy, right? You see this? We have equal highs. Or do we? Oh, no. I think I'm lying. No, it's already been tapped. Never mind. But there's a high created here. And now we trade it lower. April 30th. Now let's go to the 4 hour. So we already now marked out the daily and we're gonna have a rough back. You guys knew this. You guys knew that May 2024 was a rough one. So we're gonna. So this is pretty nice as well because this looks like the current NASDAQ. The time that we record this is what is it? It's April 2026. This looks a bit like what we're now seeing. That it's ranging, big ranges, but not following through. So I think it's also a nice exercise to do that. Okay, so we see daily low here. Then there's an order block, breaker, 4 hour. Like this is a 4 hour for value gap and order block. And we're just going to trade. One thing is, I'm not going to keep into account the news during this back test. So it could be that some trades just randomly, we're going to see like 830 big, massive expansions, of course. Then we're going to know what the news brought. But in general, I'm not going to just now go on Forex Factory and just go back to May 2024. I'm not going to do that. Usually, I would recommend that, but for time reason, I'm not going to do that. I'm good with that. We're just going to see that we think we're in a position at 10 a.m. We're just going to stop out. And we're like, oh yeah, there's probably news. And it's fine. That's fine. Okay. So higher time frame levels are marked out. The intermediate term time frame levels are marked out. And not super clean, not super clean. So the higher time frame, intermediate time bias is pretty neutral. And when that bias is neutral, the intraday trades, the 1 minute trades are going to be smaller. I'm not going to target fancy targets. It's going to be like a thief in the market, short in, short out. And hopefully see what an work it is to just prepare this. So now we're almost ready to take a trade. I see also a 1 hour fair value gap here. You see 4 hour order block. Cool. Also a 1 hour order block. So when I say backtesting is boring and tedious, this is what we're gonna do. It takes a while. It takes a long time. Okay. Cool. Let's go. So Tuesday, we need to go to, and what I didn't mention, we're gonna of course just trade the New York Open. We're not gonna trade London session. We're just gonna only trade New York Open, and we're almost there. Almost there. Cool. This London. At London, we trade into the 1 hour bullish fair value gap. I think if you now go to the 4 hour, I think we're gonna see also 4 hour bearish fair value gaps. So we could trade between here, longs towards the 4 hour. I see also in 1 hour. I'm gonna move this to make it cleaner. 1 hour. I'm gonna quickly peek to the 4 hour. Yeah, massive 4 hour value. Okay. So my bias for this first day of the month is going to be that I'm open that we're gonna react from this area. Because at this area, we already had a liquidity sweep, market structure shift, it already traded higher. This is, of course, because we come back so aggressively, it's a lower probability trade, but I'm open just for a low-hanging fruit trade that we're going to see at the New York Open. We're going to see buy structure towards the midnight open right here. That's my drawn liquidity ideally for this first day. Cool. Let's go to the New York Open to see what we have. Okay, 8:30 is probably news. Okay, here we go. So what do we see right now? I think this is what we saw earlier, the continuation model, where the structure is already formed before the open. So here we have a aggressive sells, aggressive buys. For value gap 1, we're on a 15-minute time frame, not on a 1 minute, just 15-minute time frame. 15 minutes, see another 15 minutes. So based on this, during the open, I'm interested in maybe taking a trade like this. So what I want to wait for is what do we do inside this fair value gap? What do we do inside this fair value gap? So let's see. Let's drop to the 1 minute. We forget the 5 minutes. We also do the 5 minutes. I'm going through all these time frames. If you see me trade live on YouTube or during the streams, you see me doing this every single day. So I cannot skip this part. I just need to go through all these time frames and mark out all the stuff. Yeah, these highs are super sexy. So ideally, we trade lower at the open and then trade higher. So let's see. That's 9:20. Okay, let's go. Cool. No entry yet. No entry yet because the bias is higher. But this is nice if the bias is higher. We love to see first a little bit lower. And I'm going to do candle for candle because I cannot skip the entry, unfortunately. Okay, so at the start, we have a little consolidation. This looks nice. 10 a.m. game. And I'm during this backtest, I'm also not taking into account stuff like SMTs. I'm not going to go to ES. It's a pretty naked backtest. But I'm still hoping to see a move towards the midnight high. Let's make it a little bit cleaner here. So the 50-minute bullish value gap is invalidated already. But the whole range is not super sexy here in this first day of the month. And I told this during the YouTube stream on this month as well. This time the recording is April 2026. First day of the month could be choppy because the monthly candle was opening. That's cool. So let's see. Do we get displacement? Where are the fair value gaps? Not super sexy, but it is enough. It is enough. So in this move, what I see is a fair value gap 2 actually. I'm also going to the 5 minute after this to see if there's a better structure here. The delivery is super choppy, but I like it. I like it. Order block. Quickly go to the 5 minutes. No, when I would trade this live, I'm probably not gonna take this. Okay, so what I'm eyeing for this trade is the midnight high as a target. I need a 1 to 2. So let's see if we would do that. Where would our stop loss be? So let's say this is our target. 1 to target. Is this a valid trade idea? From here. And what I do during a backtest, and also when I take a trade myself, is this the nice structure? So we can grade this as an A, B, C, or D setup. So if we have the depiction where we go from aggressive styles, aggressive buys, PD array area 1, like with all the fair value gaps, the order blocks, and then PD array 2, I don't see this too much. Like we don't have the clean energetic candles. Like these are the first energetic candles. Making this a B setup. I'm gonna take it just for data purposes. I don't care if this backtest is gonna be a super horrible month. I just want to share my thoughts. I would say this first trade, I'm gonna press the button now, is a B setup because we don't have the clear displacement, but we have such a clear target, and we have now candles moving towards that target, and we see old highs failing, bearish value gaps failing. I think that's a very nice trade to take. Cool, let's go. Exciting. And a stop loss. Cool. Well, I think the B setup played out perfectly, right? So then what I'm gonna do is I'm gonna make another box here, text box, with May 2024 trades taken, 1 wins, losses, and well, win rate. I'm gonna just add it in later. Okay, losses. There we go. 0% win rate, guys, so far. We're bad traders. I like this. It's clean. And then I'm gonna do the same here. I'm gonna anchor it. Oh, wait. Let me do it in a better place, like this. Make it a little bit bigger. Yeah, this is good. That's not super clean. Like I have a little bit OCD. Like you're live with me in the stream, but I have a little bit OCD. I like to be a little bit cleaner here. No. But when I do these videos, this takes such a long time all the time because I'm so OCD here. Let's make it blue. Yeah, this is better. This is better. Okay, awesome. Okay, and then I'm gonna now anchor it. Cool. Okay, so first trade, B setup. And this is very nice data because the reason why I take it is, of course, would I take this in a real scenario? No. But this data, we're going to reuse this later. So I'm sure that we're going to get similar trades in the coming few days. We're going to backtest. And then we're going to refer back to like, hey, remember that May 1st trade where we did not move away cleanly? So I gave you a model. And this is already nice nuance. So if price does not move away very clean with big energetic candles, it's just choppy, like big wicks, small bodies, stay away. Stay away. So take one for the team here. Okay, cool. Let's zoom out to the 15-minute time frame. And here we see that it just failed. Do we get another trade at potential? Maybe, maybe. This looks cleaner. Cleaner, aggressive sells, aggressive buys. So maybe there could even be a re-entry in this area. This looks more like the setup. Do you guys agree? So if you then compare this with this, I think this is cleaner. Aggressive sells, aggressive buys. So we have the liquidity sweep, the market structure shift happens not here, but let's swing high right there. I like this. I like this. Let's see if we can get your retracements into them. Okay, let's see. Okay, scary candle. Not super sexy, but hey, this creates an order block if the bias is still good. And the bias could be wrong here. Maybe we're on the wrong side of the market. So now if you create up close candles with your value gaps, I might want to take the trades and just the wrong side of the market. Is this then gonna be it? Like this is what I do during the session as well. Like I'm just gonna sit here, wait for this for value gap. Do we react from it? No. Okay, wait longer. And here I want to like I think this could be the setup, but look at the time. It's already lunch. I don't like this too much. But this is sexy. I like it. Wait just 5 minutes for value gap being traded into, and now we're already trading PM session. So this is a hard day to trade, I think, because we did not move away actually, like we just stayed in that range, creating failure swings, which is nice to use later. We can target this later, or maybe we're going lower first. It's a Monday. No, it's not a Monday. It's a Wednesday. We have a clean lows, so let's just see. But now you have this one trade. It's a loss. It sucks, but it's fine. Okay, question. The question that's asked is, when should we take into account the bias based on the daily sniper model? The daily bias sniper model is that you look at how the previous candle closed compared to the do I say this correctly? How yesterday's how yesterday's candles closed compared to the candle before. I have it in my head, but I was so let me explain it with candles. Where's my bearish candle? There we go. So the answer is I don't use that here. So let's say it's this. So at day 1, we have this candle. At day 2, we sweep the previous day high, but we fail to close over it. Then I'm expecting the next day to trade at least towards the low here. That's the daily buy sniper. And you can even use a 4th day. In the daily buy sniper, I also discussed the 4th day. So when there's a swing high created like this, and there's still a nice drawn liquidity, then the fourth day is going to be even sexier. So that is the daily buy sniper. I don't use that here. I think it's a very nice confluence, but I want to keep the rules as simple as possible. And that is just very simple. I mark out the higher time frame arrays. I look at the structure, which is the most obvious drawn liquidity. I think based on this first example, that midnight high we target with this losing trade is super sexy, but unfortunately not for now. Cool. So I was not sure how to describe this in words. But yeah, this is daily buy sniper. Cool. So one of the mentorship videos. Delete. Let's go to the next day. So first day, and you see how long we already do over one day. And that's why backtesting takes just a very long time. It's very hot here. I need to, it's like 35 degrees where I'm right now in Vietnam. It just takes a long time. And it sucks. Next day. For the next day, I'm just going to go to the hourly. And then just before the open, around 8 a.m., we're going to do the same exact thing. We need to build a routine. So every day, we do the same thing at the open. Whoa, that's insane. Okay, so that's this is probably FOMC. So I think we traded before FOMC, guys, which is fine. That's what I said. We're gonna take dumb, stupid trades because of news, but this looks to me like FOMC, right? So if we're gonna now look at May 20th, we just took the loss on FOMC, which is maybe a good data point that you should not trade before FOMC. Don't do it. Don't do it. Don't do it. Because this is what happened. Because now our target is smashed. Like smashed. Okay, back to the next day. 7, 8. Yeah, I'm going a little bit earlier. I'm going towards here. Because if I'm now, this is how to cheat yourself into backtesting. If I'm now going to the 4-hour, it prints the next 4-hour candle. And I don't want to see the next 4-hour candle because then I can see the buys of the open already. That's cheating. So at the start of the trading day, we see this. Zooming out, it is horrible. It is horrible, but we have a 4-hour bearish value gap sitting here. This is low probability price action, guys. So we're not clean trades on the lower time frame, which is fine. Yeah, so we had a big rejection from FOMC probably during the PM session here, making me most likely maybe want to trade lower towards the low here, just based on this 4-hour candle. Okay, cool. Using that bias, let's go to have a small bearish bias because of that big wick right here. Nothing here. Let's see if in this candle there's fair value gaps. Yeah, that's what we look for. This is our higher time frame box. Boom. Okay. So here as well, we have this bearish fair value gap. Also, there's a 15-minute bearish fair value gap sitting here. So I'm favoring shorts right now towards these lows. It will be nice. So maybe we can cash a trade like this. And hopefully you see what I'm doing now. This is what I do every single day. I go to Discord and I share my screenshot. This is exactly this. Highs and lows for value gaps. And then implementing the model during the open. Okay, this is London. We're not trading London. So we're going to wait until the open. It's going to be at 9:39. We are in the fair value gap. Cool. So the start of the idea is coming. And from here, one more. There we go. 9:15. Okay. From there, we go to the 5 minutes. So we have a slightly bearish bias. There is already, before the open, pay attention, there's already a liquidity sweep. The last low before that is here. So there's not a clear structure shift, but we have on the 5 minutes, we have bearish for value gap sitting here. So we might already have set the high before going lower. So I have a bearish bias. I think this is a very nice target. It's London low. And of course, the eventual target that will be the lows right here. So I would have a bearish bias for this day. And now let's wait at the open. Super awesome. So this is the 9:30 explosion profile. You've seen it in part 1 as well. So let's drop to the 1 minute. And maybe we already missed the move. Yeah, I think we maybe missed the move. But look at this. So this, what we're now seeing, confirms like, okay, we want to go lower. Awesome. We have the liquidity sweep, the structure shift, and even here, this candle, 9:30 candle, is that nice wick. That's also a mini liquidity sweep. So we have 1 minute for value gap here. And we have an order block sitting here. There's order block. So I think we should be good. Maybe the next candle, we could even trade another value gap. Yeah. So my entry, if I would trade this, would be here. Right here. It's a very explosive profile, right? London low is already being hit almost. And we have, of course, the lows all the way at the bottom. So last swing high will be my stop for 1 to 2. That does mean if London low is swept and after London low we're just going higher, that sucks. I'm going to take the loss again. But this would be now my trade idea. Why not be above this high? Could be. But then I think like if price comes back all the way up here, the trade idea for me is already invalidated. So I'm happy to be wrong. So I want to take my my stop loss at the high. If you were going to backtest this yourself and you notice that you have a lot of times you get stopped out before the real move, then you should change your approach a little bit more towards here and be okay with less risk to awards or just bigger trades. But for now, let's do it like this. See if we can come back to. So we take London low. See that step? Okay. So here, what I do on stream, and you see me doing it as well. I'm not going to go blindly in here because London low has already been taken. I'm going to be a little chicken there. I want to see reaction from this level. This, boom, that's it. That's it. And now we are in. That's the reaction I want to see. So zooming out, liquidity sweep, market structure shift for value gap 1, for value gap 2 with order blocks. A+ setup. Whatever happens, I love it. I love it. Oh. Cool. You see it? Heartbreaking. Trade taken. 2 losses. We came back one more time to the order book. Look at this. Stopped out by 1 point. So losses are normal. If you see this, like, hey, we now already have for 2 days, like losses are fine. This is why we backtest. We need to learn. So 1 was don't trade when there's no displacement. And 2 is if you get stopped out before the real move, you need to put your stop loss higher or make your stop loss bigger. Done. So we could even make a 3rd column. It's called lessons. I would say lesson 1 was displacement in the range and the other one's bigger stops. Cool, right? So the buys was amazing. The structure was amazing. The execution was not amazing. So you take the loss. And you can see in the Discord, I still have this. So this is for me, for my trading, something I'm always struggling with because I'm still a fancy ICT trader. But ideally then, you would have put your stop loss still at this high, the original high for 1 to 2 like this. And this would be your trade. And I think you would have, you would have had TP. And look at where we stop. Look at where we now stop. Exactly. Let's zoom out. Look at this. Equal lows. So maybe we're not done yet for this trade session. Maybe we can take a continuation lower. And maybe I say, let's do it. So this is a loss. Super nice trade. Super sexy. And I hope your eyes are now also being trained like the model is always there. Like this is May 2024. And we do this still to this day. So I love that. So if you now look at the 5 minutes, I see, let's, like with this naked chart, it's pretty crowded now, but there's let's zoom in a bit. I'm going to put the annotations back in a sec, but there is a fair value gap here, order block with the upclose candle. And there's now also here in this area, a fair value gap and order block. That's the point of interest for the continuation trade lower. So let's put back the annotations. So there's a fair value gap right here on the 5 minute being traded into. This is such a sexy structure. Order block. So here, if you've seen the order block videos, there's a pretty big wick. So I'm putting my order block line here. Doesn't really matter. Like this. So what I now want to see for the trade on the 1 minute is price coming back here and give a similar reaction on the 1 minute as we've seen as our trade idea. Remember that let me zoom in a bit. This reaction we saw on the 1 minute, but I said I'm going to wait a bit. And we got that wait, like this was the reaction. Super nice. There's also already a order book sitting here, but ideally, we're going to wait for the 5 minute bearish value gap to be traded into. Like this. And now for this ID to be valid, we need to see now, because there's bullish for value gaps created. I don't like that. I also explained this in part 1 and also in the secrets videos. I want to see the bullish for value gaps fading now. Because maybe the bias is now already wrong. Almost. Nothing. Nothing. So we leave an equal low behind. Interesting, right? Cool. So bias was amazing. Execution was not good. Model is there, but stopped out before we move. Let's not cheat. Let's put it back. Yeah, right here. So next time, bigger stop. You hear me say in the past 2-3 weeks, on the live chart in while we're doing this in 2026 is that on the higher time frame, it is pretty hard right now. Like not this, of course, you see this chart as well. But you hear me say like, hey guys, when you see higher time frame, intermediate time frame, not super clear, you will take more losses, lower time frame. And then you have two choices. One is take less trades or be okay with just having a lower win rate. At the start of the backtest session, I said, yo, this looks exactly what we have now. Not nice price action. And then now we have 0 out of 2 is completely normal. That's fine. And maybe if we're going to finish the backtest, we're going to have 0 out of 8 and we had a nice losing streak. And then we can say, okay, cool. What did we learn about the backtest? What lessons could we have? We already have 2 amazing lessons. And then it's going to be super fun because then I can post a YouTube video that says part 2, 0% win rate. And nobody's going to click on it. And they miss out on all these nuggets. Because I already explained in the streams about win rate that what is broken in the trading industry is that people think win rate is what you should focus on. Like a 90% win rate will make you profitable. But that is something only the marketing geniuses told you. Because win rate is a broken metric for 2 reasons. One, it is personal. I'm going to make a dedicated video about this. But win rate is personal. That means if we're going to do this the same time, everyone here is going back to May 2024 and does their own trading, same model. We're going to all have different win rates. Maybe you guys have 100%, I have 20%. Cool. Because you have just a little bit different nuances or different entries or maybe too late. And that's fine. It's a personal metric. So if I post a video, 90% win rate or the part 1 from this series, 86% win rate, that is my win rates. If you're going to do the same, you're probably not going to have the same. Maybe you're going to have higher, maybe even higher than 86 or lower. Both is fine. Secondly, more important, that's why I love to make this part 2. That's why I said, yo, comment for part 2, because at 86% win rate is just a random metric over a random period of time, and win rate is a changing metric. So this model, every entry model, has losing weeks, losing months, winning quarters. So that means at some months, your win rate of your model is going to be 60, 70, 80. But at some months, it's going to be 10, 20, 30, and you have a losing streak. So when you're now going back on YouTube and trying your next 90% win rate, know that you're a beginner. You're getting fooled. And I'm a slave to the algorithm. I just wanted to test, hey, if I'm going to set a ridiculous number, like 86% win rate, would people click on it? And I hate to say it, it is the most viewed video in the past couple of weeks. Dumb, right? And of course, the video is super valuable. The backtest is super valuable. We're going to do this similar right now. But because the title says 86% win rate, I know that's why people clicked. And it breaks my heart. Because that means they're going to buy more courses without making actual money on the chart. So now you know that. Limiting belief, gone. You now know, don't chase win rate. Chase a model that works for you. I think this model is super beginner friendly and for everyone, like even for advanced traders. And just do it and be okay. And that's why I said, that's why I love that you guys chose this. Maybe we're going to have a 0% win rate and we're going to laugh about this. But then we have lessons. And then we know, okay, cool. Then we're probably in the May 2024, we'd have lost a few accounts. Cool. I think I lost a few accounts, for example, in March 2026. Super hard trade environment. Cool. That's fine. Little losing streak. And there we go. Okay. But no rents anymore because you guys came here for the backtest. So let's continue. But I want to give this nuggets in between because I think it's so important that you know that. That's maybe even more important than the backtest. Okay, so this was Thursday. Took a loss on the Wednesday because we traded before FOMC. Nice. We shouldn't have done that. So maybe that also, let's put it at the lesson. Displacement, lower time frame, not before FOMC. I think that's a valid lesson to put on. And of course, we don't do that. But we still have these equal lows. So hopefully before Friday, before the open, we still have these lows sitting here. Thursday, let's go to Friday. Okay, I like this. Did I cheat? Oh no, nice. Oh, it's 8 a.m. Okay, so before the open, we already have a massive move. Look at this. Like we already traded back into this value gap when London. Remember the continuation model of this model is when there is a London low created. Oh, and they already took out this high. Remember that was our high from earlier? Oh, the suckers. But this is nice because then we maybe can try to catch a retracement and then a continuation. And the London low is then probably going to hold. Cool. Let's go to the lower time frame. Yeah. So this, I think this, oh yeah, it's the first Friday of the month. NFP, we know it. So cool. Now we're showing up after NFP. NFP just happened, 8:30, massive candle, first Friday of the month. And it's cool, right? That you can identify news events even when we don't look at Forex Factory, because that's how we build a routine. Okay. So yeah, ideally, just at the open, lower than higher. Monkey sees green candles. Let's just buy a nice trade. Let's go. Let's see how we open. I'm not going to the 4-hour time frame yet. I want to do it close to 10 a.m. But I think we can take a long on this trade idea today. We go a little bit lower because we already traded into that 1-hour bullish value gap. I think we should be good here. Yeah. So there's not much to rebalance, and then the equal lows is gonna stay. Like okay, cool. Maybe there's an SMT with ES, but the equal lows will probably just be there. 15 minutes, 5 minutes. Yes, of course, it's just NFP candle. Okay, let's fast forward to the New York Open. So ideally, we first trade lower, then higher. And this looks to me also perhaps like a little accumulation, accumulation here, manipulation into key level, and then higher, like the power of 3. So it's also on the cards here, but this idea. Cool. So let's see. I'm just going to trade higher. I'm not going to take the trade. So if that happens, so be it. Okay. Now we are at 10 a.m. So the 10 a.m. game is activated. Now I want to see what we have on the 4-hour. Oh, wait, I cannot do that yet. 1 sec. Because otherwise, if I'm now going to the 4-hour, that's cheating. I'm so sorry. I don't want to cheat. What I mean by that is if I, after 10 a.m., if I then go to the 4-hour, it shows the whole 4-hour candle already. So I could see the bias. I did not. Cool. Let's go to the 4-hour. Oh, it's also a 4-hour BC, guys. Oh. Yeah. Okay. So I think this is high probability 10 a.m. game. So 10 a.m. at the start, accumulate, manipulate into key level, then distribute higher. That's it. That's what we're going to do. So back to the open. Let's just see, wait until after 10. We trade to the key level. That's now. So here 10 a.m. game is activated. I'm going to look for longs. This looked already interesting. So we have a displacement out of that range. And this for me is going to be the first PD array rule. But because there is a lot more to rebalance, I want to wait for the second PD array rule. If I create it now here, trade into, trade higher, one more. And now I'm waiting. I know what I'm doing during stream. I'm now waiting for this candle to be closed over. Then I'm going to take the trade. Low hanging fruit will be this high. Yeah, that's it. Oh, yeah, okay. This candle's the entry. Let's say late to the party. Stop loss. Go back to the lesson. Stop big. Big, big, big. That means we need to, I think this swing high is nice to put it on there. We can even do this one. Let's do safe. Let's do super safe. Let's see what happens. Because we had a lesson and this is a random target. Like I don't know what's on the left side here. Let's just see what happens. So what do we have? 10 a.m. game. This box, the yellow box, is an overlapping 5, 15 minutes and 4-hour, and I think also 1-hour bullish value gap. So if you have buy structure from there, we waited for PD array 1, and it's already PD array 2, and then we move away from there. I like that. I like that. If we take a loss here and it goes lower, I'm open for a second bullet like this. If you trade a little bit deeper into that, that's fine as well. Cool. Showtime. Trade 3. Lesson. Okay. We're still in. We're still in. Doesn't look good, by the way, but we should already be moved away. Look at the delivery. Horrible. Look at this. And I cannot state this enough, but on the higher time frame and the intermediate time frame, you're still in difficult price. Actually, it's still consolidating. We have now some displacement higher, so the long idea is super valid, but you see that delivery is still not very sexy. But hey, we are in. We learned from the lesson. Super cool. Let's see if we can trade higher. I need to put because it's futures at the end of the trade day. I need to put it off. So it could also just be a break even or like a small win. Well, win is win, but of course we're not going to cheat and call this a win. So during the YouTube video, I'm gonna cut this. Fast forward cut. Okay, market close almost. So weird delivery, right? Market close is almost right here. Cool. Yeah, marked out here. This is a win, but a small one. What do you guys think? Let me know in the chat. Is this a win? Like, I don't see this as a win. It's a small win. It is a win, but I don't know. A win is a TP. Let me know in the chat. Win or not? Win or not? Are we flexible? No TP. I love this. Cool. So we need to make a second category. Let's just call this. Let's just call this break even. Break even / small win. Cool. Awesome. What I love about this, you're gonna see this a lot as well. That you just have no delivery at all. If you're now going for the past couple of weeks, I took these trades a couple of times. And here in Vietnam, that means I stayed up until 5 a.m. looking at these candles. Not fun, but it's normal. Even 2 years later than this price action. So far, first week, this was the first week of May. 3 days. 3 trades, 0 wins, 1 small win, 2 losses. Are you already discouraged? Are you ready to just give up? No, of course not. Because I have hundreds of data points on this. And every single scenario we've already seen the past couple of weeks, which is amazing. What I want to do now during this recording is take like we already 1 hour in. At the 1 hour break, I want to give you guys like, let's say 2 minutes to get something to drink. I'm going to eat this massive banana because I haven't had dinner after my 2 hour practice. But let's do 2 minutes. And then we're going to continue with the new week, second week of May. And of course, let me know if there's questions in the meantime. Stop loss placed on point. Yeah, but that's the thing. Like, when I say during the videos or during the mentorship calls, like if you make a loss, that is completely fine. And if you make a mistake, that's completely fine. But the next time, if you want to learn, is same situation, different behavior. That means in one of the trades, we got stopped up at 1 point before the real move. I would say you can call it unlucky. I don't believe in unlucky. I believe in execution mistakes. All right. I think we could have put our stop loss higher. You could call it also greed or whatever you want to call it. The name doesn't really matter. But that means the next time a similar situation occurs, and we had that now, if you get stalled out before the real move, and I had that when I started out, when I was not profitable, just put your stop loss bigger. And who cares if you have a lower risk to reward for a couple of weeks, but then you can rake up some more trades. Because how stupid would it be if you would be stopped out again? Like I will be super tilted. No, not super tilted, but if with this again, right? And not tilted because of the loss, but tilted because I already been there, right? You already been there. In the book Best Loser Wins from Tom Hoogart, there is one, like in most books, also in my videos, the best nuggets are at the end. The biggest wisdoms, the biggest frameworks are at the end of the video. Same for Best Loser Wins. In it, like the last chapter, he says, yeah, yo, I make a PDF. Tom Hoogart, one of the best traders ever. Tom Hoogart. He says, yo, I have a PowerPoint presentation. And in the PowerPoint presentation, it's like slides with my wins, my patterns in wins and my patterns in losses. And I put lessons there, like for the mistakes I make, I say lesson 1, this, lesson 2, this, with screenshots. If I take winning trades, I put there winner focus or like some, and then also text it, hey, this is why it won. And he calls that his book of truths, the most powerful framework ever on the last pages of the book, where the majority already put down the book and probably took another, just went back to the market and lost again. And the book of truth is so powerful. It helped me as well. And we are basically now, with the lessons here, building our small book of truths. And we only have three trades. And of course, we're not going to sit here all day. So we're not going to have like 30 trades of data. But imagine if you have 100 trades of data. And you have all these lessons. And you can use those lessons to take better trades. Weird, right? You make mistakes, you write them down, you try to make those mistakes not again, and because of that, you take better trades. That is called improvement, intentional improvement. Okay, let's go to the next day. Next week, actually. Next week. Oh, I cheated. There we go. Let's go to the 4-hour time frame. I remember this price action. Not from this month, but we have this similar. In 2025, this exact structure appeared. So tap 4 hour, probably we have a daily for value cap 2. So now, based on this, we are at Monday. We are zooming out. We have those horrible equal lows here, traumas. We just trade into the daily bearish for value gap and the order block, but I think we can trade back to the highs here. I think we are bullish. We're just going higher. So where is the most obvious place price can go? I would say first here and then higher. And that's then, if I make a weekly outlook this Monday, that's going to be my weekly bias for the week. I'm just waiting for price to trade lower and then do for buy structure. That also means early in the week, I might favor shorts until that level is reached. So I want to first short towards the 4-hour bullish value gap and then long. And I keep repeating this. At this day, I do exactly the same. That's how I make the weekly outlook. That is how I trade. That's how I make my money. Well, let's go. So already we cheated a little bit because we already saw that candle, the first opening candle that went higher. But that's fine. That's fine. Let's fast forward. So ideally, first lower, then higher. If we now trade higher, cool. There's no trade. I'm waiting for down close candles. And I think we can already see that Monday here is a no trade day. We just had consolidation here. Maybe we're gonna, oh, it becomes interesting. We have some, no. So I think we can all agree that this is a no trade day. We just went up only. The higher time frame buys is not okay. So this Monday, no trade. Cool. There's a lesson in that. Maybe Mondays are not the nicest. No, that's not true. Their Mondays are super clean, but sometimes they're just like this. Most times they're like this. And if they're not, they're clean, like very clean. For Mondays, there's almost no in between. It's or super clean or this. Okay, cool. Then we now have another 4-hour value gap for the next day. So we skip Monday. Monday, no trades. And we're already getting a little bit of a routine. And I know this, guys. We're trying to dance a little bit now. We already know the routine. We know that we go from the higher time frame to the lower time frame. Let's go to the daily finally. Look at this. After Monday, there is a massive daily for value gap created with the order block. Where is price most likely going to go higher from, right? So shorts towards the daily busy, longs from their higher time frame back to all-time high. That is the bias for the week. Cool. Let's go to the next day, to Tuesday. And it also means, very important, if this bias continues, I'm not going to take longs. Like I have weeks where I just am wrong on the buys. I'm not going to chase this price action. I'm going to wait for lower prices first. Yeah, same here. During this day, I think we could have played a 10 AM game here because it's a nice sweep, but like I already seen the 1 hour that I would not have taken this. It's very simple. And I think if you go in the lower time frame, we're going to see the same. Look at the open. Look at how horrible the open is. The open is right here. Consolidation, and then move higher, and then lower again. And there's another lesson right here of this no trade. Because if you see on the, I'm going to write this down right now so you can put it in your notepad. If the intermediate time frame, this means the 1 and the 4 hour, is not super clean, the lower time frame is going to be even less clean, period. And we already saw that. I said on a 1 hour, nah, not for me, because I'm waiting for clear lower prices, and we didn't get that. If the 1 hour is not super clean, which it was not, cool. That means let's go to Wednesday. And maybe we're going to see CPI on Wednesday, because we didn't have a CPI candle yet. So you see this price action most of the time before CPI. Maybe it was already here, but I think we can get bigger candles. I do see a nice 15-minute sell structure forming, but it's already marked close. So let's go to the next New York Open. So the short move should come soon, right? And maybe we have a news candle coming in, 8 AM. We have to finally the move, guys. Cool. This is nice. So we had sell structure created before the open during the after hours, which is fine. Like this is information we're going to use during our trade. Like we cannot pick bottoms or tops. We just need to trade with what we have. Okay, let's go to the 1 hour. These are the 4 hour bullish value gaps. This is the daily value gap. So there is so many nice downward targets. I think what would happen based on this, I look at this at the open. I think the 9 AM candle is also going to be a candle like this. And then maybe the 10 AM game can be played like this. This is what I would predict as one scenario here. Bearish candle, value gap like this. If not, the open will already retrace. The New York Open will already retrace. But I think we can get shorts on this price action to the daily bullish value gap. So let's go to 15 minutes. We're doing every day the same, guys. We're not going to deviate from our plan. There's a 15-minute bearish value gap here with already an up close candle here. So maybe we're not going back there. Right here. Boom. Okay. This is marked out. So bearish erase towards lower. Then the 5 minutes overlapping 5-minute erase. Well, I think this whole area is an overlapping 5 and 15 minutes for value gap. So let's do 5 plus 15. And then during the open, let's see if we can retrace back into that and then take trades. Cool. Okay. This is nice. So this, when I see this, I'm so happy because let's go over the frameworks. We know that we want to trade lower. We have a lower bias. Before that, we have accumulation, manipulation into the areas we marked out, and we're now waiting for distribution, the AMD, the power of 3. That can happen between 9:30 and 10, the first 30 minutes after the open. That's the FTS model, or the 10 a.m. game, where it's going after 10 a.m. Both is fine. Clear bias. Yeah, the bias good. Order flow is good. We have a clear draw on liquidity, and now we just need to wait for under 1 minute to get our model. And when we get our model, we need to know that we have a big stop. We don't want to get stopped out again. So now let's go to the 1 minute to see if we can find reaction from this. So that means we need to find down close candles. We need to wait for that. I don't see down close candles here. It's now 10 a.m. If we now go to the 5 minutes, we have a lot of for value gaps here as well. Not sexy for our trade ID, right? We have that 1 hour bullish value gap here. So maybe we're going lower first, but for now, it looks like the bias is wrong. And then there will be no trade because here we don't take blindly trades. We wait for a reaction lower. If it doesn't come, cool. Maybe it comes later. But now we are already in the PM session. So it means also here, low probability, cleared on liquidity, but no trades. Awesome. Monday, no trades because it was consolidating. Tuesday, no trades because we're consolidating. Wednesday, super clear idea, but no entry. Let's go to the next day. If we go to, we still have the same bias. So I think the trade idea we now have is still the same. We even have these 4 hour busies below here, the bullish value gaps. So we're still good. Yeah, at some point, we just do more of the same. Cool. Let's go next day. So this is PM session, and I hope we're not gonna get another Asia push. It's so annoying. I hate waking up and then seeing, or not waking up. I'm in Vietnam, but opening my trading view in the evening, and then when New York starts and everything already happens, I'm like, oh guys, come on, it's so annoying. But we maybe have that. Not here today. Okay, so we just are still in the same range from Wednesday, but I think the bias is still the same. Nothing changed. We have a pretty nice 1 hour structure now, because inside this 1 hour bearish value gap, we have something called a turtle soup. That is a sweep of a swing high before continuing lower. It's a high probability high. So it wouldn't surprise me if you can trade lower today. So bias, daily bias is still lower towards, like, low-hanging fruit would even be these 4 hour bullish value gaps right here. But ideally, we're going to the daily bullish value gap. Okay, then we fast forward to the New York Open. There we go. There we go. Aggressive buys, aggressive sells. We have something here. And yeah, so now at 9:45, we have a 50-minute bearish value gap. This could be the start of our trade ID lower. Finally, let's go to the 5 minutes. Similar, we leave behind equal lows. So it wouldn't surprise me if you from this point are gonna trade lower. Cool. Okay, low-hanging fruit target is here. It's the first 4 hour bullish value gap. If we look at this price action also in the 5 minutes, I think the stop loss should be, like, we learn from our mistakes. Hopefully we cannot do cool fancy stops. We had one mistake. It sucks to make that again. So I think the trade is invalid if it would come here. So then this would be the trade idea. And what do we have then? We have before the open, the aggressive buys, aggressive sells. This is a 15-minute fair value gap. And inside that 15-minute fair value gap, we have also aggressive buys, aggressive sells, and like move away from the fair value gap. So I am happy with this trade. I think this is an A setup. Cool. Let's see. Let's see. Another loss. Cool. So 4 losses. No, not 4 losses, 3 losses. And if you then go back, this is what I do when I take a loss. The day before this recording, I took a similar loss where I took a short and it just went higher, like poof, but super nice setup. And the question you should ask yourself when you take losses is, and my students here, you know what I'm gonna say already, would I take this trade tomorrow again? That's such a nice question to ask yourself. For this one, 100%. So it's an honest loss. It's good. Because look at what we had before we took the, and I think I remember this trade. I think I took, I'm almost certain I took this trade in May 2024. Like this. Look at how sexy the rejection is from the 15 minutes bullish value gap here. So would I take this trade tomorrow again? Yeah, cool. Next day. And while I'm fast forward, let me share some nuggets. Is you will have this too, where you go to a month and you just take trades and nothing works. Or nothing works, we take fucking 4 trades. But I hope you get my point. Like, we're spending a lot of time on 4 trades because I want to share every single step and nuance of the model. But if you then have 4 trades, 3 losses, 1 small win, you're like, oh, this model is probably not working anymore, right? The whole self-talk is super annoying. But it's a lie. It's a lie. We are 3 trades in, 4 trades in. But the only thing that you are in is time. I sweep here. You lose time here. And you feel like, oh, it's probably not worth it, but it is worth it. It's so worth it doing this. You training your eyes to find setups. By now, should we reconsider? That's the question I ask myself when I have this. When I take some shorts, but I get stopped out. And it's funny actually because our small win from earlier. Look at how clean TP that went later. I see now. But is the bias wrong here? I would say it's still good. The bias would be still good. So let's see at 9 a.m. I want to see the 4-hour right now. Because if you're just leaving this all behind, yeah, it could just be that we're gonna leave, or maybe for some nice flash crash, first lower then higher. But the market is super bullish here. Not sure what happened here in 2024, but now low-hanging fruit would just be this high, right? At some point, my bias is just gonna be, yeah, let's not be fancy and let's just continue with the trend, right? Instead of trying to catch your trades and then higher. So for this trading day, when I see this at the open, I would love to trade there. I'm probably going to get a 10 AM game here. So then my eyes would go to a continuation higher. So at the open, we'll be fully open with aggressive buys, aggressive sells. We have an order block sitting here. This is nice. So then the order block, I want to see, do we create buy structure to here? We're just continuing, not finding the trend anymore. So this is the bias. Cool. Let's go to the lower time frame to see, do we get reaction from there? Also check if we have nice overlapping on the 5 minute. Yes, a small 5 minute for value gap here as well and here as well. So could be nice. Cool. So let's see, do we get, and it's also a 10 AM game, do we get aggressive sells, aggressive buys? And if not, also we could start the sell idea. So for now, doesn't look like higher. Cool. Then that 50 minutes idea is off the table. But now this one changes teams. Inversion for value gap. Inversion for value gap, bearish order block. If you know what a breaker is, bearish breaker. So now this becomes the idea all of a sudden. So let's see. Do we trade into this for value gap, and trade lower? If we trade lower, where to? Session lows. So that would be the midnight low here, but that would be the lows right here. This candle did not close yet, did it? Now it closes. Not sure, it was a little bug in my trading view. Cool. So now, short idea is still on the table. I would not be in here. The model is not here yet. Not sure what happened with the candles. The candles are a little buggy here. Let's see. There we go. Cool. So aggressive buys, aggressive sells, inversion for value gap, order block, and then on the 5 minutes we see more as well. See if we can get some. I want to see. We're at 11, but I want to see more down close candles coming in. Ideally from here. Yeah, from here. But it's already PM session. So here as well, I was looking for a long, did not come. Cool. Then I wait for the short, did also not come. And then, well, we didn't do actually anything this day. So I think this is a pretty nice save that we didn't take a loss. because there would be a loss in both ways. If we took the long, it was a loss. If we took the short, it was also a loss because it did not move, or a small win or whatever. Cool. So no trade there. Cool. Let me know if there's questions. I see one question. Did we wait for the second PD array in the last trade? Then come back to this one. So in this case, let me go back here. It was the short. So in this case, I did not wait for the first PD array. I waited for value gap 1, just PD array 1, to be traded into and moved away from, like this. Why do I now not wait for the second PD array? Is because this is more of a reaction time frame, because the original idea is just from the 50 minutes internal range liquidity lower. That's already the whole idea. If that's my idea, if I then see this on the lower time frame, I think the same trade was 2 Fridays ago. We took also a similar short where there's a 50 minutes bearish value gap, and I'm just waiting for the 1 PD array inside that idea. So you could even say that the 15 minutes bearish value gap was like the test, and then this reaction is like the second PD array, like the confirmation, basically. Let me know if that makes sense. Cool. Well, it's not a very exciting back test session so far, which is good. Cool. There we go. Okay. We are now, oh, it was already the trade week. Cool. So trade week, pretty boring, right? Pretty boring. If you look at the weekly profile, I think we did amazing. There was no weekly profile here. It was a Wednesday low of the week at 8 a.m. Small range, consolidating most of the time. This is amazing that we managed in this week to just take one trade. One trade, one loss. I think it's pretty impressive. Same if you review your trades from, for example, last week. You look at the 1 hour, the 4 hour, and you see it ranging, and you're like, oh, that's pretty decent. Or you took so many losses and you blew some accounts, and you do the same. You're like, oh, that is why there was no follow through on bullish or bearish ideas. That is called lower probability environments. Cool. That's normal. Like you have months like that. This is fine. I try to normalize this. It's not always fancy and fast. I wish it was so nice. When this happens, for example, when there's a lower time frame, not super nice on NASDAQ, I just go to other assets, gold, forex pairs, to look for something sexy. If you now look, for example, at the dollar pairs in 2026, that's super sexy. No. If you then look for the gold or NASDAQ, there were very nice trades. Not always, but you should be able to do this same trick pony on other pairs. Cool. Next week. Oh, I'm cheating again. Am I? No, I'm not cheating. It's exactly 8. Never mind. Boom. Okay. Before I do that, let's go back to Friday, because we need to take a look again at the higher time frame. Is there something you missed? Because we were waiting for the daily bullish value gap. Remember that weekly bias, where I was waiting for price to come first lower than higher, did not come. I was waiting for this. Did not come. Cool. So then it's Monday again. And when it's Monday, there needs to be a weekly outlook. Cool. Let's make the weekly outlook right now. I think the weekly outlook is pretty obvious. It's pretty obvious. One is, and it's something I missed here, there's another daily bullish value gap. Do I see it correctly? Yeah. Daily bullish value gap. It's a little crowded here because all the arrays, but cool. Missed this. So the low of the week, and it's a very funny miss, was in the delivery was horrible, but the low of the week was in a daily bullish value gap. Cool. We trade away from that, making the down close candle a order block. I take the wick. Again, if you've seen the order block secrets video, when there is a small body, big wick, I take the wick. And there is a clean high here, or multiple clean highs. So it's going to be the point of interest for this trade week. And that's what we're going to do into Monday. Monday, lower expectations because it's a Monday. But we're still just going to look for trades. This is Friday. Let's go to, this is London. Okay. So here, there is a potential 4-hour bullish value gap created, potentially, because I know that there's a little bug here in this trading view that it doesn't, but it's cleaner. So this green line is becoming more messy, of course, because we have more lines and we need to remove some stuff, but this is the daily bullish order block. It's a 1 hour. This is a nice point of interest for a low. Because we leave the Friday high intact, because we already moved away from this daily bullish value gap. So how nice would it be if you could trade today something like this? Let's wait closer to the open. Let's see if that's still the case. Okay. This looks nice, right? So at 9:30, like we have that idea that maybe from the 1 hour bullish fair value gap, and I also see that there's a 50 minutes bullish fair value gap, we could trade higher. I like this. To then just trade towards the highs here. What we need for that is not, of course, a bearish fair value gap. That's not nice for a bearish idea. But we're still going to look for, do we create bullish structure? At the open, massive. Like I think that because it's 2 years ago, the candles are not loading anymore, but this probably just these were candles or maybe fair value gaps. Let's see what we have. So we trade away from that level. Not super aggressive. A quick tip here. When it's not super aggressive, remember this one, displacement lower time frame, could be tricky here. This could be come back now in this trade. They want the lessons. On the 5 minute, there's a small 5 minute bullish fair value gap sitting here. Let's see if we trade higher. Oh, we tap into that. That's nice. Let's see if we move away from that. And I'm chilling on the 5 minute here, guys. I'm just waiting. Okay, not nice. Not nice. We need to trade higher. No, still not. Oh no, we have a consolidation again. Oh no. Okay, nice. 11. Okay, good enough. No. Guys, why did you pick this month? This is not fun. Okay, this is Monday price action. Okay. Oh, another low here. And we already, okay. So, conclusion. Monday, would you trade this? Nah, right? So no trade. Cool. This looks like PM model, by the way. This looks like PM. Like if you now look here, let's demo trade. Like this is not going to be for the stats, but this looks like PM model. If you now displays higher, for like a 1. Oh no, we Monday. So this is how I see. This is a very nice example for your notes, and you can also when you watch this video on YouTube, you can pause the video and just screenshot this. Because when I say on Discord or on socials, like, yo, Monday could be low probability, this is what I mean. It's not that all Mondays are bad, but this is what Monday I have in my head. Like, hey, Monday is just not super nice. That is why I don't stream on Monday, because I'm just expecting this. If it doesn't come and it's nice, of course, nice. Thank you for the money. But I'm just expecting this. That's why I don't stream. Cool. Next day. So far in May, it's already May 14th and only 4 trades taken. I think it's pretty impressive that we are navigating lower probability price action like this. So we're doing almost the opposite of the part 1, where we had like a nice win streak, where we were navigating high probability price action. Now we are navigating low probability price action with a pretty decent result. And $3 doesn't sound like a decent result, but it can be really worse if you are just wanting to force trades in these environments. Trust me, I did that before when I was not profitable. Okay. Oh, okay. I think this is news. Do you guys agree? Would this be news? An ADM candle that looks like this? I think this is CPI. I'm almost sure it's CPI. But that is the sweep we love to see, because this could be the sweep that trades us higher. Because we already were at the daily bullish value gap. We already moved away from there. We don't need to trade lower. So a liquidity sweep here. And then higher, so aggressive buys. This one big wick. Yeah, so at the open, I'm curious. I would have a higher bias. So here's the nice sweep into the daily order block. Now I have 5 minute bullish value gap here. See if we trade higher from there. Yeah. If you go to the 15-minute time frame, it's probably always yeah. That was so sexy. Okay. So now we have a massive order block. I'm not sure why the candle's not here. I think it's because of the news, but this is the order block in total. We have an overlapping, also a fair value gap sitting here. So let's just pretend this is an overlapping fair value gap and order block. Super big sweep, probably CPI sweep. And then for 10 AM game, what I'm now going to play is, do we move away bullish from this area? So then the trade idea is going to be like this. Let's see. Oh, the 15-minute candle did not close yet. So let's just wait a bit until 10. Why is it doing it to me all the time? Yeah, there's not even a 15-minute value gap. What is this? Okay. There we go. There we go. This is what we were already expecting, but I was a little late to the party. So then I would love to take my trade from here. Stop below the swing low, and that means we need to put our TP a little higher. But I would say this is the trade. So we have a liquidity sweep, structure shift, for value gap 1, and this for value gap 2. Showtime. Okay, so now we have the high. This sucks because this is a nice example of what I said, like you want to be in, so your stop need to be in the right place. And again, look at where price came back to. That's fine. Let's roll down. That's fine. But now we have an awkward scenario where the target, the weekly target, is already hit. So ideally, what you could do is just put your TP here, but then your risk to reward is a 1, 2, 1, 3, which is low. But you rake in wins. I talk about this in my story video where I talk about how I became profitable in 2.5 years. This is what I did at the start when I was just wanted to rake in wins. Not per se making a lot of money, but just getting confident on my model. Like, hey, it works. And you see it here as well. It just works. But no, we said we're just going to do this. Bigger stop, 1 to 2. And let's see what happens. Oh, it's the market close already. So I would say, is the small win, big win? Let me know in the chat, guys. Is this a win or a small win? You guys decide. Big win, small win. I would agree because it's not a full TP. Take this a win. Yeah, but like the thing is, if we would say this is a win, but then the next trade we take a full TP, then this trade still feels a little bit like cheating, right? Like I think after 5 trades, we crave a big full TP, of course. But I think we need to be strict here and just take it as a small win. It's a bigger small win. It's a medium-sized win, just like you have a whatever McDonald's medium fries. Yeah, but I'm gonna be I'm gonna be strict here, and let's do it as a small win, because then we can celebrate more when it's a full TP. But again, like what I hope to message here is that the win is not the biggest factor here. The win is seeing the fucking model in real time before the candles print. Liquidity sweep, market structure shift for value gap 1 and 2. Result is irrelevant in this small data set. We're literally doing like 2 weeks of backtesting. What if you're going to do a year of backtesting? Then you have, of course, more data. And what we did very well here is the alternative of this trade would be that we put our TP here, but put our stop loss in a place that would give us a 1 to 2. But we did at the start, the first mistake. And then we would have been in here again. And we learned from our mistake. So instead of getting stopped out before the real move, we got ourselves a small win. And learning from your mistakes you made earlier is a super big win in your trading in the long run. So I'm proud of that. You should be proud of that, because we're building our book of truths here. Okay, next day. So let's do this week and let's see what happens. Like whatever result happens, maybe you're gonna get a backtest with 0 wins. Be fine. But let's go to the next day. Okay. So because of that expansion, I think our bias is pretty nice that we could have this Tuesday as a low of the week. I don't want to say that too loud, of course. No, but you have the classic accumulation on Monday, then Tuesday manipulation, and then distribution starts the rest of the week. That's what I have as a bias right now for the rest of the week. So I'm going to be slightly bullish towards all these highs here. Let's see it's important how we move away from here. Yeah, I think we just can play continuations here. Overlapping 1 and 4 hour for value gap. During London being traded into. Consolidation. Oh, I was like, did I cheat? No. News. Yeah. Say me what news this is, but it is news. And it's fine. We need to trade with what we have. And it means at the New York Open, I'm going to consider, this is a sweep, potentially SMT, but there's equal lows here. But I think this is an SMT with ES, probably. But this could be an area of interest. But of course, this gigantic fair value gap is going to be the point of interest for longs. So during the open, 2 candles later, let's wait for price to basically do this. If it doesn't do that, by the way, it's going to give nice sell structure, because then it gives like this whole up close candle becomes an order block to trade lower. But for now, we're just going to trade with the trend like we always do. So that means around 10 a.m. or around the open, actually. It's right now. Trade into it. Oh, I'm going too fast. I'm going too fast. I'm cheating, but we need to at the open at the fair value gap. I'm so sorry, guys, but I need to redo this because we wait for aggressive buys or aggressive sells, aggressive buys like this. So now we have a bearish fair value gap that got disrespected. It's an inversion fair value gap. There's a bullish fair value gap that got respected. And we move away from there. Looks interesting. Another fair value gap. I think that's enough. So stop ideally below the low, right? Target 1 to 2. Because in an ideal scenario, if you want to scalp this, your TP is just here and your stop here. We can do both and see what happens, but I don't like this trade. Like, this is not the model. This is too small for my model. This is like scalping territory, 20 pips. But let's just put it here for, but ideally, this is the trade I want to take for the backtest. Because it's so big, I am open to put it below this order book here in the fair value gap here. It's going to be risky, but I'm open for that. Like this. If it gets stopped out, I'm open for a second bullet, same like that. Cool. Showtime. Trade 6. We got it. Let's go. We got it. Trade 6. Full TP. Full TP. Imagine watching this video and you're an hour and a half in and you're just waiting for that loser who finally takes the win. But we got it. We got it. We got it. Let's go. Boom. Trades taken. 6. 1 win. Boom. Super high win rate. Let's go. Okay, but this is cool. And what I'm hoping also trying to just give you is we do everything the same. This is consistency. Executing something consistently. 6 trades, 1 win, 2 small wins. Don't forget that. 2 small wins and 3 losses. Pretty decent, right? And the small win was the first one was like 0.2 R, or maybe like a half, maybe. And the other one was like 60%. So it's not too shabby. Not too shabby. Okay, done. Next day. For me to not clear this place, I wouldn't have taken it. Okay, cool. I think this is amazing. I'm gonna add this in the video. I'm gonna add this in the video. This is amazing. Okay, let's go back to the video. One of the questions I got from my students here is, I wouldn't have taken this because there was no clear displacement. And we, of course, had that first lesson from earlier, like there needs to be more displacement on the higher time frame. And how I see displacement is fair value gaps. And there was actually 2 fair value gaps here. 1 to any inverse fair value gap. So displacement, how I see that, and the framework I can give you here is I'm looking at 2 things. One is, of course, the obvious fair value gap, but also supporting the aggressive sells, aggressive buys. And there's the inversion fair value gap. Plays a big role in that. Last year, I started using the inversion fair value gap more as an extra confluence to see like, okay, we not only have the fair value gaps, but there's an extra confluence present here as well. And that's why for me it was enough. Even I agree, because especially the candles down here are not super clean, 100%. But remember the idea where we are in, like we are in a 1 minute, very zoomed in, but we are in a 15-minute bullish fair value gap where we just wanted to take longs from. So inside that we have inversion fair value gap, fair value gap 1, fair value gap 2. That's enough. Also, and if we compare this to the first trade, this wasn't there. There was no inversion fair value gap and 2 very obvious fair value gaps. It was not clean enough. But it's always a balancing game. It's always a balancing game. But this is enough to take. Okay, let's go to Thursday. Okay, cool. So we displace higher, 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 higher. Wow. A bull run incoming. Oh yeah, look at this. We're at 18K. 2 years later. Yeah, you're hilarious. Okay. I think we're going to have an easy day on Thursday. Yeah. And with easy, I mean, we want to take longs, but we could also first take shorts. Like we can be fancy today. We can ping pong. Because I think we can agree on 4 hour, we're going to do this. So depending on how we open on the lower time frame, if you zoom in on this is the higher time frame bias. But let's say the open is more like this. Like this. Then I'm open to take a short towards the fair value gap, lower time frame, and then long again. And then you're basically trading the retracement before the move higher. So let's go to the New York Open. I'm gonna make this a massive 4-hour for value gap, overlapping 1 hour for value gaps here as well. During Asia, we already have a little bit. Let's see how we open. You consolidate, that is nice. We want that consolidation before the open. This makes, if you see this before the open, I love that, because then you have your accumulation, manipulation, distribution idea. There is literally buyers and sellers in the market before the open. And then the open is probably going to be an energetic move and a reversal, like we want in our model. 7, 8 a.m. Hey, what do we do? Surprise, surprise. Are we trading lower? Who would have thought? So, cool. So if you first trading lower, that's fine. I want to take longs after. Let's go to the open. This 9:30. Yeah, so I'm first eyeing the short idea. I'm not too fan of the short idea. I think we can go lower, but I would not have taken this. Yes, I see the sweep here from 8:30. Maybe if I zoom in a little bit more, we can find a cleaner entry. No. I don't like the structure for a short. So I'm going to wait for price to sell off and then wait for buy structure, which did not come. Oh, and I made a backtest mistake here. I did not look at the 4-hour time frame. The 4-hour for value gap was not marked out. Good. So whatever happens, this is not going to count as the win because we know the outcome now. But we trade back into the massive 4-hour for value gap, which was different now. Let's go to the 1 hour. And again, hindsight, so it doesn't count. But I want to see, was the model there? Like, I don't like cheating. And maybe we can even take a trade here. After. But first, let's see if we could have taken a trade here. And if we did not do, then I'm gonna see, could we have taken a trade here and then go higher, and from the 1 hour for value gap. So two trade IDs here, a little bit cheating, but so be it. That's 5 minutes. Cool. So we trade here into the for value gap here. There's no, remember what I said about the displacement in the question? There's no inversion for value gap here. I don't like that too much. But then when we do this at 10 a.m., this looks more like 10 a.m. game material. Accumulation, manipulate, distribution, but also here. No, I would have probably not be in this trade. Shallow for value gaps, not clean delivery. I probably would have missed this one. It's in a 5 minutes if I could have an entry. Oh, 5 minutes is super sexy. Yeah, but no, I cannot say with integrity that I would have taken this trade. So let's call this trade missed. Nice for value gaps here. And let's see, based on this, we just missed this complete move. Let's say hypothetically, could we take another trade? There's a 15-minute bullish value gap here. So now there's no hindsight anymore. Now we're just gonna catch the retracement. I think also in the 1 hour there was one created. Yeah. So we have an overlapping 15-minute and 1 hour for value gap here. And then the bias is this. Also an order block sitting here. Order block. Cool. So let's wait. The price to trade lower. We do. Hey, this looks like a trade idea, guys. So inside the order block and for value gap, we now have structure. So then the question about for value gap 1 and 2 again. We had earlier, like, hey, why would you now only take one PD array and why not wait for the second PD array? Because this first PD array is inside the 1 hour and 50 minutes bullish PD arrays. So there's already I'm waiting. This is the lower time for confirmation in the original idea. So I would be interested in taking this. Stop below the low because we know how good stops we need to take for 1 to 2. Let's see. Showtime. I'm in here in this. Tending to be higher like this. Okay, showtime. Trade 7. Nope. And we trade lower. Cool. I would have taken this trade. This is fine. So trade 7, loss. Cool. We zoom out again. Yeah, we just started consolidating inside this for value gap. And we didn't even go higher. So honest loss was fine. And we're probably seeing a obvious high being printed now, which gives us nice information for the next trade day, which is going to be the last one. Last trading day, guys, before we're going to wrap it up and go over the conclusions of our backtest session together. Cool. So that long idea was wrong, which is fine. And now we're trading lower, but we're still, let me go back to Thursday again. And I want to show the daily time frame now. There's now a massive daily bullish for value gap created. And I think we are going to use that, right? So, and it's massive. So it's harder to find a level because it's so big, but it's probably what we're going to do. In that fair value gap, we have 4-hour bullish fair value gaps. So these are the areas for price. So the bias is going to be higher. But the question is where higher from? How deep are we going to retrace? And that answer is going to be very simple because it's going to wait. What do we have at the New York Open on let's see if the 4-hour fair value gap is still there. Yeah, it's still there. That's nice. Okay, so now we consolidate. We take liquidity on the downside and the upside. So there's nothing here in this range. Let's go to 8 a.m. And then at the open, we start to move. The highs here at 8:45. This is a London low. So both could be taken. There's no entry here. There's no model here. And my apologies for all the boxes. It's a lot. Well, these are the 4-hour bullish fair value gaps. And this the daily fair value gap. But inside this range, it's not super clean. So the lower time is not super nice. So I'm waiting. This could be an SMT here. And we're now already at 11. I think there's going to be no trade day. And we are at PM session. Oh, look at this. No trade day. And also, screenshot this. Because if we trade in this live, please pay attention. If we trade this live and we see this range, and we see that bullish fair value gaps and bearish fair value gaps are not being followed through. You see this sometimes multiple sessions per week. Majority of the week, it's at least one session that looks like this. Then you can anticipate it. Then you have a nice trade idea that just doesn't work out today. Awesome. It's so nice. Because then you can save yourself from losses and you can say to yourself, oh, this sucks. I cannot press the button today. Let's come back tomorrow. Because let's say you would have traded this live. And you were like, okay, London low is going to hold. This is a liquidity sweep. And then we trade higher. But how we trade higher, remember one of the lessons, there's no clear displacement here. Not very true. There's a little balance price range here. But the only thing, but this move here should not come that deep, right? And if that was the move, then it shouldn't have moved away from this bullish fair value gap. Then it would just moved here and higher. But we don't, which is fine. Maybe we then trade lower. So that means bearish fair value gaps should then be created like this for then price to trade lower. Do we do that? A little bit, but we don't even take out a short-term low here. And then you know that you have, it's called seek and destroy, that you have low probability condition on your hand. And you just save yourself from a loss. Another lesson. So we are now in May 17th. That means we have, with the weekend, probably we had like 10-ish trade days, 12 maybe, 7 trades taken. 7 trades taken, 1 win, 2 small wins. There's no break even. So we can remove this, like small win. And 4 losses. That means the official win rate is, I'm gonna go grab my calculator now. Win rate, 14%. It's gonna be such a fun YouTube title. 14% win rate. And but win rate is not the only metric we need to calculate here. 14%. Okay, because 7 trades taken, that means the win is +2. Loss is -4. So the net result is -2. If you take the small wins into account, I think we can be closer to -1. Close to -1. I don't think there will be any course seller in the world who's going to say, buy my 14% win rate, entry model. But for me, the most important part about trading is making fucking money. And if I don't make money, I want to lose as little as I can. So if I now say to you, I have a 14% win rate, you're going to laugh in my face and you think I'm going to lose all my life savings. But we traded the same model every single day for almost 2 weeks. We took 7 trades, only 1 win, but we still have such a small loss. This is not even losing a challenge because we did not have a big losing streak. So you have a 14% win rate, a very hard 2 trade weeks, and you not even lose an account. And then you see so many people failing platform challenges, blowing accounts, blowing life savings. Do you still believe that win rate is the only metric? I hope to break that. And I hope this video is going to be shown to a lot of people. If you search win rate, you will lose because it's personal. It is also it's a faulty metric because we just took a lot of losses, but at the end of the day, we lost almost nothing. Pretty cool. Pretty cool. And I'm very happy and I'm very excited that you guys have been with me. And I see in the chat now, yeah, you had your 86% in the previous video, now 40. This is exact 100. This is so cool. I'm gonna use this. So, yeah, guys. So, if you watch part 1 and 2, yeah, I have 100% win rate. No, amazing. Like, if you're gonna now back to June or July, maybe the win rate is gonna be 30 or 40, or maybe another outlier to 86, which is all good. You should calculate the rest. So the wins, how many were the wins? The losses, how many were the losses? There's where you make your money. And we did super consistent. All the entries were the same. We made even 3 lessons. Like, hey, we could maybe add some nuances to our execution here with the displays with a lower time frame where we need to wait for, not trading before big news events. Of course, during this backtest, we didn't look at news events, but we saw that we got stopped out in one trade. And then in the PM session, FOMC came and took out trade towards the P points. And we had one loss, which could be a very sexy win if we not get stopped out by 1 point. Cool, that's a lesson. Bigger stop, and we did that in the next trades. And because we had a bigger stop, also bigger TP, that means the small wins. That's a curse from that. That you will have days where you just have a small win, not a TP. But if that makes sure that we don't lose as much, because losing sucks. I'd rather have a small win than a loss, right? It's worth it. A nice lesson. Write it down. And this is how you should backtest yourself as well. You're going to have months where you have 14% win rate, some 86, some 50. It doesn't matter. How much did you win or lose? If it's a losing week, losing month, like these are 2 losing weeks, cool. But how much you actually lose? Not a lot, which is amazing. Because it means if you're going to have some win streaks where the +2s are going to stack on top of each other, all of a sudden you are up like +10 or +15, and you're like, oh, trading is the easiest thing in the world. But then you also watch this video and you see, hey, not everything, not every week is nice. I said it before, the current market conditions, as time recording, April 2026, are pretty hard. Pretty hard. I'm not the only one who, I talked to a lot of traders, they're like, what is happening? It's weird. And not only ICT traders, supply and demand traders, support and resistance traders, everyone, when there's a lot of stuff going on in the world, the market is just harder. Does it mean we're going to change our model? No. Does it mean we're going to risk less or we're going to do funny stuff? No. We can execute the exact same trades in the exact same way, and we are okay, and we just accept to just take more losses. If you cannot handle those losses, cool. Then take less trades or don't trade. Stay out of the market. But I'm okay with just executing this model, even in harder conditions, and see what happens. Let the data build. Who cares if I have a 14% win rate? I don't. I'm super happy that in a 2 losing week, I only lost -2 or -1. So nice. So nice. I'm happy with that. And this is hopefully how you can approach trading as well, because I know a lot of traders, if they lose, they lose 86%, like a 40% win rate, they would feel like a failure, feel like a loser. Trading doesn't win. How can that Dion guy have an 86% win rate and I have a 14% win rate? No. Doesn't work like that. It's normal. It is just normal. It's a normal part of trading. And that's why when I work one-on-one with people, my first test with them is, let's build data. Let's do this a lot and see what happens, just to see how you react in losing weeks, losing streaks, winning streaks, winning weeks, and see that both sides of that spectrum is super normal. Awesome. Cool. And I hope you also see that how we traded now in May 2024 is the exact same way how we trade in April 2026 or March 2026. I hope it's inspiring. I've been doing this for so long. I've strategy hopped for so long, but this works. This works. And if you have a slightly different model, that works too. As long as you do this, just head down And I hope you also now see, this is a very raw video. I like creating these raw videos. You see that it is all real. There are no magic indicators. There are no, it's just you predicting the market, right or wrong. That's your edge, and hope for the best. That's what speculating is. And you will have win streaks, losing streaks, but normalizing it. Because I know one of the mentorship exercises is that very big data building exercise, which is horrible. I know that. Like, it's super annoying. But it's the only way, in my opinion, how you can train your eyes on your model. And you know, okay, it's probably going to happen or not. We saw some very nice situations already in this video where we already considered like, oh, nice, lower probability conditions, we're not going to trade. We're just going to skip this day. And now you can use that same knowledge. Well, we did it today with NFP and the Eastern weekend. But also next week, if you're going to see this price action, I'm going to refer to today and say, yo, remember the backtest? We now know. And when I say, guys, I'm probably not going to trade, you now know. It's not because I have my crystal ball is working again. No, it's very simple. It's consolidating. Look, for example, like I see someone here in the audience who trades crypto a lot, and we have a chat today. And I said, your higher time frame of your crypto looks fucking horrible. There is no even a point in executing lower time frame then. So you have two choices: not trade that, or try to use your same model on different assets. So if you, for example, like trading Bitcoin, gold moves similar, NASDAQ looks similar, the DAX moves similar. So you can try to build data on that. If you trade the dollar pairs currently, it's pretty hard to trade. Cool. Then try to, when you know it's lower probability, you know your lower time frame is not going to be hard, but you still want to push some buttons because you don't want to sit still for another 2 weeks, right? So then you're just like, okay, can I use my model on different assets? Not forcing trades, but just filtering. Like, hey, can I use this on the cat pairs or on the NASDAQ or the S or the YM or the Dow Jones? Or that's the same on the DAX, on the UK 100. Yeah, you cannot diversifying, but just expanding. And it doesn't mean you're going to force a lot of trades. No, you're just going to look at the rest of the assets. If you want to know the assets, like I can put them here on the screen as well. On the right side, probably my camera is now going to be in in that screen, but I can remove this by now as well. Boom, right here. So you have the indices. Wait, I think I can make this bigger. There we go. You have the indices: NASDAQ, ES, YM, the DAX, UK 100, the dollar pairs, the NCD pairs, the AUD pairs, the CAD pairs, GHF, JPY, gold, silver, oil, crypto. I don't believe that if on your favorite asset it doesn't work for now because it's just consolidating and does look nice, I don't believe if you go through the whole list that you cannot find your model on a different asset sometime per week. So that means if you recently did not take a lot of trades because it was not nice, then this is your focus point for in a trade weekend. Just go to this chart, do what we do today. Just go for a few weeks and see, hey, would it be there? If I would trade this, would it be there? And let it be confidence, proof that you can do that next week as well. Put it on your list. I want to trade the DAX right now, the German index, or I want to trade gold right now because I've now proof that it also happens on this asset, my model. And then go. You just expand your trade skill. And no, I don't trade all these this whole list. I use it as a watch list. I teach you guys how to make a weekly outlook. Most weeks, my trade pairs are the same. Like it's mainly NASDAQ and gold, the dollar pairs. So sometimes something else like a JPY pair or CAD pairs, but it's like 10% of the trades. Majority is 10 EM game, an FTS model on NASDAQ. Gold is super clean as well on that. So and the dollar pairs too. It's nice, and the DAX is nice. So cool. All right. I hope you enjoyed, guys. Very cool that we had this insane long session, 2 hours and 15 minutes by now, where we go over so much. Well, I'm going to spend the rest of my weekend to edit this, but I hope you enjoyed. I hope you enjoyed that. I hope you enjoyed how real it is. I hope you enjoyed the nuggets, the thought processes, but also the reactions to losses. That is fucking normal. You're going to lose a lot. A lot. And that's okay. If you have a 50% win rate, you're going to lose 50 out of your 100 trades, and they come in sequences. That's what you see here. It's normal. It's fine. Cool. Awesome, guys. Hope you have an amazing rest of your Friday. The market is close to closing already because of the holiday weekend. So don't open your trading view, please. Don't trade. You know better. Nice backtesting session. We can do this more often if you guys are open to that. But I think for now we have a lot to chew on, to process, and it's gonna be banger of a video. And the comments, I already am so excited for the comments, guys. Oh, you sell mentorship and you have a 14% win rate. I'm sure it's gonna come, and that's okay. It's okay. And then we're gonna get thick, juicy payouts, and people are like, "Oh yeah, the Dion Trades 14% win rate, and then another 10K payout, and then oh, because then they haven't listened to my rant about win rates. I should just make a video about the scam of win rate or something, or what course sellers are not telling you, some cool clickbait, and then just tell that, because now you guys know better. The win rate is a faulty metric. 99% of traders lose money, and it's not because of their strategy. It's because they refuse to do the boring work. Today I'm going to show you the easiest NASDAQ scalping model I've ever used. And I'm going to backtest it live in a random month so you can see it for yourself. But here's the thing, the backtest is the video. So make sure you not only write down the exact model, but stick to the end so you understand the exact ins and outs of the model, so you can copy and paste it into your own trading as soon as today. No time to waste, let's get into the video. These are the rules of the model. Before 9:30 a.m. EST, mark out the most obvious points of liquidity. And don't overcomplicate this. Obvious points of liquidity are old highs and lows and fair value gaps on the higher time frame. So at all times, make sure you have them on the 1 hour, the 4 hour, daily, weekly, monthly. You have your fair value gaps and old highs and lows on your charts. And the goal is to trade towards those obvious points of liquidity or trade from it. And when we have the obvious points of liquidity, buy side and sell side liquidity, what we want to see at 9:30 a.m. EST after the open, not before, is a liquidity sweep. So a liquidity sweep taking out one of the two liquidity pools. In this example, it's sell side liquidity pool. And after we take the liquidity, we want to see displacement. Displacement is a fancy term for a big one-sided move. So if we sweep liquidity on the downside, we want displacement in the other direction, in the upside, with a market structure shift or a change in the state delivery. Market structure shift is when the last swing high, that's this blue dot right here, is being violated. So that's right here. Here's where the market structure shift happens. For the entry in that displacement move, there will be multiple confluences, PD arrays created. That can be a fair value gap, it can be inversion fair value gap, that can be an order block, breaker. There are many different PD arrays, the ICT concepts you can use here. I use the value gap and the order block for my entries, and use the inversion fair value gap as an extra confirmation. So the inversion fair value gap is when the bearish fair value gap from this side of the move is disrespected. Inversion fair value gap. The fair value gap is most likely created here. And at the point of the market structure shift, the last down close candle that swept liquidity is a high probability bullish order block. So in this area is where I'm gonna look for longs. Stop below the low for a 1 to 2. We don't need to catch the whole range. We could, but just shoot base hits for 1 to 2. And if you shoot 1 to 2s with a 40% win rate, you are profitable. So don't make it too fancy. Just make your money and leave. Bonus points for the highest win rate. Wait for the second PD array rule. And what the second PD array rule means is that you use this first area as a test of your trade idea. So you're not getting in, but you're waiting, do we see reaction from here? And this is to avoid being faked out, because maybe that displacement move on the lower time frame, this structure is on the 1 minute time frame, but maybe on the 50 minute or the 1 hour, this was just a retracement into a higher time frame bearish value gap, and we just go lower. So if you are faked out a lot, you think the structure is there, but we just continue lower, use this rule. So that means you wait for another move out of that first test area, and there is where you're gonna look for your entry. So in that new move, there's another fair value gap, most likely there's another bullish order block, and you get in the second PD array rule. And then you can put your stop below here for that same 1 to 2. Both of these execution frameworks work. You will get your 1 to 2s. If price goes higher, you will be in, and it's up to trader discretion which one of these two you prefer. And when we go over the trades after this, I will show you how I use both of them to get the highest win rate possible and when I use which one. So the structure is on the 1 minute time frame. You're the New York kill zone. We're gonna backtest this on NASDAQ. If you want to trade London session, you can use an asset like the DAX, the German index, because that's a London mover. Sometimes you will see NASDAQ moving in London session as well, but the majority of the moves, the cleanest moves, will be at the New York Open. So that's what we're gonna focus on in this session. And the nice part about this setup is, for your mental game, it is very easy because you just need to wait for time, 9:30 a.m. EST, the New York Open, and price this exact structure to align. So it's very easy to see, okay, the setup is or there, or it's not there. And for your mental game, that's nice for FOMO. That's nice for overtrading, for revenge trading, because it's very obvious if your setup is there or not. But here's the uncomfortable truth. This model works. I've been trading for over 5 years and it still works, but you won't use it. Because right now, 99% of people watching this video are thinking, yes, I got the rules now. Let's open trading for you at the New York Open and start pressing the button, and you will blow your account probably in the next few days because you haven't done the repetitions. And the upcoming minutes of the video are these repetitions. I'm gonna pick a random month and we're gonna execute every single setup together. The wins, the losses, the nuances to the model. And if you cannot even sit through a backtest video of someone who does it for multiple years, and can you show you exactly how you can do this too? How are you going to make it work? How are you going to sit through a losing streak when it comes? You need to be able to do the boring work, to sit through it, take notes, and now let's get into the back test. Cool, now we know the setup. Let's go to the actual random month. And what we'll do is, let's go to August, July. Let's do August. If you're trading ICT and you see some videos, everyone says, oh, you cannot make money in the summer, the banks are on holiday. So let's try August and see how true that actually is. Random month, and let's go. All right, we are at Friday, August 1st, and let's go to the higher time frame, because the first step of this model is to have all the relevant PD arrays ready to be traded into. So here there's a weekly bullish fair value gap. If you go to the daily, there's a daily bullish fair value gap sitting here, and because of that, the down close candle that trades into a daily bullish fair value gap is a daily bullish order block. So those PD arrays are there on the weekly and the daily. Then the 4 hour, we have some lows sitting here we could target because we just displaced big time. So with this in mind, let's start trading. And now let's fast forward to the New York Open. And here we're approaching the New York Open on August 1st. And we have that daily bullish order block sitting right here, the green line, also with some lows. We just took out a low here. We don't have much to work with on this day. There is a 1 hour bearish fair value gap. I would say their bias is going to be bearish, aggressive buys, aggressive sells. So we could see some down targets coming in. So my bias for this trade would be shorts. Maybe you can trade it from this 1 hour bearish fair value gap, and let's see what we have. Here, there's another bearish fair value gap inside the 1 hour. And if you have overlapping PD arrays, that is very nice because price loves to trade towards overlapping PD arrays. And on the 5 minutes, not much. So what we wait for is some buy side liquidity to be taken, and then we start creating sell structure for a 1 to 2. And it's under 1 minute after 9:30. So now let's fast forward to 9:30. So here we are at 9:30 a.m. EST. And before that, we did not trade into the 1 hour and 50-minute bearish fair value gap yet. So that could be an entry to be going higher and then lower. But we already had a short-term liquidity sweep. We already have the sweep here. And it was probably with a news event. If you look at the time, it was around 8:40. So the liquidity sweep has already happened. So we could just see a sell-off after the open. So I'm open for this already being the high. And we're now just going to trade lower. So let's see if there is clear bearish structure created. Because before the open, we have fair value gap here. There's already fair value gap here. There's enough here already to work with lower. Like there's bearish structure created. So when there's so many bearish structure already created, we can just use this as fuel to trade lower. We don't need to trade higher here. So for that, I would say we're going bearish. And here at the open, well, there's nothing here. I'm just waiting for displacement candles lower. Let's see if we get that lower. There's nothing here. No fair value gaps, nothing. And most of the entries are between 9:30 and 10:30 a.m. EST. This is nice. Here we got something to work with. Why? Because we already assume that this is the high. So we're trading lower, and especially this candle, the 9:37 candle, is very nice. There's a bearish order block. There's order block and an overlapping fair value gap. So for the trade idea, I would say we're gonna take a short idea from here. We're not in yet. Let's see if we get tapped in. Stop above this high for a 1 to 2. It's gonna be the trade idea for August 2nd. There's no clear structure here, so it's a little forced, and especially because the structure already formed before the open. I would say this is a B setup, but I would have taken this either way because this will still be the model. And after we just trade lower and lower, lower, there's no entry. Very important here. If we see the aggressive sells, aggressive buys, I'm not going to enter here to take shorts. It doesn't make any sense because the move here already happened. So there's no entry here. So we're going to use this as no trade. So no win, no loss, no break even. And then here at 10 a.m., if we zoom out here, we have a big move upwards. Can we do something with that? So here at 10:30, there is a potential bearish fair value gap created. So here at 10:30, there's a potential bullish fair value gap created, but we're also in a bearish fair value gap. This says me that we're probably not going to take any trade here during the New York session here. I'm just going to have a low probability day on our hands in this first day of the month. Yeah, so the model did not appear here. Let's fast forward a bit into the PM session. No, so the short move we missed. So no trade. Now let's fast forward to the next day. At the next trading day, that's going to be the Monday of the next week. There is a 4-hour bearish fair value gap created in that same area where we had that overlapping 15 1 hour and now the 4-hour bearish fair value gap. So there's a lot of liquidity up here. So this is going to be the target for the Monday trade idea. If we zoom in here, there's already a 4-hour bullish fair value gap sitting here, probably being traded into in London session. So now let's go to the lower time frame, zooming in to see how we can frame a trade idea towards this area right here. So it's going to be the Friday 8 a.m. high, and of course the overlapping fair value gaps in this area up here. There's a 15-minute bullish fair value gap sitting here already. This has been trading at 8:45, and before the open we start trading higher already. We have a very clear draw on liquidity. So let's see if there's going to be, I call it a 9:30 explosion. That means at 9:30 prices rockets upwards towards a target. That's going to be on the table here because you already have a lot of nice structure. See on the 5-minute, yes, same. There's already been tapped into. So it wouldn't surprise me if at 9:30 we're going rocket upwards towards this area right here. So at the 1 minute, we need to wait for the model for a nice liquidity sweep, break of structure, and see if we got that. And here there is no entry because we just rocket upwards towards the drawn liquidity. That's fine. You just missed the move, but missing the move does not mean we cannot make money, because now we can look for, okay, can we still make money with the setup that comes after this move? Because here at the open, we had the explosion profile, but in that explosion profile, we create a massive 15-minute bullish fair value gap. And that's what we're going to use for continuations higher. So ideally now we just wait for this to happen. And we're going to use that on the lower time frame for our model. So at 10 a.m., this is also part of the 10 a.m. game entry model. It's at 10 a.m. We wait for a manipulation lower. 10 a.m. means a AMD accumulation, manipulation, distribution at 10 a.m. So that's what we're going to play. And this, let's see if we get some move lower. Not yet. Here at 11, we get that move. We tap into the 15-minute bullish value gap. Now let's see if we can get some buy structure. So this would be indicated as the liquidity sweep. Now we're going to wait for a displacement higher. Still consolidating, so there's no entry here. And then we're just going to trade higher from there. So here also no entry, because what you want to see is a clear aggressive sells, aggressive buys. And there's consolidation here. So I don't like that. So that means you missed this move. Are you going to stop hunting? No. Zoom out again. Cool. What do we have here? 5-minute bullish value gap now here. 2 actually. So let's see if we can use that as an entry. Price comes back there. And now we're already approaching PM session. PM session, not what we trade. We see that price wicks into that value gap, but already the session is done. So on Friday, no trade. Monday also no trade. And if you have 2 trading days in a row where you don't take a trade, you're going to feel restless. You're going to feel like, I don't take too many trades. Oh, I'm now behind. I see all the Twitter gurus or the social media gurus making money. Why do I not make money? You have a model. You wait for it. If it comes, you press the button. If it doesn't come, you don't press the button. And not taking a trade on a certain day is also a win because you decided to follow your plan. So now we're going to fast forward to Tuesday, and we're going to use the movement from Monday and Friday for our trade idea, because we're going to build on top of the trade ideas. Missing moves is just information. Okay, price moved away without you. Cool. Maybe we can use those areas that we moved away from for next entries. And now we're at the next trading day, and we missed 2 days in a row of movement. Does that mean we're not trading? Of course we're going to trade. Look at this 4-hour bullish fair value gap. I would say for this open, for this trade idea, this is going to be the most obvious trade idea ever. So what I'm seeing here already, and we did a 4-hour time frame, we're going to execute on a 1 minute, but I already see that we sweep a high right here. We sweep the Asia high or the PM session high, and then we close lower. There's another 4-hour bullish fair value gap sitting here. But ideally, if we want to go higher from here, which I think we can, on the higher time frame, we'll probably just do this. And if we do that, then we can short towards it. It's a liquidity point where we can trade towards, then trade from it. So with that in mind, let's zoom into the 1-hour time frame. It's also a little swing low there. Let's fast forward to the New York Open. So now we're looking at the NASDAQ at the New York Open at 9:15 a.m. EST. And what do we have? We have the 4-hour bullish fair value gap sitting there, and there is a liquidity sweep already happening up there. Cool. That is at 8 a.m. After that, there is a 15-minute bearish fair value gap sitting there, which is nice. Let's see if that's going to hold. Let's zoom in more. We need to find areas where price could trade back into. So for now, there's nothing. So at the open, let's see how we open. So we open not very bearish. So there's no entry here. Target is going to be down here. So let's see if we can find entries towards that. So we sweep some highs here, and this is looks like bullish setup. And here it comes a very nice nuance I want to explain, because the higher time frame said clearly we're probably going lower first, right? The 4-hour bullish fair value gap. But here at the open, we have aggressive sells, aggressive buys. We have a market structure shift. We have fair value gap 1, and here fair value gap 2. So textbook model would say second PD array rule, we're going here, right? But if the 1-minute idea is long, but the 4-hour, the higher time frame says lower, you have a conflicting bias. And you need to be very careful for executing a conflicting bias on the lower time frame. Because if you're going to trade the 1 minute, it's going to be very sexy most of the times, but your higher time frame idea should match the lower time frame, and here it doesn't. So I will not be in here, and I'll explain why. So I'm actually still waiting. I'm seeing this as manipulation. So where all the Twitter gurus and all the traders go in long here, I'm gonna wait, and I want to see, do we move away from here? And we don't. So you're taking a loss here because target is very clear. It's a 4-hour bullish fair value gap. We knew this from the start of the trading day. So when there's buy structure conflicting with the higher time frame, I'm not in. So liquidity sweep is the first step. What is the last swing low that made the high? So this is the recent high. That is right here. So I'm going to remove the erase right here. And then we're going to look for a short idea. There's a fair value gap sitting here. We already trade into a fair value gap down here. So already, this is already enough to take an entry. So I would just go in. Like your entry does not need to be perfect. If the target is going to be all the way down here, it's going to be a big move. It's going to be 150 point move. If you want the 1 to 2, you have a very nice trade idea on your hands. So I would say this would be the first entry idea. Let's see if we can get another entry idea. See if we tap into the fair value gap. No, we don't. So I say you can also take an entry here if you miss that first move. Same trade for 1 to 2. And then price goes to the target. So day 3 of the back test. Friday no trades, Monday no trades, and here first trade, first win, 1 to 2. Why? We waited for the higher time frame. Let's go to the 4-hour. For the higher time frame, the 4-hour bullish fair value gap to be traded into. Now let's go to the next day. Now we're looking at the Wednesday at 7 a.m. EST, so just before the open. This is the 4-hour bullish fair value gap we traded into as a short the previous day, and now we are looking at neutral bias at the 1 hour. To be honest, because we have bearish ideas and bullish ideas. Why do I say that? I see bearish fair value gaps being respected, but I also see now bullish fair value gaps being created. My bias is still from the 4-hour. Remember that the previous day that we were first lower, that was a short, and then go higher. So from that perspective, I have a bullish bias, and let's see if we have a follow through. So if that 1-hour bullish fair value gap that was created in the Asian session, is that going to be respected? And we can see a nice opening move. Let's fast forward to the New York Open, 9:30 a.m. EST. And here we just open at 9:30 a.m. EST. So down here, we already have a liquidity sweep. But again, before the open, we don't like that. Ideally, the model is after the open. There's a 5-minute bullish fair value gap there. But here on the lower time frame, there's where we're going to put our eyes on. We have a short-term liquidity sweep right here. This move at 9:30. Then my eyes are going towards the fair value gap here. So I'm waiting. Do we see price going into that fair value gap? No. Cool. So that idea is off the table. So we wait. Do we now have an idea? I would already say, based on this movement, that we have a little choppy price action. It's just going up and down. So I don't like that. So I'm going to wait. Do we respect the second fair value gap? No, we don't. So here you see a very interesting profile occurring. When, and write this down for your trade plan. When you see bullish and bearish fair value gaps being disrespected, you can expect choppy price action. So what I mean by that, here was already the hint. So when this fair value gap is disrespected and there's a new fair value gap created, this should be a reversal pattern. So aggressive buys, aggressive sells. So that means price goes lower. And then that first fair value gap should become an inversion fair value gap to push price lower. If that second fair value gap, this one, is also not holding, like you see here, you have choppy price action on your hands. So then you wait a little bit longer for a clear model to appear. So now we are approaching 10 a.m. So 10 a.m. game territory, and it's still choppy price action. So here is where you save yourself from an unnecessary loss. Let's go to the 15-minute time frame. This is what I like to do when there's choppy price action. I'm just waiting for a little higher time frame to give some trade ideas. So here at 11, we see movement upwards, and that's nice. So we see the displacement higher here in the 50-minute. I would say it's a very choppy day. So the exact model is not there. We don't have the clear liquidity sweep, clear break of structure. It was already down here, but this price action is just horrendous, and then we're just trading higher. So for me, this is no trade day, but the cool part is, and it's nice for the next day, is we creating in that move we missed, create 1-hour bullish fair value gaps, which we're going to use later. No trade on Wednesday. Let's go to the next day. Now look at the 4 4-hour time frame here on the next day, on Thursday. And in the Asian session, we trade already in the 4-hour bullish fair value gap that was created the day before. In the trade ID we missed here on Wednesday, we already traded into that. It's interesting. We can use the information for the next day. 4-hour bullish fair value gap here and a 4-hour bullish fair value gap here. So with that in mind, we also in this 4-hour bearish fair value gap, I would say for the New York Open, we can try to take shorts towards or here or here. Of course, we even have the Asia low sitting down here. So down the higher time frame, we can use this because the move already happened before the open, the up move. I'm expecting this maybe to happen. So that we don't need to trade all the way down here or down here, but just this move, we can short towards it. If that happens already, we can maybe long from somewhere in this area. At this trade day, I'm just waiting for which move do we make at the open. Do we make the sell move at the open like this towards the fair value gaps, or do we make aggressive sells first and then create the buy structure? I'm just waiting for that at the New York Open. So the buys is neutral. So let's see what the candles will give us. Also here we're looking at the New York Open at 9:30 a.m. EST. This yellow box is that 4-hour bullish fair value gap. That's going to be the most important level of this trade day, because we can use that level as a place to trade to or a place to trade from higher. So the long and short idea is all going to be based on that idea. So ideally at the open, we first trading lower regardless. And I don't care if we get an explosion profile lower and we just miss that short move and then wait for buy structure, or we just gonna take some nice shorts toward that. Let's see what the opening candles give. So here the open is very choppy. Most days I don't trade the first candles after the open because I'm expecting this exact chop to happen. There's bullish fair value gap created here, is inverse, is disrespected, and in that move there's another fair value gap created, balanced price range here, overlapping part between a bullish and bearish fair value gap. Let's see if we can trade back into that. We do. Now let's see, this could be the start of a trade idea. Why? Because we have a liquidity sweep, we have aggressive buys, aggressive sells, and we have a last swing low that made the high. It's right here. This could be the start of the trade idea. Now you might wonder, do I now trade blindly here, stop at the high, target here? No. And the reason why I don't do that has to do with how we delivered into this fair value gap. There's a nuance. We delivered very aggressively. Look at these candles into this level. There's even a bullish fair value gap created right here, there as well. So if that happens, I'm waiting for, again, for a reaction and a close below this fair value gap. If we get that close, then I probably will take a trade that looks like something like this. But for now, we wait. And that has saved you a loss. You see? Cool. So we take the high. I think still that bullish fair value gap can be reached. So let's see if we can get some sells soon. And I want to see this displacement lower, bearish candles lower. It's now 10 a.m. 10 a.m. game activated. And here we get some down movement. But look at this. There's no fair value gaps. And that sucks because their bias could be right, but there's no fair value gaps. And that sucks. So here we have the first fair value gap in this whole entire move. Let's zoom out to the 5-minute time frame. There's also a 5-minute bearish fair value gap here, and we had a 5-minute bearish fair value gap here. This makes me want to go short in this fair value gap from the 5-minute time frame, because here we see the model on the 5-minute time frame, not on the 1 minute. We see liquidity sweep, we see a break of structure with fair value gap 1 and even fair value gap 2 right now here on the 5 minutes. That is enough for me to press the button. I don't like these wicks here. These are rejections, but we still have this 4-hour busy. So that is going to be the move. So let's see if we can find a nice entry down here. I think we can just take this, but the stop loss placement is going to be more difficult. So I'm probably going to short towards the consequent encroachment, the midpoint of this fair value gap, 412 like this. It's going to be a risky trade, but I think this is going to be good based on the 5 minute, not the 1 minute, the 5-minute buy structure. So let's see if this trade survives. And it does. And just after the fast forward, the actual setup becomes. So I think this entry on the 1 minute is not too clean, as it's too risky. But look at what happened after. Fair value gap, no disrespect, and we can just trade lower. All in all, again, bias was the 4-hour busy right here. And we waited for this fair value gap. This would be the best entry, to be honest. I missed that, staring at the 1 minute time frame. But after that, we zoom out a bit and we see this very clean second fair value gap. So the model, liquidity sweep, aggressive sells, aggressive buys, break of structure. And the break of structure here on the 5 minutes is in the same time as the fair value gap right here. And then we trade lower. So another trade, another win. And with this win, let's go to the next day. Here we're looking at the start of the Friday candle, the day after. And we had that massive sell. And we even sold off even more all the way towards here. So we could short even more. We just needed 1 to 2. So we had our money, but we could even get a bigger target. And after the sell-off, we even created a bullish fair value gap on the 4-hour. So let's mark it out right here. Bullish 4-hour fair value gap. That's a nice point of interest for this day. Also, there is a 1-hour bullish fair value gap here. So for this trading day, I'm going to be bullish towards this high and this 4-hour bullish fair value gap and this 1-hour bullish fair value gap. So now let's fast forward to the New York Open. So here we're just before the New York Open at 9:20. And what do we have? We already have a London liquidity sweep. Ideally, we trade lower first and then go higher, but we don't need to. We can just go up in one go. So we could see an explosion profile again as well. So drop to the 1 minute. There is already a small liquidity sweep here. So let's see what we do at 9:30. So the starting point is a liquidity sweep. Let's see if we get that. Right here, we have a bullish fair value gap sitting here. There is a small sweep here, not super nice, but if we trade higher from here, we don't need to trade lower too much here. So if we now close over this down close candle that becomes an order block, we could see a setup coming in. See next candle. Yeah. So there is where we already want to get in. So we have a small liquidity sweep. And the reason why I'm not waiting is because we're already in a 4-hour fair value gap and there is a very clear drawn liquidity. That's the high from the day before. So I would already go in here a little late to the party, stop below this low for 1 to 2. And think you can even, it's almost that high. So I think we should be good there. So the next candle does also a fair value gap created here, fair value gap and a order block. And there, let's see what we get. Yeah, so we tap into the fair value gap here. That's the entry, 938, and then go to the high. So again, clean target. And the signature of the open right here is this one. We have that aggressive sell lower. And here you just wait like this. Rejection 934 is what gave it away, and then you just wait. And it's important, like don't go blindly in this candle because we could go lower here, but you need to wait for the change in character here. Down close candle, if you close over it, it becomes an order block, and we see we tap into the fair value gap right here, 938. That's the official entry. I was a little early to the party, but that's good enough. So again, another trade, another win, and it's the end of the first week of August. So then now go to the second week of August. So now fast forward to the Monday. The TP from the Friday gave a very nice 4-hour bullish fair value gap. So we can use that. So for this day, we have a nice high sitting there. So we have internal range liquidity, a fair value gap on the 4-hour, and we have a high. So we're going to use that as a place to trade from and towards. So let's go to the New York Open. Here with 9:30 a.m. EST, and we have the high here, and we have the fair value gap, and I'm just going to wait until we reach 1 of the 2. So it looks like we're going lower here, bearish fair value gap is not respected. So now there's a bullish fair value gap. So then with this structure, I would say we're first going higher, but none of it happens. So this wants to make me go long into the high right here for 1 to 2, stop below the low, because we have the liquidity sweep, break of structure, fair value gap 1, fair value gap 2, and even fair value gap 3. The only thing that I don't like about this setup is ideally we are bullish on the higher time frame. So ideally higher time frame, we do this. So if that happens, I might just gonna take the loss on this and then short towards the 4-hour bullish fair value gap. But let's see what we do. Go higher. Yeah, and get stopped out. So first loss here. And it's important because this loss hints that we potentially want to go lower. So see if we can find a short entry here. No, there's not. So here, stopped out, and then it goes into profit. So first loss, that's fine, can happen. The model was there, aggressive sells, aggressive buys, but just the 1 to 2 just could not happen on this trade. So that's fine, you take a loss. And now let's fast forward to the next trade day. So the editor, there's going to be a loss, -1 on loss. Fast forward to the next trading day, we see that we traded towards that 4-hour busy after all, but then in the PM session, so it's just unlucky, you take a loss and that's fine. So now we have the same bias. We live the same bias, still in that 4-hour bullish fair value gap, and we just expect it from internal to external. So we have 2 highs sitting now right there. So this is going to be the target for this trade session. So now let's go to the New York Open. And looking at the news, I think Tuesday, this is probably CPI. So we have CPI here. So just before the open all happening. So the drawn liquidity is already being met before the New York Open. So now we are around the New York Open. So the whole move, let's go to 1 hour. The entire move has already happened here. Let's see what we do at the New York Open. Because we take out the highs here and now we start displacing lower. If we do that, we take out extra liquidity and we have such an aggressive move. My eyes are immediately going towards equal lows down here. There's the London low and the PM low. So let's see if we can find an entry towards that. And no, we don't get any short idea here because we don't follow through from the bearish fair value gap here. So there's no entry. Also, these lows are still intact. So weird price action here. So no trade on Tuesday. Let's go to the next day. Here on Wednesday, we see that we moved up like crazy. And in that move, we created bullish fair value gaps again on the 4-hour time frame. So there's where our eyes are going. Draws on liquidity lower. And yes, we are bullish higher time frame. But I think we can make this exact move. So that means at the New York Open, I'll be looking for shorts. And then if that happens quickly, I'll be looking for longs after back higher. Fast forward at the New York Open, we have this 4-hour bullish fair value gap. We have Asia low sitting here, London low sitting right here. So there are failure swings. These lows are nice to target, but it doesn't look very bearish yet to me. So let's see if we can get some nice price action to the downside at the New York Open. 930 right now. So we go higher. So no any short idea yet. We need to see down close candles. Nothing here. And here we have something. Here we start moving lower. This is a very nice candle. So zooming out here, we have accumulation, manipulation, and potentially distribution lower. Let's say low hanging fruit target would be here. It's London low, session liquidity. So now what I see is break of structure here, quit sweep, break of structure. We need to be even more precise here because this is the high and this is the last swing low that made the high. Have a small sweep up there. So then if you move away from here, close below it, yeah, so here's the entry. Here I would take a short towards the London low, 412, like this. And it hits TP. So the target was lower. Based on the higher time frame, I think we can even go lower here. The 4-hour bullish fair value gap. This is just low hanging fruit. So this is London low. We have Asia low, 2 4-hour bullish fair value gaps sitting here. And there was nice sell structure. And see that we don't call any tops here. We just wait. We just wait for price to show its hand. And this candle at 9.55 was the hint. Then we wait for reaction from here. And there we get in. Official entry could be here in this fair value gap, together with the bearish order block that's created because we have the fair value gap here. This is an up close candle that trades into another fair value gap, making the up close candle a very nice bearish order block, and then we trade lower. Cool. Let's go to the next day, to Thursday. At the start of Thursday, we still have that 4-hour bullish fair value gap open. Also 4-hour bearish fair value gap sitting here. So we might have a bearish bias here. And the higher time frame idea is still exactly the same. From here to there. So there's where we're going to trade towards. We have this short-term high. So intraday at the 1 minute, these are the liquidity pools. So we have the 4-hour busy, and I would say the Asia high from Wednesday. Now let's go to the New York Open. And here before the open, we have another news event, probably CPI, PPI, a big one, big wick here at 8:30. It's a news wick. After we take out the high here, it's already taken. So from here, this is the starting point of the trade idea already before the open. I'm not going to trade before the open, but we already trade into the 4-hour bullish fair value gap. So the long idea could start here. Let's go to the 1 minute and let's see if we can find a setup here long after the New York Open. So here we look at the New York Open. We already had that news wick, so we don't need to trade lower here. This low could already be the low. So based on that, we have a 1 minute fair value gap here. And we're going to open right now. So we trade into that. And this is a nice reaction. So this is what you want to see for the trade idea. And we can just trade back towards the pre-CPI high. And here's the nuance, because you might think like, yeah, fun, this long idea, but look at that massive displacement. Is it not going to be showing us that we go lower from here? But keep in mind that is there on the 4-hour, we had that massive 4-hour bullish fair value gap, that's yellow box here. And we're just going to trade higher from there. That's the higher time frame bias. So then on the lower time from here at the New York Open, I'm just going to look for longs. If this trade idea fails and we're going lower, I'm probably going to take this, like a similar setup, but then lower. So I'm going to shoot 2 bullets. But for now, I'm looking at this and it looks nice. Let's see what the next candle does. Yeah, so this is enough for me to press the button. There's another fair value gap. Let's say I'm late to the party. I'm going to put my entry here. So it's a late entry. So stop below the recent low for 1 to 2. Another super nice trade. Let's see where our TP is now. It's not it's been in a random place here. So not the cleanest trade, but you cannot have the cleanest trade. So I want to make it as real as possible. Let's say you just missed this move. Let's see. And even when it's not very clean, it still got TP. We tap into this fair value gap here at 1 point, and then we go to TP. So another day, another win. And make sure at this day, again, the same signature in price happened. We had that fair value gap here at 9:30, and don't go blindly into that, because that could fail. Like when I was trading this live, I was actually expecting this to happen, that we maybe sweep the low, but you don't, like the price doesn't care about your expectations. Like it just prints the candles. And if you want to go higher, cool, follow the buy structure. And I didn't go in right here. that will be more risky. I'm just waiting. Okay, let the candle show me its hand, and it did right here at 9:35 already. And then we just hold into profits. Cool. So with that TP, let's go to the next trading day, to Friday. Because here on this Friday, on the 4-hour time frame, we are in a weird scenario. Look at this. We are in a consolidation here on the 4-hour, making the higher time frame neutral, meaning lower probability. And lower probability means that the lower time frame is probably not going to be as clean as we want. So I'm not going to be very aggressive here. But what do we have? Most recent high, most recent low, and we are still inside that fair value gap. Let's go to the 1 hour to see if we can find more. Yeah, also here, still trapped here, bearish fair value gap, bullish fair value gap. So it doesn't look like a very nice day to trade, but still, let's see if we can find an entry. Also, the bias is neutral, so we're going to flying blind here. Let's see if we can find the model at 9:30. So here at 9:30, we sell off. So this could be a manipulation lower. The higher time frame is still bullish, but it's consolidating, so it's not very clean. Let's see if we can create buy structure from here. Doesn't look like it. We are now approaching the yesterday's low. That's the big news event low. And let's see if we tap into that, if we create buy structure. That'll be something I'll be interested in. So we have the last swing high that made the low. That's right here. It's now violated. So there's a market structure shift, liquidity sweep. We sweep the previous day low. And now we start trading higher. This is interesting, right? So this fair value gap is definitely respected. Also a fair value gap right here. So for the 2 PD array rule, you are good as well. This is already good for me to take a trade. Stop below the low here. So let's say I take it here. Stop below the low for a 1 to 2. See if we can get the trade. And a big fat stop loss. So cool, right? The reason why this loss is so cool, and like, Dion, do you like losing money? No, I don't. But remember what I said in the 4-hour, at the start of this trading day. The 4-hour is consolidating. That means on the lower time frame, you're most likely will not see your setup being followed through. And the setup came, right? We have the rules. Like we have the previous day low sweep, that is the red line. We have the break of structure for value gap 1. Then we just displace higher, but no follow through whatsoever. That is because the higher time frame is not good. So this is a nice loss. In a real-time environment on these days, I will sit in my hands. But I want to show you this for the example. Just shoot the model when it's there. But for new ones, higher time frame consolidation makes the lower time frame just harder to trade, and you will just take more losses. And the rest of the session, there is nothing. So end of this trade week. Let's go to the next week. Cool. So here on this Monday, we open on Sunday very bearish. So that means we probably want to go lower a little bit more on Monday as well. We have also a relative equal high sitting up here. So that's going to be the point interest. Let's see on the 1 hour if you can find something nice. Yeah, there's a 1 hour bearish value gap that it could be used for short ideas. So we have the Friday low, we have the Sunday low. Let's see if we get that right here. But all in all, again, low probability price action. Look at the candles here on the 1 hour. So it's not very nice on the lower time frame. So this is where you should be very aware that you could take more losses. Let's fast forward to the New York Open. And here at 9:30, we're just waiting for the first PD rate that's been hit. Is it the 1 hour bearish value gap, or is it going to be the Friday low? And it's going to be the 1 hour bearish value gap. So now all our eyes go to the lows here, and the red line is the Friday low. So do we get nice sell structure? Yes, we do, but there's no clear fair value gap. I don't like that. There's one here. So I'm going to wait for price to come back here and give a trade. So let's see, do we react from here? That's the most important part. If we react from here, I'm going to short towards the low. If it doesn't, I'm going to wait. And here it looks like we do not get an entry. So I'm waiting. The fair value is not respected. And all of a sudden we start trading towards the low here. And I'm like, shit, I missed the move. So I'm not in this move. I was not in this move when this was printed at August 18. I was just like, oh, well, we are going towards that Friday low right here. That's the drawn liquidity now. So just sit there in pain, just waiting for price to go to the target without you, not chasing it. But what happened here? We create buy structure all of a sudden. There's a sells, aggressive buys. There's a bullish fair value gap now. What now? It's 10 a.m. Here is where it gets interesting because we created another low here. So the liquidity pool just became bigger. Early buyers are now into the market. How nice would it to take them out? So I think the drawn liquidity is still there. And we're now at the 1 hour fair value gap still. It would be nice if this would be a sell structure. This is what I was calling on my live stream as well, like this. So now if we see this is where I want to take my entry towards the lows here for 1 to 2. This will be the trade idea because the lows are still intact. The drawn liquidity is still there. And I cannot get tapped in. That sucks, right? No tap, no tap. And a execution mistake right here would be this one. There was another fair value gap I didn't see. So ideally, your trade would be here. Your stop was a little lower. But then my stop loss would be in a very random place, right? It would be in the middle of this fair value gap. All in all, I would say I would have missed this trade. So no entry, no win, just a missed trade. But it's still nice that we have a clear drawn liquidity. We miss a move and we just wait, sit on our hands. Okay, cool. This would be then the move. And then we take it and miss it, and that's fine. Let's go to Tuesday, New York Open. Here at Tuesday, we are close to the London session and we are traded back into the 4-hour bearish fair value gap here. And we have now the low sitting down there. So with this price action, it's still pretty weird price action, but this is still bearish because we react from a bearish fair value gap. We're expecting bearish arrays. So my drawn liquidity is going to be the Monday low for this day. Let's fast forward to the New York Open. So here we're now at the New York Open. Here on the left, we see the Monday trade that we missed. We are still in that weird consolidation, but we moved away from this 4-hour bearish fair value gap, meaning my bias is bearish. We already had a London move down here, and now my eyes are going, do we respect this 15-minute bearish fair value gap? I think we can see sells coming in. I'm bearish on this day. See on the 5 minutes, also bearish fair value gap. So now on the 1 minute, I'm just going to wait for sells at the New York Open. Let's see if we can get an entry somewhere. And it's pretty nice. This is an explosion profile. Explosion profile. So we have a liquidity sweep here. It's nice little wick, changing character here. Wow. And now we trade lower. Cool. Very important here. FOMO protocol. If you see this happening on a chart, you're like, I missed the move. What I do then is zooming out. So from there, I go to the 5 or the 15-minute time frame to see, is there an entry? So what that means is now at 9:45, there is a potential fair value gap created here. So at 10 a.m., this is part of the 10 a.m. game, I'm just going to look for a continuation short like this on the 1 minute. Very simple idea, right? Price goes lower, monkey sees lower, monkey trades lower. That's going to be this trade. So I'm just going to wait until 10 a.m. at the 10 a.m. game to see, do we trade into that and then start trading lower? So that's going to be right now at 10 a.m. So let's see if you can get an entry. Do we get a tap here? So this is a pretty clear tap. How we deliver here is not very nice, in my opinion. I'm not the person who shorts this massive green candle. So I'm going to wait. And I want to see, do we create a bullish fair value gap here? If we don't create that, I'm going to take shorts with my stop loss above the recent high. Next candle. Let's see if we trade into it. We do. So there's no short idea here. Maybe even a long idea. But for that, this is a very important nuance. Remember what I said about if the 1 minute looks nice, but the higher time frame looks not nice, we have a problem because the higher time frame shows sells. Sells from the 4-hour SIBI, from these 50-minute SIBIs, like this on the 1 minute. Very simple idea, right? Price goes lower, monkey sees lower, monkey trades lower. That's going to be this trade. So I'm just going to wait until 10 a.m. at the 10 a.m. game to see, do we trade into that and then start trading lower? So that's going to be right now at 10 a.m. So let's see if you can get an entry. Do we get a tap here? So this is a pretty clear tap. How we deliver here is not very nice, in my opinion. I'm not the person who shorts this massive green candle. So I'm going to wait. And I want to see, do we create a bullish fair value gap here? If we don't create that, I'm going to take shorts with my stop loss above the recent high. Next candle. Let's see if we trade into it. We do. So there's no short idea here. Maybe even a long idea. But for that, this is a very important nuance. Remember what I said about if the 1 minute looks nice, but the higher time frame looks not nice, we have a problem because the higher time frame shows sells. Sells from the 4-hour SIBI, from these 50-minute SIBIs. Okay, my camera just died, so let me finish this analysis. Here's when we're going to wait for price to close over this 50-minute bearish fair value gap. So if we are closing above here, above this area, there is where I'm going to look for long entries. But for now, a higher time frame, I'm still bearish. So I'm looking for sells. And here we see that. So when I see this failing, I want to take my entry already in the inversion fair value gap. So then my entry would be at the inversion fair value gap, stop above the high for 1 to 2. And that's all based, like here on the 1 minute is like, oh yeah, it's a inversion fair value gap, a random one. No. Because we are trading, remember on the 15 minute, from the value gap back to the lows, that's what we're going to do right now. And on the 1 minute, we just look for a confirmation for that. And that's going to be right now. And there you go, clean take profit. If you want to have a fair value gap entry, there was also an entry right here, but all in all, clear take profit here on Tuesday. This is only 2 weeks of backtesting, and you got all my insights of when I take a trade and when I don't take a trade. And as you can see, backtesting takes time and it's pretty boring. But the cool part is, once you do this a couple times, you will train your eyes to see your entry model in real time before the candles have printed. If you want a part 2 where I go over the rest of the month and share more insights and frameworks on this model, make sure you comment part 2 below and I'll release it very soon. And now the question is, are you going to do this yourself, or are you going to now click away and watch the next 90% win rate entry model video and keep being stuck in that unprofitable loop? I trade a setup live every day with my students inside my Discord, where I share daily trade ideas and a ton of free frameworks. I'll leave a link to the Discord inside the description. Don't forget to hit the subscribe button. Thanks for watching, and I'll see you in the next one.
In this video, I will walk you through my proven open, high, low, close model. And you can use this model to master your daily bias and be on the right side of the market all the time. You can use this to get funded, profitable, payouts, all that stuff. And I use this exact model to gain over $1 million in funding and over $100,000 in profits. No time to waste, let's get into it. The open, high, low, close model is all around one single candle, because a bullish candle on the left side has a open, a low, a high, and a close. Just like a bearish candle has an open, a high, a low, and a close. And by anticipating the next candle to be a bullish or bearish candle, you can play the open, high, low, close model. And the goal is to trade the distribution phase, the body of the candle. So for example, here we have a open of the candle, we have accumulation, then we manipulate trading lower into a key level, making the low of the candle, and then we displace upwards, starting the distribution of the candle. If you know the classic AMD, this is exactly this. Same for a bearish candle. You have an open, accumulation, we manipulate, creating the high of the candle, and then we distribute lower, creating the low of the candle. And the key here is to wait for manipulation into a key level. And what's a key level? For a bullish candle, it's in the discount array. That means old low, bullish value gap, bullish order block, bullish breaker. Vice versa for shorts. A bearish candle, you wait for a premium level. That's an old high, or a bearish value gap, bearish order block. You get the point. When price hits that key level, you wait for market structure shift, the last swing high that made the low, or the last swing low that made the high. And bonus points if in this key level there's an SMT created, aggressive sells, aggressive buys, smart mode reversal. If you're not sure what that is, I have dedicated videos to market maker models and to key levels here on the channel. And now the main question, how do you use this? You can use this for a weekly candle, a daily candle, and a 4-hour candle. And for a weekly candle, this candle is just 1 week. And that means if you have a weekly candle and you expect the next week to be a bullish week, you wait for Monday and Tuesday to be accumulating or manipulating. So on Monday or Tuesday, low of the week. You wait for the market structure shift to then trade the rest of the week into the distribution phase. Same for bearish, Monday and or Tuesday, sometimes also Wednesday. Most of the time it's Monday or Tuesday, accumulation, manipulation, and then we start distributing. Meaning that Monday in general is not the highest probability trading day of the week, because you are accumulating or manipulating. And you do exactly the same when you predict the next daily candle. If you expect a daily candle to be bullish, you play a classic Judas swing. That means the Asian session is the accumulation, the London session or the New York session is the manipulation, and then we start distributing. Same for shorts, Asia, London, New York, classic Judas swing. And you can even drop to the 4-hour to play exactly the same. And this is what I do on the indices, on NASDAQ and ES. You can play the 4-hour candle, because at 10 a.m. during the New York Open, there's a new 4-hour candle created. And if you anticipate the next candle to be bullish or bearish, you can play the first 30 minutes to an hour to be the accumulation or the manipulation, and then start the distribution as a scalping model. And we'll go over weekly, daily, and 4-hour examples later in this video. But first, let's answer some other questions. And the first question is how to determine key levels. So what you need to do every single week at the start of the week, you mark out the recent key levels on the daily, weekly, and monthly. And I do this as part of my weekly outlook, and I really recommend you do the same every Monday or every Sunday. Go to the higher time frame and all the pairs you like to trade. On the right side, I have my whole list. I go through all these pairs, going to the daily, weekly, monthly to see which one looks nice. And make it easy. Only focus on recent highs and lows and for value gaps. I do this every single week as part of my outlook. I go over all the forex pairs and do exactly this: daily, weekly, monthly, old highs and lows, and for value gaps. Because when you know where the key levels are in the higher time frame, then is where you can drop to the lower time frame to insert your favorite entry models, like this open, high, low, close model. So here on the dollar, I'm currently slightly bearish, but overall pretty neutral, because on the monthly we're rejecting, on the weekly and daily we're pretty bearish. So I would lean towards bearish, but in general, I'm not going to be engaging very aggressively into the dollar pairs right now. I want to see more displacement to the downside before I'm going to engage in shorts here. And let's pick another example. Here at Euro NTD, we are currently at the monthly time frame. And what you see is that we swept a monthly level, that is the 2020 high, and also we have a monthly bullish fair value gap sitting right there. Cool. So on the monthly, old high and fair value gap marked out. Cool. Let's drop to the weekly. Here on the weekly, on the bearish side, there's no fair value gaps. I see a bullish fair value gap there. Of course, it's the same high that's been taken also on the weekly. Here we have an overlapping weekly and monthly fair value gap right there. Cool. So that's marked out. Let's drop to the daily. The daily, we have some bearish fair value gaps here. We've been tagged, but there's no follow through. It just starts consolidating. So because of that, I'm going to be neutral. I'm going to be neutral, slightly bearish towards that monthly bullish fair value gap, but we already traded into a weekly fair value gap. So there's a trade-off here between bearish and bullish. I'm neutral because we already swept external range liquidity. We already traded into internal range liquidity on a weekly. So then I'm not going to drop to the lower time frame to find my open, high, low, close model. When I would engage is when we, for example, now trading lower, sweeping these daily lows into that monthly fair value gap, and then we break structure. There is where I'm 100% going to engage back to this high. But for now, I'm neutral, so it's not on the list. And you go through this whole list doing exactly this to mark out the key levels. And now we know how to identify the key levels, and make sure you do this as part of your weekly outlook. You know that the goal is to trade distribution phase of the candle. You know, you need to wait for manipulation to key level, for market structure shift, and ideally with SMT. Let's now answer the most important question of this video: how to anticipate if something is going to be a bullish or a bearish candle. And for that, we need to tap on the topic of liquidity. And I have a dedicated video to draw on liquidity here on this YouTube channel, but let's do a quick recap. The biggest mistakes traders make is that they trade in a consolidation. So if on a daily, weekly, or monthly, we are consolidating, it is not a good idea to drop to the lower time frame. And the single reason for this is that your PD arrays are not going to be followed through as clean as they would if there was a trending condition. So if you're not sure what consolidation is, this consolidation and this is trending, and you want trending conditions. So you want trending conditions, and you can use fair value gaps and old highs or lows. You can use fair value gaps as a place to trade from. So price steps to the fair value gap, and you use that too long. So once we are bullish, every time price trades back into a bullish fair value gap, there is where I'm going to use my open, low, high, close model, because we're trending and I'm anticipating a bullish candle. Same for if we're bearish. Every time we are here, I'm going to look for a bearish open, high, low, close, trading from an old high or fair value gap back into the range, or just following the continuation. Because price only does two things. It trades to internal range liquidity, imbalances for value gaps, or it trades to external range liquidity, old highs and lows. And remember, when identifying key levels, all we did was going through daily, weekly, monthly, and mark out all highs and lows, external range liquidity, and for value gaps, internal range liquidity. And you use time frame alignment for your actual execution. So if you have a daily or weekly array, you can use 1 hour structures, more for the swing traders. If you're 4 hour array, you can use 50-minute entries. And if you're 1 hour array, you can even go to the 1 and 5 minutes. But more on that in the examples we're gonna discuss later in this video. Bonus points is follow displacement in order flow. When bullish, go long. When bearish, go short. So if you are trending on a higher time frame, try not to short that. Try to just wait for the retracements. Same for bearish. Wait for the retracements and go short. In a trending move, the opposing arrays should fail. So if we are bullish and we just had sell side of the curve, buy side of the curve, we just tried to do a key level. What you want to see is that your discount arrays, your bullish fair value gap, bullish order book, bullish breakers are holding, while the premium arrays, the bearish arrays, are failing. That's what you want to see. So especially here on the smart money reversal, here's where you want to see the premium arrays failing and discount arrays holding, because that's indicating that you probably have a reversal on your hands. Pair this with SMT and you should be golden. So once price taps into a fair value gap or an old low here on, I'm anticipating a potential reversal or at least a reaction to take a long from. And not only can you use this to catch here at bottom here to expect a reversal from the bottom, what you also can do, use the next candle as your open, high, low, close. So let's say this candle trades into an old high and it rejects. You can use the next candle to be anticipating that it's going to be a bearish candle back into a fair value gap. Cool, now let's dive into some examples to see this on the chart, starting with a weekly open, high, low, close. Here in this first example, we're looking at the open, high, low, close model on the weekly time frame. So that means on a weekly candle, if you expect a bullish candle, you want an open, low, high, close. And ideally on Monday or Tuesday, we made the manipulation move, set a low of the week in a key level, and then trade higher. So here we're looking at this Euro-US-dollar daily chart, and look at how bullish we are. So that means we want to continue bullish. We want to play an internal range liquidity to external range liquidity. And here on Friday, we set this high, and then on Monday, we have a doji candle. So that's overlapping with the accumulation. So on Tuesday or Wednesday, we want price to trade into this value gap or this value gap to then trade to the high. So knowing this, let's drop to the lower time frame to see if we can find an entry around this exact bias. So we want Tuesday or Wednesday to set a low of the week inside these key levels. Now let's take a look at the 1 hour. Same price action then on the 1 hour, and let's see what price gives us. So here we are at Monday, Asia. Let's drop into London. And here during Tuesday in New York session, we drop into that first day for value gap. And we don't need to catch bottoms. We need to wait for price to give us the indication that we want to go long. And that means aggressive sells, aggressive buys, and potential smart money reversal. Want to see displacement. And here we get that. So here we have the order block, a breaker here. We have a value gap that could be a breakaway gap right there. We have an order block right here, the series of down close candles that trade to the highs. And we're doing this on the 1 hour right now. You can also drop to the 5 minute to find a smaller entry, to find a more specific entry down here. But we're just doing this on the 1 hour. We just need to know our buys based on the open, low, high, close. Because this on Tuesday, sweeping Monday low, could be a low of the week inside the key level to trade towards these highs. Awesome. That is your bias from a weekly open, high, low, close model. So let's say you take your trade already here on the order block and breaker. You have your TP at the highs and you have your stop loss for 1 to 2 here below the lows. And let's see what price gives us. So we consolidate. This is the Asian session in London on Wednesday. So it's choppy Wednesday here. So for the whole week we're consolidating. So this is not a very nice trade, but hey, you are in. And sometimes you just don't know if you can get choppy price action. You just know your model. You know, okay, this could be a potential low of the week. Let's see if we can trade to the highs. If that's not the case, yeah, you just are in choppy price action. That's part of it. And eventually price trades to the highs. So with choppy delivery, we still caught the low of the week. Why? Based on a daily internal to external higher time frame. And around that, we play a weekly open, high, low, close. So looking back here, we have a Monday consolidation, Tuesday manipulation, and the distribution starts the rest of the week. And the cool part is here, you know how the 1 hour was so choppy. Look at how clean this daily looks. That's the power of this. So just knowing your higher time frame bias will get you the money in these kind of scenarios. Let's now take a look at a open, high, low, close model on the daily. Now we're looking at gold on the daily time frame. And there's a cool indicator. It's called Power of 3. You can see it on the top left corner here. And it will give you the current candle here on the daily. So if you double click it, you can even go to another time frame because we're doing this on the daily. You can see here how the daily currently looks like. And what do we see? We see price trading lower, but we have a very bullish move here on gold. So I would say this is a retracement. So I want to steal long and we're coming into this kind of the range, OT, optimal trade entry. And we are trading in a daily bullish fair value gap. And we also here have a order block, these series of down close candles. Let's mark out the start, the body here. So in this area, I'm expecting price to make a low. And then you know, okay, the open, high, low, close model, we're looking for a bullish candle after we hit this area. So we already hit this here. So then what we want to see is on the daily, Asia, London lower into the key level. That could be somewhere here. And then start to distribute towards the highs. Open, low, high, close on the daily. So let's drop to the lower time frame, let's say to the 5 minute, to see how we can frame a bias around this. Now look at gold at the 5 minute chart at the start of the London session here at 1. Let's go a little further to 2. And here we are in that area of the daily fair value gap and daily order block. From this point, you can expect some form of reaction. What we want to see is price opens, manipulates lower, and we just wait for that displacement higher, breaking structure, leaving fair value gaps. Nothing complicated here. So see what price gives us. Here we have something. Aggressive sells, aggressive buys. We break structure right here. We are in a key level. Why is it a key level? This is an overlapping daily bullish value gap, bullish order block. So you can already take your entry here at the start of the order block right there. Let's see if price even wants to test a discount array right here. So here we are in overlapping value gap and order block. See what price gives us here. It goes to the bottom value gap here. So in this area, you could take your entry. Most of the time, I take my entry just here, right here already. So I was in drawdown, stop below the low, target 1 to 2. So let's say these highs, open, low, high, close. I think you can even go to these failure swings. If you've seen my liquidity video, this is all low resistance liquidity, failure swings. So you can even make a monster trade out of this. This is exactly a trade I took myself. You can see the execution on my Twitter and on in the school group. But let's say low hanging fruit right there, open, low. And now we're going to see if we can get the distribution. We're still in London session, target Asia higher. And there you go. All using open, high, low, close in a key level. So zooming out, remember what we want to see? We want to see price trading into this area down the lower time frame on the daily open, high, low, close. So Asia accumulation, London manipulation into a key level. What we saw the manipulation, we saw a low being formed, aggressive sells, aggressive buys, and we took the entry accordingly. It's all based on the open, high, low, close coming into a key level right here, overlapping daily order block and value gap. And as you can see, the daily candle printed like this: open, low, high, close. And I would do exactly the same on the 4-hour time frame. And it's one of my scalping models, and we do exactly the same, but then with a 4-hour open, high, low, close. So right here, we are really bullish here on ES, and we have an overlapping 4-hour fair value gap and order block. So what it means, on the 4-hour, the next 4-hour candle, I want to see an open, I want to see a low into a key level. That can be somewhere here, ideally in the bullish order block, but we can already trade the fair value gap, then break structure and go to the upside. So exactly the same. Let's drop to the 1 minute, to the lower time frame, and you can do the same on the 5 minute. Do whatever your preferred entry model is, because the execution on the 1 and the 5 minutes won't make a huge difference in your long-term win rate. So you can use both the 1 and the 5 minutes for this one. Same as you can use the 5 minute, the 1 minute for the daily open, high, low, close as well. The open, high, low, close model is based around creating a bias, a high probability bias. So the execution around that bias can be on the 1, the 5, the 50 minute, on the 2, 3, 4 minute, doesn't really matter. We're now looking at the same price action on ES at the end of the London session. We're approaching 4 a.m. and let's see if we create some structure. So what we want to see is aggressive sells, aggressive buys. We want to see a low created. So here we have some accumulation here, consolidation. I want to see aggressive sells, aggressive buys. Where do we get that? We tap the order block right now. Could be something. And this looks like we want to create a low. Why? We take some in this key level, overlapping 4-hour value order block. We sweep some short-term liquidity, and then we start breaking upwards. So from this point, let's see if the rates are holding. See a bullish value gap right here. Let's see if we can trade back into it or we just leave. It doesn't look like we want to trade back into this. Why? Because there's an order block sitting right here. We tap that here and we get another fair value gap. So then what I want to do is, based on this open, high, low, close, we can already take an entry right there. But the key is at the new 4-hour candle. On the indices, a new 4-hour candle is created on the 2 a.m., 6 a.m., and 10 a.m. So here we are starting with a new 6 a.m. candle to create an open, low, high, close. Because based on this move, I'm expecting this to be the low of the day. So I want this low to be protected. So my stop loss can be below this low to be protected, so we should be good. But an open, a low, and a high and a close on 4-hour. So we are now creating a low. Look at how the candle is forming. This is the current 4-hour candle. An open, low, high, close. I want to see the next fair value gap coming up. We are accumulating. We're chilling. And there we go. So there is some price action. Let's see how the 4-hour candle is printed. And I think you could already take your trade right here. Stop below the low. 412. This will be the first entry. Let's see if we can get another entry. So based on this, there is some accumulation. And there's not many fair value gaps. So I don't like this too much to trade. So I'm going to be later. I'm going to wait until I see some fair value gaps. This is displacement. So here at 6:30, here is where I would take my second entry right there. And what do we have as a target? Remember the liquidity video about all the failure swings? There we go. Low hanging fruit failure swings, I would say relative equal highs. So here we have a series of relative equal highs. It's all pretty nice. And look at time here. This is all Asia high. So I would say you can take this as a target, this Asia high. So you target session liquidity. It's pretty fine. So right here and right here. For the stop loss placement for this candle, I want to put my stop loss below the start of the 4-hour candle. For 1 to 2, let's put a little upwards for 1 to 2. Ideally below the low, but let's just do it like this. Let's see what price case says. So come back into drawdown. And we're approaching New York session right now. So we're almost stopped out here. So a little lucky here. That's why I need to have a good stop loss placement, ideally below these lows. And here we have another structure, so you can take another entry in the New York session right here. Stop below this low. And we are now approaching the New York open, 9:30. And at the start of the new 4-hour candle, look at 10 a.m., new 4-hour candle, we hit the TP point on both of the trades, exactly at 10:01. And this is more of a scalping model. Maybe less exciting because we were watching so many candles print and you need to wait for a while, but you could take an entry here, here, and here during the open, all based on a 4-hour open, high, low, close. And look again how this looks at the 4-hour. Look at that, how beautiful this candle prints. Let's remove the markers. Look at how we anticipated the low of the day right here in the overlapping order block and value gap, and the next candle prints higher. Based on this price action, I would say the 10 a.m. candle is also a bullish one. Why? Low of the day, 4-hour internal to external. Look at all the failure swings up here. So I would target the highs here. And let's see, boom. 10 a.m. candle goes to the highs. Makes sense, right? Failure swings. 4-hour internal to external. And here you have it, the open, high, low, close model. This is the exact entry model I use almost every single day to have a rock solid daily bias. And now you can use it to get funded, get payouts, get profitable. I created a free training where I break down how to get profitable and how to get to 100K and more in funding. I'll leave the link to that video in the description, so make sure to check it out right now. Thanks for watching. If you liked it, consider liking and subscribing, and I'll see you in the next one.
All right, guys, look at this. I just turned a tiny $500 account into over $8,000 in exactly 30 days. And because I finished on the top of a leaderboard of a trade competition, I won another $8,000. There's a total profit of $16,000, starting with only 500. That is a 3,200% return. Crazy, right? Now, I'm gonna be honest. I didn't do this by acting like a gambler. I didn't full port, I didn't hope and pray, and I didn't trade 50 times per day. I did this by using one single entry model and ignoring 90% of the market. And in this video, I'm gonna show you exactly how I did it. So you can just copy the frameworks. We're going to speedrun this. 3 steps. First, we're going over the one model I used. Second, the risk glitch. How I survived when everyone else just started blowing their accounts. And third, the math you need to scale a small account into large numbers, which you can use on prop firms and personal accounts. Cool, let's go. Most people treat prop firm accounts and these competitions like a lottery ticket. They let their monkey brain take over. They leverage to the max, chase every candle, and eventually just get wrecked. That's why 80% of the competition was already out by day 5. They wanted the excitement, but they got the liquidation. I didn't do that. I treated this like a casino business. I acted as the house. I realized to win this, I didn't need to be a genius. I just needed to be the only guy in the room who wasn't emotional unstable. Because here's a secret. Complexity is your enemy. And when you have only $500 to start with, you feel the urge to catch every move. That's a trap. Don't do it. To flip this account from $500 to $8,000, I stripped everything down. One entry model. And I told myself, if the setup comes, I'm going to shoot my bullet. If it's not coming, I'm sitting on my hands and just do something else with my day. Let's look at the chart. This is the model. It's part of my market maker blueprint, and it's so simple. Every beginner can do this. I look at 3 things. I look at the higher time frame bucket, the ITF bucket, and the lower time frame bucket. Higher time bucket is daily, weekly, monthly. ITF is 1 and 4 hour, stands for intermediate term time frame, and a lower time frame bucket is 1, 5, and 15. Here is your higher time frame bias. This is your lower time frame structure. Here is your execution. On the higher time frame, I'm looking for price to come back into internal range liquidity. Internal range liquidity is value gaps and order blocks. External range liquidity are all highs and lows. So I'm just waiting on, for example, the daily, go from internal to external. That is it. That's my bias. If I see that on the higher time frame, then I drop to the 1 and 4 hour to look for market maker models inside higher time frame in terms of external bias. And what I mean by that is, if you know what a market maker model is, it starts with an original consolidation, then trades lower and lower and lower into a key level. That is this key level on the higher time frame. But now we're looking at a 1 or 4 hour structure. And all I then want to see is this. This is a smart money reversal. Make it easy, no fancy names. It is an aggressive sells into that fair value gap or that order block, and then aggressive buys back into the range. A break of structure is when this last high that made this low is being violated by this move. And we do this on the 1 and the 4 hour. And once we have that, once we break that structure, it will leave behind clues like inversion fair value gaps or order blocks or breakers. And inside those on the 1 and 4 hour, there is then when we drop to the lower time frame on the 1, 5, and 15 minutes to look for the structure. So from here, we can just go to the lower time frame to see, do we see the aggressive sells, aggressive buys on the 1 and 5 minutes, leaving order blocks, fair value gaps, breakers, and then take your entry right here. That is it. And I've dedicated videos to internal to external, liquidity, market maker models, and also lower time frame execution models like the 10 AM game here on this channel. I'm not going to waste your time and break them down step by step. I will also link those videos inside the description. This is the first big trade of the trade competition, where I only used a small percentage of my initial balance to get a huge head start, a huge profit on the account that I can later use to compound with a 5 risk to reward. How? Let's look at the buckets. First, daily bullish fair value gap from internal to external. The initial drawn liquidity is right here. So the initial take profit point was here. The reason why I held had to do with the economic data that was coming out. Because at this point in time, there were talks about multiple rate cuts, quantitative easing. That means the money printer is going up. And if you know what it means from a fundamental perspective, you know that an asset like silver or gold or stock markets with the money printer or with quantitative easing will run like crazy. So I was expecting a big expansion here on silver. So that's the reason why I did not close here, but held it until a 1 to 5. The reason why I closed at a 1 to 5 was because I wanted to use that money from the profits to recompound into new positions, the ones that we're going to discuss after this. From the daily internal, let's drop to the ITF to 1 and 4 hour. And here is where the entry is taken. And what do you see here on the 1 hour? Aggressive sells, aggressive buys, leaving a 1 hour fair value gap here. So this is already the first hint that we want to go higher. And once I saw this candle being printed and we rejected from this first fair value gap, right here is where I took the entry. And then in hindsight, you see another fair value gap, you see another order block being created. And if you go back to the buckets from the ITF, this is exactly what you should look for. Let me show you. This is what we saw on silver right here. And inside this price action, you can even drop like to the 1 and 5 minute to find a similar entry. So what I see here in the lower time frame, fair value gaps, just follow fair value gaps and displacement. Fair value gaps, one here, with order block sitting right here, big massive order block that's being respected, and then we trade higher. So here on the 5 minute, you could also find your entries. I took this from the 1 hour and I didn't even use the 5 minute because the bias and the drawn liquidity was so clear on the HTF and the ITF. The lower time frame is not necessary. And I know majority of you watching is an intraday trader, but sometimes you don't even need the lower time frame. You can just enter with your stop loss in a good place and you should be fine. So from the internal to external on the daily, then it started running and basically traded the low of the whole session here on Friday and just expanded like crazy, like just up only, and it hit TP right there within a few hours actually. Like this trade was taken on Friday and TP was here on Monday already. So this one gave a nice $1,700 profit. This trade was the basis of the success of the trade competition. Without a big win at the start at these kind of competitions, especially when you want to compound very fast, you need a bigger win at the start like this. So you can now use the 1,700 from this trade together with the 500 that was already on account to then spread it out under multiple positions that you can compound as well. Now you don't risk 1, 2, or 300 per trade, but now you can risk 600, 700 per trade because you have more capital to play with. And yes, I'm aware that the percentage are very big compared to, for example, prop firms or a personal account where you most of the time risk between 1 and 5%, maybe 10% of the account. But there is a time element involved in these kind of trade competitions where you need to risk a little bit more because you don't have the luxury of time to let it compound because it's only 30 days. But the cool part is this model repeats multiple times per week on multiple different assets. Forex, indices, metals, crypto, everything. The next bigger trade was on GBP US dollar using the exact same logic with the HTF, ITF, and LTF with the 3 buckets. This trade on a higher time frame, we see a daily bullish order block sitting here and also a bullish breaker. And this is the starting point of the idea that was taken on Tuesday, December 2nd. And I just dropped to the ITF to find the structure. Here we're looking at a 1 hour chart and the green line is the daily bullish order block. See an aggressive sells into the order block, then aggressive buys coming in, and your eyes immediately should go to this right here, a fair value gap. Once you were there, right here, there is where you could take your entry. And now based on this higher time frame logic and the ITF logic, let's drop to the lower time frame. Let's see the 15 minute and see how you could also take an entry on the lower time frame. That's exactly the same structure with fair value gap here, order block sitting there, then another fair value gap right here. And here is exactly where I took the trade, right here in this fair value gap at 32.03. Right here during the PM session. So the HDF bucket is a higher time frame order block, and then on the 1 hour time frame we did aggressive sells, aggressive buys, and here on a 15-minute time frame together with the 1 hour time frame you could take your trade. And to be completely honest with you guys, my original target was these equal highs, but when I saw this expansion without any retracement, I wanted to use that profit to compound the rest of the account even more. And with this trade, I was even in the first place for an entire week before the rest of the top 5 started to catch up with me. And also the majority of the time, you won't have these clean expansions. There's a little luck factor involved. Most of the time, it will be with more retracements like this. But this was just one big clean trade to a drawn liquidity. And here's a trade that was taken in the final week and got me to the 2nd place of the trade competition. And eventually to the $8,000 balance and the $8,000 price with $16,000 in total. Higher time frame bucket, daily, internal to external. Drawn liquidity is here, but with the time element involved, I did not hold until that. I already had like a 1 to 7 or 1 to 8. It was enough. And I didn't want to risk price retracing and then go higher. But after the competition, there was a deadline involved. It was the final few days of trade competition. So I didn't want to be at risk of price just coming back here and vaporizing the paper profits. I wanted to look in. I wanted to look in the top 3 spot at least. Because before this trade, I was by far not at 2nd or 1st place. I was like 3rd, maybe 4th. I was hanging on by a thread. And the number 1 and 2 were already miles ahead of me. If I remember correctly, I was at $4,000 balance and those 1 and 2 guys were already at 7. So I need just to close this trade to secure my spot in the top 3 to be eligible for the bigger prices. So higher time frame, internal to external. Let's drop to the 4 hour to see the entry logic, see aggressive sells, aggressive buys, leaving a 4 hour fair value gap. And you guys know by now that this is the ITF 4 hour structure. And then we can just drop to the 1, 5, or 15 minute to find the entries. And if we drop to the 5 minute time frame here, you see price coming back, aggressive sells here, aggressive buys here. with an inversion fair value gap, with a bullish fair value gap. All the lower time frame structure is there as well. That is enough for me to press the button. And then price just rockets upwards with a little retracement here during the Asian session. And on the final day of the trade competition, it expanded again, locking in the final few profits of the competition. And I repeated this setup many times during these 30 days of the trade competition. No deviation, no feeling the market, just executing the data on a model that works in the long run. The one model I just showed you that is part of the market maker blueprint. But a good strategy is not enough. You need aggressive defense. You think you need to take massive risks to win the competition? Wrong. You just need to survive so you can let the compounding do its work. My rule is very simple, the 2-bullet rule. If I take 2 losses, I'm done. Screens off, walk away, go to the beach. No revenge trading, no trying to get it back. Preserving capital is the ultimate offense. But finally, how do you turn $500 into $8,000 and with the prize money even $60,000 without reckless gambling? And it's by using the house's money. And what I mean by that, if you start with $500, if you go to 1,000 or to 2,000, you're not risking that initial 500 anymore. You're risking free money, the profits money. And this is the cheat code. I wasn't afraid to lose anymore because the principal of 500 was safe. And this allowed me to execute my one model without hesitation. While other traders were scared to pull the trigger because they were risking rent money, I was aggressively executing because I was playing with profits. If you have data on your model, you know that something works. Together with zero fear, you will get a massive ROI. So listen up. I didn't turn $500 into $16,000 because I'm a genius. I did it because I was the most bored person in the competition. I waited for one model, I respected my data, and let the other guys blow their accounts where I was sitting on my hands. The trading industry sells you excitement. I'm selling you a repeatable, boring trading business. That is the speed run to becoming profitable. If you want to learn the exact model I used to flip $500 into $16,000, the entry criteria, the risk rules, the data points, I teach it in my new Market Maker Blueprint. I'll leave the link to the Market Maker Blueprint inside the description. And next to the Market Maker Blueprint, make sure you watch the video that's now appearing on the screen. Use this video together with this one to grow even faster. I'll put it on the screen somewhere here and you'll also find it in the description. It's time to stop gambling, start winning, and I'll see you in the next one. Bye-bye.
In this video, I'm going to walk you through a proven A+ setup with a checklist so you can follow it step by step. With this A+ setup, you can get profitable, get funded, get payouts, and I use this exact A+ setup to gain over $1 million in funding and over $100,000 in profits. No time to waste, let me show you how it works. So the first step in the checklist is a liquidity sweep in a key level. A liquidity sweep in this example is a swing low that's being ran into a key level. A key level is a old low, old high for value gaps or blocks. Most of the time in this bullish example, I use an old low or a bullish for value gap as my key level and use time frame alignment with this. So if this is a weekly for value gap or an old weekly low, then use a 4-hour structure to get this entry in. Most of you watching this are intraday traders. So let's say this is a 1 hour for value gap. Then I use a 5-minute structure. This is a 50-minute for value gap. Then I use a 1-minute structure. So when you see the liquidity sweep into a key level, then you want to see second is a market structure shift. Market structure shift is when the last swing high that took the low is taken out. And it is right here. So here you have a market structure shift. Then for the entry, you wait for a retracement into a for value gap, order block, or breaker. And the more that are present in that area, the higher the probability it is. I don't have like a set PD array I'm trading. Most of my entries are around for value gaps and order blocks, sometimes a breaker as well. But use for yourself the PD array that works the best for you. So let's say in this area, there is a for value gap that's being created because this displacement of the market structure shift. There's an order block in the area. There's a breaker in the area. So once price comes back into here, I'll also use premium discount or optimal trade entry to go from swing high to swing low to want the displacement range. When the price comes back to discount of the range in a long example. If you're in a bearish example, then you want to short into premium of the range. But here in this example, we're doing a discount of the range. And what I just did was Option I or Control I on your keyboard if you want that shortcut. And OT is from swing low to swing high. So once price comes back into the OT area, that could be a very nice point to take an entry. And finally, the structure needs to form in a kill zone. So use time in your trading. Use time and price. So let's say this is in London kill zone or New York kill zone. Let's say it's at 9:30 a.m. EST. Awesome. That's what we want. And I'm not going to waste your time in this video to breaking exactly how value gaps work or how breakers work or how premium discount works. I have dedicated videos to all of these concepts here on this channel. I'll leave the link to them in the description. I have a full 90-minute mini course where I break down every single ICT concept very fast, very precise. So check that out after this video. And now you know the framework, let's dive into some examples to see this in real time. I spent hundreds of hours studying ICT concepts, and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, want to get it right now, I will leave the link to this PDF in the description. Here we're looking at ES on the 1 minute chart, and look at the time, it's 10 a.m. So inside the New York kill zone, we just traded into an overlapping 15-minute and a 1-hour bullish fair value gap. And we just had a liquidity sweep right there. We took out a swing low into a key level. That's the first step. Time frame alignment, 15 minutes and 1 minute structure. And now let's see for the second step is a market structure shift. What's the last swing high that took the low? That is right here. So once we broke structure here, there is where the entry comes in. For value gap here, you have an order block sitting right here. So inside this area, you could already take in a trade stop below the low for static 1 to 2. You can also target these highs, but let's say you also only want 1 to 2s. See if we find an entry. So price comes here into the value gap and then moves higher towards the area. Cool. And let's say you miss this first entry. I like to take my entries in for value gaps. So let's say here's the other value gap. Take your entry right there. TP above the highs for 1 to 2. And also the second entry would have given you TP. Why? Because the drawn liquidity was this high. For the next example, we're looking at NASDAQ at the 5-minute chart, and we just took out session liquidity inside a key level. The key level was a daily bearish for value gap. So once we take out the liquidity into a key level, we start to break structure. Last swing low that took the high, and now we have this fair value gap. So your entry can be taken right here. Stop above the high for 1 to 2. Ideally, you can target the upcoming swing low. So I would want to do that. A little high risk to reward. It's also a bearish order block right here, and also potential OTE entry. So our entry could also be here at the OTE, but when we have all that overlapping PD rates, I'm just good to take my entry on the start PD rates and let my stop loss be able to trade into them before trading lower. Like I don't need to catch the absolute top. I just want to make money. So my stop loss will cover potential trades into the OTE area. So let's see what price gives us. So we tap into it 2 times, here and here. Maybe even 3rd time. No, we don't do that. And then here we go to the draw on liquidity. That's this swing low. So if you would have waited for the order block for the OTE area, you would have missed this move. An example where price for this first entry does not come back to premium of the range. So if you would have wanted a premium discount, then you would have missed this trade, and that's fine as well. You cannot be in every single trade. The A+ setup is when price comes back to premium. If you go back here, once price taps into here and then creates a new low down here, there's a new range created right here. And for the second entry, price comes back into premium of the range. So for this entry, one on the PM session here, there is where the A+ setup was. So the entry would have been officially right there, not here. And there the entire A+ setup was present. Liquidity sweep into a key level, market structure shift, price come back into the fair value gap in premium of the range, and it's formed inside the PM session, inside that kill zone, and price goes lower. And in this final example, we're looking at NASDAQ on the 1-minute chart and looking at the time we are in the New York kill zone, and we have a old daily low right here. So what we want to see is a liquidity sweep. Well, we take a swing low here, and from here you want to see a market structure shift. So do we get it already? No, because there's no last swing high be taken out. But then we have another liquidity sweep down here inside key level, the daily low. And then we break structure. The last swing high that took the low right here gets violated. And here is where your entry could be. For value gap, order block breaker, and if you miss that one. So here, your first entry could be stop below the low, target the high. Entry 1. Let's say you miss this one. There's another value created here, right there. Second entry could be here. And this is a trade I actually took myself here in the second fair value gap. Stop below the low, see a bigger target. And where can we trade towards? Well, there's all these failure swings. So you can basically target all these highs here. But let's say you want to target low-hanging fruit. When I would target this high, then you see the risk to reward is not worth it. So you need to or up your TP, that's what I want to do. Or make your stop loss smaller, so you can put your stop loss below this fair value gap. Let's make a bigger trade right there. And price taps into this fair value gap. So here you are in for the second entry. And there's where price starts to move. And already that first liquidity pool is taken. And why is price so fast here? Why does price not stick around here? That's because there are failure swings here. Low resistance liquidity. Those are swing highs that don't take out any liquidity. So if you watch my liquidity video on my channel, you will see exactly this happening when you have low resistance liquidity. So price chills here for a while, and just after the New York lunch, the trade hit TP. So not only that one, you could have taken 2 trades. A smaller one and a bigger one was all based on the A+ setup. You wait for liquidity to sweep into a key level, the daily low in this example. You wait for a market structure shift. You use your value gaps or blocks or breakers for your entries. And the structure is forming inside time. And what you're missing here is price that comes back into discount of the range. Right here, you see price does not come back to discount of the range. And here again, when you use premium discount, you would have missed this trade again. So in bullish conditions, very trending conditions, you might want to be more flexible with the premium discount, or let your stop loss be able to price to come back into the discount range before taking the long example. Based on my data, I noticed that I take my trades earlier and use my drawdown, my stop loss for price, if it wants to come back deeper into the range, to OTE, to discount range, to cover that so I don't get stopped out before the real move. And there you have it, the A+ setup. Use this setup to go backtest, go journal this, and build data on what's working for you. This is the exact framework I use to get funded, to get payouts. I'm very confident you can do too. If you like this video, consider liking and subscribing. If you're not inside my free school group where I trade every single week, I share my trade ideas every single day. There's lots of free trading material available inside that. I will leave the link to my school group in the description. Thanks for watching, and I'll see you in the next one. Bye-bye.
I trade the New York session every single day. I love the volatility. But let's be honest with each other. Sometimes the morning session is absolute trash. Sometimes it's just stop hunts, high impact news, chaos, or worse, it gives you absolute zero clear setups. It's just noise. Most traders panic when this happens. You stare at the screen for 3 hours, you get bored, and then force a stupid trade at the end of the session just to feel involved. That is how you blow accounts. I don't stress when the morning gives me nothing. Why? Because I know that while the AM session creates the mess, the PM session is most likely to clean this up. The PM session is not about finding for a position, it's about continuation. It is cleaner, it is slower, it's where the easiest money of the day is made because the narrative has already been revealed. But before we go further, a crucial rule. This works for US indices. If you trade NASDAQ, ES, or YM, pay attention. If you trade Forex pairs like Euro dollar or GBP US dollar, turn this video off. Forex pairs usually die in the New York PM session. There's no volatility, but on the indices, the PM session is where the smart money balances the books. In this video, I'm going to break down the 3 phases of my PM session protocol, step by step, using the kill zones indicator to make it visual, and how to apply the protocol mechanically on a chart every single day, so you can start making money too. Before we look at candles, you need to understand the logic behind the protocol. House trades based on a framework, not random patterns. That is for gamblers. In this protocol, there are 3 phases. The first phase is the narrative and the bias. Before execution, you need to establish the narrative by identifying who is profitable currently in the move and where are still liquidity pools resting. The PM session model is most of the time a continuation move. Where the AM session already expanded, you will see that lunch most of the time retraces, and then PM session just continues the move it started at the AM session. So the first step you need to do in phase 1 is look at what we did at 10 AM. What did we do during the New York AM session? So you have a bullish bias for the PM session if price is trading above the 10 AM open. If you're trading below the 10 AM open, you probably have a bearish bias. But what is more powerful about this framework is the profit check. You need to ask yourself, who is profitable right now? So what that means is if price expanded during the AM session and we are starting the PM session like this, there are some short-term stops resting below here. So people have stop losses below this. So for the PM session, it will be very nice if it sweeps those liquidity pools and then continues. Similar, if you are bearish at the AM session, you need to look for short-term liquidity pools to be ran into before continuing the move lower towards a drawn liquidity. And next to the 10 AM anchor and the profit check, you really need to know how to find liquidity and make this very simple. Liquidity is nothing more than highs and lows. And the 3 best liquidity pools is session liquidity, daily liquidity, and weekly liquidity. Session liquidity, London higher low, Asia higher low, AM higher low, and of course daily and weekly are highs and lows as well. So locate the nearest liquidity pool buy or sell that have not been tapped yet. So when a PM session model appears, we most likely still have a liquidity pool that's not been targeted yet. We still haven't met the daily drawn liquidity. Same if you're bearish. So if you are preparing yourself for the PM session model, make sure you have your session liquidity and daily liquidity marked out on your chart and see if we still can reach that. When we determined our bias and a narrative, in phase 2, we're going to look at the setup with something called spooling during lunch, and that's 12 PM New York time. What you'll see is that the algorithm uses the lunch hour to reach retrace into a PD array, rather to the AM trading range. So if we're bullish, you will see that the lunch hour retraces before then the PM session continues. But the retracement is very important to look out for. So the key criteria for the setup in phase 2 is expect some form of retracement. And that retracement will form between 12 p.m. and 1:30 p.m. EST, New York time. And to validate if this still works, a little filter, if you're bullish, when price makes this retracement, the PD arrays like value gaps, order blocks, and breakers still need to hold before continuing upwards. If you see them failing, we're most likely going lower. You need to see your discount arrays holding. Same if you're bearish. You want to see your premium array holding to continue lower during that retracement. And during this PM session, there are no new extremes. What no new extreme means is ideally the lowest low for buys right here, or the highest high for sell of the retracement forms before the PM session fully kicks in. So this retracement move and the low that's being set right here needs to kick in before the PM session starts. And I would say that the PM session starts at 1:30 p.m. EST and kicks off fully after 2 p.m. with a new 4-hour candle opening. So in phase 1 and 2, you want to see this. You want a clear bias that we are bullish, ideally with also a clear drawn liquidity up here. And then in phase 2, when we do the lunch retracement before 1:30 p.m., you like to see the low being created. So then the expansion can start in the PM session and you can take your entries right here. And talking about entries, let's talk about phase 3. This is where the money is made. And you can use 2 options. You can use the silver bullet that starts at 1:45 p.m. until 3. Yes, I know ICT says from 2 to 3, but I've seen based on my data that you can take many entries already at 1:45. The focus is on the continuation of the AM trend or a run on the first liquidity target. That means we're just playing the continuation right here. And what to use for triggers, you need to wait for a fair value gap to form in the direction of your bias on a 1, 2, or 5 minute charts. That means when we have this lunch retracement, we take out some short-term liquidity, then this fair value gap you need to wait for. That there is a fair value gap created right here. And then your entries then be taken right here. And this should happen prior to 1:30 p.m. ideally. And this entry is from 1:45 p.m. and up. But again, there needs to be clear drawn liquidity, some form of session liquidity, for example. The second option is the final hour macro, the power hour. Shout out to Flux Trades. I learned this a long time ago using his YouTube video, so shout out to him. And that happens after 3, where you see the final flush. In the final hour, closer to the end of the day, is when price just aggressively reprice towards a certain area. So what you will notice is if you have a clear drawn liquidity, but this move hasn't happened before 3, you can expect potentially power hour when this move is going to happen from 3 p.m. And the best way to spot if this is going to happen, so you will see some consolidation before that, but you want to see an aggressive sells, aggressive buys. And the tell here is the aggressive sells leaves a fair value gap that is not being respected, is ignored. There's an inversion fair value gap. So when that happens, and also, of course, there's a new fair value gap formed, there is where the entry most likely is going to form. In the power hour, you then go to the drawn liquidity. The entry can be taking the fair value gap or the newly created breaker block right here. These 3 phases are the theory. It sounds simple because it is simple. You're suffering from a smart guy syndrome that most losing traders have, where they try to overcomplicate very simple things. Now let's go to the chart to see examples, and also I will show you an indicator how to make this very visual. Here we look at NASDAQ at the 50-minute chart, and you see the colored boxes here. These are the different sessions, the kill zones. If you go to indicators and type in ICT kill zones and pivots, this one, and then go to settings, where you can pick the London session from 2 to 5, the New York AM session from 9:30 to 11, and the PM session, the one from this protocol, from 1:30 to 4. You see the boxes here on the chart, where the purple is PM, London, New York. And this is how you can use the 3 phases in action. For the first phase, we need to know, okay, what does 10 AM? What do we do here? I see that we trading back into the range here, right here, also in a higher time frame for value gap, and then react from there to the upside. So for the PM session, my bias is going to be bullish based on this 10 AM game anchor. 10 AM is bullish. So I'm going to try to catch a continuation during the PM session. The profit check, who has been profitable today? Well, I guess everyone here. I think price could rebalance to imbalances for value gaps. This for value gap has already been balanced, so I don't expect it to come back. But these 2, I'm expecting for lunch. Look at the time, it's 12:30 to retrace back into around 1:30 and then continue. And then identify untapped liquidity. Well, let's zoom out. What do we see right here? I see a massive fair value gap sitting here, also a high. But these 2 liquidity pools could still be ran into during the PM session. Cool. And then for the lunch spooling, what I want to see is a retracement closer to 1:30. So let's mark out 1:30 right here. And we see what happens here. We see there is a retracement here at 2:30 right here. So there's an accumulation here, then the manipulation back into this fair value gap. And now we start moving upwards, creating also a bullish fair value gap here on this 15-minute time frame. So here this PM session model could play out. You just play the continuation. And this is now how the 50-minute structure looks like. So from this point, we can just drop to a lower time frame to find our entries. Using option A or B, well, looking at the time, it's almost 3, so we're probably going to have a power hour today. Here at the 1 minute, we already have the liquidity sweep, break-up structure, fair value gap, also fair value gap respected here. So the structure is holding. So my eyes are now going to see if we can get a reaction on this level. No, we don't. We trade from this fair value gap and then higher. Then in this structure, there's another fair value gap created. So then I'm expecting price not to come back here anymore. Then I would take the entry a little late to the party here. So let's say I take it here. Stop below this low for 1 to 2. You can also target the highs in the fair value gap, but keep in mind in the PM session, it is low hang fruits. It's boring. The ranges are small. You just want to catch base hits here. In the PM session, you won't catch massive expansions. And then price goes to the draw on liquidity. If you zoom in more on this price action, see the price comes back in this fair value gap again. You see how the structure is holding? That is what you want to see when you're inside a trade. Fair value gaps, order blocks, everything is holding. But now we are on the 1 minute in the power hour. But we all did that by zooming out on these 3 phases. Where in phase 1, we identified that AM session is expanding. So we just want to catch the retracement and continue. In phase 2, we saw the setup forming with this retracement into a key level. And then on the 1 minute, we could just find our entry during the power hour. Predictable, boring, and profitable. Now let's see if your eyes are trained already. Right here in the New York AM session, we have a bearish buy. So we expand lower at 10 a.m. So the continuation move is going to be lower. If you look at the left side, we have a daily low sitting here. But that's going to be the draw on liquidity. So we have a very clear bias and narrative for this session. Then in phase 2, we want launch to spool, want to retrace, which we see right here at 12:45. We see a retracement move back into this bearish fair value gap. I'm not going to catch bottoms or tops here. We just want to see, okay, go to a lower time frame and see, do we find an entry on the 1 minute? Do we find an entry on the lower time frame? And it doesn't look like it's right here, but we still have the liquidity pool down here. So during the PM session, there is where I'm going to hunt for setups. So let's see what price does here. So here you see the first change in character with a bearish fair value gap there. Then we start trading lower. This is the signature in price that we most likely want to go to the downside towards here. So now it's the question, we need to find a fair value gap. Do we trade somewhere in? Yeah, we do, right here. So here at 130, here's your entry towards the lows here. Entry in the fair value gap, target at the lows for 1 to 2. You might wonder, am I not scared that price comes back into these fair value gaps? No, because there's a mitigation block sitting right here. And see how price respects that mitigation block right here. And not only that, let's remove this purple box here. We even created some structure inside our entry right here. This fair value gap. So you could also took it right here at 145. And I want to show you something based on this trade. And it's about having enough. So we hit the target, and then price starts trading upwards. And notice what happens after we hit the target. The market reversed. And that brings me to the most important rule of this whole framework. Having enough. You don't need to catch the bottom. You don't need to catch the top. You don't need to catch an expansion. You're just catching base hits with this PM protocol. Most of you stay in trades too long because you're greedy. But the house isn't greedy. Only the gamblers are greedy. The casino takes a mathematically probable portion of the move and leaves the rest to the gamblers. So if you can follow this 3-phase blueprint with the 10 a.m. anchor with the bias, the lunch spool, and the execution frameworks during the silver bullet and the power hour, you don't need to stress about the morning chaos ever again. And this is an entry model I give my students when they're too busy with their 9 to 5 or family responsibilities. If they can't trade AM session, you can just start trading the PM session with this exact protocol. If you want to see this applied in real time, you can find it inside my Discord, together with a complete technical bootcamp, prop firm frameworks, and more. So come join the Discord. It's free. It's time to stop gambling, start trading like a business. See you in the Discord. And before you go, make sure you check out this video that's now on the screen, because combining that video with the video you saw today, you can make even more money with trading. Thanks for watching, and I'll see you in the next one. Alright guys, welcome to this new video. I got a ton of requests creating this video, and today in this video I'm going to walk you through the entire 10 a.m. game plan checklist. I look at this exact piece of paper every day before I trade, and there's simply one rule. If I cannot check every single box for the checklist, I will simply not trade. I will not press the button, I will sit on my hands. This video is going to walk you through fully how to do this yourself in just 3 simple steps. Without further ado, let's hop to the chart to see some examples so you can copy paste this entry model to make money. Cool, so step 1 is going to be the prediction. We need to predict the next 4-hour candle. It's called 10 a.m. game for a reason. It's because we play the new 4-hour candle at 10 a.m. New York time every single day. And a simple way how you can predict the next 4-hour candle is look at the previous one and also look at higher time frame PD rays. What I see right here is a 4-hour bullish order block right here, and I see a bullish fair value gap sitting right here on the 4-hour. And here at 6 a.m. that's the candle where the New York opens. We traded to that area, we could reverse form and then just continue with the trend to the upside. So because this is a rejection candle, we trade into it, but we leave a big wick to the upside. I'm predicting that the next 4-hour candle is going to be a bullish one. If you predict a bullish candle works with an open, a low, and then a high and a close. So with this bias, this is what we're going to use on the lower time frame to find our entry criteria, our entries. And this isn't just on NASDAQ and on the indices. This works on Forex, on metals, everywhere. For example, here on silver, what we did is we swept a weekly low right here, and we swept a weekly low inside a key level, a 4-hour bullish value gap, and now start to react upwards. Oh yes, we have a 4-hour bearish value gap, but here you can play a 10 AM game as well. So with this buys, we just swept liquidity, and also we are in a pretty big uptrend on the higher time frame. My buy is definitely going to be longs. I want to see at least price trading back into this top for value gap, and maybe also into the order block that is resting above it right here. Also from that, the prediction is going to be a bullish candle. Oh, you thought we were done here? Notice that even a third example here on YM, the Dow Jones. Here we're trading to a 4-hour bullish for value gap at 6 AM, so at the New York Open with a bullish bias. So also this candle, I'm going to play an open high low close, a bullish candle. The prediction is going to be a bullish candle at least towards these relative equal highs right here. Cool. Now you know step 1 out of 3. That's how to predict the next 4-hour candle. We need to talk about step 2. That's the actual setup on the lower time frame. So across all the 3 examples on NASDAQ, silver, and Miami, we have a bullish bias. And if you have a bullish bias, you predict that the next 4-hour candle is most likely going to be a bullish candle. And we wait for the lower time frame, if we expect a bullish candle, for a power of 3 or an AMD. So that means accumulation, manipulation lower in a key level, and then start the distribution, catching the full range of that 4-hour candle. So this is where we focus on the lower time frame. And what you will see is that price is not always as picture perfect as you see on all these YouTube videos. Sometimes there's more nuances. So with step 1 with the bias, even when you have choppy delivery at a lower time frame, you can still make money. So let's take a look at the example right now. We're looking at NASDAQ at the 1-minute chart. And the big yellow box right here is a 4-hour bullish for value gap. So already before 10 AM, we are potentially starting the aggressive sells in a key level, aggressive buys. So it means at 10 AM, when the new 4-hour candle opens, I don't need price to come back into this low. This low is already good, like in a kill zone, 950. So the setup is most likely going to appear in that displacement range before 10 AM. That's this range right here. So all you need to focus on is and wait for that small accumulation. The accumulation doesn't need to be long. Remember, accumulation, manipulation, distribution. The first few minutes of the 10 AM candle needs to be some form of accumulation. Can be a few minutes, can sometimes last 30, even 1 hour. It depends for 10 AM. The nuance I want to show you on this exact example is that because we already traded into a key level, we will not trade back into here. So somewhere here in this range is going to be the accumulation, manipulation, distribution. I don't care if it's here or all the way down here. It doesn't really matter. So that's step 2. Predict the next 4-hour candle is 1. Now we look at the setup. We need to wait for accumulation, manipulation, what we see right here. And for the actual entry, first I want to show you the exact setup also on silver on YM. So here look at the same example on silver where we had a 4-hour bullish for value gap. And step 1, we predicted the next 4-hour candle is going to be a bullish one. So when price opens here at 10 AM, see there's already a fair value gap created here, but we're looking for that accumulation, manipulation, distribution. So we need to have some form of manipulation below that 4-hour candle because the 4-hour candle wick needs to be put in. Every single candle has a wick. If you see a candle without a wick, that is suspect. So we need a clear 4-hour candle wick being put in. This could already be it. And before we look at the actual entry setup and how we take the entries to make the most amount of money, the similar setup will appear here on YM on the 1-minute chart. Here at 10, we already traded into a 4-hour bullish for value gap, so a key level. So we don't need to come back to this low anymore. We're going to play a continuation into the displacement range. We already see fair value gaps here. Our setup, our manipulation will probably appear somewhere here. So we anticipate accumulation, manipulation lower, probably here. There's not much to rebend, or maybe here. Set the low of the 4-hour candle wick there and then trade higher in the distribution of the AMD. So from all the 3 examples, we now know how to predict the next 4-hour candle is bullish on all of those. And also we know how the setup is created. That means we let price come to us. We know exactly what to look for. Our eyes are trained to wait, to be patient, to what's actually coming. And now let's go to step 3. Cool. And now the most exciting part, how to make the most amount of money based on these 3 simple steps. Step 3 is the signal. What actually do we need to look for before we take an entry? This example here on the NASDAQ, we already knew, okay, 4-hour candle is going to be bullish. Here at 10 AM, we immediately sell off. So we're probably going to have an accumulation here, manipulation into here, and then start distribution. These candles already show its hand that we most likely are now going to start the distribution. So the low of the 4-hour candle is now being put in. What I'm looking for is the 2 PD array rule. I want to see 1 PD array being the test PD array, and this example is going to be this bullish for value gap. Ideally, I also would like a inversion for value gap to be created. So here's the test for value gap, test PD array, and I say test PD array because it's purely to see, okay, are we actually want to go higher, or are we just going to trade lower and lower? And here, after we start creating the up close candles, this bearish for value gap got completely ignored, inversed. So that means this is going to be inversion for value gap. So this would already be the second PD array, the 2 PD array test, the second PD array for me to enter. So when we close above this inversion for value gap, we have PD array 1, PD array 2. Here could already be the entry after this candle close. If you even want to wait more, you can just wait for a new fair value gap to be created. Let's see what we do here. It's a very choppy delivery. You could already take your entry right here. after the inversion fair value gap was closed, stop below the low for a 1 to 2. That'll be the first option here. If you'd rather wait for another bullish fair value gap to be created because you maybe don't like inversion fair value gaps, you could take your entry from this fair value gap here, where your stop then is going to be below the last line of defense. It's going to be this bullish fair value gap or below this low. I like to put my stop loss below the last fair value gap or below the last low. But let's say we do below the last low for 1 to 2, and then we start the distribution. So a very short accumulation. You can even maybe not even call this accumulation. We go lower immediately. Why do we not accumulate for a long time here? Because before 10 a.m. at the open, at the 6 a.m. candle, we already traded to that key level where we want to move away from to the upside. And then we manipulate, test fair value gap, test PD array, inversion fair value gap for this first entry. If you want to wait a little bit longer, you can take it right here. Wait for the basically the third PD array. In my opinion, 2 PD arrays are enough. And now let's see how this works out. So you already could see how choppy this delivery was. So even when the bias is correct, this is an actual trade I took myself. The bias was so easy. The bias was so correct because we're basically just playing a 4-hour internal to external. We just wait for price to create the bias structure. And we did it right here. We stayed in this area for such a long time. And that can happen. Like, you cannot predict the actual delivery, but what you can predict is the bias. Your actual daily bias is created right here. Step 1 is predicting the next 4-hour candle. Check. Step 2 is the entry. We want to have an AMD, an accumulation, and manipulation lower into a key level. So here's 2. And for the actual entry criteria, use the 2 PD array rule. Step 3, use 1 as a test PD array. This was our test PD array. And then take your entry in the next PD array. So you are less likely to get faked out. And you might wonder, does this work every day? Yes, it does work every day. As long as there's a clear step 1. That means as long as the next 4-hour candle is pretty easy to predict, like we saw here, which is nearly every single day, you can play the whole 10 a.m. game. So when we look at the same example on silver, it's here before 10 a.m. We already traded to the key level, so we don't need to come back here per se. But at 10 a.m. we want to see an accumulation. 10 a.m. starts right here. Accumulation, manipulation lower. If I'm looking at this price action, if we zoom in on this price action, I see here is we already balanced here, but we did not balance this fair value gap yet. So we could make the manipulation into here. Not sure. We just want to see some form of manipulation outside of this consolidation range. See, we consolidate and then we trade lower. So here you see very clearly the accumulation. Now the manipulation lower, and I honestly don't care. I'm not a bottom ticker. I don't care if the manipulation is created here or we take this low one more time. I don't care. I'm just waiting for those 2 PD array rule. At that point, we have an inversion fair value gap sitting right here. That's PD array 1. So the next fair value gap that's being traded into could be here, could be here. There's where the entry is going to be here. That's it. Here's the entry. Right here, stop below last line of defense. I would say below the inversion fair value gap here for a 1 to 2. So price stays inside that fair value gap for a while. But we know the bias of the 4-hour candle is very strong. And there it goes. So where we saw step 1 is predicting the next 4-hour candle is a bullish one. Step 2, the setup, is an AMD power of 3, accumulation, manipulation, distribution. And how we do that is with the 2 PD array rule. We wait for the first PD array to be created. That is right here after the manipulation, the inversion fair value gap. And then the second PD array is going to be here inside this bullish fair value gap. Delivery here, don't expect if you take a trade that it goes to TP in 5 minutes. Sometimes it does, but the majority of the time it happens like this. It just stays for a while. Entry was at 10:48. It started moving 30 minutes after. And then you had your TP. And in the third example on YM, we already knew 4-hour candle is going to be bullish. We know that the manipulation needs to happen probably because here is already before 10 a.m. we already traded to the key level. So price to accumulate, manipulate lower, and then start distribution higher. Let's see at 10 a.m. right here. 10 a.m. starts, we accumulate. There's already a manipulation. Look at this. Accumulation, manipulation into a fair value gap right here. So with this already price showing that probably this is going to be already the low of the 4-hour candle. So then here, where the entry can be found, right here. Stop below the last line of defense right here, or it can be below the low. I like it to put it here, below this fair value gap, or I want it to. And then price goes to a TP. And the reason why I show you 3 examples on 3 different assets, because it not only nearly happens every single day, but it also can be used across all the different asset classes. Where step 1 is predicting the next 4-hour candle. Step 2 is the setup, accumulation, manipulation after 10 a.m. and then start the distribution. And for the entries, use the 2 PD array rule to get the highest win rate and don't get faked out as much. This strategy happens constantly and it gives order in the chaos of the New York session, especially at the open. Now, I know it can be hard to remember, and that's why I created the entire 10 a.m. game cheat sheet with all the entry criteria I use every single morning when I trade. It walks you through phase 1, 2, and 3, so you never miss a step. If you want to download this exact checklist, I'm giving it away for free. Just get the link in the description or in the Discord, and it's also across all my Instagram. Just grab it and start trading on it. And if you want to see me trade this live every single day, just join my Discord and see how I make money with this together with my community. So come join us, grab the checklist, and start winning with us immediately. Thanks for watching, and before you go, make sure you check out this exact video, because watching this video about a 10 AM game together with this video, you not only have an insane hit rate, but you also actually going to start make money with this exact entry model. Cool. Enjoy this video. Thanks for watching, and I'll see you in the next one.
One candle will change your life. If you're tired of all those complicated ICT strategies and you work a 9 to 5, you cannot watch the chart all day, this model is going to be perfect for you. And the model I'm going to teach you today is otherwise known as the candle range theory or the next day model. Like, there's so many different names for the same beast, but I want to teach you the exact concept that lay under all these fancy names. So let's get into it. The first one we'll do on the daily, weekly, monthly, the higher time frame is marking out swing highs and swing lows. If you're not sure what swing highs and lows are, I've dedicated videos on liquidity on this channel. So every time we're going up, we mark out old highs, we mark out old lows, old highs. And our model is going to be based around those old highs and old lows. And we want to see how we close the candle around those highs and lows. And what that means is, if you have a daily, weekly, monthly extra range liquidity is an old high, and we close over it, so you see a body that is closing over the high, then we expect the next candle to be bullish as well. Why? If you zoom in on this single candle on the higher time frame, then on the lower time frame, you will see this happening. You will see trending conditions to the upside. So when we have a certain pair you're watching, you see this happening. Then the next candle, so let's say this is a weekly candle, and you see this happening on the week, and the next week you're going to anticipate a bullish candle, so an open, low, high, close. And on the lower time frame, that will look like a open, a low, a high, and a close. So you can catch that move right here to take it to the upside. But what if the body does not close above the old high or low? In this case, an old high. We see a rejection happening. And if you zoom in on a rejection candle like this, on the lower time frame, that looks like this. We trade upward, but then when we hit that high, we reject, breaking structure, and we probably also create a lower time for value gap or breaker. So when you see this happening, then you can anticipate the next candle to be a bearish one. So then you play an open, high, low, close to the downside. Price goes open, high, low, close. So when you have your higher time frame highs and lows marked out, look at how they close around those so you can predict the next candle. And very important here that we're not going to blindly trade when we see this candle, we're not going to blindly short. We want to drop to the lower time frame to see these kind of structures happening for the shorts and these kind of structures happening for the upside. So from this point, when we close above a high, I'm going to frame the next candle as a continuation to the upside. We have a run on liquidity and we continue to the upside. And when we have the rejection candle, then we call it a rejection or reversal pattern, because price trades to the high and it's not strong enough to continue higher because it rejects. So that indicates weakness, and we want to trade the weakness to the downside. And when you are trading this, you now know how to predict the next candle, but you also need a target. And the best targets are also highs and swing lows. So if you're bullish, just long towards the next swing high. And if you're bearish, just find the next swing low to trade towards to find your low hanging fruit targets. So you look at how candle close above a high. If it closed above, you predict the next candle to be a bullish candle. So you play a bullish open, high, low, close. On the higher time frame, this looks like this. On the lower time frame, it looks like with our value gaps or order blocks or breakers. And if reject from a high, that means we are not strong and we want to go lower. The price gives a clue here that price wants to go lower. On the lower time frame, that same candle looks like this. And we need to have a market structure. Since we're not going in blindly, we want to have some form of sell structure on the lower time frame to find our trade. And it's going to be towards a target. It's going to be or external liquidity or internal liquidity. Just find the nearest liquidity pool. And if you're not sure what liquidity is, I'll leave the link to my liquidity video in the description. And I created free training on how to go from emotional trading and blow accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight value. So make sure you check out the link in the description to watch the training as soon as possible. Cool. Now let's see this in action. Here we're looking at Euro US dollar on the weekly time frame. And let's look at what we do right here. So we have a high right there. And here in this candle, this doji candle, we trade into the high, but we reject from it. And yes, it's a doji, but because we trade into the high, but we fail to displace higher, we expect the next candle to be bearish. We trade lower, we trade lower, we trade lower. We see how the candles are closing in comparison to the previous candle. And here we have a small upwards candle. We also see an overlapping weekly bearish for value gap. And right here, we see a sweep of a high and then a rejection lower. So when we see this candle happening, the next candle we can predict to be a very bearish one. Trade lower, we trade lower. Then we have this massive up close candle. We have created another weekly bearish for value gap. And we do not displace higher. Also, we reject from the for value gap. So that indicated we probably want to go lower, and then we do that. And now you might wonder, like, okay, this is nice on the higher time frame, but how can I trade around this? Like maybe a swing position from the 4 hour, 1 hour, or maybe even lower to the infinite time frames. So for that, we need to zoom in. So we know the framework now on the higher time frame, like we've seen right here. So we traded to a high, but we failed to displace above that high, so we expected rejection. And in this example, we also saw some overlapping fair value gaps that also supports that clue that we might not want to go higher, but want to go lower. We're rejecting. And now let's drop from the weekly to the 4 hour time frame. Here we're looking at that exact same price action, and let's break it down if we could find an entry. Let's start here at the top. So here we have that weekly high, and we tap this here on the Wednesday at 9 a.m. in a kill zone, so that's nice. And then we displace lower, leaving a fair value gap. What I want to see when rejecting from a high, I want to see a market structure shift. And a market structure shift is when the last swing low that created high is violated. So that would be right here. So this price I won't be engaging. I want to wait until we close lower than here, and we do that right there. So we leave a fair value gap. We cannot get tapped into it. As you can see, we just trade lower and lower and lower. So in this whole move on the 4 hour, I would not be in. So yes, you've seen the reversal. Yes, you've seen it happening, but no entries. But it gives a nice indication to what price might want to do. And you see what we do. We reject from the highs. And what are we targeting? We are targeting all these swing lows. Swing low here, here, and there. You see how clean this goes through. So when you see the rejection from the highs and you see price trading down very aggressively, we can look at premium arrays to find even lower price because we can take out all these lows. Eventually, we want to take out these relative equal lows as a part of a bigger market maker sell model. If you're not sure what a market maker model is, I'll leave the link to that also in the description. So we displace here lower, leaving a massive 4 hour fair value gap. So once price comes into this fair value gap, you can already take an entry with your stop above the recent high. And if you're not a swing trader and you can watch the market, you can even zoom in here on this 4 hour fair value gap to maybe look at the 50-minute sell structure. So here we're looking at that same 4 hour bearish fair value gap, but on the 50-minute time frame. And we have a aggressive sells, aggressive buys here at 4, so in the London kill zone, which is a nice time to make a high. And then we wait for the last swing low that made the high to be violated. That's right there. So once we trade below here, that is where I want to look for sells. And you see this fair value that created with the structure shift. And this is where I would like to take my entry. So it would be right there, stop above the high. Low hanging fruit would be a 1 to 2 like this. And it would be a very nice trade. And it's all based on the weekly rejection up there, a 4 hour sell structure. And inside that 4 hour sell structure, we're even going lower to the 15-minute to find an entry. So let's go back to the 4 hour time frame. You knew right here that you want to go lower. Here's where there's not a clear entry. Once we displace here in this piece of price action, you could take a very clean lower time frame entry. And you don't even need the 50-minute time frame. You can just take trades from the 1 and 4 hour and you can make a lot of money. But maybe you're like, but I don't want to wait a few weeks to take a trade because this was in September and this was like over a week after this price action. Do I need to wait a week for a new trade to be taken? I would say no, because we are now doing this on Euro US dollar, but there are a lot of other pairs where you're going to do exactly the same as part of a weekly outlook. So at every start of the week when you want to start trading, go to the higher time frame, apply this concept, look at what looks nice on the higher time frame and frame your watchlist around that. And I share my own outlook exactly like this in both the school and the Discord. So if you're struggling with this, make sure to just join. I'll leave the link in the description, but now you know how to do it too. Cool, so let's go back to the weekly time frame. So looking at the weekly, we just took a trade in this area right there. But let's continue doing this. So when you see the model, so for example, right here, you see a sweep of liquidity and also overlapping with a weekly bearish fair value gap. In this piece of price action again, drop to the lower time frame because this is your rejection candle. So for this candle, you might have a very nice trade idea on the lower time frame. Let's drop again to the 4 hour time frame. So here's that weekly bearish fair value gap where we rejected off from. Here on this Tuesday, big rejection. In these kind of moves, 99% of the time you are not in. That is fine. You don't make your money right here because this move will give you the direction, the displacement with fair value gaps and other premium arrays, and you need to trade off of that. So when this happens, big range, what I like to do is draw a premium swing high to swing low and discount and try to look for premium arrays. So there's an order block, a breaker. My eyes immediately go to this fair value gap. We have multiple fair value gaps. We have one here on the 4 hour and also one here. Because I want to short and discount, I'm going to make this fair value gap smaller. I'm only going to leave that in premium of the range. And as you can see right here, we tap into premium of the range and then we start rejecting again. So on the 4 hour, you can just have a sell limit at premium of the range. Your stop is above this high. Why above this high? Because this high created high resistance liquidity. We took liquidity before the massive move down and you can target a simple 1 to 2. and would also give you a nice trade. Let's drop again to the lower time frame to see in this piece of price action if we intraday can also find a nice trade. Here we're looking at the same area, but then on the 50-minute time frame. So we start to trade into premium of the range. We also have an overlapping 50-minute for value gap right here and an order block right here. And look at the time we were trading into it, 10:30. That is the New York kill zone. So wait for aggressive buys, aggressive sells. We see some displacement. Ideally, again, we want to see a structure shift. I see a swing low that made the highs right there. So with this candle already, we have the structure shift. So this is a significant fair value gap. Well, if you mark it out in time, you see how it's respected. So you can already take a trade from here. You can even take it later in another fair value gap right here, tapped in 2 times. So let's say you miss this initial move and you get in this fair value gap, your stop is going to be above this high. And this is an intraday trade I wanted to, like this. And you would have had TP as well. So it doesn't matter if you trade from the 4-hour or the 50-minute or from the weekly. Based on the framework you just got, you know now how to trade this. You have a projection candle on the weekly, then you drop to the lower time frame to find your structure. You can do it on the 4-hour, the 1-hour, if you work a 9 to 5, because you don't have a lot of time to watch the chart. But if you have time to watch the chart, you can go inside those 1 and 4-hour levels. You can drop to the 5 and 50-minute to find a intraday trade idea. So from the weekly for value gap, we had 2 trade ideas that both followed the exact same buy. And this is for when you cannot watch the chart, when you work a 9 to 5. And if you can trade intraday, you can take this trade. Same trade, 1 to 2, and just find the approach that works best for your own situation. And you thought we were done with this? No, of course not, because this model keeps working. So we trade lower from this place, we expand lower, and maybe you're like, yeah, but why didn't I trade all the way back to down here? Because we're looking for low-hanging fruit targets. We just keep targeting hold lows. So here inside this weekly bearish value gap, you see that we take out some highs into a premium level and reject from there. So this candle, I'm not interested in. I'm interested in the next candle, this one. So we're gonna do exactly the same, drop to the 4-hour to see if we can find an entry. And here you have that weekly bearish fair value gap. And we see that we trade into it right there, here at Friday at 5 a.m. And then we start to trade lower with a fair value gap right there. I see a fair value gap right here. And also I see a fair value gap right here. So if you have a bearish bias, you can take your entry in one of these fair value gaps. I like to wait a little bit. I think this fair value gap is a little too small. So I want to see, do we respect it and then trade lower? So most likely, most of my trades, I will be in this fair value gap. If we trade on the 4-hour, where do I want to trade towards? Well, I see a swing low right here that I want to target, but we also had a higher time frame swing low that we could target right here that we marked out on the weekly. Either way, most of the time, I just want a 1 to 2. So stop loss above the high for 1 to 2, and it will be right there. You can even go even lower right here, but you can also do 1 to 2. Whatever your preferred risk management is, I think with a 1 to 2, you can make a lot of money. That's what I do. So you would have to trade right here. This is when you work a job. If you want to trade intraday, let's do exactly the same, but then on the 50-minute. So you will see first trade idea. Let's drop now to the 50-minute. So here we're looking at the same price action on the 50-minute time frame. Here we tap into that weekly bearish value gap, and this looks pretty clean on the 50-minute. Aggressive buys, aggressive sells. So we have a market structure shift right there. We have a similar for value gap right here on the 50-minute. We see on the 50-minute, we don't respect this too much because we see some trading above it here during Monday, during New York session. We trade back into that original for value gap right here. So this is going to be the starting point of our trade. I mentioned on the 4-hour time frame that most of my entries are right here, but let's see where we can find our entries using the 15 minutes. So here on this Monday, this is already a separate trade idea. What I see here are failure swings, low resistance liquidity. So this is really what I want to target. When I see this happening, we have Asia low with failure swings. This is going to be a target. Then we have aggressive buys, aggressive sells. I'm going to follow fair value gaps and order blocks. What I see here is a 15-minute fair value gap. Let me zoom in a bit. So here's the 4-hour fair value gap. Here's a 50-minute right here. Overlapping, this is your A+ setup here, guys, because you have up close candles that trend to a high, sweeping liquidity. So there's a high resistance liquidity, leaving a bearish order block. We also have a bearish breaker. So this is already an entry which I would like to take right there. Start your value gap. Target is the failure swings, the Asia low for a 1 to 2. And that's nice because the 1 to 2 even covers a potential tap into right here for a 1 to 2. This is option 1. All based on the weekly and the 4-hour bias. Cool. We trade lower. Look at the time. It's intraday. We're not trading this. It's the market close. We come back in the London session because we're on Euro US dollar. So here we start here at 2. And this is inside that other 4-hour fair value gap. Let's zoom out to the 4-hour. What we're now discussing on the 50-minute is this fair value gap. Let's give it a little different color. I'm gonna give it a green color so you know which one I'm referring to right here. So we trade into a 4-hour bearish fair value gap during London session. And then on the 15-minute, we look into this fair value gap. We see in London session, we see displacement lower.
leaving this for value gap, it would also give you an entry here on Tuesday, right here. Same target, because we have not reached our target yet for a 1 to 2. It will also be same trade. So if you miss the trade on Monday, you can take a trade on Tuesday. Well, let's continue, shall we? We have another value gap sitting right here, and that was the original trade idea from the 4-hour time frame. So let's make this one more yellow so we can recognize it, and let's see what we do when we trade to that 4-hour for value gap. We traded to that 4-hour for value gap here during the Asian session, and then we move lower, and during the New York session here at 9, we tap into it again and then sell off. So on a lower time frame, I would not have been inside this trade, which is pretty interesting, because on a 4-hour, I would have had my limit right here. I would be in the Asian session, but if I would take this intraday, I would not be in, because intraday it did not give a lower time frame structure, which is completely fine. That's the difference between trading intraday or trading more as a swing trader like this. The cool part is both are good, both make you money as long as you use the model on the higher time frame, where you have a rejection candle, you go to the lower time frame and find your sell structure. And I think by now you get from this weekly move down, we took multiple trades, both on the 4-hour if you're working a job, but if you can trade intraday, also multiple trades. And we can keep doing this until we are in a higher time frame drawn liquidity. And from this point, when we start rejecting lower, just focus on the swing lows and see if we reject somewhere. So right here, we were rejecting, but then we continued to the downside. If we now fast forward here, because I'm using the replay button, is from this low, we reject. So this swing low, we see that we create a low, then we go higher. And after this displacement from March 3rd is where you need to pay attention, because now we change structure on the weekly time frame. And then you have, of course, your weekly bullish for value gap. And when you are bullish, you want to trade to old highs. So right here. And right here, the original short idea will be what we discussed here. I'm not going to bore you with doing this again, but in this time frame, you look at how the candle closes. So this candle trades to a weekly for value gap, rejects. So the next candle, this one is where you go to the lower time frame to find your long ideas. Same here, and you can do exactly the same. Here, look at the live chart here. You have a weekly bullish for value gap. We tap into it, we displace. So when this happens, you know that we want to go to the upside towards the next high. And that's right here. And this all on the weekly. You can then drop to the 4-hour time frame as a swing trader to find your entries. If you want to be an intraday trader, you can use the 4-hour as your levels and then your 5 and 15 minutes for your entries. So this far we mainly discussed the rejection model, but we also have the continuation model. So what if we traded to a high, but we trade over it? So we show willingness to continue with the current trend. So in this case, it's a bullish trend. Let's look at some examples. Here we look at a live NASDAQ chart on the daily time frame, and let's start below here. So here we trade into a volume imbalance, and then we trade higher. And we're going to mark out the value gaps because they play a big role inside this model. Because if you have this model together with a value gap, that is pretty powerful. So let's see the model in action. Right here, we trade higher, we trade higher. This candle closes over the previous candle, so we see another one higher. This candle right here, we reject. So we take the high, but we fail to displace over it. So in the next candle, we are going to look for a lower time frame sell structure. Well, in hindsight, this doesn't happen. You see, there's another buy structure. So in this day, you or have no trade or you have taken a loss. That's fine. But that same daily value gap is still on. So when price trades into the value gap here and rejects, from this point, this candle, April 30th, is where you're going to look for long scan the next days. Same here. We sweep a low, we reject, and we go higher. We close over it, close over it, close over it, until we don't. So we see some weakness coming in, we trade lower, and then we reject again. And where to reject from? We take some lows, but also an overlapping for value gap, and we go higher. We trade above the high, higher, higher. Then we have a massive rejection candle. So this candle, you're going to look for shorts. Well, big doji, so a tricky day. A rejection candle from the order block. Why is it an order block? It's a down close candle. It trades to a value gap, order block, and higher, higher, higher. So based on the one candle model, you could have your whole buys for this move. And if you go to lower time frame, you could find your 1-hour moves right here. Aggressive sells, aggressive buys. You could take your entry here in this value gap, right here. Or your entry in this value gap, right there. And if we go to the next daily value gap, we tap into it right here. This is a trade that took live with you guys on stream. Aggressive buys, aggressive sells. Very nice value gap sitting right there. If you missed that one, you take the next one. So here you could have taken all trade ideas based on the daily structure, 1-hour level. And inside those 1-hour for value gaps, you could even drop to the 5-minute if you want to go intraday. But this video is getting pretty long, so I won't bore you with another lower time frame examples. I think you get the point right now. So you go for your daily structure. Based on the model, you look at how we close above old highs and lows. When you have a bias, you can drop to the 1 hour, to 4 hour to find your entry in there. And if you are an intraday trader, you can go inside this 1 hour for value gaps right here. You drop to the lower time frame to find your buy models as well, but then on the 5 minutes. And when I say one candle will change your life, I mean it. This simple model will get you the bias, both if you work a 9 to 5 or you can trade intraday. This will give you such a clear bias on all the pairs. So now you know when not to trade a pair and when to trade a pair. And when you have a high probability pair on your hands using this model, you can take your trades and get funded, get payouts, make money. If you want to learn more or want to see me daily, I have a school and a Discord group. I will leave the link to that in the description, and make sure you check out the free training I have to get funded, get payouts within 90 days in the free training below. Thank you for watching. I hope you enjoyed. If you did, consider liking and subscribing. Make sure you check out the other videos on the channel as well about market structure, liquidity, daily bias, all that stuff. It's all there. I'll leave the link to that in the description, and hope you enjoyed. See you later. Bye-bye.
Ever wondered why you lose so many trades? Good news, this struggle is easy to fix. My name is Dion, full-time trader with over $1 million in funding. And this video, I'm going to break down the most high probability ICT entry model, the unicorn setup. To do this, I will share the 4 puzzle pieces that create this high probability setup. No time to waste, let's get into the video.
When you want to determine where to find the ICT unicorn model, you need to look at 4 puzzle pieces. 4 puzzle pieces that will rule them all. And let's go over the first one. And the first one is one of the most powerful concepts in trading, and that is called the breaker. And if you want to understand what a breaker is, you need to understand 3 key concepts. You need to understand what order blocks are, you need to understand what liquidity is, and where you can find it, and how market structure works. If you're not sure about one of these 3 concepts, I have dedicated videos on this YouTube channel, and I will leave the link to that in the description. So when we look at order blocks, we need to know what order blocks are, because breakers are order blocks, but then on the different side, the other side of the curve. And how you can determine an order block is the last down close candles that swept the low before a market structure shift, come back to the order block, and then go higher. And with a breaker, what happens is price ignores the order block, and we can use it as a bearish breaker to the other side of the curve. So we are going to use it as resistance instead of support. More on that in a second. Then you need to know what liquidity is, because a breaker is a breaker structure. So there needs to be some liquidity being taken before the move. This is a key part of a breaker. And also you need to understand what market structure is. When is there a market structure shift? When the last swing high that made that low, that took liquidity, is taken. When that liquidity point is taken, right here, you have a market structure shift. So order blocks, liquidity, and market structure. And what is then a breaker? A breaker, in this bullish example, is the up close candle, last up close candle before that liquidity sweep. So you can identify it by a swing low, a swing high, then that swing low is broken, right here, creating a lower low. And after that, this swing high is broken, creating a higher high. So low, high, lower low, higher high. And the up close candles in this bullish example will give the breaker. So if you look at it in candle format, we have your low, you have your high, you have your lower low, and you have your higher high. And then these up close candles are the breaker. And it's up to trader discretion if you want to do the top candle or you want the whole range. Preferably, I'd like to take the whole range. So from this swing low to this swing high and mark out the breaker. You can also only do this candle. Again, up to trader discretion. Same for bearish example. It's the down close candle, last down close candles before liquid sweep. So swing high, low, higher high, lower low. And again, there needs to be a breaker structure. There needs to be liquidity taken before this move to be a valid breaker. If there's no liquidity being taken, it's not a valid breaker. So here you have a high, you have a low, a higher high, and have a lower low. The down close candles here, again, you can take from candle to candle, take the whole range, or just this candle. I prefer to take the whole range, but again, it's up to trader discretion. And as I look at an example on the charts, we are looking at NASDAQ at the 1 minute chart. And we are now at the New York Open. Look at the time, it's 9:30. And we have this down move with some further swings here that could be nice to target later. And what you see here is a breaker formation. I see a low being formed. I see a high. This should be a bearish order block, but because we're gonna break it, spoiler alert, we're gonna use it as a bullish breaker. So a bearish order block becomes a bullish breaker. Low, high, lower low. And let's see, once we take this high, then we're gonna talk about a breaker formation, and we do. So right here, from the low to the high, I like to just take the up close candles here. So I would mark out the breaker like this. And what do we see here? So we have a low, a high. The low is taken, liquidity sweep, setting a low, and now we also have created a high right there. And then you can just take your entry from the breaker. stop loss below the breaker, I'll just target the clean 1 to 2. Don't make it more complicated, and this 1 to 2 is also overlapping with these failure swings up here. And let's see what the price does. So it gives a nice push, and it comes back into the breaker before eventually going to the TP point. This is only using a bearish breaker, and as you know, there are more puzzle pieces to this unicorn model. So let's now talk about puzzle piece number 2. I spent hundreds of hours studying ICT concepts, and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, wanted to get it right now, I will leave the link to this PDF in the description. So now you know how a breaker works. The second puzzle piece is one of the most important things you need to add to the unicorn model, because a breaker is only one side of the equation. The other side is the fair value gap. And the fair value gap is one of the most easy concepts in ICT concepts. It's a 3-candle pattern where there is a gap between the high of the first candle and the low of the third candle. And the goal of the unicorn setup is to combine these two. So you know how a breaker works, you know how a fair value gap works. When they overlap, there is where you get the unicorn model. So in this example, you have the low, you have the high, you have the lower low, and you have the higher high. When price comes back into the range with an overlapping fair value gap and a breaker, there is where we have the unicorn setup. So not only look for breakers, also look for fair value gap. So if you have a fair value gap or fair value gaps multiple overlapping with a breaker, that is where you need to pay attention, and there is where your highest probability entries will occur. And now let's see this one in action. So you now already know how a breaker works. So we have a high, a low, a higher high, and a lower low. And now we have the breaker marked out. We also now have a fair value gap. So now you have an overlapping part between a fair value gap and a breaker, and now we have the unicorn. So we can just take an entry at the start of the breaker and fair value gap, the unicorn, stop above the high or stop above the breaker. I prefer this one. I prefer above the breaker, but if you want to be safe, go here for 1 to 2, and then let's see what price gives us. And as you see, price does not tap us in and goes to the TP point. And it's to show you like nothing 100%. With every model, you will still be left behind sometime. Now, if you look at this example on USD, JPY on a 50-minute time frame, what do we see? We have a low, a high, a lower low, and a higher high. We also have a overlapping fair value gap. So what is this? This is a unicorn setup. Let's mark out the breaker. From this point, I will take my entry. I will do my entry at the start of the breaker, stop loss below the low, before I static 1 to 2, and let's see what the market gives us. So it taps in, and you see how the wicks are inside the unicorn, but the bodies are closing above it, making it very bullish. And then price comes to the TP area. So all based on a simple unicorn format. So now you know the basis of the unicorn model. It's the breaker overlapping with the fair value gap. But there are 2 more puzzle pieces where you can make this unicorn model even more high probability. And this third element is one of the most important thing in ICT concept, and it is time, and specifically the kill zones. And there's a difference between Forex and indices kill zone. So if you trade Forex, watch the top of this chart. And if you are trading indices, please watch the bottom. So we have Asian session, Forex from 8 till midnight, London from 2 to 5, New York AM from 7 to 10, and London close from 10 to 12. If you trade Forex, try to frame your entries inside the kill zones. If you do indices, Asia is the same, London is the same, but the New York AM session is a little different from 8:30 to 11. And then you have a PM session for the indices, for the US indices. And there's also a silver bullet window. There's where your most high probability trades will occur. That's between 3 and 4 for London, and between 10 and 11 for New York AM, and 2, 3 p.m. for New York PM session. And bonus points here, and when you have currencies and pairs that are from the region of the kill zone. So for example, the Asian pairs are AUD, JPY, NZD. Why? Because their region is in the Asian time zone. They're living in Asia. Just like countries from Europe, let's say Euro, GBP, CHF, are all European pairs. They move in London, just like the USD and the CAD move in New York session because they're from the region. So if you, for example, have Euro and USD, you know they're probably moving in London and New York, not in Asia, because the regions are not there. So try to think about the region and match them to the specific kill zone. And the fourth and final element of the high probability unicorn setup, we now have a breaker overlapping with a fair value gap that makes a unicorn. If you combine a unicorn with the kill zone, with execution in the kill zone, it's even more high probability. And the fourth and final puzzle piece of the unicorn model is a draw on liquidity. Your unicorn model needs to match with where the price likely wants to go. And a draw on liquidity, there's a dedicated video on this, on liquidity, on this YouTube channel. But to give you a little heads up, price only goes to two things. It is internal range liquidity, that's basically imbalances for value gaps, volume imbalances. And we can use that as a place to trade from. So if we have a value gap, we can use it to trade higher. And price can also trade to external range liquidity, old highs and lows. So it goes from internal to external, from an imbalance to an old high or low, or going from a high back to an imbalance. There's only two things. At intraday, use a 1 hour array, let's say a 1 hour for value gap, combine it with a 1 and 5 minute entry. Use 4 hour arrays, 4 hour for value gaps, to a 50-minute entry, and daily and weekly arrays for a 1 hour entry. And bonus points here. If you want to find your highest probability draw on liquidity, follow the displacement, follow the order flow. So that means when price is bullish on the higher time frame longs, frame your bullish unicorn setups. And in a trending move, the opposing arrays should fail. And what I mean by that is if we go higher, we have on the sell side of the curve, we have bearish fair value gaps. We have bearish order blocks, bearish breakers. When we are trending to the upside, these should all fail. And that is where it's confirmed that you're gonna from bearish to bullish or vice versa. So the opposing arrays should fail. And if we go back to our previous example on USDJPY, when we have a clean unicorn, look at where the unicorn is formed, where the low is taken at 3. This is during the London session. So the London silver bullet from 3 to 4 is where your trade idea is probably going to be set up. And the execution is here at 4:45. And let's see if there's a clear draw on liquidity. Well, if you look at the daily time frame, this structure is formed inside a daily bullish fair value gap and also in a daily bullish order block. So in the higher time frame, this was already a very nice move from internal potentially to external. So if we know that, then we can safely sell on the lower time frame, and now we're doing this on the 50-minute inside this area. So now the green line is that order block and the fair value gap. In that area, there is where the structure in this unicorn is formed, making it more high probability. And when can we trade towards? We can take out all these failure swings, and that's what we also eventually do. And you see when this unicorn setup is traded, how it gives a very clean move to take out all these failure swings. And now you have it. 4 puzzle pieces to get a high probability ICT unicorn model. You now know what a breaker is. You now know what a fair value gap is. And the overlapping part is the unicorn model. If you combine that with time, with the kill zones, and you're finding your higher time frame draw on liquidity, you have a very high probability entry model on your hands, which you can use to get funded, get payouts, and get profitable. Next to the unicorn setup, you might wonder how order blocks work, or fair value gaps, or liquidity, or market structure. Good news, I got videos on all of them here on this channel. So I will leave the link to that video somewhere here, up, down, so you can continue your journey learning all the ICT concepts and start making money. Thanks for watching, and I'll see you in the next one.
$1 million entry models. In this video, I'm gonna break down the exact step-by-step framework that got me to over $1 million in funding and over 100K in payouts. And using this exact step-by-step framework will get you to $1 million plus in funding as well. And you can do this being a complete beginner. It's all there for the taking, no time to waste. Let's get into the video. The framework I'm about to share with you has 4 simple steps. And the first step is finding your favorite confluences. And confluences is just a fancy term for your favorite ICT concepts. It can be for value gap, order block, breaker, market structure shift, all that stuff. And what nobody tells you is you don't need 20 different PD arrays on your chart. You don't need the Reapers, the NBOX, the NDOX, all that stuff on your chart to make money. Just pick a handful, master them, and combine them into one single entry model. And I built a specific playlist on my YouTube channel where I explain all the different confluences like market structure, market maker models, time and price, daily bias, order blocks for value gaps, kill zones. If you go to my YouTube channel under playlists, then if you go under build your model, there is where you can find all those videos. And I'll leave the link to that playlist also in the description. And the ones you've seen in that playlist are the ones that I use to make money. And there are a ton more PD arrays or ICT concepts you can use to make money, but these are the ones that works for me. They're very simple and I want to simplify everything for you. So when you find your favorite confluences, there's where it's time to go to step 2. And it is get an entry model with your confluences. And you can build a model yourself, or you can use one of my favorite entry models. And the past couple of weeks, I created a dedicated video to all of them. You have the school model, you have two A+ setups, you have a turtle soup model, open, hide, closed model, and there's more entry models. And there's also a specific YouTube playlist for this. If you go back to the YouTube channel, you have your build your model where you can find the confluence from step 1, and here you can find my favorite entry models. So you can build one yourself using the confluences, or you can just use my entry models and then backtest it yourself. So step 1 and 2 is nothing special, right? You find your favorite confluences, you watch the video, you take notes, you go to the chart and see if you can identify them, and then you build an entry model around those confluences. And I created free training on how to go from emotional trading and blowing accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight values. Make sure you check out the link in the description to watch the training as soon as possible. Cool. And there's a third step in this framework, and there's where 95% of traders miss it completely. They are or too lazy or just don't want to make money. But it's the part of trading that takes the most time. It's the most tedious, and to be honest, it's just not a very fun part of trading. Everybody wants just to push buttons and then make money. But the third step is all about executing and building data. And by building data, I mean making mistakes. Go to the chart, execute and mess up. Fail as many times as you can. Fail forward and journal all your mistakes. And there is one specific insight I want to share, and I shared it in my Discord, and it's the following. I got many DMs with a screenshot of a trade and the message, I don't understand what I'm doing wrong here. A simple message that showed a lot about what level a trader is. Because a trade is taken based on an entry model, I hope. And entry models you can find on the YouTube channel here. An entry model is nothing more than X, Y, Z is happening on the chart. And based on that, you decide to press the button. And you have an edge with your entry model, and that's your win rate. That's where you need to build data for, because you need to have a certain win rate to know, okay, I can make money now. That means if you take your entry model, have a 50% win rate, you lose 5 out of 10 trades and 50 out of 100 trades. Beginners and losing traders. So if you're one of those, it's okay. Now we're gonna fix this. Beginners and losing traders think that when their entry model appears, they are going to make money. But the I don't understand what I'm doing wrong here shows a lack of understanding of probability and risk. With your entry model, for example, has a 50% win rate, you must shoot 100% of the time when you see your entry model appearing, when all the stars are aligning with your model. But even then, only 50% of the times you're gonna make money. So the I don't understand what I'm doing wrong here, maybe rephrase this. Maybe you are doing nothing wrong here. That's just your edge. You just hit one of those 5 out of 10 times you need to lose in order for you to make money. Very important framework in step 3 about building data. Yeah. So you have your entry model, and let's say that's a school model. Cool. That means you need to build data on this, because you need to look, does this model work for me? If I go to the charts, you can go backtest. You can backtest on TradingView or FXViewPlay. There are many tools you can backtest on. Does this work for me? And at the same time, go look at live price action day after day, show up every single day, every single trading day, and try to execute your model and mess up, make mistakes. And over time, in a few weeks' times, you have so many data points, and you can conclude, okay, maybe this entry model has a 40% win rate or 50% win rate for me. That's fine. If you should have wanted to, you make money. That's cool. And if you need some help with journaling or data building or your trade plan or daily bias or whatever, I have a school group where I have free courses on everything. So don't buy an expensive course. Go to my school group, go to the classroom, and in that classroom, you can find everything you need to start making money yourself right now today. I will leave the link to my school group in the description. But executing and building data is one of the most important things in your trading. Because if you lack confidence, you lack your psychology, you're very scared on a chart or lots of anxiety, that means you have no confidence. Because confidence is built on proof. But how can you be confident if you don't have any proof that something's working for you? So you need evidence, you need proof that something's working for you. And how can you build proof? By doing this, by building data. Backtest and journal. So backtest is journaling is basically forward testing. So you're going to actually look at live price action and try to find your setups and build data points over time. And over time, you know that, okay, if I'm going to the charts in the long run, I'm going to lose 6 out of 10 times or 5 out of 10 times, and I'm still going to make money. So when you are in a trade and it goes to your stop loss directly, you are okay. You are not mentally drained. You are not too anxious. You just accept it like, hey, cool, can happen. It sucks. Yes, you lose money, but in the long run, you're going to make money. And now you know the first 3 steps of this framework. Building data on your entry model is the most important thing in the world. I want to introduce you to step 4. And it's the most powerful concept I use to skyrocket my win rate. And it's not some fancy PD array. It's not some fancy entry model concept. No, it is being a judge. I have a background in law. I've been to law school, and I want to share the framework that I use from being out of law school into trading. And it's build a case like a judge in court. So with every trade, you are the judge or you're a lawyer, and you need to make a case with bullish and bearish arguments. So you go to the chart, you see your entry model, and okay, for example, I'm bullish. Cool. You're gonna build your case around being bullish. One important thing here is that the higher time frame is more important than lower time frame when building your case. If you have a 1-minute buy structure, that is less important than a daily buy structure. Make sense? Cool. So for example, you are bullish. Example, you have a daily bullish fair value gap, you have a 1-hour market maker buy model, and you have a 5-minute structure. That is a pretty nice bullish argument, a bullish case for price going higher. So you might want to long. But it's very important to also build a bearish case and see how strong that bearish case is. Because maybe the bearish case is even more significant, and you might have a short on your hands. And if you are long against a very bearish case, that's not a nice idea, because you want price to go up very cleanly if you're long. But let's say the bearish arguments are very small. You have a small 1-hour CBs on the sell side of the curve. Then you don't have a lot of bearish arguments against your position. And if the bullish case outweighs that bearish case by a ton, then you have a high probability setup in your hands, because you don't expect price to go down very aggressively. So that's cool, because price needs to go up. And an example here is on a GPUSD screenshot I just took while recording this video. This is a live price action here. And you see a drawn liquidity at the upside. You have a liquidity sweep. You have a massive displacement with a fair value gap. And when you want to take a trade into this fair value gap, there is where you need to look for, okay, what are my bullish arguments? What are my bearish arguments? Because this is, in hindsight, this is not printed yet. This here is not there yet. So you don't know that price is going up. But you do see a fair value gap. You do see that there is some bearish fair value gaps, but there's mostly failure swings right there and right there. And with dollar being very bearish right now, you probably have an argument also that the USD pairs, among others, GPUSD, is going up. So with that, you now have a stronger argument against higher price than lower prices. So if you have your bullish setup on your hands, and that could be here, if you miss the move, there's another fair value gap right there. In one of these two, you could have taken your entry if that was your model. But when this price action occurs, when you're looking at a live chart, not in hindsight like this, but when you're looking at a live chart and you're not sure how to cancel print, make a bullish case, make a bearish case. In this case, the bullish case is way stronger than the bearish case, and that makes the GU trade to the upside more high probability. And that's what you want to collect. You want high probability trades. And hypothetically, let's say this didn't happen and price just traded lower. Cool. Then you just take a -1. That is fine. Your stop loss should be good, like your risk management should be on point. If your risk 1% and your stop loss is here, you need to just lose 1%, not 2%. So make sure your risk management is on point and just journal. Just journal that. Cool. I had a bullish case that was stronger than the bearish case. It didn't work out. Try to just find things that you missed. If you didn't miss anything, cool. Then you journal as your edge. I did everything I could, was a -1. Cool. Up to the next one. You will probably take more than 100 trades over a trading year. So one trade like this, yes, it sucks to lose, but it's normal. And you need to lose to make money. Remember, if you have a 50% win rate, you need to lose 50 out of the 100 trades, 50 stop losses out of the 100 to make money. And here you have it. My framework to $1 million entry models. This is the exact framework now you can use to get over $1 million in funding by just finding your confluences in step 1, finding your entry model in step 2, building data on that entry model in step 3, and now you know how to build a case like a judge in step 4 to skyrocket your win rate and learn from your mistakes. If you like this video, consider liking and subscribing. Make sure to check out the links in the description to find the relevant videos, and also make sure you join the school and the Discord to get my daily outlooks. Stay updated on all the free material, and I hope to see you in the next one. Bye-bye. In this video, I'm going to show you the school model, my highest win rate entry model with a checklist so you can use it too. You can use this entry model to get funded, get payouts, and just skyrocket your win rate. I actually used this exact model to get my first funded account that eventually led it to over $1 million in funding and over 100K in profits. No time to waste. Let me show you how it works. The school model is a very simple concept. It relies on external range liquidity, old highs and lows, and internal range liquidity. And the first step of it will be price trading towards a old high or low. So in this example, a old daily, weekly, or monthly low. We tap it, and we break structure, and we go from external range liquidity, old low, towards internal range liquidity, a fair value gap. Vice versa for shorts. Price goes to an old daily, weekly, or monthly high, break structure, and then we go to the internal range liquidity. The core school model is very simple. It's a daily high and low. It's a 5-minute structure, and we target a 1 hour fair value gap. So this example, this is a daily high, this is a 5-minute structure, and we target a 1 hour fair value gap. Same here, we target a daily low, 5-minute structure, and target a 1 hour fair value gap. You can use also weekly highs and lows, monthly highs and lows, and instead of a 1 hour fair value gap, you can also use a 4 hour fair value gap, but the core model is this, and you can mix and match to see which one fits your trading style the most. And a few extra notes here. We go from external range to internal range liquidity. That means you are trading from an old high to a fair value gap. Most of the time that is counter trend, making it lower probability. But why not try to trade with the direction of the higher time frame, and also use market maker models here. So here you have a buy side of the curve. We go to an old high, and then we start a sell side of the curve. Market maker model, smart money reversal. If you're not sure what a market maker model is, I've dedicated a video to market maker models here on this channel. And let me share some extra secret sauce here. So remember this framework. Let's say with the rule here, trading with the higher time frame trend is better with the school model. Cool. Let's dive deeper here. Let's say we are here on a daily structure. So we are going up and up and up, and we create a daily bullish fair value gap here. Fair value gap looks like this: candle 1, candle 2, candle 3. Let's break this down. Daily bullish fair value gap has candle 1 high, it will be right here, candle 1 high, candle 3 low. So here you have an old daily high and an old daily low basically. But what if we can play the school model in this candle 3 low that is overlapping with a daily bullish fair value gap? Remember, we want to trade with the higher time frame trend. So once we trade into here, we not only take a daily low, start the school model, because we trade from daily external range liquidity to internal range liquidity. This is going to be a very small trade, of course. We're going back to a, let's say if here's a 1 hour fair value gap. This move will be the school model. You don't need to catch all the big moves. You just want to be a thief in the market, going in and out very fast and make your money. So when you have an overlapping school model, daily low, towards internal range liquidity, overlapping with a daily bullish fair value gap, there is where all the money is, and there is how you can trade with a higher time frame trend. That is why the higher time frame for buys is so important. So yes, you trade from external range liquidity to internal range liquidity, but maybe you can use a daily structure,
to trade in line with the higher time frame trend. And let's say this is a higher time frame daily high. Of course, you can trade from extra range liquidity back to intra range liquidity. Totally fine. But the highest probability trades are with the higher time frame trend. So you can use this framework to play along. Daily high and low, 5-minute structure, 1 hour for value gap, extra range liquidity to intra range liquidity. And here in my free school group, I not only share all my trade ideas and new frameworks I'm sharing, here you can also learn the exact school model. You go to classroom, go to start here, and there you have a full mini course, among other things, the entry model. So to make your first trade, you need two things. You need a location and you need an entry model. And the entry model is the school model. So go here in the school group, watch the entry model, and not only this, I have listed 30 examples of this exact model of actual trades I took. So right here, part 1, school model, literally trade executions on Twitter with the exact screenshots attached to it. And I won't bore you with all the examples, but just know that there are 30 examples right for the taking, where you can just look at this, back at this with real-time executions. And now you know how the model works and that you can find more examples in the school group. Let's look at some examples right now, breaking it down. This first example, look at NASDAQ at the 1 hour chart. And remember, this is what we want to see. Daily high low, 5-minute structure, 1 minute for value gap. And in this piece of price action, we just have a massive move upwards here on the 1 hour chart. And before we going upwards, we're never going up in one way. Like if we're going up, we're always retracing. We're always retracing before going upwards. And same here. I'm expecting price to go up. But before go up, I want to retrace in at least this for value gap. Even this for value gap or maybe the order block here. But this is the low-hanging fruit target. So the school model is played around this. So here we are at Thursday at the New York session. And Wednesday high is already tapped early in the day. So let's go to the 5-minute to see how this looks like. So here on the left, we see Wednesday high, right there, the Asian session, and it's already tapped at midnight. So the first step, the daily high, is already taken. I don't see very active displacement in the London kill zone. Most of the time, NASDAQ moves in the New York session. So I'm expecting the entry to be in the New York session. So I'm skipping the London session. I come back at 8, 9 a.m. Ideally at the open, 9:30. So let's see what we do at the open. We have displacement here from 8 a.m. But the structure is weird. Like we have a very small liquidity sweep right there, but you don't break down as much as like this price is a little choppy. So I'm waiting here. And if you already take your first entry, like let's say you want to tap it into this volume balance right here, stop above the high. Right here, you would have been stopped out, and that's fine. I rather wait for more clear structure later in your session when I see this kind of moves. So right here at 11, we started to move up and then aggressively start moving downwards. This is the structure I would like to see. And why I want to see this, like here, if we draw this out, it's a consolidation. Little liquidity sweep and then breaking down. If we see this, we have go lower and lower, lower, aggressive buys, aggressive sells. This is the model, the market maker model I want to tap into. Like this structure is not too aggressive enough for me. So this is what you always want to see. Remember, the framework, this is what you want to see. So if we copy this to a structure right there, this doesn't look to me like the structure. This looks to me like the structure. So let's see what we have. We have a 1 hour booster value gap as a target. We have multiple for value gaps. So there's all that question of which one do you pick? When I have multiple value gaps, I like to take in the first one, ideally in premium for a short, and then let my stop loss cover the rest. So in this case, I would take my entry order here at 12 at the lunch. It's a little outside the kill zone. So probably gonna need to hold this towards the PM session. Target, the fair value gap, the 1 hour value gap for a 1 to 2. So my stop loss now is allowed to trade into that upper value gap. That's nice. Yes, you are in drawdown, you're not at that sniper entry, but this is the school model. You don't want to be in, you want to make money. So let's see what price gives us. So we have a first nice reaction, but then we come back into the PM session. Looks nice. And here is where most traders panic. Because, oh no, displacement against your position, but you have a school model on your hands, daily high, market structure to the downside, and price taps into the top value gap 2 times, and then starts to break down towards the target. So, as expected, price could trade it to the top value gap. It did. So yes, you're in drawdown, it's uncomfortable, but this is how the school model works. And as the next example, we're looking at AUD USD on the 1 hour chart. And this school model works on both Forex, indices, gold, crypto, it works on all of them. So here we see we take out Tuesday low, right here, and also Wednesday low. And we are at Thursday, where in a kill zone. We're approaching London kill zone. So let's drop to the 5 minutes with day low being swept with a 1 hour bearish value gap. That's the target. Now let's see if we can find a structure to the upside. So what you want to see is price taking out the low, breaking structure for value gap or block breaker to the target. Here you want to enter. That's the goal. So let's see if we get that. Price, aggressive sells, aggressive buys. Awesome. This is great. This is exactly what you want to see. So let's wait for value gap. For value gap created, awesome. So the trade will be like this. Here's your entry. Price should allow to come back into these fair value gaps. Target 1 to 2, ideally overlapping with the fair value gap. You also can go deeper into the fair value gap, but if you can get a 1 to 2 like this is awesome. If you want your stop to cover the low, can be, but then your trade needs to be bigger. That's up to trader discretion. I like to take it like this. So see what price gives us. And we go to the target without a fill. So it can happen. You're the right side of the market, but you miss a trade. So in this case, you just miss a trade, you go back to the drawing board and you just go out for next opportunity. If you drop one time frame lower to the 1 minute to see if there was an entry there, well, here in this move, there was no entry, was the value gaps. The value gap here did not get tapped. The value gap here did get tapped, but this created the 5 minute value gap. So either way, 1 or 5 minutes, I wouldn't be in. So this is just a missed trade, journal it, and up to the next one. Here we're looking at ES at the 1 hour chart. And what do we see? We have a big, massive displacement right here, and we just rebalanced. And remember what I mentioned about the higher time frame trend. If you want higher time frame trend, you want to go long. It would be nice if you can long in a daily fair value gap. And daily fair value gap or fair value gaps overlapping with daily lows. Well, in this case, what I showed you right here. So if you have daily lows overlapping, you can use the school model in your favor because you already take out daily lows and then continue the trend to the upside. That's what we're going to do right here. So here we have a Tuesday low, Monday low, and Friday low. 3 daily lows, 3 daily sales and liquidity pools being taken out. And then we trade into the 1 hour fair value gap. So already your trade idea is activated once we hit one of these lows. You just wait for a 5 minute structure to form. So price trades lower, no lower. What time is it? It's the New York kill zone. You have the open here. And here is no displacement, right? There's no fair value gap. We trade even lower. And here I see aggressive sells, aggressive buys with fair value gaps. Awesome. So we have 3 daily liquidity pools taken out, aggressive sells, aggressive buys. So the trade's going to be in the fair value gap. We have a 1 hour bullish fair value gap here. I want to allow price to come back into this 5 minute fair value gap right there for 1 to 2. And then let's see what price gives us. Taps into it and then trades higher towards the TP point. And you can even refine this entry. And if you see my previous video breaking down the A+ setup, you recognize what's happening here. Here the example was from internal range liquidity to external range liquidity, from fair value gap to an old high or low. But these exact rules, a liquidity sweep in a key level, the key level is in the school model, the old high or low on the higher time frame, the old low. When we have that old low, you wait for the market structure shift, price coming back into the fair value gap or block breaker, ideally in premium discount or the OT area, and the tap into the old low is inside the kill zone. And then your drawn liquidity is in the school model, a old 1 or 4 hour fair value gap. A+ setup from external range liquidity to internal, and vice versa now from internal to external. If you have a 15-minute level, and yes, we have the school model here, but you have also an overlapping A+ setup here. So here's the school model, but here we are trading into a internal range liquidity pool. That means a fair value gap, 15 minutes to 1 hour fair value gap. 15-minute level, you can go to the 1 minute to find your entry, internal to external. External range liquidity would be right here. So this will be the school model entry. Let's see how you can frame an A+ setup around it as well. And I think you can even get a better entry. If we look here at the 1 minute, aggressive sells, aggressive buys, you have a market structure shift right there. Fair value gap 1, fair value gap 2, you could take your entry right there. Fair value gap 2, stop below the low, and your target would then be from internal to external for 1 to 3. So here you are with the school model, you're a little thief in the market. With the A+ setup, you could have taken a bigger trade, bigger stops, bigger TP, and price eventually hits that target. So here you have both an example of the school model and the A+ setup. So no matter which one you like to use, they both work. So here you have it, the school model, going from external range liquidity to internal range liquidity. Use this model to go to the chart, execute it, backtest it, build data so it works for you. In my free school group, I have the framework with 30 examples lined up on top of a complete course, so you can go from 0 to profitable very fast. And if you like this video, consider liking and subscribing, and then I'll see you in the next one.
In this video, I'm breaking down my 9:30 a.m. New York time opening range liquidity strategy called the FTS model. If you've been struggling with false breakouts or missed reversals right after the open and you missed the move, this video is going to change the game for you. Let's break it down. So what is the strategy? It's focused on the initial move after 9:30 a.m. EST New York time when the Wall Street and New York stock market opens. At 9:30, you wait for manipulation into liquidity, into an old low or an old high. It's called a liquidity sweep. And after that, you look for signs of a reversal to target opposing liquidity. And opposing liquidity will be an old high or low or a fair value gap. And basically, instead of reacting emotionally to this opening move, we know better and we wait for the real move. And this strategy works so well is because we're trading with the institutional order flow, not against it. Because at 9:30, when the stock market opens, the liquidity floods in, pushing towards liquidity pools. And where retail traders chase false breakouts and go short here, we let them get trapped in their shorts and wait for the real move to the other direction. And it's so stupidly simple because it's clean and repeatable. You don't need indicators or 15 different confluences. Just liquidity, displacement, and patience. Let's get into the step-by-step process. The first step of this model is the liquidity sweep. There's a liquidity sweep of two sell-side liquidity pools, where this is a session liquidity pool, very significant. And the second step is aggressive sells, aggressive buys, which we have right now with two inversion fair value gaps. So the V-shaped recovery, the aggressive sells, aggressive buys is present. When we have the liquidity sweep and the V-shaped recovery, the aggressive sells, aggressive buys, the third step is displacement, leaving fair value gaps and also inversion fair value gaps. One fair value gap here, also a fair value gap sitting right here. The fourth step is a market structure shift. The last swing high that made the low, that made the liquidity sweep happen before the move to the upside. That's this one. When that has happened, we call from this point a market structure shift. At this point, we also have a breaker sitting here, the up close candle, and also a bullish order block. So here we have multiple confluences stacking on top of each other. So where's step 1 and 2, the liquidity sweep and the smart money reversal, the aggressive sells, aggressive buys, creating high resistance liquidity, meaning that this liquidity, these lows are protected. Step 3 and 4, the displacement leaving fair value gaps and the market structure shift, is price showing its hand that we want to reverse to the other direction. This signature in price shows that we want to go from lower to higher, from bearish to bullish. With that in mind, we are focusing on an entry in a fair value gap, an order block, or a breaker, or you can also take it in a change in state of delivery. From all these concepts, there's dedicated videos here on this channel. We target a 1 to 2 risk to reward minimum, and it needs to be an obvious liquidity pool what we're gonna target. An obvious liquidity pool would be this high. This is previous day's high right here. And ideally, the trade is taken in discount of the range. So when we let price run, price runs all the way to the upside. And at this point in time, you think you have missed the move, but here's where the power of this entry comes in. If you use the premium and discount, that means swing high to swing low of the displacement range, then you ideally take longs in discount of the range. For shorts, you take shorts in premium of the range, but in this example, it is discount of the range. So in this area, it's a 50% is discount of the range. We have a fair value gap, an order block, and a breaker. That is a significant area for price to come back to. So entry could be in this fair value gap, targeting the obvious high for a 1 to 2. And when you have a 1 to 2, see that also our stop loss covered a massive part of the fair value gap, but also the inversion fair value gap down here. And then we let price do its thing. And in just over an hour, we have a clean TP. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. So this is the strategy. Step 1 is a liquidity sweep, then a V-shaped recovery, aggressive sells, aggressive buys. Step 1 and 2, creating high resistance liquidity. That's what we want to defend our position. We have displacement, leaving inversion fair value gap or fair value gap with a market structure shift, the last swing high that made the low. Step 3 and 4 is the market showing its hand that we want to go in a certain direction. In this case, that is higher, where retail traders are trapped in shorts.
And then 5 is entry in a retracement, fair value gap, order block, or breaker. It's all present here. Ideally in the bottom 50%, that is discount of the displacement range, swing high to swing low, and target a 1 to 2 to an obvious liquidity pool, and that was the previous day's high. And now we know the strategy. Let's look at some examples of the past week. In this example on this Monday, there is a equal high created at the London session, and then we wait for the New York Open to happen right here. At the New York Open, we see the second step after the liquidity sweep, we see the V shape, aggressive buys, aggressive sells, making these highs high resistance liquidity. And the third step is displacement, leaving fair value gaps right here. And we have a market structure shift, that is the last swing low before sweeping the highs. And now we have the market showing its hand that we most likely want to go lower. Where do we go lower to? Here there are some relative equal lows from the Asian session. It's going to be the draw on liquidity. So after we created the liquidity sweep, the V-shaped recovery, high resistance liquidity created, fair value gap, market structure shift, also inversion fair value gaps. We look for an entry in the retracement, fair value gap, order block. Order block is sitting right here, or a bearish breaker. And if you have the displacement range from swing high to the most recent swing low, that is right here, then you can take your entry at the start of the fair value gap for a 1 to 2, and that price do its thing. Just like this. In this next example on Thursday, there's a relative equal lows created here in the PM session from the day before. And at the New York Open, right here at 9:30, we see that we sweep the liquidity. We even go lower one more time, creating another liquidity pool, creating high resistance liquidity. Then we have aggressive sells, aggressive buys, the V-shaped recovery. There is displacement leaving fair value gaps. There's a market structure shift right here. That is the last swing high that made the last low before going up. And the market now showing its hand that we want to go up. Then entry in the fair value gap, targeting an obvious high. Zoom out. A very obvious liquidity pool would be the previous day high, that are the relative equal highs sitting right here. Right here for a 1 to 2, target previous day high, entry in the fair value gap for a 1 to 2. And price going to the target after just 50 minutes. And this next example, we're looking at the Wednesday. And here at 9:30 a.m. EST, New York time, we sweep liquidity. Then we have aggressive sells, aggressive buys. And then when this swing high is violated, we have a market structure shift sitting right here. Then there's no clean displacement leaving fair value gaps or IFVGs in this area. That starts later, close to 10 a.m. right there. So then the entry is going to be in the fair value gap or the order block here or the breaker, targeting an obvious drawn liquidity. That's going to be relative equal highs right there. So as you can see in this day, the model did not give an exact entry, which is very important, that no strategy has a 100% hit or win rate. So at this day, on this Wednesday, the model was almost there, but the entry did not come. So we missed the move and we wait for the next day for the next opportunity. And some other helpful tips so you can execute this strategy even better is there needs to be significant liquidity pools. That means higher time frames, relative equal highs, relative equal lows. There needs to be a clear draw on liquidity. Also, there needs to be a clear manipulation that is a fake move in the opposite direction of the actual move. And there needs to be other confluences present, like the fair value gap, the order block, the breaker, the SMT, the New Week opening gap. And I've dedicated videos on all those confluences here on this YouTube channel, but also in the ICT Bible. And I will leave the ICT Bible inside the description. If you got value out of this video, make sure to check out the video that's now appearing on the screen. Because in this video, I show you how I use this exact model to gain over $450,000 in funding in just a few days. Thank you for watching. Don't forget to subscribe for more, and I'll see you in the next one. It has come to my attention that most traders are completely blind to when the most important reversals are actually supposed to happen. They know how to find liquidity, they know fair value gaps and order blocks, but they're doing it with zero understanding of timing. But what if I told you that the most successful traders I know, including myself, have built their entire trading career around one single 4-hour candle that opens around the New York Open? For the past 2 years, this simple time-based model is all I've used to generate multiple 5-figure months and consistent funding. And in this video, I'm going to show you exactly how it works. We're going to break down the 10 a.m. game, how to frame setups on the 50-minute time frame, and how to find entries under the 1 minute. No time to waste, let's get into the video. I've traded this setup for multiple times this week with almost all wins. And many people ask me what this massive candle is. It's an indicator. If you go to indicators, type in higher time frame power 3 from 2 degrees. If you click on that and go to settings, make sure it's set to the 4-hour time frame. So what we're going to do is we're going to trade this massive 4-hour candle. And no, we're not swing traders. We're not going to hold this position for multiple days or multiple hours. We're going to use this candle to execute on the 1 minute time frame. First, you need to understand the autonomy of a candle. This bearish candle opens right here. Then it trades higher and higher towards the high of the candle right here. And then it trades lower towards the low of the candle and then closes right here. So on the chart, that looks like price trades first here, then it goes up. And then when the top is set, most of the time this top wick is formed when we sweep liquidity or trade into a higher time frame for value gap and then start trading lower towards the low of the candle and then close right there. Now you know the autonomy of a 4-hour candle. The first step of the 10 AM game is predicting if the next candle is going to be a bullish or a bearish one. When you complete step 1, based on a prediction, let's say it's a bearish one, we anticipate price to make a bearish candle. That means first in step 2, it consolidates. Then it goes higher, manipulating. Manipulation happens towards a key level, a higher time frame for value gap, and then starts creating cell structure to create the body of the candle, the distribution of the candle. So where we use the 4-hour time frame for step 1, we use the key level on the 15 minutes. We want to see at least a 50-minute PD array being hit. And the structure that's being drawn right here is on the 1 minute time frame. So step 3 is going to be finding entries inside that cell structure on the 1 minute time frame. So we go from 4-hour to 15 to 1 minute. That's the 1, 2, 3 you need to remember. And yes, this looks like a children's color book. The only thing I care about is giving you guys as much value as possible. So if you're familiar with the ICT Judas swing, the accumulation, manipulation, distribution, or in other words, the power of 3, that is what we're playing right here. So we have the 4-hour candle. Let's say we anticipated a bearish one, accumulation, manipulation higher, and then distribution lower, creating the body of the candle. And our goal with the 10 AM game is not to catch bottoms or tops. What we want to do is see this reversal happening and try to frame our entries around here. My favorite entry is going to be in the second PD array. And I see the first PD array as more as a confirmation to avoid being faked out to the upside. And the PD array I'm looking for here is an order block or inversion for value gap or a normal for value gap. And then when I see reaction from that, there is where I'm going to take the entry. Let's see that in action right now on a trade I took. But before we go there, I'm not the only one winning with this model. My students are trading the 10 AM game every single day and they're getting consistent wins, consistent payouts, just from playing the same simple entry model you're learning right here. Just working their accounts up, getting funded, getting payouts. Inside the Discord, I share a 10 AM game entry model checklist. So every morning when New York open, you can use this checklist to trade this model yourself. I'll leave the link to this checklist and the Discord inside the description. And yes, it's free. So for this example, the first step is predicting if the next 4-hour candle, this is the candle of 6 AM, we're going to predict the next candle, the 10 AM game, if it's going to be the up candle or a down candle. And this example, it's harder than usual because we sweep liquidity here with a 6 AM candle. And we also leave a 4-hour bullish for value gap behind right there. So there's 2 options here for what can happen at 10 AM. One is we open into the value gap and trade higher, or we reverse from this liquidity sweep and then trade lower. So with this neutral bias on the 4-hour time frame, we're going to drop to the 1 minute time frame to see if we can find that AMD, that accumulation, manipulation, distribution. So every day at 10, mark out the 10 AM open. I mean, because we play the 10 AM game, we need to have our friend with us as well. So mark out the opening price. The indicator does it for you as well. Let's see if we accumulate at the start of the 4-hour candle. And I would say we do. We accumulate. There's no clear displacement, so we wait. Right here at 10:38, we sweep some short-term liquidity that could give a potential reaction. And no, it does not give a reaction. We need to see displacement lower if the entry model is going to happen. And here we see something interesting happening. We see a change in character, a market structure shift, because this swing low, the last swing low before the high, is now violated. So you have a breaker here, an order block, also a inversion for value gap sitting right here. So this could be that first array, the test array, to see if you can get this structure, the confirmation, the aggressive buys, aggressive sells. This is the confirmation. When we react from there, then here is where the entry is going to be to the downside. Price trades back into the inversion for value gap and then starts trading lower, leaving another for value gap. So this for value gap is the second PD array. So this is going to be the entry. Entry in the for value gap. Low hang fruit target is going to be this low, the 10-12 low sitting right here. Target that, stop above this high. You can also put it above this for value gap for a 1 to 2. Both is fine. It depends on your own risk management. And then we see this trade chilling a while, and eventually trading to the draw on liquidity. So we have the 10 AM open. We were neutral on our bias. We wait for what price is going to do. We went up and up and up and up and up until we took some short-term liquidity. We have an aggressive buys, aggressive sells. First PD array, second PD array is your entry to a low-hang fruit draw on liquidity. And there you have the 10 AM game. For the second example, we're looking at a very bullish chart. Here at 6 a.m. I have a big expansion candle. So it wouldn't surprise me if the next 4-hour candle is going to be a bullish one as well. I don't like shorting this. So we're going to look for a bullish 10 a.m. game. That means price opens, trades lower into a key level, and then starts the buy structure, the accumulation, manipulation, distribution. So it ends to step 1. What is the bias? Is bullish. Step 2, look for key levels. We have a 50-minute bullish fair value gap here. So we could use this as a point of interest, and we could use this 4-hour bullish fair value gap as a point of interest. So when a candle opens at 10 a.m., you mark out the opening price, and we want price to trade lower towards a key level. So we're waiting for that. And here you see a very aggressive move downwards. If we zoom out, this was the 50-minute bullish fair value gap. So here, from this 50-minute bullish fair value gap is already an area where we could anticipate buy structure to start. And buy structure looks like aggressive sells, aggressive buys, PD array 1, PD array 2. This is what we look for in a reversal during the 10 a.m. game. The other one was the 4-hour bullish fair value gap here. And this is a nice example why you should wait for that second PD array. Here, we trade into that 50-minute bullish fair value gap, and then we created first bullish fair value gap. We tapped into it and trading higher. But you need to wait for that second PD array. There was no second PD array here. There was no fair value gap. And you see that price is just trading lower. So this one would have stopped you out. From this point, we see some reaction. We tap here at 1140 inside the bullish fair value gap on the 4-hour, and we create buy structure. Change structure, see a fair value gap here, also a fair value gap right here. Because we moved away so aggressively, I'm not expecting price to come back here. So I'm anticipating this to be a breakaway gap. And we don't need to trade the first PD array. So let's see if this fair value gap or this fair value gap is respected. I'm just waiting for the second fair value gap. And a second fair value gap is being formed right here. So for this trade, I'll put my entry here. My TP, low hang fruit, is going to be the high right here for a 1 to 2 below this swing low. And it reaches TP. Step 1 was a bullish 4-hour candle. Step 2 was an accumulation, manipulation lower, and then creating 1-minute buy structure to the upside. For the entry, wait for PD array 1 to confirm that we indeed are starting the buy structure, and take your entry in PD array 2 to get your entry. And this is the 10 a.m. game, the model I play every single day. If you want to trade this live with me for free every single day, check out the link in the description, join the Discord, and I see you on the inside. This is everything I had to share with you for today. But before you leave, make sure you check out this video right now. I'm putting on the screen, because if you watch this exact video together with this 10 a.m. game, you're going to grow even faster. Thank you for watching, and I see you in the next one.
I made over $100,000 in profits with ICT trading, and turtle soups are a big part of it. It's an advanced ICT model. In this video, I'm going to show you the exact frameworks I use to skyrocket my win rate using turtle soups. I'm going to show you the exact 2-step model and how you can use this to actually make money. No time to waste. Let's get into it. The turtle soup model is an advanced ICT model. And what it does, in an uptrend, price trades upwards towards a clear draw on liquidity. And before it goes to the draw on liquidity, you see the prices start to consolidate, leaving short-term sell-side liquidity. And what a turtle soup does is it takes that short-term sell-side liquidity before continuing the move. So price basically takes extra liquidity first, and then targets the opposing liquidity. Same for a short example, price trades lower towards a clear draw on liquidity, but before we go there, price takes out short-term buy-side liquidity before continuing the move. So what happens a lot of times is you get stopped out before the real move. And this video, I'm gonna exactly explain how to anticipate this and how to avoid getting stopped out before the real move using turtle soups. And why is trading the turtle soup so important? If you've seen the liquidity video on my YouTube channel, you have seen that there is a high resistance liquidity and low resistance liquidity. And high resistance liquidity is when price sweeps liquidity before making the move. So in the short example, we sweep short-term highs before starting to make the shift lower, market shift, fair value, order block, all that stuff. This is high resistance liquidity. You want, if you take a position, that your position is defended by high resistance liquidity. So if you take a short, you want to be defended by this. If you're taking a long, you want to be defended by high resistance liquidity. That price sweeps some form of liquidity before the actual move. And next to high resistance liquidity, there's also low resistance liquidity. And low resistance liquidity is when we don't take out any liquidity before the actual move. And you want to attack this. So let's say we trade into a key level, and inside that key level, we create high resistance structure. Where it is, because we take liquidity before the shift up. There is where you have a very high probability setup on your hands. Because you have high resistance liquidity creating a key level. You have a market structure shift. In this displacement, you have a fair value gap. You have an order block. Most of the time, you also have some form of SMT or an inversion fair value gap or a breaker. So from this area, you have high resistance liquidity defending your position, and we are targeting low resistance liquidity. That's what you want.
And I created a free training on how to go from emotional trading and blowing accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight value, so make sure you check out the link in the description to watch this training as soon as possible. So going back to the turtle soup, is what happens is you have a bullish bias and you have a high risk liquidity created before the move. So when this happens, you can already take a move here, but especially in this move is where you have high risk liquidity defending your position, and you can just take your trade inside a order block for value gap breaker right there. You have two entry possibilities. Same here for the bearish side. We have extra risk liquidity, we have high risk liquidity created, and we're targeting some form of low resistance liquidity. Let's say a very obvious draw on liquidity. And it's an advanced concept, but I'm gonna break it down in just two simple steps. Step one, you need to have a clear draw on liquidity, a higher time of draw on liquidity. Because when we are in an uptrend, we need to have trust in, okay, this short-term liquidity soup of extra range liquidity is just a turtle soup and not a reversal. So to have that, the first step is to have a very clear draw on liquidity. And there's an entire blueprint on how to identify liquidity here on this channel. But the quick summary is this. On the higher time frame, daily, weekly, monthly, you need to have trending conditions. And what you do is you trade from internal to external, from a value gap back to an old high, for value gap back to an old high. And once price is there, then you have a very clear bias. When price comes here, your draw on liquidity is going to be the extra range liquidity. So when price comes into this fair value gap, here is where you can pay attention, because price at a lower time frame, zooming into this price action, price goes down into that fair value gap, and then it goes upwards. And what you can anticipate perhaps is a turtle soup before the real move. This on the lower time frame right there. Similar for bearish trend, price goes from internal to external, fair value gap to old low, fair value gap to old low. When price comes here, price goes lower, lower, lower. It can consolidate a bit, and then after turtle soup, it goes to the drawn liquidity, the old low. So step one is identifying your higher time from drawn liquidity. So have a clear target where we want to trade towards. The second step is trade turtle soups in the direction of the drawn liquidity. So if your drawn liquidity is higher, you want to look for bullish turtle soups like this. And if you're bearish, you want to look for bearish turtle soups. And now you might wonder, how do you know it's a turtle soup and not just a reversal? Because when price goes up and up and up, you still have the drawn liquidity higher, and it starts to just consolidate. And after that, it doesn't do this, but it just goes straight lower. How can you anticipate it's going to be a turtle soup? And here is my exact framework for this. You want to look for high probability turtle soups. And there are three components to a high probability turtle soup. One is SMT. SMT is a cracking correlation between correlated pairs. So let's say we have NASDAQ or ES, Euro US dollar, GBP US dollar. And when you have correlated pairs, they need to move in tandem. So if NASDAQ makes a lower low, you want the ES also to make a lower low. When they stop following each other, that means one makes a lower low, but the other one doesn't. There's where you have an SMT on your hands, and it could indicate a potential reversal. So that's for SMT. The turtle soup needs to be made in a key level. And what's the key level? It's an old high or low, extra range liquidity, or inter-range liquidity. So here in this example, we see that the price makes the turtle soup inside a fair value gap before continuing to move upwards. You can also have a turtle soup at the highs. So when we have the old high and we maybe gonna trade lower, then you see this happening. So we have already swing high, and then we sweep the liquidity one more time, making a turtle soup before going higher. And it's gonna be like a rejection candle with a wick there. And you can recognize turtle soups in the smaller body and the bigger wick. So it's a rejection candle. So you will see that happening right here. So inside the key level, you will see that you will see a rejection candle. Same here when we have a turtle soup at the highs. You'll see at the highs, we sweep that old high before start breaking lower, making a turtle soup. So we have SMT in a key level, internal extra range liquidity, and we have time. Because what happens is, what if price already moves higher? You think you missed the move. And then outside of a kill zone, just sure what kill zones are, make sure you check out this video. Outside of kill zone, price makes already some move, but it starts to consolidate. Then inside a kill zone, let's say London kill zone, New York kill zone, there is where you can anticipate price to create turtle soup. Because what if this is Asia session? If you want to play your classic Judah swing, your accumulation, manipulation, distribution, then in Asia consolidation, and you have a key level below the structure, then you can anticipate a turtle soup there as a potential low of the session. And of course, this whole example is vice versa for bearish turtle soups. So the two-step framework for turtle soups is identify a higher type of drawn liquidity, internal to external or external to internal. And step two is trade turtle soup in the direction of the drawn liquidity. How can you spot a high probability turtle soup? It's SMT in a key level and using time. And now it's time to see some examples in action to train your eyes. Let's go. Here we're looking at ES at the 4-hour chart. And on the higher time frame, what do we see? What I see is that we are in a bullish trend, bullish order flow. So I want to look for bullish trades. So if there was a turtle soup, I'm looking for a bearish turtle soup, taking out some form of lows. We don't need per se a turtle soup, but we want to trade inside the kill zone, inside time, because we want to trade high probability trades. So now here, this is the London session, and for ES and NASDAQ, these are US indices, so they move in the New York AM session the most. So we're gonna wait for that. So let's fast forward to the next candle, the 6 AM candle, and here we see a massive move downwards. So at this point in time, if you would watch this live, you are anticipating potential lower price coming in, and that's totally fine, because beforehand, you of course cannot see the candle being printed, so you need to wait for this. So here you have, okay, we are very bullish, we are trading lower. If we start creating fair value gaps lower, so that means, let's say the next candle, it's going to be a bearish one, then you potentially have a structure shift on your hands, that we're just going to trade in a fair value gap and then trade lower. That's the case, but you need to look at how the candles are printing. So when we see this happening, then let's go to the lower time frame, so let's say the 50 minutes, to see what we can do here. So if we remember the turtle soup depiction, this is what you want to see. So what I'm seeing right now is we have a consolidation. Look at this, not very trending conditions. And what is this low? This is a daily low. So now let's see what happens inside this price action. We leave behind failure swings. We have a current PM session high. That's a low probability high, so it's nice to target. But there is nothing here. Like now we are at the open and there is no bullish signal at all. It's just bearish. We wait just for the next candle to print. So at the open, when this happens, you just wait. You have basically now two trade ideas. One is price just continuing lower. And that's where it's very important to see how we trade inside key levels. It's 4-hour and bullish order book. So at this point, we see price creating some green candles, but we still have premium rates here. We have the order book here with a value gap. So let's see what happens there. We just need to see the candles being printed. So now this is interesting because we're now creating bullish fair value gaps. So we're now seeing here is a bullish fair value gap, and this is a bullish breaker right there, inversion fair value gap. So this area could mean longs. So I'm not going to take blindly longs because we still can just react from this fair value gap, but we could have a turtle soup on our hands. We're inside the kill zone and we are in a key level, potentially creating a reversal. And this reversal on the 50-minute looks like a turtle soup on the 4-hour. So let's see what the next candle does. So here, this signature price, we trade into the fair value gap and the bodies are closing above it. That's a signature price that I want to go long. So in this candle at 12:30, I would already be long right there. Well, where do I want to target? Low-hanging fruit is of course the PM highs here. If you go to the left side, there's lots to rebalance. I want my stop loss to target the last discount array. That's going to be this tiny value gap down here. So right there for a static 1 to 2. Let's see what the next candle does. So we come back into this again. And what do you see here? Do we see another turtle soup? Yes, we do. So inside this lower time frame key level right there, there's some accumulation. And we take out this swing low before the actual move. So here we have a lower time frame turtle soup inside a higher time frame turtle soup. So here we have a little drawdown, turtle soup, and then price comes back here to the order block, and price starts to move towards the TP point. So here we went from 4-hour internal to external, and look at the 4-hour right now. This is a 4-hour turtle soup. Right here we sweep this low, and then we start breaking up upwards. And not only this, you have here a very nice entry model in your hands as well, because now you have a 4-hour bullish value gap and a bullish order block where you can trade off from as well. So the next day when price comes back in that area, you can already look for longs. The price comes back to the value gap, and what do you see here? You see Asia lows right there. Here you see also out of the kill zone lows. So remember, time is a very important topic inside turtle soups. So you see here relative equal lows right there. And look at this in the PM session. What do we sweep? A turtle soup right there. So not only do we have a turtle soup right there, also we have a turtle soup right there. And we start to trade higher. You know, for a high probability turtle soup that you need key level, you need to have time, and you need to have SMT. So now let's look at an example on SMT. On the left side, you have NASDAQ. At the right side, you have ES. So two correlated pairs, so they need to move the same. So here at the lows here, you see that the Thursday 6 p.m. candle takes out the previous low, but here we don't do that. So here at the bottom, there's an SMT. It's outside the kill zone, so there's nothing to do here. But what we want to look for is SMTs in key levels. So when we display upwards, we leave here a 1-hour bullish value gap. And we zoom in here. What do you see? We have here a London low, 2 a.m. low, inside a key level. And here, during the start of the New York session, we tap into the value gap, we don't take out any lows, and then we trade higher. But at the same time, yes, the correlated pair in that same 1-hour bullish value gap does take out the London low, creating a SMT before the move higher. And not only is this an SMT, ES just made a turtle soup. So when one of the two makes a turtle soup and the other one, you have an SMT on your hands, so you know that there's probably some short-term shift on your hands. And you see that here, like it looks like we're gonna trade lower, but then boom, we trade higher. That's because we have a turtle soup and SMT inside a key level, inside a kill zone. After the push right there, we have another fair value gap created here, and we have the lunch low right there, and we sweep that with this low right here, and that same low does not get taken out on ES. So there's already an indication that this is going to be a high resistance low, that we're not going to take this out. And maybe look at the time right here at the bottom. It's Sunday Asia low. So this is of course not a setup what we're going to take, but later in the day we are going to use this information that is probably a protected low, because there's already a liquidity sweep, a turtle soup inside a key level. So once we approach the New York session here on this Monday, we anticipate this low to be protected, and we just want to trade from internal to external. So here we have a 1 hour bullish value gap, and we want to trade towards an old high, take this high or this high. So with this in mind, you can look for bullish price action. So let's drop to the lower time frame to see if we can find an entry. So here we look at NASDAQ at the 5 minute, and here was the SMT low right there. Now we have a clear draw on liquidity, that's this high right here, the PM high, and we also have another high right there. A very bullish bias. So let's see if we can find bullish structure. What do we see here? We have a turtle soup. We take out some liquidity before the real move. And it's nice because we want to have high resistant liquidity. We take out some liquidity before the real move. And price comes back to the order block right there. And then we trade high, creating a fair value gap. I see 2 fair value gaps right there and right there. So for an entry, we know, okay, this is a protected low. So we don't want to come back there. We want to take out highs. I want to take the first fair value gap, put my stop loss below the other one for a 1 to 2. Well, let's say we're going to trade to this high for a 1 to 3. We only do 1 to 2 to make a lot of money. So let's just stick to 1 to 2. See what price gives us. We get tapped in. We come back here to that fair value gap right there. So there's some drawdown here, very scary. And as a chop, we get the TP. And as you can see, we almost got stopped out. This is very important to have a good stop loss. And the first high got targeted very quickly, just in 1 candle. And this took a little longer. It was a very uncomfortable hold. But the reason I want to show you this example is that most trades are not as clean as you see online. Most trades, you are around your entry for a long time. You are in drawdown for a pretty long time. But using these frameworks that you know, okay, this is a high resistance low, so we don't come back lower. We have a order block sitting right there. And this order block should not be violated. And we don't, because we are closing right there. And yes, you can say this is a little luck, and maybe you get stopped out in this trade, and the next trade you get a win. It doesn't really matter. You don't need to win all your trades. But just using these turtle soup frameworks, this is what I use to make a lot of money. So you might use these exact frameworks as well. And here you have it, the advanced ICT turtle soup model. This framework is what I use to make a lot of money, and now I've shared my secrets with you. If you got some value out of this video, if you like this video, make sure you like, subscribe, and leave a comment down below what you think of this video. This is all I have to share with you for now, and I hope to see you in the next one.
What if the only thing that's standing between you and $500,000 in funding isn't years of screen time, but one single entry model? This is not a hypothetical question. One of my students, Sil, who I've been mentoring, just sent me that he crossed over $500,000 in funding, starting from scratch. He went from zero to one of the most successful traders I've ever seen. Out of immense gratitude, he gave me the permission to share this exact entry model with you for free right here. I'm going to give you his complete checklist, the exact things he's looking for in the market every single day to extract thousands out of the market. To do that, we're going over his exact entry model, and he's going to explain exactly where he looked for and actually applying it on a live chart. This is the most special videos I've ever shared with you, so make sure you stick to the end. No time to waste, let's get into it.
Okay, just before we get into it, I'm going to talk about the framework and the checklist that I use before I look at any trades. Number 1 is the higher time frame bias, the daily and the 4 hour. The daily structure must show bullish intent. Last daily candle closes bullish, or there's a sweep of a daily low. 4 hour candle aligns with bullish bias, a recent 4 hour close to support long, and the market is not consolidating. Number 2, liquidity sweep. A recent low has been swept. Stop run is very visible. Sweep takes liquidity below prior swing low, not just noise, and the sweep leaves a strong rejection wick. Number 3, structure shift, the confirmation. After the sweep, 4 hour prints a bullish close, reclaiming structure. The bullish close is very strong. Market shows no immediate bearish continuation after the sweep. And number 4, which is the execution. Usually I'll enter after the next 4 hour candle closes bullish after the sweep has happened. Stop loss is usually placed below the wick that performs a sweep, or below the candle that closes bullish. The target is normally a draw on liquidity, old highs, clean levels. And finally, when not to trade. When there's no valid sweep. 4 hour fails to close bullish, or the daily closes bearish below sweep zones, and also during any major high impact news.
If you want to become profitable as soon as possible, you need to join the thousands of others in the school group, Market Masters. If you go to the classroom in the school group, there's a 5-day getting profitable challenge to make sure you complete that. And after that, there's not only a 5-day challenge, but a complete roadmap course with a step-by-step program on how to become profitable, from the trading pyramid, psychology, trade plan, getting funded, entry model, everything is there. And this is not all. Live trading every single week. And on top of that, there's also a Discord. And inside this Discord, there are many other traders crushing it. I share my insights every single day, from outlooks to trade ideas to concepts. So make sure you check it out as well. I will leave the link to that in the description. And now let's get back to the video.
So what I'm going to do is show you basically how I identify setups using my model and what makes me press the button, what exactly I'm looking for. So on the chart here, we have the German 40, the DAX, and we're looking at the weekly time frame. So basically what I start is by looking at the weekly or the daily, depending on where the sweep happened. In the situation we had where the current weekly candle swept the previous low. So from here, I mark it up, then I drop down to the daily, then I start looking at how this sweep happened and what was the reaction after the sweep. So you can see we swept the low here and there was a nice rejection. From here, I drop down to the 4-hour, and this is basically where my setup happens, and this is where my execution happens as well on the 4-hour time frame. Everything happens on the higher time frame. So what I'm looking at is what the reaction was after the sweep. As you can see, we had this nice rejection here, and then from here I'm waiting for the next 4-hour candle to form. That 4-hour candle is what I like to call my MMBL signal candle here. So from here, I am looking to see how this candle closes. If the candle closes bearish, then this trade is no longer valid. But if it closes bullish, and this is where I start hunting for my entries. So in this situation, we had a bullish close here. So from here, I would then be looking to enter a trade, a long position, from this candle close, targeting a high. So I normally like to risk 1%. For example, it will be, stop loss will be just around here. And my target could be either this high here for 1 to 2, or you could go for 1 to 3 here, or 1 to 4, depending on your risk tolerance. Okay, so that's just a simple example of how I look for my entries. Okay, so again, on the high time frame, I look for a liquidity sweep. On a high time frame, could be the daily, could be the weekly, but it has to be a high time frame liquidity sweep, nothing lower than that. Then from there down to the 4-hour, where I wait to see how the candidate performs the sweep, reacts. Normally a nice rejection like this indicates the price wants to reverse, but then I also wait for the next 4-hour candle to form and see if that closes bullish or bearish. Like again, if it closes bearish, the setup is no longer valid. But if it closes bullish in this situation, then I start looking for my trades. I wait for it to finish, and then after that, I then take my entry, stop loss below the candle, I tag it in a 1 to 2, 1 to 3, or 1 to 4. Basically, I like to go from liquidity to liquidity. So if liquidity is in swap here, I like to target the next liquidity zone, which in this case is up. I have got another example here on the US 30. Again, on the high time frame, I'm looking to see how we swept the previous candle. So in this situation here, nice sweep here, and also a rejection. We swept this low and also all these lows to the left. Then I'm dropping down to the 4-hour to see how we react from there. We had a nice rejection. After this rejection, I'm still being patient. I'm not going in yet. I'm waiting to see how the next 4-hour candle forms and how it closes. Does it close bullish? Does it close bearish? Stronger bullish close obviously is a high confirmation for me, but in this situation we had a rejection here, but it still closed bullish, so that is still good for me. So what I start to do here is I would wait for that candle to finish and then start hunting for my entries. Again, same detail, just below the candle here, risking 1% or whatever your risk tolerance is, and then I'm targeting a high. So in this case here for a nice 1 to 4. So same detail. So this is basically exactly what I look for in all my trades using the exact same model. I'm waiting for a high time frame liquidity sweep, daily or weekly. Then I drop down to the 4-hour, wait for a nice rejection, then wait for the next candle to form, see if that forms bullish or bearish. If it's bullish, that gives me kind of confirmation. Then I take a nice entry targeting a draw on liquidity. This is just a short, simple explanation of how the model works.
Give the microphone to Mr. Funding, Mr. 500K Funding. Followed everything I told him, like to the T. Like, I'm gonna create my own model, and I was like, let's do it. And it's insane, and I love it, and people love it. So many DMs from people wanting to hear this model. So here it is. Still, take it away.
Thank you very much, Dion. That was very, very generous of you for the intro. So today is more of like a continuation of the previous explanation, and obviously then I'll dive onto the chart as well to show some explanations of trades that I took, why I took them. So one of the first thing I'm going to do is obviously talk about the model itself. Like Dion was explaining, obviously I started my trading with Dion. He taught me ICT concepts, which I really, really loved. And I started using that in the early stages of my trading journey. But I just wanted more. I just wanted to do something more, something that was more personal to me, to the way that I trade and what suits me as a person and my personality. Because remember, trading is all about personality as well. So I decided to come up with a model for myself, which means I don't have to sit on the chart all the time. So I basically created this model on a high time frame. It's basically a high time frame model. Some of the stuff basically checklists that I go through before I even take any trade, just by staring at the chart, is number one, there has to be a high time frame bias. I am mostly into buys. I rarely take sells unless, of course, it's very, very obvious. But in most cases, when the market is selling off, I just sit on my hands and I wait for a buy structure to form. That buy structure has to be on the daily 4-hour minimum, because that's where my execution is. Weekly, I don't really go on to the monthly, except obviously in exceptional circumstances, more weekly, daily. I mostly look for it on the daily when I'm trading during the week, and obviously at the start of the week, then I look at the weekly candle to see how we perform in there, or sometimes in the middle of the week as well. So there has to be so number one, there has to be a higher time frame bias. The daily structure must show bullish intent, and the 4-hour has to align with that bullish intent as well. Sometimes I take trades even when the previous daily candle is not bullish. And I'll explain why. So I basically have two setups. The first one is what I call my first setup, which is the 5.0, and that has to be where the previous candle is bullish, previous daily candle is bullish, and the second one is my 5.0A, which the previous candle doesn't have to be bullish. As long as the 4-hour is bullish and there's a confirmed sweep on it, then I can take a trade. The next one is there has to be a liquidity sweep, either on the daily, weekly, or at least the 4-hour. If we have a bullish move and the previous 4-hour candle does not get swept, and I sit on my hands and I don't take the trade. Obviously, there has to be a confirmed structure shift after the sweep, which means either the 4-hour candle that does the sweep closes bullish, or the next candle closes bullish. Obviously, my execution is on the 4-hour. And again, when I don't take a trade, finally, is if obviously those setups don't align. No previous bullish daily candle, no previous 4-hour candle, or the candle that performs the sweep fails to close bullish, then again, I sit on my hands. Without further ado, I'll just dive onto the chart. So yesterday on the Discord, I posted what I was looking at on US 30 DAX as well. Also NASDAQ I looked at, and also CAD JPY. So if we start with US 30, so obviously the previous daily candle last week, we could see that we had this huge sell-off here, which was on Friday. So naturally, I was just waiting to see how we opened the next on Monday. So coming to Monday, so obviously this candle here, bearish candle here, basically swept all this lows here, all the way down to here, which is good for me, which means we've taken a lot of liquidity and there could possibly be a reversal going forward. So if we then drop down to the 4-hour, this is exactly what I was looking at. So I started off by looking at this rejection candle here, which is great. But that was on Friday. And then over the weekend, obviously Saturday and Sunday, we had the market open quite bullish. But for me, even though the market opened bullish, there was no initial sweep. So in this situation, I would just wait and sit on my hands. Obviously, that was Sunday night anyway. But come Monday morning, in the early hours of Monday morning, we had this bullish candle. And then this 4-hour candle here came down and swept liquidity. So that was my first confirmation. So remember I was saying, even though the previous daily candle is not bullish, normally this one has to be bullish for me to start looking for trades. But I have a different or more aggressive version where even if the previous candle is not bullish, I can start hunting for trades if there's a confirmation that we're moving upwards. And this previous three candles here gave me that confirmation. So what I was just waiting for was a sweep. We had a nice sweep here, and then as per my model, the candle that performs the sweep has to close bullish, which happened here. So once I saw this bullish close, I then start looking for my entry. If this candle had failed to close bullish, then I would have to not take the trade and wait for another setup. So in this situation, what I did, I think I also posted this in the Discord, is after the sweep, I then took my entry from here. Normally, like I said, I tried to risk 1%, but depending on how the wick of this candle, this one here, my confirmation candle, I would then think of what my risk to reward would be. So in this situation, I believe I went 1.5. 1 second, I went here, and my stop loss was just 1.5 is what I did. And I was targeting this highs here, but I actually went all the way up to a 3.5, I believe, up to way up to 4. So yeah, so this was the actual trade I took. So again, we had a sweep here, bullish close, and obviously I went in, giving it the US 30. I think I also posted it on the Discord. With US 30, I tried to allow more room between 1.5 to 2% because of the volatility of it. With DAX, in most cases, I stick to 1%. But in this case, this is what I did, and obviously the trade went all the way to here. So obviously, draw liquidity. There's various ones. Is you can target this high here, you can target this high, or you can go all the way here again. So you have the option to either continue the trade or take profit where it suits you. That is the example for US 30. So I will then go on to my next example, which is the DAX. Again, I said the DAX and the US 30 had a similar setup. So with the DAX, again, same detail, look at the previous day, see what happened there, and then go on to the 4-hour again. We had this open and, a couple of bullish candles. Again, I was just waiting because it wasn't any sweep. So I actually put on there, say this is my, once the sweep happened, this then becomes what I call my MMBL signal candle. So I'm waiting for this to close. So once this closes, that gives me confirmation, and then I take the trade again. Again, once this happened, trade entry from here. Okay, targeting I want to target this high here. And this one was quite good because it was the risk wasn't that much. It was a nice 1 to 3, which again I posted in the Discord. So yeah, so this was a trade. But then again, with this, because the drawn liquidity on is all the way up here for me, I'm looking for us to go all the way to this high here. What I then do is, even after this trade happens, I then start looking for other entries. So basically how the model works for me is, if we're having a strong bullish momentum, I just basically wait, and every time we have a sweep and a confirmation, I then take another entry. So for example, after this first one happened, we then had another liquidity sweep here with this candle. I'll just annotate with this. So we then had another liquidity sweep here with this candle. As you can see, swept the previous low, which is this one here. And after that, I'm waiting for another bullish close. So obviously this candle didn't really close bullish. I wouldn't take that as a confirmation. This one here didn't really close bullish. But then again, we had another sweep here with this one, swept this previous low, and then obviously this candle here closed bullish. This was a second entry for me, just like that. Obviously to keep going to either this high, because I get this high here, or this high here, or all the way to the top. But unfortunately, this one was a -1. So as you can see, it was, nice into profit. I was up over 100 points. Obviously then later, we then had this, bearish momentum here, and obviously I got stopped out. So based on this price action here, now I'm going to wait. I'm now not going to hunt for any trades because I have a max of 2 trades. So I've taken one trade, which is a win, and I've taken another one, which is a loss. So now what I will do is actually wait, sit on my hands, and see how the next day candle forms. As you can see on this one here, if I remove this, took this high and massive rejection. So in this situation, I'm waiting to see what happens the next day. So that's an example of how I just basically ride the momentum up. Unfortunately, it didn't follow through this time. It's followed through in other situations, but in this case, it didn't follow through. And as you can see, basically we're consolidating here on the 4-hour. So I'm just going to leave this alone for now. NASDAQ, same detail for NASDAQ again. Again, we swept liquidity. Then I waited again for this one of these lows to be swept, and as you can see here, it was a tiny one here. Not much of a confirmation, hence the reason why I didn't take the NASDAQ trade. If the wick had come down and completely swept this, then I would have probably taken this, but it wasn't really convincing for me, so I sat on my hands on this one, unfortunately. But it was, as you can see, a good trade, and it went up and took this high here, or this way, even all the way up here. Didn't get to this one, but a nice 1 to 3, 1 to 3.5 this would have been. Finally, I'll talk about CAT JPY. Again, I posted this. So CAT JPY had the same structure. The reason why I didn't take CAT JPY, and I posted this in the Discord as well, is because there was no liquidity sweep on the 4-hour, as you can see. So no sweep. This candle here didn't sweep this one, and this one here obviously swept, but went all the way down. So if say I'd taken this trade here, that would have been a loss. But based on my rules, if there's no sweep, I'm not going to take the trade. And you can see why, because we didn't sweep the previous low. This candle just came all the way back down. And again, another structure is forming, but I'm still waiting to see more before I take any trade. So far this week for me, I had a +4 on US 30, +3.5, something like that, 3 on the DAX and obviously a -1 on the DAX as well. And now I'm just going to sit on my hands and see what happens for the rest of the week. And if I see more structure in the pairs that I trade, which is mainly CAD, JPY, NASDAQ, DAX, and US 30, then I'll look to go in again. That is just an explanation of the model and how I search for trades and how I look for it. And any questions? Thank you.
First question is, do you look at extra confluences, like buying only in a discount area or 4-hour daily range?
So, like I said, for me, it's more of a liquidity to liquidity. So if say, for example, the market is ranging and we have a liquidity, then I don't go into that. I just leave it alone. But there has to be a clear run on liquidity. Also, a strong rejection as well. If we have a liquidity sweep, but the rejection is not that strong, then I leave it alone as well. So these are the things that I look at, which is why I don't get that many trades. I only get maybe 1 or 2 trades per week in most cases, and sometimes not at all. But yes, so there has to be a nice rejection after this sweep. And if there's a consolidation, say with a daily consolidation or 4-hour consolidation, then I just sit on my hands. I don't really use premium and discount, to be honest with you. For me, it's just pure liquidity. I've simplified it as much as I can, and it just has to be a liquidity sweep. That's what I look for. No, I don't use kill zones either. So in regards to win rate, it's more between dependent. So I've got 2 actual models. Like I said, I've got the more aggressive one and I've got the more conservative one. It's normally between 50 to 60. And obviously I target 1 to 3. So that's really good for me. Yeah, I can see one more question. I'll answer that one. So basically, as I explained in the beginning, for me, obviously I started trading ICT and it really worked well for me. But ICT obviously uses more of the lower time frame, 1 minute, 5 minutes, 15 minutes, which I did. But due to time constraint on my part and due to my personality, looking at the 1 minute chart was a bit too much for me. So I wanted something more calm, something that aligned with my personality. So I decided to come up with a more higher time frame model. So based on a lot of research, and I like the concept of liquidity, so I just basically use that to create this model. 1, so I don't sit on the chart all the time, and 2, so I can easily automate it. I know with the 1 minute and the 5 minutes, you can automate it, but it takes a lot of work. But with the higher time frame model, it's a lot more easier to automate because you're only looking for trades every 4 hours, basically. Pearl, I said, I created, basically there's a code that I created on CTrader for it to send me an alert to my Telegram every time there's a sweep. So yeah, so basically this model that I showed, even though I trade it manually sometimes, is actually a fully automated process. In most cases, I don't even get involved in a trade at all. It just automatically looks for the setup, automatically takes the trade, stop loss, TP, and it just sends me a lot on my Telegram to let me know how the trade is performing. And sometimes if I have other accounts where I can't automate it, then I just take it manually on there. But it's a fully automated process, obviously based on research. And after I was happy with the model is when I then decided to automate it to make it a lot more easier for myself.
Cool. Awesome. And yeah, thanks again, Sil. And now let's dive into the live price section.
All right, welcome to this new video. In this video, we're going to talk about how to play the 10 a.m. game. And during the live streams from the last couple months, you've seen the 10 a.m. game playing out so many times. And let's go over them from this week. So we had 2 beautiful ones. And let's start with this one. So when you have the New York Open at 9:30, look at the time, 9:30 here. You should look at where is the easiest draw on liquidity. And the easiest draw on liquidity are pairs. It's price action what is paired with the staircase effect, failure swings. And it's even better if your bias is bullish because you see all these failure swings, that we draw into a higher time frame liquidity pool. Let's say a daily BISI. So here on Tuesday, that was the play to look at before the market opens. So let's play this out and let's see where you could have entered based on the 10 a.m. game. If you don't know what the 10 a.m. game is, just look at the 2024 mentorship. There's a whole breakdown on what it is. And it's a entry model on the 1 minute on NASDAQ, what happens almost every single day, where you can get easy wins. So what you look for, daily pre-value gap. You want aggressive sells, aggressive buys. The smart money reversal from a market maker buy model. And then what you want to see is, if you suspect we might go higher, you want to see discount rates. That means bullish for value gaps, bullish breakers, bullish order blocks. You want them to be respected. So we tapped here, and then we displaced higher, creating this 1 minute for value gap. Well, let's see if it holds. And looks like it does. So that's amazing. And now you have this bullish breaker and the bullish order block combined here together with a fair value gap. What is that? That's a unicorn setup on a 1 minute. Let's see if price comes back there. It does. So here's this the unicorn setup. So this could be your first entry. Remember, the 10 AM game, we don't play the first fair value gap. We play always the second. And how cool is that the second fair value gap is paired with a unicorn setup? What's the target here? These highs. So that would mean first entry possibility like this. If you do 1 to 2, it's right here. If you want to 1 to 3, it's right here. So entry possibility 1. Comes back here a few times, and then we displace again, leaving another value gap. It's going to be your second possibility. And if you notice you are on the buy side of the curve of a market maker model, then you should want that down close candle support price higher. So here, second entry. Right here. Same drawn liquidity. 1 to 2. It's right here. If you want to 1 to 3, you can put it like here. Look at the time. It's after 10 AM, so we're playing the 10 AM game. Price comes back here, consolidates, and then it goes to TP on both setups. So it doesn't matter if you missed the first value gap, there was a second entry possibility as well. And then drawn liquidity, remember, you want to target low resistance liquidity, and you want high resistance liquidity to back up your setup. So here's high resistance liquidity. We took liquidity here into a higher time frame array, and then we pushed higher. That's exactly what you want. This was the first one. This was on Tuesday. Then let's go to Thursday. And look at the time. It's 10 AM. So here we open at 10 AM. And if you want to long, then it's nice. Let me remove this. If you want to long, it's nice that the price goes lower first. And again, you want to see that exact same signature. Aggressive sells, aggressive buys. And then you are going to verify for yourself, are these value gaps holding? For value gap 1, for value gap 2, and you should be good. So here, let's see, we took some liquidity here, right here. And then we create our first fair value gap. Again, if one fair value gap is not enough to say to yourself, we are at the good side of the curve, you want a second fair value gap. And it's forming right here. So this could be your setup. Fair value gap 1, fair value gap 2. TP at the high, 1 to 2 here, 1 to 3 right here. And then here, there's another fair value gap. If you want to play a really small range, you can even try your luck here as well. You're targeting 40 pips, which means only like 10-ish point stop. It's more dangerous setup. I would definitely recommend putting your stop loss below the fair value gap or below the swing low. But let's say for this one, you were targeting a 1 to 2 instead of a 1 to 3 because you're already quite high up on the range. Comes back, very scary. You have a small stop loss, that means big drawdown. And then it goes to TP. So again, a 10 AM game played right here. I hope you enjoyed. I noticed that only 20% of people watching the video actually subscribe to the channel. So it would be amazing if you could subscribe right now. If you like this kind of videos, share with all your trading friends. And with that said, I'll see you in the next one.
I made over $11,000 in payouts within 2 weeks, only using one entry model and one trade plan. And this video, I'm breaking down this exact entry model and trade plan that got me these results. Follow this system and you have everything you need to start generating payouts yourself as well in record time, just like I did. Not only will I show you the entry model, I will also show you when I enter the positions and how I manage the positions to maximize profits. I made this happen using only this one approach, and now I'm showing you exactly how it works. No time to waste, let's get into the video. Losing traders only follow their gut. Their gut tells them that price will go higher or lower, but you need an actual system that actually gives you an edge if price is going higher or lower, so you can actually make money consistently. And most likely this is not the first ICT video you watch. You watched hours of ICT videos already, but you just don't have a system. You know how fair value gaps work, you know how an order block can work, you know what market structure is, but how can you actually make money from it? And to be honest, that's even worse than knowing nothing at all, because you already have knowledge, you already have some potential, but you're not using it at your fullest. That's a shame. So let's change that right now in this video. So take out your notepad, watch carefully to learn the exact strategy that got me funded and payouts. And did you ever feel stressed when in a trade, feeling anxious, not sure if price will go higher or lower, going against your trade or not? That's probably because you're not sure where the next drawn liquidity is. Your bias is going to be step one of this video. And for your bias, first you need your higher time frame levels. Higher time frame is daily, weekly, and monthly. You can also add the 4 hour here, but I like to use daily, weekly, monthly. And these levels and structure will give you the draw on liquidity. And what are levels? Levels are the PD rates, the confluences. So for value gaps, order blocks, breakers, liquidity pools, all that stuff. So let's say you see this on the daily time frame and we just swept an old high or we traded in another fair value gap. And we see the price taps into it and then displaces lower. We see energy lower and we break structure right here. So this depiction alone could give you already a nice indication if you want to go higher or lower, because we just traded from a key level on the daily, we broke structure, and now you could just wait for price to come back into premium of the range, premium and discount in this displacement leg. And in this area in premium, you're going to look for your confluences, a fair value gap, a breaker, or an order block right there to use that as your higher time frame level. So the question is, are you struggling finding that drawn liquidity that you think price going lower and you get stopped out again and again and again and you're in the wrong side of the market? Let's fix that right now, because a key rule is price moves from internal range liquidity to external range liquidity or vice versa, from external to internal. And external range liquidity is old highs and lows. Internal range liquidity is fair value gaps or volume balances or gaps. So the same example, this is on the daily structure. We have a key level, we have a daily structure, and right there is where you want to pay attention. Because once price start to retrace towards premium of this range, you have multiple draws on liquidity. First draw on liquidity will be here, just the next low, because we're going from internal range liquidity, from a value gap to external range liquidity, an old low. And we don't expect price to come back up here. Why? We swept liquidity into a key level, so it's a high resistance high, and we broke structure. So we are now anticipating price to go lower. So this will be the first TP point which you can use as drawn liquidity. And most of the time in this leg up right there, or if not a reversal, we just trade a continuation. Either way, there's always a next fair value gap or low in this area. So your next TP point could be right here. And knowing this on the daily, this gives you exactly what you need to now start to go to the lower time frame to find your entry models around this exact higher time frame bias. And I created a free training on how to go from emotional trading and blow accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight value. So make sure you check out the link in the description to watch this training as soon as possible. So for step 3, now you have your higher time frame level. You wait for the higher time level that is hit, and then you need to be patient. That means if your higher time level is not hit yet, you sit in your hands, you do nothing. And that's the boring part about trading, but it's also the part that will make you all your money. So sit still until your level is hit, and then look for a 1 or 15-minute structure in line with your higher time frame bias. If your high time frame bias in this case is lower, you want to price to react from this daily bearish value gap or the daily bearish order block or the bearish breaker, and we want to trade toward this low. Then when price is here, then we drop to the lower time frame. So we're going to do exactly the same, but then on the lower time frame. So once price is there, you wait on the 15 minutes or 1 hour to do exactly the same. So you wait for high resistance structure. High resistance structure is structure that sweeps liquidity before the move into your higher time frame level. So your higher time level is this daily bearish value gap, and this is the same daily bearish value gap. And in 1 to 15 minutes, you look for your entry. When high resistance structure is created, you see another fair value gap or order block or breaker. You just let price come back into a batch of confluences that cause the structure shift. So if there's an order block here, awesome. If there's a breaker, cool. For value gap, everything. The more they're present, the better. And also, if they're an SMT,
Also very nice as used in extra confluence. An SMT is not an entry model as itself, it's an extra confluence, just like a fair value gap is. And if you're not sure what an SMT is, I have videos on SMTs, but also on fair value gaps, order blocks, breakers, everything here on the YouTube channel. So wait for price to come back there, and then you can just take your entry right there. You can put your stop loss above the high resistance high or the top of the fair value gap. And we talk about this fair value gap here, this higher time frame level. I like my risk to reward to be at least 1 to 2 to make it worthwhile. If you do it 1 to 3, 1 to 4, that's awesome as well. But I want at least a 1 to 2 and then trade price towards the key levels. And that is going to be this low and this other discount level that can be old low or fair value gap. Most of the time, there are multiple areas there you can trade towards. But now you're like, hey, but I don't execute on the 50-minute or 1 hour. I'm an intraday trader or a scalper. I use the 1 to 5 minute. Can I use this as well? The answer is yes, because we do exactly the same what we did right here, but then on the 1 and 5 minute. So if this is the 1 and 50 minute, this exact level is where we're going to do exactly the same. And you can do this to refine most of your entries. When you are the 1 and the 5 minutes for your actual lower time for entry, look if there is a red folder news before your trade ID. To go to Forex Factory, if there's, for example, CPI or NFP or a big news event, just when you want to take a trade, you probably have a very low probability trade in your hands. Try to trade after the red folder. So once you have this 50-minute fair value gap, or the 1 or 5 minute, you want to wait for price to tap it before you take your entry. And you have two options here. You can take the entry exactly here at the tap, right here already. And you still want to target at least at 1 to 2. And you can just put your stop loss just above the fair value gap or above the most recent high or low, in this case a high. What I like to do in my trades is wait for the tap again and wait for another displacement low on the 1 or 5 minute and take my entry when I see a reaction from that level. So I'm sure we want to move away from it. And then put my stop. Something like this for a 1 to 2 or 1 to 3, but at least I 1 to 2 to take my entry. And then once you're in the trade, it can be quite anxious because you see price move up and down and you really want to get out of the trade. Your brain is wired to want to go out of the trade as soon as possible. Your brain wants to lock in paper profits, but it also wants to take your trade off when you are in a little bit of drawdown already. So to make the least amount of decisions possible, I have a very simple trade management system. You set your stops, you hit your stop loss and your TP, and of course you have your entry, and you make sure that your contract size, your lot size is good with your risk management system. So it means that your stop loss, if you say you want to risk $1,000 for a trade or $100 for a trade, that when your stop loss is hit, that's exactly $100 or $1,000, exactly the limit you have set. And trading is hard enough. So don't try to make more decisions than necessary. And that means no partials, no moving stops. You just take your entry, you set your TP, set your stop loss, and that's it. And you just wait what will happen. Worst thing that can happen is that price goes to your stop loss and you take the -1. If the -1 is not good, if you're very sad about that -1, maybe your -1, the amount you lost at the stop loss was not good. Maybe you should reduce that one. But you just want to wait for what the trading gods have in store for you. There's one exception to this rule is when price is 80% towards TP. So that means price comes to the entry, you take the entry right there and price starts to move. When price is 80% towards TP, so around here, there is where it's okay to put your stop loss to break even because it's not very nice if you're almost at TP and price goes all the way back to your stop loss. Ideally, you don't even touch your stop, but if you are prone to tilt or you really suck at losing, just make sure when price is 80%, put it at break even. So worst case scenario, you get out, you can take it out break even. But ideally, just set your stop loss, set your TP and wait for it to happen to get the most out of your trades. Because what you see sometimes, most often see is that price just comes back to your entry or around the entry and still goes to your TP. And yes, sometimes it goes to your stop loss and that sucks because it's trading, you will lose a lot. But you will kick yourself when price comes back to the entry, take out little, buy some liquidity right there and then goes to your TP. So ideally don't mess with your stops. If you get stopped out a lot before the real move, increase your stop loss or wait a little bit longer. But for trade management, make it very easy. And now let's go to the chart to see this trade system in action.
Cool, so here we're looking at NASDAQ at the daily chart. And what do you see? Here on the daily, we have a massive daily bullish fair value gap. And after that, we trade into it and we displace higher. A down close candle trades into key level is an order block. So this down close candle, we can mark it out as a bullish order block. Also, we have a daily bullish fair value gap. So we trade it to a daily level, we react from it. So from this point, I'm still bullish and I want to trade towards the highs. Do we also have a level where we can trade towards? We can towards this level and maybe we can refine this even on the lower time frame. Let's see the 4 hour. There's also a 4 hour bearish fair value gap right there and right there. So now I have our bias on the daily. Breaks down. Let's go to the lower time frame, the 1 hour. So this is on Friday. So we trade to the daily fair value gap and the order block and we sweep liquidity right there. Aggressive sells, aggressive buys, a smart money reversal. So a potential buying model could be on. And we have a fair value gap right here. So now the week will close very soon right here. So on Monday, here is where you need to pay attention. because we have a potential trade idea here. We have a daily fair value gap, we have a daily order block, and a 1 hour bullish fair value gap on top of this as well right here. So let's see on Monday if we trade into this. And we start, of course, the London session around 2. So this is a Monday at 3 a.m. and we see that we trade into the fair value gap and the body is still inside this fair value gap. But of course, we can just trade to the lows, but we need to see a reaction to the upside to have a bullish bias. And next candle reacts. So we have a swing low right here created. So from this point, we have a daily fair value gap, a daily order block, a 1 hour bullish fair value gap. And if we're going to hunt for lower time frame entries to a drawn liquidity, where can we trade to? Well, if we look here on the 4 hour, we had 2 bearish fair value gaps, one here and one here. If we do premium and discount, this fair value gap here on the constant encroachment, there is already discount. So this is a level where I would like to trade towards, back towards premium of the range and overlapping a 4 hour bearish fair value gap. So let's make this the drawn liquidity. And now it's just a matter of waiting. So already we have a aggressive sells, but we come back into the range. So potentially this down close candle can act as an order block once we close over it. So we are now at the London session. Let's see how we are closer to New York. So here is nothing. There is nothing to do. We need to see displacement with fair value gaps. And here we have it. Look what happens now. Here at the start of the New York session, we have a bullish fair value gap on the 15 minutes. We have a bullish order block on the 15 minutes. And what is this? We have a low, a high, a lower low, and a higher high. We also have a breaker here, a bullish breaker. So this is a unicorn and an order block. This is a very high probability area for price to react from to go higher. And we know where we want to go. So from the 50 minute, you can already take your entry right there. TP at the start of the premium of the range, overlapping with a 4 hour bearish fair value gap for a 1 to 2 or 1 to 3. Let's say you want to do a 1 to 2 right here. That's the first entry already. But what if you want to go even lower to the 1 minute? Let's go to the 1 minute to see if we can refine this entry. So here we have that 15 minute bullish fair value gap. And what we want to see there is, we want to see aggressive sells, aggressive buys, and create a buy model, just as we did on the daily, just as we did at the 1 hour and on the 50 minute. Price is fractals. On every time frame, the same thing happens. And let's see what price does here. So now it taps into the fair value gap at 8 and already gives some reaction. But as you can see, there's no follow through here. So right here on the 1 minute, there's no entry yet. And ideally for NASDAQ, you want to trade around the open. And what do you see here? We see price trading lower into the key level, the 50-minute fair value gap, and then we start displacing higher. This is what you want to see. This is your model that you want to see on the 1 minute. So here as well, you can take your trade into a key level. So you wait for price to come back into a fair value gap right here, and we even sweep liquidity here. So right here around the open, personally, I would already be in right here. And why is that? It's because we sweep liquidity here into a key level. We start to displace higher for value gap 1 right here and for value gap 2 right here. So here in this value gap 2 was already the entry, and you see how price also taps to this value gap multiple times. So my entry would already be right there. Well, where's the TP? TP is at the green line there, start the premium of the range, and we want to do a 1 to 3 or a 1 to 2, but we've refined our entry. So let's put it at the 1 to 3 like this. So now we have our 50-minute entry and we have our 1 minute entry, both refined on exactly the same trade idea, all based on a daily bullish fair value gap, a daily bullish order block, a 1 hour bullish fair value gap, and now on the 50-minute, even on the 1 minute, the stars align to price to the upside. And low-hanging fruit is right here. And let's see what price gives us. And there you go. And here in hindsight, this was even the low of the week. And I have the exact entry model I use to get funded, get payouts, and make money step by step, so you can do it right now too. Make sure you check out the other videos on the channel on market structure, fair value gap, liquidity, all that stuff. There is so much value I still need to tell you, all for free. So make sure you like, subscribe, all that stuff. I can't wait to see you crushing it on the charts, and I hope to see you in the next one. Bye-bye.
Is it possible to secure a $150,000 trading account in less than a week? 4 days ago, I bought a brand new 150K prop firm challenge. And only 4 days, I passed this with a profit of over $9,000. This wasn't a lucky streak. This was execution of one simple mechanical entry model. And this video, I'm putting back the curtains on this entire process. I'm going to give you the exact entry model I used, our risk management framework for the challenge, and the psychological approach required to execute flawlessly under pressure. To do that, we're going to walk through every single trade I took this challenge, the wins, the losses, and the key trades that pushed me over the finish line. No time to waste, let's get into the video. Cool, so before we dive to the actual trades, we need a framework to base our trades around. And you guys know the trade pyramids. To be a profitable trader, you need 4 core things. You need to know your technicals. You need to know, for example, supply and demand, support and resistance, ICT. I do ICT. You need to have data on your trading, journaling, backtesting. You need to have a trade plan, an entry model, risk management, and your mind should be in a good place, your psychology. On this YouTube channel, you see a lot of videos about technicals, so I'm not going to go deep dive into what fair value gaps is, market structure. You can find it all on this channel. For journaling, well, basically this video is a journal entry. So we're going to do this together today. Trade plan, I'm going to talk about it right now. And of course, psychology. I will share my exact thought processes during the trades, during the execution, but also during the trades, because it was not always fun. I will share it as well in this video. Cool. Before we dive to the trades, let's talk about the trade plan. Because I bought a new challenge with Take Profit Trader. I never used this. I saw on Twitter some guys using it and they have daily payouts. So I was like, okay, new profit. How do we approach that? Well, first of all, only buy one challenge, just to test. You want to get funded, get a payout, and see if everything clicks, everything works out. So I bought a 150K challenge. The target was $9,000, and there was a few extra rules. There was a 50% consistency rule, and the consistency rule means that the best day's profit cannot be more than 50% over your total profits. So my target is 9K. That means the best day needs to be below 4,500. There's also a 5-day minimum trading days, and the max drawdown on this account is 5,500. And there's an end of day trailing drawdown. So that means, for example, if I'm in profit for 2K, at the end of the day, that means this max drawdown goes from 144.5 to 146.5 because it's trailing up to 2K. Cool. So based on that, we want to pass the challenge as soon as possible, right? In an ideal world, if we win all of our trades, what would be the minimum days to pass? Well, 2 scenarios here. One is pass in 2 days. That means you need to have a TP of 4,400, 44 something, because you need to go to 9K. You can get that with 1 to 2s, risk 2,200 to get 4,400, or 1 to 3s, 1,500-ish risk to get 4,400. Cool. If you want to take it a little slower, pass in 3 days. And it's ideal, right? Because if you lose, of course, this game plan is going to be a little adjusted. This is an ideal scenario when you win all of your trades. And little spoiler, I did it in 4. Pass in 3 days, well, you need to have 3 days of 3K because you need to go to 9K. You can get that from 1 to 2s with 1,500 risk to get 3, or 1 to 3s, only risking 1K, and then going 1 to 3 towards 3K. So this is the framework we're going to dance around in. And I decided in this challenge to mainly risk 1,500 per trade. I like 1,500 per trade, and on a 150 account, it's just 1%. It was very slow and steady. And now let's talk about the actual entry model. And most of the entry models you see on these channels and also in ICT, entry models are reversal models. So there is liquidity being taken out. There's a clear draw on liquidity. You wait for liquidity to be taken out. Then you see displacement, breaking structure. And then that displacement range, there is an order block created, or a fair value gap, or a breaker, or inversion fair value gap. You know the drill with the ICT models by now. And this exact signature in price is what I look for in all my trades. So no fancy stuff, no fancy entry models. It's going to be down to this core principle. So now we have the technicals, we have the trade plan, we are going to journal. So now let's dive into the actual trades to see this exact plan in action. If you want to become profitable as soon as possible, you need to join the thousands of others in the school group, Market Masters. If you go to the classroom in the school group, there's a 5-day getting profitable challenge to make sure you complete that. And after that, there's not only a 5-day challenge, but a complete roadmap course with a step-by-step program on how to become profitable, from the trading pyramid, psychology, trade plan, getting funded, entry model, everything is there. And this is not all. Live trading every single week. And on top of that, there's also a Discord. And inside this Discord, there are many other traders crushing it. I share my insights every single day, from outlooks to trade ideas to concepts. So make sure you check it out as well. I will leave the link to that in the description. And now let's get back to the video. Cool. So I bought this account on a Tuesday. So we're going to discuss Tuesday, Wednesday, Thursday, and Friday. And our core trade idea for this week is going to be on the daily time frame, because we see a daily bullish fair value gap here. So daily internal to external. And this is the external range liquidity. This is going to be the drawn liquidity for this week. So ideally, if we look at the open, high, low, close of a week, let's say we have a bullish week. We consolidate. On Tuesday, we go to a discount array, for example, a daily bullish fair value gap, then break structure, and then trade towards the high of the candle and close there the week. And of course, this candle doesn't look always like this. It can look like this with a big rejection into a key level. But the key is, if there is an internal to external, this is what I'm anticipating. So it means Monday, consolidation or not the move of the week. From Tuesday week or Wednesday, we create a low of the week inside a key level. That's right here. And then market structure shift and then displays higher. Accumulation, manipulate distribution, power of 3. So this is always going to be in the back of our minds during the trade day. Cool. So now let's drop to the lower time frame during the New York Open to see the first trade. So now we're looking at Tuesday just before the New York session. And the New York Open is always going to be the starting point of the trade idea. Sometimes I take a trade before the New York Open, but the majority of my executions are after the New York Open. And you will see also in this batch of trades that trading before the New York Open on NASDAQ or ES or YM is not the highest probability. So here's the New York Open. Let's see what happens after the Open. So we want to trade after the red line. And exactly at the Open, we get a massive, scary sell-off right here. Cool. This is to induce sellers. People think, oh, well, this was the high of the week, Monday high of the week, and we're now going lower. But we know that we have a daily bullish fair value gap, and we're going to trade, most likely, a daily internal to external higher. Just to get in all the early sellers and hopefully trap them. And now what we wait for, we're not going to blindly trade into this fair value gap. No, we're going to wait for fair value gaps to be created. And pretty fast, there's already a fair value gap created. And when it is around 10, if you know the infamous 10 AM game, you can find on the channel here as well. This is what I like. So here, and we can do this on the 1 minute as well, but let's do it on the 5 minute for this trade. We have a little liquidity sweep here inside a key level. Then we displace higher and we already have a fair value gap here. So the first trade is already taken right here with the TP above this high, stop loss right here for a 1 to 3. This was the first trade of the week. And you might say, why so aggressive? Because it's only one fair value gap. Because I want price to go in this fair value gap and don't chill for here for a long time. I want it to go up to distribute to that internal to external, the green line here, as soon as possible. So I took it. Got a very nice reaction here. And one more thing about the futures prop firm, you need to close your trades at the end of the trading day. You cannot hold overnight. So this was on Tuesday a brutal hold. Why was it a brutal hold? Because we didn't displace. We just chilled. We came back to the entry. And now talking about back to the trader pyramid, about your psychology. Ideally, you want to take a trade and have TP in a few minutes, right? That's ideally what you want. But majority of the time, your trades can be stuck in some form of consolidation or maybe just chills around in your drawdown. And this was an example of this. Took the trade at 10, 20-ish, and for 4 hours, maybe more, the trade just did absolutely nothing. And I needed to close the trade before the end of the day, so I did. So this on Tuesday, we had a very small profit. I closed here around here for only like a $600 profit or something instead of the 4,500 I wanted. So on Tuesday, not the best start, but this was the trade. So here I took it off. So this trade is now off. It was, I think, around here that I exited right here. Cool. Let's fast forward to the next trading day on Wednesday. So here now we're looking at Wednesday just before the New York Open. And I think Wednesday was the most decisive part in the bias for this week. Because if you see this happening, daily internal to external, but we don't move away from the daily bullish value gap. So the bias is maybe wrong. You remember the psychology game? So I wanted to wait around the New York Open what we did. Was there something that could say to us, maybe we are wrong in our higher time frame bias and we're just going lower? So let's play it out. And here during the Open, we already see fair value gaps being created. Bearish value gap, bearish value gap. Back to the daily bullish value gap. So nothing wrong with this. So let's move it out. And here we start displacing higher. But I was not convinced on this trading day of my bias, my higher time bias. See the mental game? So I was actually more leaning towards bearish because we didn't move away from that bullish value gap. So around 11, I saw this happening. I saw failure swings being left behind. Like I really like this low to target as a short. And I was just basically waiting for some displacement lower, targeting these lows. So right here, I took a very aggressive short right here in this bearish value gap, right here on the 1 minute, targeting these lows as a short idea, right here, for a 1 to 2. It was the first trade on Wednesday. And let's see what happened. Gave a little push. But no, completely wrong. Cool. This is a price to pay your tuition money. This loss is awesome. Why? You're like, losing is not awesome? Yes, it was on this day. Because being so wrong on the short idea made me confirm my bias to the long side was indeed correct. Cool. How are we going to move around this? We're going to still continue longing towards the green line, daily internal to external. And the next trade I took on Wednesday was on the 15-minute time frame. And yes, intraday or scalp from the 15-minute? Yes, because the bias was very, very clear. Let me show you. So look what we have here. We have this loss. We still have the bias, but we're trading intraday, and we now created a 15-minute bullish fair value gap. If I see this is going to be very easy intraday internal to external. So my next trade idea was towards here, targeting this high. I want this high to be ran. So this was the actual trade idea. And here on the 1 minute, the second I saw this candle being printed is where I got in right here. Stop below this swing low, target this swing high for around a 1 to 2, little below 1 to 2, and let's see what happens. So immediately, this was scary, right? I was like, no, I'm gonna be wrong again. It was not very fun. But trust your bias, internal to external, and eventually during the PM session, price starts to move higher. Here again, look at this, and we're gonna ignore the TP for now because we're talking about the mental game here. When you see this candle being printed, almost back to the entry, you were in a nice emotional rush. You would think, yes, I'm on top of the world. Trading is the most easy thing in the world. It wasn't, because this candle was scary. And then eventually it went to TP. -1, +2, not the best day, but we are in profit. That's nice. So on Monday, we have profits, a very small one. On Tuesday, small profits, but we're still not done. Remember, our target for the week is the daily internal to external. Now let's jump to Thursday to see our next trade. And how did we arrive on Thursday? I want to take you to the 4-hour time frame. We are still inside a daily internal to external. Look at how beautiful this 4-hour bullish fair value gap is. So the lower time and trade IDs on Thursday are all based on this 4-hour bullish fair value gap to hold to then trade back to the highs. This one right here. So on the lower time frame, what I'm actually expecting is price to open of the day, open low in London session or New York, can be already in London session, and then just trade higher. So that means on this day, I took a pre-New York entry because I was open for this London low of today, then trade to the high, 4-hour internal to external inside the daily internal to external. So let's try it. So here we're looking at the London session on NASDAQ, and the yellow box is the 4-hour bullish fair value gap. So here around 3 is where something interesting happens. This is a very nice signature in price. Remember what I mentioned earlier about the entry model? We see liquidity and then go to the drawn liquidity. This is what you saw here. I was like, hey, interesting. We can perhaps use this. And an order block right here as well, right here. So this was interesting, in my opinion. For value gap, order block with a London low today potentially. So when price comes back there, I'm open to take a trade. Where to? The internal to external daily. Remember, see how the Wednesday high just stopped just below that daily internal to external? That is buy side liquidity, engineered liquidity. We want to target that. Cool. So let's see if we can tap in. This was the first trade on Thursday. We get tapped in right here at 6. So here we are in, right here in the order book value gap. I want to target this high. And I was actually convinced that we're not going to stick around here. So I put here in 1, 2, 3 right here. And let's see what happens. So this is the most nice thing in the world, right? You take a trade and the first thing it does, it just goes straight to your direction until it doesn't. Until it doesn't. But again, there's another swing high created we can target later. So I took a -1 here as well. So it was a -1. And now we're going to do the exact same thing. I'm going to wait for a New York open because we took a loss pre-open. It can happen. And now we're going to look for, okay, how can we dance around this during the New York open? We still have the same bias. Very important concept here. We still have the same bias. 4-hour, this big box is a 4-hour bullish fair value gap. And we still have that green line. We need to target that green line. We don't need to, but it's very obvious that we want to go there. Cool. So zooming out here, where can price, because we were wrong here, during the open, where can price potentially sell off to? There are some fair value gaps here with an order block. Let's go to the 15-minute. Here was where my eyes were going. Okay, we have this behind. Inside the 4-hour fair value gap, we also have a small 15-minute fair value gap and order block. Why is this an order block? There's another 15-minute fair value gap here with the order block here. So this area in price, also if you like to use premium discount, swing high, swing low, we could come close to discount as well. So during the open, I was waiting for price to drop lower. Like my bias was still the same. Like if this was the low already, fine. I was just waiting for the first fair value gaps up to then take the trade towards the green line. So let's see what happens during the open. We wait before the open. We're not going to rush. You wait. So now what we're going to play is a 50-minute bullish value gap right here at 10. If you recognize the 10 a.m. game, we open here at 10, we go lower, create structure at the lows, and then go higher. Here is where entry is, right here. So we still have the liquidity resting up there. We're retracing all the way back into that 50-minute bullish value gap, getting in early sellers. They're trapped again. And similar trade as the loss taken early in the day. So we're going to target the Asia high right here. That's going to be the target right here. Stop below the low, 413. And it's the trade idea. Same trade idea, so already -1 on the day, but we still have the same bias. From the week, we have a daily internal to external. For this day, we have a 4-hour internal to external. We already tried to catch this in London session, but now we're going to try to catch this with the loss in our head. Mental game. In the New York session, 10 a.m. game. So what do we see here? We see price trades to a key level during a kill zone. It displays upwards. There was also an SMT with ES, if I remember correctly. And then when price trades back into here, inversion for value gap, order block for value gap. Like, it doesn't matter which PD array you like to choose. It was there. I like to use for value gaps and order blocks. And now let's see what price gives us. And because we already engineered so much liquidity, we don't need to chill around for a long time. So after a while, we are approaching the lunch retracement here. And then during the PM session, price went to TP right here at 115. 1-3. Let's go. Our first 1-3 on the week. And that's cool because that's raked in a nice profit. So +3 -1, that means +2 for Thursday. And now let's drop to the Friday where we're gonna bring this challenge, the 9K, home. And again, with the exact same loss taken before New York session. Let me show you. Cool, so now we're looking at Friday at the 4-hour time frame. And we already completed the 4-hour internal to external on the trade on Wednesday. And we also are already in the weekly target, the daily high here, the daily internal to external, we already completed on Thursday. So then the bias for Friday is kind of neutral because we already completed the target, but there's still probably some movement left in the tank. So I want to show up and see, can I get that exact same move? And what's the move? Well, I want to long. I'm bullish on NASDAQ in higher time frame. So I want to see this happening in London and New York. Ideally New York, but here again on Friday, London session, it happened again. It happened again. Cool. Let's drop to the lower time frame right here. So what did I saw happening? We took some short-term liquidity, and yes, this is not a good liquidity pool. So this is a mistake from my part. I took a B setup. Here is lunch low. Here is PM low. But this signature in price is what I like to see. Liquidity sweep, mark structure shift with a fair value gap, and these down close candles that swept the low is an order block. So here is where I already want to get in, right here. So target the highs, take a target this high, this swing high for 1 to 2. And I was like, well, if we gonna sweep the London low, I may be safe as well. And now let's fast forward. Took the trade in the London session, 4:30. Well, it's already a little spoiler. But during our best friend, the New York Open, price started to move. And spoiler, it wasn't in our direction. Right here, it got stopped out. Either way, we got stopped out. And that's fine, because the target is going to be the same right here. So then with that -1, again, in the back of our mind, we still can trade towards the drawn liquidity that is going to be the Thursday high, or ideally this swing high. It doesn't really matter which high you pick here. And I needed a 1, 2, 3 to pass the challenge. So it was a little dangerous. Let me show you what I mean with dangerous. And to do that, I want to go to the actual executions. This is my execution time. This is my live chart. I want to recreate it with a clean chart. But it's the actual chart, what I traded on this week. And I want to bring you to this. So this is what I was doing. And everything I do here, guys, is live on stream with my students. And I want to show you what happened. So I got stopped out here. I was joking during New York Open. Like, I didn't get stopped out by 1 point here. I was like, I have the magic stop loss. Well, obviously I didn't. And here is where the entry is. So we have an SMT with ES. And we also took that PM low right here, or the lunch low. And then the same structure, liquidity sweep, aggressive sells, aggressive buys, and this fair value gap with the order block exactly here to the pip. I took the entry. Stop quite big, but I needed the 1 to 3. 12293. This was my TP. But remember, the high was already here. So the original target was the green line right here. Already hit at lunch. But to pass the challenge, I needed the extra mile. And if you've seen the standard deviation video in the YouTube mentorship, the manipulation leg, swing high, swing low, and then you trade to the -2. That's what I did. See how the high of the day is formed? The high of the week actually is exactly the -2. So I did that, and my TP was below the -2, so I was good to hold. I was confident to hold, and I eventually just chilled, and it went in the lunch before the PM session already went to TP. And that was it. 9K in the pocket. Trading on Tuesday, Wednesday, Thursday, and Friday. Exactly the same model. Took multiple losses, but executing the same exact model every single day. The consistency with a clear execution framework and a risk management framework will actually pass you every challenge you want. That is it. 9K, 150K added to the funded war chest. Hope you enjoyed. If you got value out of this, like, subscribe, comment what was your biggest takeaway about this, and make sure you send this to a friend who absolutely needs this. I know you have friends who blow all their challenges. So make sure you send them this exact framework. You can just copy this and do this yourself. I'm going to do exactly the same next week. If you want to see this, I'm sharing my outlooks in my Discord. Also, there's a lot of it in my school group. Links in the description. Join now, and I'll see you in the next one. You want to get funded guaranteed, and you want the exact entry model to get you that funding? In this video, I'll give you exactly that. To do this, first, we'll go over how to get funded guaranteed and how to choose the correct prop firm. Then I'll give you an exact entry model you can use to get that funding. After that, I will show you how that entry model works on the charts with recent examples. No time to waste, I'm putting an all-nighter here. Make sure you stick to the end, because especially at the end, I'm dropping the secret sauce that put everything together. Let's get into it. How to get funded guaranteed. Step 1, the starting point. Start with getting 5 challenges of your preferred size. For example, get 500K challenges. Your initial investment will be about $2,500. If you don't have $2,500 to start with, then you can start at a lower threshold. Doesn't matter. For example, pick 5 10K challenges, pick 5 5K challenges. That will set you back like maybe $100 or $200. This first starting point is very important, and you should be okay with losing this initial investment. If you don't have money to play with for challenges, I recommend the following. 1. Start the smallest, cheapest possible options. 5 or 10K challenges. And if you don't have the money for the smaller challenges, then you have work to do outside of your trading. A very important note here. I would recommend, when you don't have the money right now to buy 5 new challenges, don't go any further. You have work to do outside of the charts. Why? Your trading will be more emotional and unstable because you treat this as a lottery ticket, which is not. It's trading business. You should take it very serious, and you should be able to lose the money you put into this trading. And maybe you're wondering, why 5 challenges? Why not 1? The rules of prop firms are stacked against you. So with 5 challenges, this way you will be able to spread out the risk of your trades between multiple accounts. And why prop firms? You wonder why not. Your personal capital, because prop firms have a higher upside and a lower downside. With a higher upside, you can get easier funding, for example, 10, 20, or 100K, without spending your own 100K on your trading. And the downside, when you use your personal account, and you have, let's say, 5K on a personal account, and you blow that account because you had a bad day, can happen, you make a mistake, then your downside is the 5K. But what if you have a challenge of 5K, which is only a couple bucks? Then the only downside you have is not that 5K, but only let's say the 50 or 100 bucks you spent on that challenge. Downside is smaller, upside is bigger. It's a no-brainer to play prop firms. That's step 1. Let's talk about step 2. Buying the challenges. What prop firm to choose? And I make a difference between 2 types of prop firms. 1 is the futures prop firms. Currently we have Apex, Topstep, MyFund Futures, and the non-futures prop firms like FTMO, Alpha Capital, Fund of Next, the Fivers, also referred to as the Forex prop firms. And on the Forex prop firms, you can still trade the NASDAQ, the indices, the one you trade on the futures. When you are not funded yet, pay attention here. Focus on non-futures prop firms. Why? Once you're funded, it's easier to get a payout on non-futures prop firms than on the futures prop firms. And to make this clearer, I make this depiction for you. So you have the non-futures prop firms like FTMO, Alpha Capital. Going from not funding, the challenge stage, to funding is quite hard. It's quite hard. compared to the futures prop firms where it's quite easy to get funding. But what you want is the road from funded to payout to be the easiest as possible. Make the challenge hard, but once you're funded, once you pass, you celebrate, let's get a payout very quickly. And with the non-futures prop firms, it's very easy to get a payout. On the futures prop firms, it's very hard to get a payout. So that's why I recommend going for the non-futures prop firms route at the start. After a few weeks or a few months, when you're funded, you have some payouts. Of course, reinvest them back into the futures prop firms to play around, but try to play this game on easy mode. Trading is hard enough from itself. Just try to stay with the non-future prop firms. And a note here, when buying your 5 challenges, I would recommend spreading them out on at least 2 prop firms. Can also be more, whatever you prefer, at least 2. Don't buy them all on one prop firm. You never know if they have a surprise bankruptcy. Past couple of years, some prop firms went out of business all of a sudden. You don't want to have all your eggs in one basket, lose all your funding in one day. For example, you have 5 challenges, buy 2 FTMO, 2 Alpha Capital, 1 fund the next. Maybe by the time you're watching, these prop firms do not exist anymore, but this whole concept applies to every prop firm out here. Second example, 2 FTMO, 3 fund the next. You can mix and match as long as you don't have all 5 challenges on one prop firm. And now let's take a look at how to choose the correct prop firm. And I use a website for this. It's called propfirmmatch.com. And I'm not affiliated in any way, shape, or form with this website. I think they're doing a great job of determining which prop firms are legit and which one are not. So when you go to their homepage, propfirmmatch.com, you see here the prop firms popular, the Fivers, Alpha Capital, the ones I traded myself as well. But make it easy for yourself. Go here to filters, and what I would recommend filtering on is your country. So for example, some people from the United States are not welcome at all prop firms. So make sure you choose United States. Most important, I would say, choose the assets. So if, for example, if you're trading stocks only, look at here. If you want to trade Forex, filter here. Also very important, the platform you want to trade on. If you are very familiar with MetaTrader, for example, pick MetaTrader. If you have never heard of MetaTrader and you want to pick CTrader or NinjaTrader or Tradeovate, you want to trade more on TradingView, fine. Pick the platform you are most familiar with. I would recommend as a trader, be at least familiar with MetaTrader and trading on TradingView, for example, with Tradeovate. But CTrader, DXTrade, NinjaTrader, all are very good platforms. You can even filter on the type of steps you want, 1 step, 2 steps. I would recommend going for 2 steps on most prop firms. You can also do 1 step. That means you can pass challenge in 1 phase instead of 2 phases. But keep in mind, most prop firms have extra tricky rules with the 1 phases. For example, it takes longer to get a payout. You need to have minimum trading days or some form of weird consistency rule where you're forced to make extra trades. And remember, you want to play on easy mode. The less rules from you funded to payout, the better. And once you pick your prop firm, for example, the Fivers, you can go to the website. I think if you click here, you can go directly through the prop firm you want, FTMO or whatever prop firm you choose. From there, go to the website. And then please do your research. And with the research, I mean, go to the website. For example, here, Alpha Capital. Again, I'm not affiliated with any of these. But before you buy anything, go through their rules. So for example, here you see the rules. For example, you want a 2-step for 100K or for 5K. And you see, okay, this costs $50. Perfect. You need to have 10% profit target for phase 1, 5% profit target. These are the max drawdowns. Makes sense, but go deeper. Don't be lazy here. Every single prop firm has some form of FAQ or form where they go more in depth about their rules. So here you go to Help Center and here you see FAQ, click on it. Research this. And yes, those are many articles and most prop firms work quite similar, but I will go definitely through the different articles here. So for example, the alpha plans, this is the 1-step, this is the 2-step. For example, the 2-step, and I want to know everything. Okay, these are the phase 1 targets, phase 2 drawdown. But what do they mean with the drawdown? Is it trading drawdown? Is it static drawdown? How does it even work? Well, another page showed up here. All explanations about the drawdown. I'm not going to bore them with these details right now, but look at the examples. You don't want to be caught off guard here. While you think you're trading according to the rules, but it's very clear on their page that you're probably doing something wrong. Be prepared, do your homework. It's your money and your freedom we're talking about. Make sure you put in the work. And the nice thing about this is you only need to do this once per prop firm. So this will take you maybe 10, 20 minutes to go through some articles and read something, take some notes. Perfect. And if you're not sure during your trade, go back to the same page or type in, for example, can I trade news on Alpha Capital, for example, and then the FAQ page will show you all the details. Also, the the max lot size exposure. For example, if you did not read this and you buy a 5K account and you're shooting 3 lot size on it, Alpha Capital will just send you an email like, hey, on our FAQ page, it's very clear that you cannot trade with more than 2.5 lots. You did, so the profits you made with this trade are now invalid. So you took that amazing trade for nothing. Do you want to be in that situation? I won't like that. I think you don't like it too, so might as well do our homework here. Same with rules as weekend holding, trading news. Make sure you do your homework. So when you decide which 2 prop firms you want to trade on, let's say Alpha Capital or for example FTMO, from there you can pick them, register, read the rules, buy a challenge, and get to work. Cool. Now you know what to do. Step 1. Buy 5 challenges. Step 2, where to buy it. I would recommend non-futures prop firms. Where can you find them? Look at Prop Firm Match and do your homework when buying them. Make sure not all your accounts are exactly at one prop firm. Make sure you spread them out for at least 2. Now let's get into the nitty-gritty part. And it is step 3, getting to the first funding milestone. And the goal is very simple. You have those 5 challenges. Don't aim to pass them all. Just aim for 1 or 2. Even 1 out of 5 is awesome. Perfect. Aim for 1 out of 5. Personally, I aim for 2 out of 5. And of those 1 or 2, I want for at least 1 to get a payout in that account. Get a payout of at least 2% profit. So for example, you have a 100K account, 1 trade, wants to risk to reward with 1% risk, 2% of 100K is 2K. Most of the time you have an 80-20 profit split with the prop firm. So with a 2% profit, 80% of that is in this case $1,600. With a 10K account, it's a payout of $160. And with that $1,600, with a payout or 160 or whatever payout you have, that's awesome because now you have money to get new challenges and you can stop putting your own money into challenges. It's a waste of your money. And please promise me right now, following. Do not do this. At the end of X time period, I am a funded trader. I'm finished with my challenge of getting 10K funded or 50K funded. You have 0 control over how long it will take for you to get a funded account. That's out of your control. What is in your control is where you put your stop loss, where you put your TP, where you enter, what your lot size is, when you take a trade, if you journal your trade, if you have actual data, do you have a trade plan? Do you have an entry model that actually works? And I'm gonna give you my entry model later in this video. But focus on the things you can control. When you finish the challenge, you have no control over, because even the best trade strategies can stop working for maybe a week or 2. So if you are in a unavoidable losing streak, which you will get into someday, and you start your challenge, you're like, oh, well, I took a few losses, this doesn't work, but I said to myself, I'm going to get funded at the end of this month or the end of this quarter, and you didn't hit it. Who cares? Who cares? Don't do it. Focus on the things you can control and let the profits come to you. No rush. Just focus on taking good trades. When focus on good trades, reviewing good trades, and actually intentional improving, that's all you can do. And that's what you need to do to become a profitable trader. Some of you watching this will pass the challenge in a few weeks. Some will take months. There's no competition. And I bet some of you will beat me in my challenge. And I applaud and support you to do this. So maybe we start a challenge at the same time and I do 3 weeks to finish a challenge. But you are taking amazing trades. You're doing everything right and you pass in 2 weeks. Of course, you won the competition of speed. I applaud you for it. Get funded fast, get payouts fast, get rich fast. But it's not a competition, it's not a rush. Take it easy, focus on things you can control. And if you beat me with speed, awesome. Awesome. But don't gamble, this is no race. The goal is for everyone to win. And I don't care how long you take. And don't try to be too fancy with your trading. And what I mean by that is the goal is to get to around 35% win rate. So you can shoot for 1 to 2 risk to reward and up to get funded and to make money. And this is what so few people understand. When you shoot for a 1-to-1 risk to reward, you need a 51% win rate to be profitable. With a 1.2 risk to reward, you would need a win rate of 34% to be profitable, because 1 out of 3 need to be profitable. With shooting 1 to 3 risk to reward, you would need 26% win rate to be profitable. So when you shoot 1 to 2-ish, 1 to 2.5, for example, risk to reward, and only aim for 35% win rate, you're good. You're good. And most of the time, when you focus on good trades, you have a higher win rate than 34%. And maybe you don't shoot 1 to 2, but maybe you shoot 1 to 2.4 or 2.5, which is good. Try to match your win rate with your risk to reward. So if you know you have a 34% win rate, which you can track because you can journal your trades, you know I can only shoot for 1 to 2s and I'm good. I can make money now. Awesome. Aiming for 35% is very nice because your trading becomes very forgiving. Gone is all the pressure, right? Because for every 10 trades, you can take 6 losses. That's pretty awesome. And even better, for every 100 trades, you can see 65 times your stop loss being hit. And even then, you're not losing money. That's a pretty good deal if you ask me. And this helps a lot mentally, where so many traders struggle when going through a losing streak. Now let's talk about how to pass phase 1. Pro tip, play prop firms aggressively because you want to be rewarded for winning trades. Don't be the I risk 0.25 or 0.5 risk per trade kind of person. Keep that kind of trading for your personal account, but not for prop firms. For phase 1, aim to pass in only 2 trades. So if you have 2 winning trades in a row, it should complete your phase 1. If your target is 10%, you should aim for 5% target per trade. And how you can do that? You shoot 2% risk per trade and you aim for a 1 to 2.5 risk to reward. If your target is 8%, aim for 4% target per trade. You can shoot 1.5% risk per trade and shoot a 1 to 6. You can play around with this according to your own